Good morning. You've tuned in to CNBC-TV18. You're watching Power Breakfast with me, Vinny Motiwala. Thank you so much for tuning in as always, but a lot of updates that have come in over the weekend. We have a lot of commentary that came in from Trump, European Union. The tension seems to be increasing there on the tariff front, the Greenland issue. And because of that, let's look at what the Asian markets are doing this morning. Asian markets have opened up in the red. All of them, most of the indices on the Asian market front are trading in the red. Look at the Hang Seng, that's down almost 1%. We have Taiwan index, that's down 0.05%. Apart from that, also, whether you look at the Japanese index, 1.5% decline as of now. We have the ASX 200, that's the Australian index, that's also down. Do not forget, we're watching out for key data. Even on the China front, we'll have data points coming in, so watch out for that as well. But overall today, we have seen pressure coming in on the Asian markets. And because of that, look at the GIFT Nifty, the suggestion that is coming in there as well. We have GIFT Nifty that is indicating a gap down start for the Indian markets. 172 points decline as of now is what the GIFT Nifty is indicating. Do not forget, Friday was a bit of a muted day in terms of slight bit of a gain, but last week also was not anything exciting given the uncertainty that we've seen. So keep an eye out on the Nifty implied open. But that's the Asian market for you all right now. How is all the important cues that have come in overnight, the earnings that have come in over the weekend as well? We have a team of research who's joining us to set you up for trade, tell you which are the important stocks to watch out for in the trading session as well. Good morning, everyone. First up, I'll start with Vivek, who's going to take us through the market setup for today, important cues that we're keeping an eye out on. Good morning, Vivek.
Well, good morning. You know, the market, at least this Monday morning, doesn't appear to have taken too many positive cues over the weekend. US market, like you mentioned, ended marginally lower. Oil prices gained on Friday. Now Brent hovering around the $64 a barrel mark. Markets last week, you know, both the Nifty and the Sensex managed to end the week on a flat basis. Broader markets marginally outperformed, but they managed to snap a 2-week losing streak. Especially when you're looking at the markets on Friday, gave up most of the gains on the second half, anticipation of an earnings-heavy weekend, and that is something that the street will keep an eye out on. The first number, of course, that the whole street will be looking at is Reliance Industries. You know, Jio outperform expectations, strong ARPU growth, but the Nifty Bank will remain in focus. So many banking results that came in over the weekend: HDFC Bank, ICICI, RBL Bank, Yes Bank, IDBI. A lot of these names will react to their results, and you will see sharp moves on the Bank Nifty today as well. From the IT pack, Wipro as well as Tech Mahindra came out with their results. Tech Mahindra outperformed, while Wipro guidance is something that the street really didn't like, and JSW Infra 2 will react on the back of the fact that there was slight trimming as far as volume growth guidance is concerned. On the other hand, quite a few stocks that will remain in focus on the back of results today. Havells, BHEL, IFCTC among the key gainers, and like you mentioned, GIFT Nifty indicating a sharp gap down open for our markets today.
Thanks so much for that, Vivek. On that note, you know, let's move on and now talk about the important stocks also that one should be keeping on their radar. Upasana is here to take us through that. Good morning, Upasana.
Good morning, Vinny. Well, it looks like a result-heavy day. Firstly, let me start with Reliance Industries. So, strong set of numbers here. Revenue up 4% sequentially. EBITDA at a 7-quarter high. HDFC Bank reported stable set of numbers. NII up 6.4%. Net profit up 11.5%. ICICI Bank negative read-through on numbers. NII up 6.5%, and net profit is up nearly about 11.5%. Now, RBL Bank also reported a weak set of numbers. The NII grew by 5%, and PAT is now at 214 crore versus the expectation of 260 crore. So it's a miss on that front. Wipro revenue and margin in line with street estimates. IT revenue up 3.3%, and EBIT margin at 17.6% versus 16.7% sequentially. Tech MCC revenue growth at 1.7% versus the poll of 0.6%, and margins stood at 13.1% with an uptick of 100 basis points. JSW Infra reported inline set of numbers. Revenue saw a growth of 14%, and margins stood at 47.7% versus 49.6%. Now, CG Power also in focus as the company wins 900 crore power transformation order from Tallgrass for a US data center project. Engineers India gets an order for nearly 3,200 crore from Dagonte Group for refinery expansion. And lastly, coming to RVNL, it has emerged as a L1 bidder for 87 crore video surveillance project from Southeastern Railway. So all in all, we'll be watching out for all these stocks in today's trading session.
Thank you so much for that, Upasana. Let's move on and get the final update in what we should watch out for our trade setup. Sudarshan is here from the FNO desk to tell us the cues in the world of FNO. Good morning, Sudarshan.
Good morning, Vinny. So we are not seeing or we are not expecting a strong start to the week thanks to the Trump's tariff tantrum and the mixed set of earnings from the heavyweights like HDFC Bank, ICICI Bank, as well as Reliance Industries. And on the back of that, you can see GIFT Nifty is indicating a gap down start. But I won't be surprised if there is a buying. If we go by the GIFT Nifty's indication, if Nifty opens below 25,500, because the range for Nifty remains from 25,500 to 26,000, and that I'll explain you in the option data. As far as FI's positioning is concerned, we have seen buying in both index futures as well as stock futures. Also, they've added long positions, reduced short positions, and now longs exposure has seen a minor increase to 9% on the short side, while they remain heavily shorted, but it has seen a minor dip to 91%. Now come to the options data. On the call side, the biggest active options were 25,900 and 25,800. On the put side, the most active options remain 25,600 and 25,500. So it indicates you that it's very difficult for Nifty to slip below 25,500 immediately. Now support 25,473, that's the recent low we had hit on January 12. Resistance 25,960, that's the 50-day moving average. Financials remain on a strong footing. Support will remain around 59,500 for Nifty Bank, and resistance would be around record high of 60,437. Two stocks remain in the bank, sale and Samant Capital. Some of the stocks keep an eye on. Wipro guidance was weak. RBL Bank credit cost has increased, and lastly, commentary was very strong for Polycap.
Okay, Sudarshan, thank you so much for that. But let's talk about Reliance Industries Q3 FY26 numbers. How was it overall? Sonal is joining in with us for that update. Good morning, Sonal.
Good morning, Winnie. Well, Reliance reported numbers on Friday. The consolidated revenues came in at 2.65 lakh crore rupees. EBITDA at 46,018 crore rupees, which was higher both on a quarter-on-quarter and on a YOY basis. This number was at a 7-quarter high. The operating profit margins at 17.4%, and profits came in higher as well at 18,645 crore rupees. The EBITDA trend will come for you. The number is at a 7-quarter high for the quarter gone by, and it was largely led by their auto chemicals business. That is where their EBITDA came in at 16,507 crore rupees higher both on a quarter-on-quarter and on a YOY basis because of strong refining cracks. Reliance Retail grew 8.4% on a YOY basis due to demerger of Reliance Consumer Products, festive season, and GST cuts that came by as well. Jio average revenue per user, that was up 5% on a YOY basis, 1% on a sequential basis. And if we talk about the oil and gas business, that continued to be weak. That's where there was lower production, lower deep water gas prices as well. And that's why their EBITDA fell both YOY and on a quarter-on-quarter basis. Company in the conference call indicated that Jio IPO is imminent and the process is ongoing. So that will be the next trigger going forward for Reliance Industries. In terms of brokerage views, Jefferies says they've cut retail EBITDA by 2% each for the next two fiscals on the prevailing weakness. However, a tariff hike in Jio and recovery of retail growth to mid-teens, they are the reasons for to deliver a double-digit consolidated EBITDA growth in FY27. They maintain a buy rating with a target price of 17.95. Nuvama says 3 new vectors of growth from here on: new energy rolling out, AI investments, and the 20 gigawatt power plant for green hydrogen production. Street will be watching out for that. They also retain a buy with a target price of 1,808 rupees a share. Now, do remember the stock has already declined almost 8% in the last 1 month. So a lot of it is priced in. So the stock will be on our radar today on the back of these numbers.
Okay, Sonal, thank you so much for that. But we also have two banks, important banks actually. Well, there were many banks which reported numbers, but two important ones, ICICI Bank, HDFC Bank, that reported the numbers. Gaurav is here to give us those details.
Well, let's talk about HDFC Bank, and the reason being that if you look at the results, those are more or less in line with the street's expectation. In fact, if you look at profit, that was higher than the street's expectation. But let me take you through some of the key points for this result. First is that net interest margins that increased almost by 11 basis points, which was actually positive because street is expecting 6 to 7 basis point of increase in this quarter. Second is that if you look at the credit cost, now the calculated credit cost comes at just 40 basis points versus what it was at 50 basis points just a quarter ago. And the reason being that in this quarter specifically, bank released provisions worth 1,040 crores, which were related to a borrower group, which fulfilled certain conditions. And that is the reason why credit costs declined. At the same time, if you look at the LDR ratio, that was a key concern when they announced their pre-quarterly numbers. But now management said that by the end of fourth quarter of FY26, they will bring down LDR almost to 95%. And by FY27, they will bring down to low 90s. So that is something that the comfort management has given. But on the negative side, we have seen Mr. Bhavesh Zaveri, who is executive director. He has requested for not seeking reappointment, and at the same time, bank also reported around 500 crores worth of additional provisions because of the agri loans, which was actually asked by the regulator. Apart from that, let's also talk about ICICI Bank. Now, when it comes to numbers, ICICI Bank actually disappointed with profit numbers because it was 4% below street's expectation. And the main reason being that in this quarter, RBI asked bank to provide more than 1,200 crores for the agri slippages and agri loans once again. And this was basically because of the regulatory requirement. And the bank said that this was because they did not meet certain regulatory criteria, and that is the reason why if you look at credit cost, that inched up almost to 74 basis point versus what it was estimated to be 50 basis point. But on the opposite side, on the positive side, we saw Mr. Sandeep Bakshi, who will be reappointed as MD and CEO for the next 2 years. So that is positive for ICICI Bank. So for both the banks, we saw mixed set of numbers. So it is really important to see how the street reacts on these numbers today.
Okay, Gaurav, thank you so much for that. But on that note, we're actually going to slip into a very short break. After the break, we'll come back, get you all the developments from the White House. Stay tuned in. Welcome back to Power Breakfast on CNBC-TV18. Now let's talk about the latest Trump-related developments that we have. And that's a special segment, Trump Watch. Starting with the latest update, President Trump now has escalated trade tensions with the key NATO allies in Europe by imposing a 10% tariff on imports from 8 of these nations. Which are these nations? Denmark, Norway, Sweden, France, Germany, UK, Netherlands and Finland, starting February 1st. Now on Truth Social, what Trump also said, and the ties this directly, to ongoing U.S. interest in Greenland and acquiring Greenland is something that he is warned about, warning that the rate will jump to 25% by June 1st unless a deal materializes. This is very unusual, given that normally when you have your partners, long-standing partners, you do not impose such tariffs. Now, this indicates a bit of a friction that's going on between these European unions as well as in terms of the United States. Now, in response to Trump's decision, more than half a dozen of European countries warned in a joint statement on Sunday that the tariff threats over Greenland undermine the relations that they have as the White House seeks to pressure allies into a deal to acquire Greenland. So that's a bit of a concern there. Now, moving on to the latest update on the Iran front. President Donald Trump called for an end to the Iran's leader, which is a 37-year reign that they have been having. And it's time to look for a new leadership, is what he said in Iran. And this is to an interview he said in Politico. As, widespread protests are going on, he's calling for an end for this regime. Moving on to the last update also that we have, Prime Minister Narendra Modi has received an invitation to join Trump's Board of Peace for Gaza, which is a part of the second phase of his plan aimed at ending the war in the region. The ambitious international body aims to guide the reconstruction and the governance for Gaza in a better way following the fragile ceasefire that halted more than 2 years of conflict between Israel as well as Hamas. But that's the last that we have in terms of Trump-related update. On that note, we're going to slip into a very short break. We'll get you all the coverage straight from Davos 2026. Stay tuned in after the break. From the sidelines of the Davos summit at World Economic Forum, the World Economic Forum's president and CEO spoke to CNBC Shireen Ban on US President Donald Trump's visit to Davos this year, which is expected to be the largest ever US delegation, and what will be the key focus area of that visit. Listen in.
President Trump making an appearance the third time in the World Economic Forum. Was it a hard sell to get him back to Davos?
I think already last year he was virtually with us because it was 2 days after the inauguration. And I did say to him then, we wish you back in Davos in 2026 physically. And then we started the dialogue just after Davos. And I think he was keen to come. And what he's saying to us is that he likes it because he also meets a lot of business people here. There's like 850 of the leading CEOs of the world here. And he does like to make deals and speak to business.
And he's coming with the largest ever delegation of U.S. government officials.
That's true. He's coming with 5 secretaries, Secretary of State Rubio, also Treasury Secretary Besant. But, you know, it's true that the U.S. delegation is large, but we also have overall historic numbers. We have probably 6 out of 7 G7 leaders here. So on Monday and Tuesday, especially, we will start off with Ursula von der Leyen. We'll also have the Chinese Vice Premier. We have President Macron, and also then Prime Minister Mark from Canada, just coming back from a visit with Xi Jinping in China.
Let me ask you, what should we expect from President Trump? Do you have any indications on the issues that he is keen to talk about?
So what we've heard so far is that during his speech at 2:30 on Wednesday, he will speak about the economy in general, what creates growth, but also he will speak about the middle class in the U.S. and how he wants to strengthen the middle class also in this context of affordability challenges. And then we also know that he will meet with a lot of state leaders that are here. I think on Thursday we can expect more a focus maybe on the Middle East and Ukraine. But you know, things.
So he is going to be meeting with President Zelensky?
You already asked that, and I said I maybe. You know, the White House has to answer that question. And things are much in flux here. You know, things are changing very fast. So at the World Economic Forum, we also have to be agile as an organization.
And he's here for 24 hours.
Yeah, even more maybe.
Okay, that's the latest update there coming in from Davos 2026. That's going on. We'll bring you all more updates as well. But a quick check in terms of what the Asian markets are doing so far. Continues to be in the red, most of them. Kospi is something that's trading in the green right now. We have Kospi that's holding on to gains of 0.9%. Taiwan index that was a bit in the red now has flipped to the green. Mild gains there, so very muted yet. Hang Seng is still holding on to cuts of 0.8%. Nikkei is down more than 1% as well. Shanghai is up 0.5% now. So keep an eye out on that. Nifty implied open is indicating a gapped out start for the Indian markets even as of now, down 157 points, but we started it with down 172 points, so at least 20 points up from where we started the show. Still a gapped out start of a decline of 150 points is what we're keeping an eye out on. But that's all the time we have on Power Breakfast today. Up next, your Bazaar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Rima here in the studio, and Nigel is joining us from the National Stock Exchange studios. Nigel, good morning. Rima, good morning.
Hi, good morning. Arguably one of the most action-packed, news-heavy week, Monday to begin. So I don't know what you're going to start with, Prashant. Is it going to be about this 10% Trump threat on 8 European countries on the back of Greenland? Or is it going to be on the back of Reliance, ICICI, HDFC Bank? So much happening. Nigel?
And it's a busy one at NSE, Nigel, right? With the listing of the Coal India subsidiary.
Well, that's right. BCCL's listing is, will be there with us in the next 2 hours or so. So that's why I'm here, expecting a blockbuster listing. It should be one. But otherwise, you've got plenty of news flow, as Rima said. Earnings, you've got Trump who's going out nonstop, and you've got a retaliation coming in from some of his friends in Europe. So exciting times, and precious metals continue to melt up. So let's get straight to the action, guys.
So I'm going to start with, of course, a little bit of India-specific stuff more than anything else, right? Because, I mean, there's too much on the global front to really get our head around and make a meaningful inference from all of it. So let me just start with, a top of mind. And I think what is top of mind from an India perspective is the fact that the U.S. ambassador to India, Sergio Gore, met with a bunch of business leaders here in Mumbai. So some visuals are up on your screen. Devendra Fadnavis, the Reserve Bank of India governor, that's Sanjay Malhotra. He met with N. Chandra, a chairman of Tata Sons. And of course, he met Reliance Industries, his chairman, Mr. Mukesh Ambani as well. So that is what I want to start with, right on top. And the reason I want to make a quick mention of all of this, of course, is because instead of the usual meetings with political figures, Mr. Gore has chosen to meet with the business elite here in Mumbai and make the rounds of the financial capital. So, I mean, the way I look at it, perhaps could be seen as a bit of a, economic first kind of strategy which perhaps leads to a bit of thaw in relations. Remember, I mean, all of this happening at a time when India-US relations are perhaps at their lowest in many, many decades. So I think this is important. And, I've said this before, Sergio Gore took over. I think having someone, a close confidant of President Trump in New Delhi doing all of this, I think does go a long way. The other bit, of course, India-specific, is that President Trump has invited Prime Minister Modi to join the Board of Peace. This is, of course, aimed at the reconstruction of Gaza. Now, forget for a minute about what the Board of Peace is about and what it aims to do, et cetera, et cetera. And we don't know whether India will say yes and be part of this Board of Peace. But the fact is, we've had, for example, the Pax Silica Alliance last year. India was not invited to join it. You've had, again, strained relations with 50% tariffs, etc. So you've got President Trump inviting India to join the Board of Peace. By the way, reports say that there's a $1 billion commitment, financial commitment, a payment which is to be made to be a sort of, a permanent member of this Board of Peace. As I said, we don't know whether India will, because then we'll have to get into what India's stated sort of stance has been with regards to Israel, Gaza, two-state and all of that. So forget all of that. It's basically what I'm looking at is the indication of something like this. The other bit, which I think is still important for a heavily hit country, tariff-hit country like India, is the next ruling date. I think it's a bit of a waiting game, but I think it still is important. 2 times now, the decision has not come, the actual ruling has not come. But Tuesday is when the Supreme Court, the US Supreme Court, perhaps may rule once again, no guarantees, but may rule on the IPA-based tariffs that President Trump imposed. Now I'll come to the global bit. So this is the India-specific bit. So President Trump threatening to impose a 10% tariff on 8 European NATO countries. And this is to basically punish them for backing Denmark against his push to buy Greenland. which he wants very much. So tariffs start at 10% on the 1st of February, and they go up to 25% for the, by the 1st of June. And he said, well, these tariffs will stay on till the US has signed a deal to purchase Greenland. EU leaders holding an emergency meeting in the coming days. Will there be retaliatory tariffs? Will there be other measures which the European Union, etc., will take? We don't know. Treasury Secretary Besant made some very blunt remarks. He said Europe was too weak to guarantee Greenland security. Actually, he went on to say that Europe was too weak to guarantee its own security. We'll hear from President Trump himself. He's at the World Economic Forum, leading one of the largest delegations, U.S. delegations to Davos. But that's only on Wednesday. So I think before that there will be a flurry of meetings, etc., on this issue of tariffs on European countries. Just one last bit, right? So on Friday, the US 10-year yield went up 6 basis points. So this is a sharp one, and we got to about 4.23. 4.23 is the 200-day moving average on this one. And the reason is that President Trump said that he wants to keep Kevin Hassett as the director of the White House National Economic Council. Mark, he's the closest, the biggest loyalist to President Trump. And now that he's not going to be the Fed chair, markets basically dialed back their expectations of the quantum of rate cuts this year. Kevin Walsh, the other Kevin, as President Trump calls him, is now seen as a clear favorite for the Fed chair position. Later tonight, U.S. cash markets are shut for Martin Luther King holiday. Futures open, but only for a short while. And just to time the levels here in India, not very much has changed. We got a bit of excitement on Friday with the market rallying and then, of course, ending sharply off the highs. This is, the weekly Friday to Friday performance of India and the MSCI Asia ex-Japan market. You can see starkly what's going on. Nifty flat, the MSCI Asia ex-Japan markets up 2% is what you had. But there was enough, right? And we made this point on Friday as we wrapped up. When you look back and did the accounting, it didn't feel so bad. And I think it's because of sectors like PSU banks, 5% last week, metals 5%. On the other side, pharma and real estate were down about 2% apiece. Levels, the numbers change because they're moving averages, but the basic structure does not. We are still on the Nifty at the 20-weekly moving average of 25,643. The Nifty on the upside in the very near term must take out the 40-day exponential moving average, which is 25,913 for the index to get some breathing space. And the Nifty Bank is trading exactly at the 20-day moving average, which is 59,506. Gift Nifty will give you a quick sense of how we're likely to start, and then we'll pick it up from there. It's 148 points lower. And I think a lot of the pressure perhaps may be coming in from some of the large results which came through. And, not very cheerful-looking numbers. Reliance reported, ICICI Bank reported. We'll get to all of that in just a bit from now. Nigel is going to talk us through the F&O positioning and the numbers there. Nigel, take it away.
Well, Prashant, what stands out with the last few trading sessions is the FIs, they've returned to their sell ways. And in fact, in Friday's trading session, the FI sell number, in fact, it outweighed what the DI buy number was. And I think besides earnings, besides their underweight stance on India, and besides some kind of hope that we could see some kind of a relief in budget 2026 that gradually pulls the FIs back, the rupee stability, that's top of mind, because you had the rupee weakness in Friday's trading session as well. And in line with that, you did see that, in fact, the markets as well did come off the top, because the FI selling could continue if the rupee doesn't stabilize out there. So I think the rupee first needs to stabilize, then we can be hopeful that some kind of turnaround with regard to these FI outflows, because it's getting quite intense now. Even in Friday's trade, it was more than 4,000 crores. Moving to what they did on index futures, well, we did see shots, getting covered in Friday's trading session, actually. So there was covering both on index futures as well as on stock futures, as the chart tells you on the screen. And if you look at it, the swing factor was close to around 8,000 contracts, because the long addition was 4,000 contracts. The short covering was close to around 4,000 contracts. So net-net, there was 8,000 contracts that were added, towards the long side. Remember, for 6 straight trading sessions, the FIs continued to add net short positions on index futures. So this was after the first time that we saw some signs of short covering. The long positioning, though, it's at the lower end of the range at just around 9%, with the shorts heavily stacked in the system at around 91%. What about index options? Well, they wrote calls aggressively. Close to around 4 calls were written for every 1 put, telling you that the writers, they believe that the upper levels are definitely going to get protected. And that's why the PCR, it's been in that vicinity the last 10 trading sessions. We have seen it make a low of around 0.6 and make a high of around 1.5. Now it's holding at around 0.76 odd because the call writing was quite aggressive. So the 25,900 call, the open interest was more than 50% higher. While on the downside, the 25,500 put gives you some kind of hope that there will be some fight at lower levels. So what are you looking at? The GIFT Nifty is suggesting that we pull back 150 points or thereabouts. You'll not want the recent low of around 25,473 to get broken on the downside. That's the crucial mark. The bulls will fancy the chances that maybe we could see some kind of a fight back from that vicinity of around 25,500, 25,550. On the upside, though, you have the 20-day MA, you have the 50-day MA, and the options data suggesting that the 25,900, 26,000 odd mark becomes a key resistance mark. So we are in this band of around 500 to around 550 points. The Nifty Bank will have to do the heavy lifting. We've got a couple of big earnings reactions that come in there. ICICI Bank stop loss getting extension, that will be read positively. But the 20 and the 50 DMA, that's where we are at. You don't want the 59,000 mark to get broken on the downside. The stock to track in terms of decent numbers and maybe a better outlook could be JK Cement. Stock's corrected 15 to around 20% from the recent peak. Numbers look pretty okay on the volume front. And as we have been saying, volumes are picking up, pricing is picking up, and input cost has remained subdued. So I'll keep an eye out on that earnings reaction besides the other large names.
Of that, Nigel, thank you very much for this setup. By the way, just pull up the European futures and the Dow futures. European futures are down between 0.5% to 1%. So they are still to react to Trump's threat of 10% tariffs, which could go up to 25% on Greenland. And even Dow futures are down close to about 350 points. It's pretty much red across the Asian market screen as well. The Japanese market's down 1%, Hang Seng's down close to about 0.5%. And we spoke about the GIFT Nifty, 150 points lower on that. Ed Yardini, president of Yardini Research, is now joining in. Ed, thank you very much for joining us. Top of mind is Trump's Greenland-related tariff. How seriously should one be taking it? European leaders are calling it a dangerous downward spiral blackmail, and it could fracture the NATO alliance.
Well, it's not a happy development at all. Obviously, it does raise real questions about the commitment of the United States to NATO. And that's not a good development in the face of what's going on still between Russia's war on Ukraine. So the geopolitical situation is messy. And then it all sets a precedent here for China to basically do a tit for tat and have the attitude that if the United States is going to have rediscover the Madison Doctrine, where Latin America belongs to the United States sphere of influence, and then throw in Greenland, I think it increases the possibilities that China will decide now is a good time to at least put a blockade around Taiwan. So it's a very, very messy and dangerous geopolitical situation. And right now, the only clear winners in the markets is the precious metals at this point.
So are investors turning defensive in their portfolio because of rising geopolitical tensions? How should one reassess their portfolio, their exposure to various markets in light of what is happening or could develop in the future? What are the changes you would recommend?
Well, I think you have to go with the flow, and the flow of funds is certainly going into precious metals. Gold, silver, palladium, platinum have all done extremely well. And then I think there's a perception that if the world's becoming a more dangerous place, that means more defense spending, and more defense spending means more demand for base metals like copper, tin, lead, aluminum. And so those metals are doing extremely well. Stock market's actually holding up quite well in the face of all this. And I think it's because last year we also had a lot of tariff threats coming out of the administration, but it turned out to be basically Swiss cheese. A lot of holes in the tariffs, and clearly the administration, President Trump, believes the tariffs are a great way to negotiate with people on all sorts of issues that don't even have anything to do with trade. And so the markets at this point are kind of taking the view that this too shall pass.
Yeah, no, absolutely. This too is so. You think these tariffs will come into effect at all, Ed? Or you think
yeah, I kind of doubt it. I mean, last year was all about tariffs, all about tariffs with the European Union, and it seems as though we came to some agreements. No, I think this is just a negotiating tactic by the administration just to make the Europeans realize that he's serious about this. But there are negotiations going on now, 24 hours a day, seven days a week, given all the turmoil that Trump keeps throwing into the geopolitical situation. So it's very hard to predict. But I would go along with what the markets are indicating, and that is you want to have a diversified portfolio of stocks, precious metals, maybe some bonds, but bonds may not do very well in this kind of environment for a while. And meanwhile, the stock market may, at least in the United States, may continue to broaden out away from the Magnificent Seven. Besides the geopolitical situation, there's lots of other interesting things going on. And one of the interesting things is more competition among the Magnificent Seven, which is bound to narrow their profit margin and maybe lead to some disappointment. So I think the market is moving towards what I call the impressive 493 and away from the Magnificent Seven.
Ed, if you're in Europe and you're seeing all these headlines, right, blasted at you, I mean, Besant saying, well, Europe can't even defend itself, forget defending Greenland and things like that, right? What is it going to lead to? I mean, you're going to basically rile up people a lot, right? I mean, I'm talking about the voting public across countries. That perhaps down the line brings some changes as well to more sort of extreme kind of parties. It in a way pushes up support base for the more extreme ideologies across the region, isn't it?
Well, yeah, I think it certainly goes to it brings out the extremes on both the left and the right. But this isn't all Trump's doing. I mean, the reality is things have been sort of moving in the wrong direction for a while here. Certainly in the past few years, the fact that Russia decided to invade Ukraine, and there wasn't really much pushback at all, other than from Ukraine being provided ammunition and defense hardware. That kind of started the geopolitical mess, if you will, and that occurred under Biden. So, you know, I think a lot of the geopolitical problems are because we just really don't have a kind of a harmonious situation and a projection of the same policies, particularly in an alliance like NATO, which has to project strength, and it doesn't help at all when the president declares that, or I guess it was the Treasury Secretary that declared that Europe doesn't have the strength to support themselves. That's not a very good message to send to Russia versus Ukraine. So again, the Madisonian doctrine of we're creating a sphere of influence for ourselves in our hemisphere. How does that not influence Putin and Xi in their thinking? How, you know, the Putin doctrine is Ukraine belongs to Russia, and maybe some of other parts of Europe belong to Russia. And you've got the Xi doctrine, which is that the South China Sea belongs to China. And oh, by the way, there's an island called Taiwan there. And the Taiwanese are spending some money here in the United States, suggesting that they're looking for an exit strategy.
All right, Ed, finally, before we wind up, what do you make of Sergio Gore's visit to India and the comments that we've got from him? And, Mr. Trump as well inviting our Prime Minister Narendra Modi to the Board of Peace. Do you think there could be some kind of optimism that we get closer to a trade deal? Because, Sergio Gore's comments actually, it led to a bit of a spurt in our market and some kind of excitement as well, just throwing in some hope out there. Mm-hmm. Your take?
Yeah, I think there's clearly a lot of reasons to conclude that the relations between India and the United States are extremely low, but that could change in a heartbeat. I mean, there's a lot of negotiations going on in trade. The U.S. ambassadors talking to influential business people in India. Modi's been invited to participate in this peace board for Gaza. So there clearly is a lot of Zoom calls going around in the major global capitals, including in India and the United States. And I think that at the end of the day, Trump would like to get these things resolved in a way that doesn't make things worse for the United States. And so I think the situation with India will get better because it's not very good right now. And I think the situation with Greenland will also find some sort of compromise situation. But when Trump negotiates, it's very noisy. It's kind of like New York's real estate negotiations, and I think this will calm down. So, and I think the markets are right not to take it too much to heart.
Yeah, thank you very much for joining in. But there was some research which said that in his first term, he followed up with 40% of his threats. But in the second term already, he's followed up with 60%. So maybe he doesn't want the taco term to be repeated, at least in term 2. But thank you very much, Ed, for joining in. Time for a quick break. Here is a list of the top stocks that we've lined up for you on our show. Welcome back. It's a busy Monday morning. Lots of stock to keep on your radar, and our entire research team is ready to prep you up for Monday. This is CNBC TV18's list of top stocks for the day. But first up, let's go across to Sonal on Reliance Industries. Sonal?
Good morning, Reema. Well, EBITDA for Reliance Industries this time around came in at a 7-quarter high. On a consolidated basis, revenues came in at 2.65 lakh crore rupees, which was higher on a quarter-on-quarter basis. EBITDA at 46,018 crore rupees. Margins came in at 17.4%, and profits at 18,645 crore rupees was a number higher on a YOY and on a quarter-on-quarter basis. Let's talk about the brokerage view then. CLSA has an outperform call, target at 1650 rupees a share. They say new energy projects are progressing, and the recent $20 billion market cap correction may have priced in the retail weakness that came in lower than their expectations. Citi has a buy call as well, target at 1815 rupees a share. Recent correction likely limits the downside. Goldman Sachs has a buy call again, target at 1820 rupees a share. They say solar manufacturing capacity ramp up is underway, which is a positive. JP Morgan also has an overweight rating, target price at 1675 rupees a share. Profits were in line with their estimates, but internals were weak. But now valuations have improved post-correction, so they could see some green. Catalysts from here on include geo-listing, tariff hikes, and new energy ramp-up. So these three catalysts are something that almost every brokerage has spoken about.
Okay, all right, Sonal, thanks a lot for that. Coming across to you, Gaurav, tell us about HDFC Bank.
Well, yes, if you look at the numbers for HDFC Bank, those were more or less in line with the street's expectation. In fact, if you look at profit, that was a bit higher than the street's expectation. So first, let's talk about which were the key positives from this result. First is that net interest margins. If you look at the number, that came in at around 3.51%. 11 basis point higher than the street's expectation from on a quarter-on-quarter basis, and 6 basis point higher than the street's expectation. Second is that the credit cost that declined almost by 10 basis point And the reason being that there was a contingency provision which was reversed worth 1,040 crores. And lastly, when we talk about LDR ratio, which was a key area of concern, management said that by the fourth quarter end, LDR ratio will come down to 95%. But on the flip side, on the negative side, we have got the bank who reported 500 crores worth of additional provisions because of the regulatory inspection in their agri PSL loan. But all in all, good set of number from HDFC Bank in this quarter. When it comes to ICICI Bank, here we saw profit actually decline higher than the street's expectation, and the key reason was credit cost, because bank reported more than 1,200 crores worth of credit cost in this quarter, and this was again because of the agri PSL loans which regulators find were not in the compliance with the regulatory requirements. And that is the reason why if you look at the credit cost, that increased almost to 74 basis points versus street's expectation of 50 basis point. Other than that, if you look at the net interest margins, they remain flat. But on the flip side, there was a positive news in ICICI Bank this quarter, is that Mr. Sandeep Bakshi, who is MD and CEO, got reappointed by the board for the next 2 years. Now, this was a much awaited move for ICICI Bank, and given this move, that is actually a key positive trigger. But on the flip side, credit cost is a key negative trigger in this quarter for ICICI Bank.
Thank you very much for that. Reliance Industries, HDFC Bank and ICICI Bank together account for 21% of the Nifty weightage. But onto the IT earnings. Big boys Wipro, Tech Mahindra also reported numbers on Friday post-market hours. Starting with Wipro, well, it's a bit of a disappointing set of numbers. Go by the ADR. ADR on Friday slipped 7.5%. In after hours, it's recovering up about 2%. But the takeaway is that it's a negative reaction to Wipro's numbers. So what disappointed the street? The Q4 guidance, the Jan to March quarter guidance, stands at 0 to 2%. This is lower than analyst estimates of 1 to 3%, 1.5 to 3.5%, because analysts pointed out that the Harman DTS acquisition will have a 2-month incremental contribution to Wipro's Q4 numbers. So that could approximately add, 100, 150 basis points. If you strip that out, organic revenue growth in Q4 could be lower than what we had in Q3. So the Q4 guidance has disappointed the street. That said, margin performance was pretty strong, 17.6%, an improvement of 90 basis points on a quarter-on-quarter basis, and the company guides for maintaining margins between 17 to 17.5%. Tech Mahindra, on the other hand, was a strong performance, a beat on revenues and a beat on margins. The company's top line 1.7% ahead of estimate. The company has expanded margins to 13.1%. This is the 9th consecutive quarter of margin expansion, and they seem to be on track to achieve their goal of 15% margins by Q4 FY27. Deal wins too are the highest that we've seen in the last 5 years over the last 12 months, and Nomura has raised the target price to 1,810 on the back of these numbers. So Wipro weak on the back of a Q4 guidance miss. Tech Mahindra has been an all-round beat. Gaurav is back with us for more on L&T Finance.
Well, as for L&T Finance going with red, and the main reason being that the credit cost was a bit higher. Remember, the credit cost has actually declined, but it is a bit higher than the street's expectation and also higher than the management commentary that came in earlier. So first, let's look at the numbers. Now, net interest income grew almost by 18%, and net interest margins actually improved almost by 16 basis points on a sequential basis. Second is that if you look at PPOP, which is pre-provisional operating profit, there also we saw a growth of 25% on a year-on-year basis, and this was supported by fee income. And secondly, the OPEX, which was contained at 4.05% as a percentage of assets. But on the negative side, if you look at credit cost, now that came in at higher at around 2.8%. Remember, this has actually declined by 15 basis points if we exclude that macroprudential provisions that the company has been taking, which they have not taken in this quarter, as they had indicated earlier, but still higher than their own estimate of 2.3 to 2.5%, as they had spoken about it earlier. Other than that, the ROAs, now they stand at around 2.31%. Remember, there was a one-time impact of 29 crores in this quarter because of the new labor law, and that is the reason why ROAs have declined almost by 6 basis points. But even if we consider that, they were targeting for 2.8% ROAs, but they are a bit lower at 2.3%. So that is something that market may take in a negative way, and that is the reason going with red for L&T Finance today.
Okay, all right. Thanks very much for that. Let's talk about JSW Infra, which is the next one. Vivek has got details. Vivek, morning.
Well, good morning. JSW Infra, largely inline set of numbers, lot of moving parts, 8% year-on-year volume growth. But despite that, the management, this point of time, not confident to meet the earlier guidance of 8 to 10%. So they've trimmed the volume guidance down to 5%. What was weak in the quarter gone by? Coal and iron ore volumes continued to languish. When you're talking about the revenues, higher by 14%. Adjusted operating EBITDA up almost 10% in line. Marginal softness as far as EBITDA margins are concerned. And the company has given organic as well as very incremental details as far as guidance is concerned for FY26, 27 and 28. And it's a very strong set of guidance that the management has given. So that is something that the street will like. What they won't like is the soft-term weakness as far as volumes are concerned.
Thank you very much for that. Let's get to Wipro then. I had a chat with the management of Wipro and asked them the key question. What led to this Q4 guidance of 0 to 2%, which has come in lower than analyst estimates? Listen in.
We have talked about in quarter 3 results in terms of the contribution that came in from Harman. In quarter 3, if you look at our revenue growth, it was 1.4% overall. And of that, we said 0.6% is coming in from organic, which is within the guidance limit, guidance range, Rima. But as far as quarter 4 is concerned, we're not calling out it separately.
But needless, is there a possibility that organic growth in Q4 will be less than the organic growth in Q3?
So if you look at our quarter 3 performance, I think we had 3 of the 4 markets doing sequential growth, and we had 4 of the 5 industry sectors doing sequential growth. Second, I think as far as our pipeline is concerned, it's very strong, both in terms of large deals and smaller deals. And this is again secular across industries as well as markets. I think our focus right now is to execute and go and win them. I think that will determine how our quarter 4 will look at by sectors and by markets, Rima.
Srini, you refer to tariff uncertainty impacting the manufacturing and the consumer sector. What is the revenue contribution of these 2 sectors, and what exactly is happening? Are clients deferring their projects, or are projects getting cancelled?
I think, if you look at specifically on the retail side and on the manufacturing side, the discretionary spend for us has come down. I think that's where we see a little bit of outlook which is a little bit muted. And second, also these clients are looking at a lot more cost optimization, specifically on the manufacturing side of our business. I think we have deals which is both vendor consolidation and also optimizing their cost on the run and support side. So that's another bucket that we're going after. So broadly, that's the reason we're looking at it. If you look at tariff and trade and the global politics that's going on, geopolitics that's going on, I think more and more of our clients, I think they're sensing and responding. And if you look at specifically one of the biggest market, which is US, actually it's done very well overall economy, 3.2%, irrespective of the challenges that we saw at the beginning of the year. So I think more and more is getting normalized. What is very important for us is how these 2 industries will perform in the next few quarters, and what kind of spend and outlook that they will talk to us specifically this month, because that's where we will get to know better in terms of where the spend pools will be, Rima.
Aparna, what led to the margin improvement in Q3? Can you provide us a breakup?
Yes, certainly, Rima. Our margin performance has been fairly consistent over the last 8 quarters. We've been on this journey to expand margins, and that journey continued into Q3. 17.6 is one of our best performance in terms of margins over the last several quarters, and we're quite proud of what we've accomplished. It's been an all-round improvement, both operationally, and we've actually optimized SG&A quite a bit. We've improved our utilization rates. We've improved our profitability in fixed price programs. There's a lot of effort that's been continuously put in, especially now with AI coming in. And we've also absorbed the dilution on account of the Harman DTS acquisition of 1 month. As we look forward, I think the landscape continues to be competitive, and we will continue to invest in our clients and some of the large deals that are there in the pipeline that Srini spoke about. We'll also have to absorb 2 months incremental impact of the DTS Harman acquisition. So we've got our work cut out, and we will get back to that after these interviews.
Okay. 2-part question here. Can margins expand further from here, Aparna? And two, you spoke about large deal wins. While the overall deal wins are strong, your large deal wins at about $870 million is less than half of the average of the last 4 quarters when it comes to large deal wins. So what explains that?
So, large deals are very binary and they have a long deal cycle. So I'm not going to be you should not be looking at that one number. If you look at our large deal wins in the first half, it was very strong. We had 4 mega deal wins. We've grown on a year-on-year basis. YTD, north of 70%. So that's commendable. So we're not worried about the large deal wins at all. Typically, we clock around $1 billion, and at $900 million, it's pretty much out, in line with the average that we try and clock. We are having a very good pipeline, and like I said, our endeavor would be to go ahead and convert those deals, and you should see that momentum continue in the coming quarters. Margins, are we looking to expand from here? We had earlier stated an aspirational band of 17 to 17.5%. We're comfortable in that band, and then we will see, how the environment plays out. For us, for now, we need to invest for growth in our clients, and that's what we're doing.
Saurabh, when are you planning a salary hike? Because the last salary hike, if I remember, was in September of 2024. So it's been more than 1 year.
Yeah, Rima, it's been more than a year, and we will take a call. As you said, Srini and all are traveling next week to Davos. Once they are back, we'll deliberate and take a call. But I must tell you, 2 or 3 data points which are important. One is that we are seeing, from a stability standpoint, our attrition levels are coming down. In fact, in this quarter, it's been down more than 2% for the quarter. And over trailing 12 months also, we are seeing that. We are seeing an expected similar number in the next quarter as well, coming Q4 as well. So the market environment is tough. Second is we are also seeing a better utilization. So from a supply side, I don't see a challenge. If there is a demand coming and growth coming, we will continue to make sure that we are covered on the supply side. From a campus placement standpoint, this quarter was muted. We only had about 400 freshers. But I think in Q4, we will be adding about 2,500 people, and for the fiscal, around 8,000 people will be adding as freshers. So if I look at it both, how we are adding people, how we are doing on attrition, what we're doing on supply chain, we are comfortable, and this is an important part, and we will be taking a call on the salary hikes very soon.
We'll take a quick commercial break here. We're going to come back in just a bit, and we'll talk about the big number which came through on Friday evening. That is Reliance's third quarter earnings. Retail was a problem, and we'll talk about that and more in just a bit. Stay tuned.
Welcome back. Let's put the spotlight on Reliance Industries. It has a near 10% weightage on the Nifty, and today the stock will be reacting to its Q3 numbers. Largely in line with estimates, though analysts do point out that retail was a tad bit softer than expectations. But the stock has already corrected 7% since the start of the year, and Reliance is now very close to its 200-day moving average. 1457 is where the stock closed on Friday. 1435 is the 200-day moving average. So just 20 rupees above that level. Deven Choksi, Probal Sen of ICICI Security and Gaurav Malhotra of Axis Capital are now joining in for this discussion on Reliance Industries. Thank you very much for joining in. Gaurav, let me start with you. How did the numbers fare versus your expectation? And considering the stock went into its earnings a bit subdued and muted, is everything priced in, and where from here?
Yeah, see, from Jio's perspective, the results were very steady, right? I think so telecom has become super predictable in terms of how the earnings for whether Jio or Bharti are coming along. So we see around, say, 4-5% increase in ARPU. We are seeing some increase in subscriber numbers. So on the whole, we saw Jio with around 12% YOY increase in its revenue. Some margin improvement, which is to be expected, given that the bulk of the network expansion is behind us. I think so with the Jio, the key thing is that, the timeline of the IPO. I think so that is the key trigger for the name. And obviously the usual discussion around the tariff hikes, which we expect will happen, sometime between now to the June quarter. So on the whole, from Jio's perspective, a pretty steady kind of a quarter, very, very inline-ish.
Deven, overall assessment of Reliance's numbers, particularly on retail, what were your thoughts?
Well, I think the retail numbers, I think we have to look at it in perspective of 2 or 3 things. First, I think the FMCG business is demerged with effect from 1st December 25. And at the same time, the company expanded into some 460 plus odd stores in Q3, taking the tally to somewhere around close to 19,980 or somewhere. So the total number of stores expanded, the FMCG business separated out. And at the same time, I think the company has invested in the logistics, particularly for quick commerce, I think, which is their new entry into this particular segment. So in my viewpoint, I think these 3 areas, if one wants to call it as a cost, yes, agree that this particular quarter, I think it has seen the cost of around 60 bps in the profit margin. But overall, I think this I see as an investment that they have made. Probably, I think you should be seeing significantly large amount of, I think, comeback as far as retail is concerned in subsequent quarters, also due to the GST normalization, which will place effect in subsequent quarters. So overall, I believe that retail business is not so bad. I think though, I think on the number side, it has pulled down by 60 bps. Believe that I think things could bounce back very sharply in retail.
Probal, on the oil to chemicals business, numbers look pretty robust. What were your key thoughts? What stood out for you? And what going ahead? What should we expect from the O2C business going ahead?
So I think what is happening in the both refining and petrochemical segments is that I think now increasingly there's a lot of pressure on lower cost and inefficient units in terms of the costs and the way economics are playing out. So what can actually help tighten the demand supply balance is probably an increasing momentum as far as closures are concerned of smaller and lower cost or rather higher cost units, specifically in Western Europe from what we read. With respect to this quarter, very clearly, GRMs were obviously at very, very strong levels. So that has helped numbers. Domestic demand continues to be strong. And what Reliance spoke about in their briefing post results was that almost 2/3 of its petrochemical capacity is now running on ethane or on its ROGC. And dependence on naphtha is now only about 1/4 or 1/3 of its overall, petrochemical capacity, because naphtha cracking economics are what have been really hurting petrochemical margins. So I think that move will continue to be there. There are still a lot of refinery disruptions that are there, specifically from Russia, that should help keep margins at a resilient level. So from a segmental outlook perspective, I think near-term margins will be helped, particularly in refining by refining closures and disruptions. Longer term also, I think closures will probably accelerate for people who are at the marginal costs. that should help set the demand-supply balance. So we would expect that steady state earnings with small improvements in margin should continue over the next couple of years.
Okay. Got that. Probal and Gaurav, from both of you, if you could tell us what the target price is, because the stock is corrected ahead of the earnings, down nearly about 8%. So what is the target? All three of you all, if you all could just tell us from here, what's the upside or downside? Gaurav?
Yeah, so our target price is 1873. So that's almost like a 30% upside from current levels.
30%. Okay. Probal?
Our target price is 1740. So we have a buy rating with about a 20% upside from here.
Okay. And Devin, for your clients, are you recommending buying Reliance at this juncture?
Yes, absolutely. I think the reason for buying would be clear. The Geo platform in this particular first half of the 26 is getting separately listed. So the valuation unlocking is definitely going to be seen. It's going to be a key driver. At the same time, I think we are seeing the growth in the ARPU for Geo platform, which is likely to take, even if I consider the 10 rupee hike in ARPU over the next 3 quarters, probably I think we are talking about the addition of 6 to 7,000 crore worth of EBITDA, due to which I think this particular ARPU is increased. And at the same time, I think the higher amount of ROC being seen because of the 5G expansion is almost complete for Geo platform. So yes, I think consumer businesses, both retail as well as Geo platform, which are the main drivers, are likely to get re-rated in the books. And that's where we believe that the price of 1850 should be possible for Reliance.
Okay, likely catalysts ahead in the form of geo listing, ARPUs increasing, and that is keeping investors bullish. Plus, JP Morgan points out, post the recent correction, RIL has improved relative valuations. And given the catalyst, most of the brokerages that we have, as Sonal was pointing out, bullish. JP Morgan overweight, Morgan Stanley overweight. Their target price is 1847. CLSA 2 has a bullish call. Goldman Sachs buy 1820 with a target price. Get into a break. Thank you very much, gentlemen, for joining in and giving us your take on Reliance Industries. On the other side, we'll connect with Harmesh Kant, Head of Research at Chola Securities, for some more fundamental stock talk.
Welcome back. You're tuned in to Bazaar Morning Call. Well, another big stock in focus on the Nifty itself will be ICICI Bank. To help us out with the quick analysis, we have Dharmesh Kant who joins us. Hi, Dharmesh. Good morning. What do you make of the numbers? Looked a little bit soft, on various parameters. But otherwise, the extension to Mr. Bakshi's tenure, that's going to be the music to the ears of a lot of bulls on that. What's your view on it at current reckoning?
Yeah, good morning, Nigel. Thank you for inviting me for the show. So numbers were more or less a muted set of our numbers for ICICI Bank. Still, it managed to grow their advances by 11.5% as compared to the other private sector peers. For the case in point, HDFC Bank was 9% kind of a growth. Even, Federal Bank came out with only 8.6% kind of advances growth. Yes Bank at 5.5%. So private sector, we are seeing that advances growth has been quite muted. And they do stand out, and because of the provisioning which related to earlier years, and RBI has directed them to make a provision for that PSL segment, around 1,200 crores of provisioning they have to do. Because of that, the PAT was on a negative side. The difference between HDFC Bank numbers and ICICI Bank number was the other income part. So ICICI Bank reported around 3% kind of a growth on the other income, whereas HDFC Bank, the same number came at 30%, and that's the reason why the numbers of HDFC Bank on a reported basis or a PAT basis looks quite attractive. I think ICICI Bank will languish around. The stock price, not much of a reaction till Q4 numbers come around. And let's not forget 25 basis point rate cut happened in December. So much of our pass on will be happening in Q4. So my own sense is private sector players will have a tough time negotiating Q4 on the price action point, because they are still stabilizing their advances growth. Until the business picks up in that space, allocation will be more towards public sector banking space, which has been reporting a pretty steady set of numbers. All the 5-6 banks which have come out have reported higher teens, around 15 to 19% kind of advances growth with better asset quality. So stay cautious from investment perspective. You can still have it in your portfolio, but you will have to spend time around for getting better returns.
Okay, all right. So your preference is actually leaning towards PSU banks in the near term, and I think from there, Bank of India is a stock that you've liked. Is that correct?
Yes, Nigel. I mean, we initiated around 107, 110 rupees with our price target of 155. So which was done in Friday's trading session. The price target has been achieved. We are waiting for the fine print of the numbers. So post that we will revise it.
Okay, all right. Dharmesh, I want to ask you about the cement pack as well. I understand that your team as well, were doing various checks in various parts of the country. I think the BR market is something that, y'all have been looking at as well. Now, we had JK Cement that came out with a set of numbers. From the recent peak, I think the stock is still down 15 to around 20%. What's good about the numbers is the volume growth, and their focus on increasing capacity from around 28 million tons all the way to around 40 million tons. Valuations are not cheap, but it's never been cheap. They appear to be doing the right things because the EBITDA per ton on a sequential basis has improved despite having lower realizations. Your view on the stock, and from the pack, what do you like?
Yeah, the numbers were quite decent, and volume growth is what we have seen across the board for last 2-3 months. So volume has not been a problem with cement companies. The pricing was a challenge which they were unable to take forward on a blended basis or a net of discount basis. It used to be more of a flattish kind of a pricing. This month, many companies have taken price hike, and our expectation is around 15 to 20 rupees on a blended basis per bag price hike. Pan-India basis, most of the companies will be enjoying. Though JK Cement numbers were attractive in the future, as you detailed out, looks exciting about it. But valuations, I think, for mid and small cap companies, you should be a bit wary about. For cement, if you are playing it, it should be large cap place. And there we think the market leaders in Ultra Cap and Ambuja Cement looks pretty attractive to us. Though valuations for Ultra Tech is far a bit tad higher than Ambuja Cement. So the top pick remains Ambuja Cement in the basket, and this quarter should pan out well from a trading perspective for all the cement companies, maybe 15-20% kind of a stock buy gains we can see over the next 3 to 4 months.
Ambuja Cements. Got that. Well, thanks a lot, Dharmesh, for joining and giving us a quick analysis, a short but effective chat. We look forward to catching up with you soon. For the time being, slip into a short break. On the other side, we have our technical experts who will be joining in to tell us what's the view on the market, with the GIFT Nifty suggesting a 100-point downtick.
Okay, welcome back. Hormuz is now joining in. 5 minutes to go for the pre-open session with the big movers which we saw on Friday and stuff which saw very large volumes. I mean, in terms of single stocks, there was no dearth. Hormuz, take it away.
Absolutely, Prashant. Morning, and no dearth for single stock movers on Friday's session. Earnings reactions predominantly. The Federal Bank being the first one, is the snapped a 5-day losing streak on Friday, and it was a very, very sharp up move after its results that were announced. It's back at record high levels. It was the biggest single-day gain that the stock saw since September of 2019, and volumes that were the highest since October of 2024. So strong gains on strong volumes. Close to 7 crore shares were traded on Friday. 20-day average of just over 80 lakh shares. Out of those 7 crore shares, 1.3 crore shares were marked for delivery compared to a 20-day average of just around 51 lakh shares, and it has had a pretty good last 12 months. The stock gained up to 40% back at record high levels. On the downside, though, LTTS or L&T Technology was a negative earnings reaction. The stock ended at a multi-year low, the biggest single-day drop since June of 24. It's declined in 4 out of the last 5 trading sessions. Friday's volumes the highest in nearly 2 months. Close to 5 lakh shares were traded, 20-day average of just 63,000 shares, and out of those 5 lakh shares traded, 2 lakh shares were marked for delivery. Here too, the 20-day average is just 33,000 shares, and it is now down to the lowest level since June of 2023 is LTTS. And lastly, barring LTTS, which was the only IT underperformer, most of the other IT stocks did very well courtesy Infosys' results. Infosys was up almost 5%. Oracle Financial, Tech Mahindra, which is going to be reacting to its results today, that also did very well on Friday's session. And look at the volumes here. Infosys had almost 2 crore shares traded, 20-day average of just around 70 lakh shares. Same is the case for Tech Mahindra, close to 40 lakh shares traded, 20-day average of just around 12 lakh shares. And even on the delivery front, almost 50% of Infosys' trading volumes were marked for delivery. Oracle Financial had its delivery volumes, which were almost double its 20-day average as well. So IT stocks did fairly okay. They continue to remain in focus today as well. And watch out for a lot of these banking earnings reactions as well.
All right, Hormuz, thanks very much for that. Those are some individual names. Sudarshan Sukhani is with us, and so is Mitesh Thakkar with what they'd want you to do as far as trades go. Gentlemen, good morning. Good to have both of you here. Head-spinning amount of news flow. I think that's why just focusing on prices, and I mean, the firm believe that prices show everything, reflect everything eventually. How is the price setup looking? Sudarshan, let me start with you.
Well, the price setup told us that the Nifty went below its 50-day moving average. We talked about it last week, that the bulls live above it. So the price setup was telling us that things are not going well. Now, it's difficult to anticipate where we will go on the downside. But at this point, any dip or decline or gap down is not a buying opportunity. The market must stop falling once and give signs of life. That has not happened. So I would not suggest any kind of bargain hunting in the index. Just step aside.
So existing outstanding prior positions, etc. I mean, Sudarshan, I mean, if you're carrying something, then
if you're carrying something, then you wait patiently for intraday rallies and exit at that point. A gap down is not a good point to exit long. Usually, you see a rally during the day, so that's an exit.
Mitesh is already holding his head. I think it was just maybe signs of times. Mitesh, what's your view in terms of what to do and how to position oneself?
So a couple of things, Prashant. Last week we said that we need to get past 25,900, 950 zones to get strength, and the high was around 25,900. Very clearly failing at upper levels. 2, there was no downside continuation, but this choppy activity, what's happened is that the weekly indicators have started turning down, which means that we could slowly be turning weaker over a short to medium term kind of a picture. We've maintained targets of around 25,400, 350 as the first support area. We didn't test that last week. We had a low of 25,473, but there's a strong chance that we might do it in a couple of in the next few trading sessions. And if we start breaking below that, I'll pencil in for a deeper correction. So for the timing, till we get past 25,950, 26,000 broadly, I would not be very aggressive on the long side. In fact, avoid longs, barring a couple of IT names. And on the downside, 25,400, 350 is the first trigger. If you break that, brace for further weakness.
Okay, all right. Hi, gentlemen. Good morning. Mitesh, you go first. What's the stock calls you have?
So on the stock side, Nigel, I have three sells to a buy. Buying is an HCL Tech. That's another stock apart from Infosys, which had a very strong session on Friday. So HCL Tech is a buy on a mild decline, say around 1695 to about 1690, which is about 5-6 points lower. Buy with a stop at 1677 for targets of 1725. And on the sell side is DV's Lab with a stop at 6300 for targets of around 6100. Asian Paints is a sell with a stop at 2780 for targets of 2700 or below. And L&T is also a sell, keep a stop about 3900 for targets of 3770.
Okay, got that, Mitesh. Sudarshan, what about you?
Well, I have two sells and two buys. Two buys because, we are going to get a big gap down. So sometimes good quality stocks can be bought on that down gap, but not the index. So the sells are Voltas, sell Voltas with a stop above 1435, IIFL short with a stop above 645. The buys are Tata Consumers with a stop under 1165 and Can Bank, where I have just heard about PSU banks, and PSU banks are generally going to outperform, I think. Buy Can Bank with a stop under 155. All the stops have to be adjusted depending on how the markets open.
Yeah, got that. Thanks very much for that. So those are trades from Mitesh and Sudarshan, and we'll have both back with us in just a bit from now. Well, Santanu Chakrabarti is India analyst, BFSI, BNP Paribas. We talked about, of course, the numbers from Reliance. The others were, of course, HDFC Bank, ICICI Bank. Let's start with ICICI. Santanu, there is, of course, the numbers, and then there is the extension to Mr. Bakshi for another 2 years, which I think does bode well in a sign of strong confidence, right, for investors. How do you see it, and what's the view on ICICI Bank as a stock from here?
So it's our second most preferred bank next to HDFC. And my only worry in the near term is that given the standards it has set for itself as kind of the bellwether for the sector, a slightly lower growth number in retail loans and savings accounts, maybe 2 straight quarters of weakness might precipitate some weakness in the particular counter. But we remain very constructive about its prospects over the next 12-month period. And definitely the the leadership continuity bit should bode well. And given the track record that the bank has put up in the last 3 to 4 years, all I'll say is that bulk of the market was actually probably expecting the continuity to play through, because in a lot of ways, ICICI Bank has set the standard for steady performance over the last 4-5 years.
ICICI Bank, though, has underperformed in the last 6 months. I know the start of the year has been good, but 6 months, Nifty Bank is up 5.5%, while ICICI Bank is down 3.5%. So the underperformance is to the tune of about 9%. Pretty stark there. Shantanu, what about HDFC Bank? Stock went into its earnings with considerable amount of weakness. How did the numbers fare versus estimates?
I think, at the top line level, it was broadly in line with what the street was expecting, maybe 1% here, there. Definitely the growth coming in at about 12% had set up the stock well for its NII number. And the fact that margins actually expanded quarter on quarter shows that the basic thesis of this bank still have a fairly suboptimal liability structure thanks to the merger, and that gradually unwinding in terms of refinance of high cost NCDs, etc. That story stays alive. And in the next quarter we expect margins to correct for most banks, but the fact is the key part of our thesis, and I think the key source of optimism around HDFC's re-rating is a benign and gradual tailwind to margins, as both the effects of easing on the liability side come through, and also its particular high-cost liabilities expire over a period of time. And that thesis seems to be in play. I mean, as far as the bottom line positive surprise coming from a right back is concerned, I think just like the the credit cost inching up happened in ICICI Bank. In both cases, market will probably look through that part of it. And I expect both stocks to react basis the performance around margins and specific loan growth categories.
Yeah. No, so Santanu, second best idea is you said ICICI. What's the number one idea?
HDFC.
HDFC. Okay. Okay. So this morning, maybe is there anything to do given moves anticipated, Santanu?
Yes, I think, especially in ICICI, despite the good news around management, the fact that, and you were alluding to it yourself regarding the underperformance in the last 6 months. See, the trouble is that when, you have the kind of performance as a bank that ICICI has had for the last 4 to 5 years, valuation and expectations of the market move to a slightly different stratosphere. And against that, if the numbers, even at an aggregate level, are a little weak, which they are for ICICI specifically for, say, retail loan growth and savings account accumulation, then that could provide buying opportunities for investors going in today. As far as HDFC is concerned, given that it had already traded fairly weak, I don't think these numbers are going to precipitate much of a disappointment. If anything, it should act as a little bit of a positive surprise.
Santanu, now that's ICICI and HDFC Bank. Federal Bank reported numbers, right? And stock really did very well post the numbers. PSU banks are doing phenomenal. Union Bank, for example, and others will report. So just from that cohort, what are the top ideas here? The PSU Bank index, by the way, last week was up 5%.
So, we have a neutral on SBI, and my main argument here is that I understand that PSU banks are placed fairly well. But when I look at the capital productivity that a PSU bank typically delivers, and SBI can be a great example to look at, you'll understand that leverage plays a very large role within that. And the other thing that's playing a very significant role in terms of the names like SBI delivering a mid-teens kind of ROE is the credit cost number being fairly low. Now, that's a trend that overall for the banking sector, that level of credit cost, 25 basis point or 30 basis point is not really sustainable. So, there will be a moment of truth at some stage. Whether that comes the next quarter or the quarter after is hard to call. Where even without any major change in, say, broad asset quality or the fundamentals of the economy of the balance sheet, you are going to see credit cost normalizing back to, say, about 45 to 55 basis points. The trouble is that spells fairly strong erosion of earnings growth and a significant drop in ROE when the leverage itself is 14 to 15 times, which is the case for SBI and multiple other PSU banks. So yes, they are trading well, but given where their valuations are, this is what is restricting my optimism around them. I understand the market share gain part of the equation. I understand that there is nothing to be worried about in terms of their balance sheet health. But pure normalization itself will stunt a lot of the earnings momentum that market seems to be betting on so aggressively.
Thank you very much for joining in, Shantanu. Let's get into our 9-10 calls. 5 minutes left for markets to open up. Sudarshan?
Well, it's CanBank. Buy CanBank with a stop under 155.
CanBank. Mitesh?
I'll go with the sell on Divi's.
Sell on Divi's. So buy CanBank, sell Divi's Laboratories. Nigel, what has HSBC written on metals this morning?
Well, HSBC has been positive on metals, and they're even more positive right now. So they have gone ahead and they have upped their target price on the top names. That's Hindustan Zinc, Hindalco, as well as Nalco. On Hindustan Zinc, they have a buy rating. Target price has reached to around 750 rupees. On Hindalco, the target price has moved to around 1,240 rupees. And on Nalco, it's around 420 rupees. What are they citing? They are highlighting that the global steel is pointing out to a couple of factors. One is there is strong demand coming in from various segments like EVs. So that's point number one. The other factor they're looking at is there has been a lack of investments in the recent years, which is creating a bit of a supply crunch. So that in turn as well is, further leading to a positive outcome in terms of pricing. And there are other supply issues, caps, disruptions. That's what could lead to a super cycle in metals. They say that metals such as copper, aluminium, battery raw materials and PGMs, they're likely to be the key beneficiaries, whereas bulk commodities could underperform. So net-net, HSBC, who has been positive, they've gone ahead and upped their target price yet again. Hindustan Zinc, Nalco, as well as Hindalco will remain on our radar.
JK Cements is the other one, Nigel, isn't it?
Well, that's right. Prashant, with this sort of global uncertainty, I think there'll be some focus on some of the domestic themes. And cement will be in focus because demand has picked up considerably and pricing is showing signs of perking up. 10, 15 rupee price hikes have been absorbed. JK Cement, those numbers look pretty okay, actually. The top line, there was a good growth of close to around 18%. And that was backed by solid volume. Volume growth was to the tune of close to around 22% because there was good growth both in grey as well as in white cement. However, because of a higher amount of sales in the non-trade segment, with the trade sales as a percentage of the mix coming down to 60% from around 67%, realizations took a bit of a knock. The volumes are good, realizations did pull back, but despite having lower realizations, the margins have improved and the EBITDA per ton has improved on a sequential basis. Now that's heartening to see, telling you that in fact their focus on the cost side as well as operating leverage is definitely holding them in good stead. The problem is the PAT number was lower, but that's because of a couple of one-offs. You have, exceptional item in there because of the labor code changes to the tune of around 48 crores. So that explains why, in fact, we are seeing the PAT number that degrew. The management says they're on course to move from around 28 million tons to around 40 million tons. And that's why their standalone net debt has perked up by close to 200 crores on a sequential basis. Net debt, the overall numbers look positive. Quite a few positives out there. Back to you guys.
Okay, just a quick word on IT. Wipro's numbers were disappointing, particularly the Q4 guidance at 0 to 2%, lighter than consensus expectations, and pre-open stock is down 6%. Morgan Stanley has downgraded Wipro to an underweight. They're saying that, last year we did see some catch-up taking place in Wipro's PE versus the rest. Wipro used to trade at a discount, but we did see that catch-up. But now going by the Q4 guidance, it suggests that the deal wins are there, but it's not converting into revenues. And therefore, the company is likely to underperform its peers yet again in FY27, which is why they've downgraded the stock. But on the flip side, Tech Mahindra has actually clocked in a strong quarter, a beat on revenues and margins. So under Mohit Joshi, the 3-year turnaround appears to be progressing on track. JP Morgan has upgraded the stock to an overweight from a neutral rating. They've increased the revenue forecast by 2 to 3%. Margin forecasts have gone up by 30 to 70 basis points, and there is a 3 to 8% increase in the company's EPS estimates. They're saying they now expect Tech Mahindra to match peers like HCL Tech and Infosys in terms of the growth metric. So Wipro could be under severe pressure. Tech Mahindra, a little bit of green, perhaps to begin trade with on the back of good numbers.
Absolutely. I think we have come to the end of the pre-open and maybe we just quickly run through a bunch of names, right? Stocks in terms of where they're settling in with regards to the numbers. So that's the Nifty, 40 points lower, much better than what the GIFT Nifty indicated early on. So yeah, I mean, Reliance is flattish, nothing very much. I mean, it already is corrected quite a bit. Over the last month and a half or so. HDFC Bank is up 0.75%. Tech Mahindra is up about 1%. We'll have JK Cement, which is down a little bit. CG Power is the other one, which is about 3.33% lower. EIL is up about 2%. There's Wipro and L&T Finance, etc., which are coming up. L&T Finance, of course, I think has been a bit of a disappointment, as Gaurav told us earlier, after many quarters of very steady performance. JSW Infra, Vivek highlighted it. There's ICICI Bank up on the screen. So again, I mean, I think the appointment perhaps acting as a bit of the reappointment and the extension acting as a bit of a buffer against numbers which perhaps have not been particularly all that great.
By the way, there are big moves outside of these stocks. RBL Bank is down 5%. Here, the credit costs went up on a quarter-on-quarter basis. Provisions impacted the profitability. That stock is down. And NetWeb, 10% up in pre-open, and this is again on the back of numbers, 140% increase in the company's top line because they managed to execute
3,700 rupees.
Yeah, so that's there's so many of these stocks which we didn't speak about. Yeah,
which we will. Okay, 40 points higher, right? 40 points lower in the Nifty in the pre-open session. I think we are 30 seconds away from the market open, and we will look at some of them. as we go along. So first, look at the index, look at the Nifty heat map, and then we'll drill down into individual names. 25,653 on the Nifty, 60,093 on the Nifty Bank. The Sensex is down about a third. The small cap index is starting about 1/3% lower. So those are opening rates to a fresh new week. And what do we have this Monday morning? 140 lower on the Nifty, 400 lower on the Sensex. Mid cap index down a third. And I think the small cap index down about that much as well. I mean, look at the market breadth, right? I mean, this is just straight out of the gate. So maybe a few minutes more and things will settle. But 1,200, 1,250 lower as opposed to about 500 names which are higher. So this is, I mean, kind of one way at this point in terms of the market breadth. Lots of individual stocks because I think that's going to be the focus opening up at the bottom of the screen. Of course, we'll have a buzzing screen both up and down in terms of what's happening. Indigo, Tech Mahindra on the Nifty heat map, which are opening higher. And on the downside, Wipro, Reliance, ICICI Bank, Sun Pharma, etc. are some of the others. 150 lower on the Nifty to begin this day. Rima.
Well, ICICI Bank, Reliance Industries dragging the index lower. ICICI Bank, top Nifty loser, 2.5% down. The street does not like the additional standard asset provisioning of 1,200, 1,300 crore, which has impacted the company's bottom line. So for now, the positive news about Sandeep Bakshi's extension has been put to the side and the stock is under pressure. Reliance Industries is the other one, open 2% lower, now 1.5% down. And the stock is exactly at the 200-day moving average of 1435. Reliance Industry, overall, headline numbers are fine. EBITDA has, the absolute EBITDA is the highest that we've seen in the last couple of quarters, but retail performance is a tad bit subdued. So Reliance Industries under pressure. Tata Motors, passenger vehicles, Sun Pharma, Cipla, L&T, NTPC, these are some of the large caps on the way down. HDFC Bank has started trade in the red. HDFC Bank has a cut of nearly about 0.5%. Where the NIM performance was a tad bit disappointing for the street, but HDFC Bank had already corrected quite a bit in anticipation after they came out with their quarterly update. On the way up, it's Tech Mahindra, which is the big gainer. Tech Mahindra straight away opened out with a gain of about 3%. And Wipro's down 9%. Clearly the casualty of the day. Wipro 242, it's breached its 200-day moving average with the fall today. It's also breached the 100-day moving average. So Wipro under severe pressure. There is a downgrade which has come through also on Wipro. So on the way up, Tech Mahindra, Interglobe Aviation, there was some penalty of about 22 crore imposed on Interglobe Aviation, but the stock is holding up in the green. Axis Bank, Kotak Mahindra Bank seeing buying. So while HDFC Bank, ICICI Bank struggling, money seems to be rotating into Axis and Kotak, which are yet to report their numbers. Some consumption names are higher. Avenue Supermart, HUL, Trent on the way up. Overall, benchmark indices down 0.5% and the Nifty is below 25,600. But outside of the Nifty, lots of big movers. RBL Bank is another big accident of the day. Stock is down 7.5%. Shobha reacting to numbers. L&T Finance, Gaurav was saying, a bit disappointing, not stable as we've typically seen. Canfin Homes, weak in trade, that's down nearly 2%. Protean eGov, where the CEO Suresh Sethi has stepped down, so that is putting pressure on the stock. NetWeb is a big mover. NetWeb straight away has opened up with a gain of about 11-12%. There is a sharp jump in the company's revenues, 140% increase. The other big mover is CG Power, which is straight away gone up with a gain of 7.5%.
Okay, I think lots of stuff opening up and both up and down, and we'll come back to more as we sort of go along. What do we have? Nifty is starting slightly weakish, 100 points. That's 1/3% down. 25,596 is where we find ourselves at. Lawrence Blanco is with us of CLSA. Lawrence, good morning. Great to have you with us here. Thank you very much for joining us. Fundamental analysts, of course, when we speak with them, they'll kind of sort of say, well, underperformance in 2025 means better performance in 2026. But I think, on the technical side, I don't know if it works that way, because weakness begets weakness, strength builds on strength. We've had a bit of weakness here in India, Lawrence. So what's the setup as we get into 2026?
Yeah, it's interesting. If you look at Nifty itself, you got up to the 26,300 upside target late last year. and we've really just been in a holding pattern. We've pulled back, but we haven't seen any major levels broken. We've got quite a good support zone between 25,300 and 25,500. If you look at the mid-cap sector, that's probably the one that we're most constructive about for 2026. We've been consolidating there for nearly 24 months. And I think a meaningful break through the 62,000 area for the mid-cap space, gives us upside of over 30% on that breakout. I think in the near term, again, we have to be patient. We've started the year in the emerging markets, at least seeing high momentum in the North Asian markets, particularly Korea and Taiwan. And that has taken some of the shine and I think incremental flows into India away towards those North Asian markets, but you haven't seen any major breakdown. So a trading range and some patience warranted. We haven't seen any major breakdowns at the key sector levels for India.
Lawrence, hi, morning. This is Rima here. Now, you described 2026 for the Asian markets as having a boom-bust structure. Can you explain what this means for the individual markets and timeline?
I mean, so the interesting thing, we're looking for the boom to continue in the tech side. So we think the first half of this year is still dominated by the acceleration in a lot of the tech plays, markets in Korea, Taiwan, and Japan outside of that emerging market basket. And that's where we've seen the acceleration in the start of the year. So that's our boom thesis. We do think that starts to roll over come the second half of 2026. And that's where we think the setup for India getting a bit more attention and out of the shadow of the North Asian markets can come to the fore and get a bit more momentum on the upside, particularly the mid-cap space, as I said earlier on. The other part that we've seen the boom structure play out is in the commodity side. So obviously precious metals have been leading that. But as we ended 2025, we saw a number of the base metals break out, which we think that uptrend continues at least through the first half of 2026.
All right. Hi, Lawrence. Good morning and good to see you. We're Nigel on this side. So the other big call that you're making is the continued dollar weakness. We've already seen it pull back more than 10%, from the recent peak. What are the levels you're looking at on the dollar index and what it could mean for emerging markets versus developed markets? Is there a ratio you track? If yes, where is that headed?
Yeah, absolutely. So if we look at the dollar index for the past 4 months, we've really just been holding in a trading range. So between 96 and 100. But that 100 area is a major level. It basically represents the lower boundary of the 2022 to 2025 topping pattern. Now, we call that a topping pattern because we have this 14-year uptrend in the dollar running into that 2022 highs. And the break below 100 suggests that we now have a major dollar top in place. And that gives us a measured downside target at the DXY level down to the 89 to 90 area. So we saw 10% weakness through 2025. We think there's still another 10% downside just to meet our downside target. But some of the cycle work that we do when we look at the dollar index going back to the 1970s is that when we do enter a dollar bear market phase, that typically lasts 5 to 7 years. And the ultimate decline is closer to 40, 50%. So we think this 20% is the base case for this topping pattern that we've seen in the dollar index. Now, the question on weaker dollar historically, again, looking at the charts going back to the 1970s, the weak dollar has been associated with rest of world equities outperforming US equities. And one of the biggest beneficiaries within that ratio is emerging markets outperforming developed markets. And we started this year with the emerging market versus developed market ratio, confirming a breakout of a 2-year basing pattern. And that suggests another 16% of relative outperformance by the emerging markets over the developed markets. So we think that weaker dollar setup is constructive for the broader emerging market basket after underperforming since 2010.
Got that. Lawrence, I just wanted your thoughts on commodities and metals, if you will. What are you most bullish on from here? And then, which stocks in that space in India would you like to own?
Right, yeah. So from the commodity side, if we start off with the Bloomberg Commodity Index, a major base between 2023 and 2025, we broke out in the fourth quarter. That has been led by precious metals. So you've obviously seen the gold and silver recently start to accelerate their advance. On gold, we do have an unmet measured target of 5,100 to 5,200. Silver, we've already accelerated past our upside target. So we're a bit more cautious on silver here, but still think you can add to the gold setup, looking at 5,100 to 5,200 on the upside. If we move over to the base metals, aluminium has been one of the key breakouts that we've seen there. We're looking at 3,500 on the upside. But we have also seen copper break out of the 21 to 2025 trading range. And on the LME copper futures, we're looking at over 16,000 as an upside target there. So those will be the metals that we will be focused on, playing these breakouts that we've seen in the fourth quarter of 2025, and we think continue through 2026.
Lawrence, you said India mid-caps are on your long list, right? And
Yes.
particularly Indian markets will come to the fore in the second half, which is when the bust cycle for Asian markets maybe play out. So any levels on the India mid-cap index, or are there particular stocks that you have on your radar that you're looking at carefully?
Yeah, we'll stick to the sort of index levels. If you look at the NSE mid-cap index, the 62,000 to 62,800 area is the breakout point, and clearing that, would confirm this 24-month consolidation pattern that we've seen. It's very similar to the consolidation that you saw between 21 and 23, where we had the last bull market phase in the mid-cap side. So we've got a very similar setup, similar duration and consolidation, and yeah, we think the upside at a minimum is 30% upside on that breakout. If you look at the mid-cap select index, so that's the top 25 liquid names within the mid-cap space within India, you've actually already cleared above the upper boundary of its 24-month consolidation pattern. So the more liquid names within the mid-cap space have already sort of broken out if you look at it at the index level, but we think that will broaden out as we go through 2026, with mid-caps being our top headline index for India.
All right, Lawrence, what about the mother market? The US markets has been on steroids, right? It's done pretty well in the last year itself and started off this year on a positive note. We have midterm elections. Typically, what is the behavior you've observed in a midterm election year? And what are the levels you're looking at on the S&P 500?
Yeah, so let's go back to the sort of first point. 2025, S&P was up 20%, but it underperformed not only emerging markets, but the rest of the world versus US ratio. And if we look at the performance year to date, again, we've seen the rest of the world ex-US outperform the S&P, and you've seen emerging markets outperform the S&P. So we think sort of a key regime change continues to play out in 2026, where rest of world equities and EM outperform DM, and obviously rest of world outperform the S&P. So I think that's important, ties into the dollar view. If we look at the political cycle in the US, the midterm election year is typically a weak year. On average, the S&P puts on just below 7%, going back to 1928. In a midterm election year, that average performance is around the 4.5% area. And it's typically the period from April through to October that sees an increase in volatility and typically on average negative declines through that period. The market tends to bottom a month before the midterm elections, which take place in the first week of November. So we're looking at a first quarter run up with a 7,400 upside target for the S&P, but then becoming quite difficult into October for the S&P before having that typical fourth quarter recovery. But within that scheme, we do think rest of world equities, emerging markets are better placed for performance through 2026.
So Lawrence, on the Nifty, coming back to India, on Nifty Midcap Index, you said that if it crosses 62,800, then it breaks out, and there could be a 30% upside after that. What about at the index level? At the Nifty, do you have a strong view on what Nifty might do in the first half, second half? Any levels?
Yeah, look, so we're currently in a well-defined trading range between 25,300 to 26,300. That's the range that we've been in since November. We do think that that's a platform, a trading range that sets up for the continuation of the Nifty uptrend. Breaking out of that would give us a new upside target of 27,800, and above that we've got another target sitting at the 28,800 area. But like I say, I think for now at the Nifty level in particular, it is a game of patience as we continue to consolidate here. But those are the two upside targets I would look at on a break above 26,300. And then we've still got that longer term end of the decade targets, over the 40,000 area for the Nifty. That's the long term structure which we keep intact and still think banks is one of the key sectors getting the market there. But in the short term, we're talking about a trading range and 27,400 and then 28,800 as two additional targets on a break above 26,300.
Okay, all right. Lawrence, we leave it there. Thank you very much for joining us, and good speaking with you here on CNBC TV18 as always. That's Lawrence Belanco. The most keenly watched voice as far as market technicals go, not just here in India, but globally as well. Now, L&T Finance reported a decent set of numbers for the third quarter. Net interest income and the net profits rose 18% on a year-on-year basis. But on terms of credit costs, etc., there were niggles. Well, let's talk about this and what should we expect going forward. We have Sudipta Roy, Managing Director and CEO at L&T Finance. Sudipta, good morning. Good to have you with us here. Thanks very much for joining us. We've not, in last many quarters, whenever we have spoken, numbers have been actually numbers in terms of growth, etc., they've been good this time around as well. But this time, it's a little bit of focus on the credit cost front, right? So on a reported basis, I think they fell about 15 basis points, but they are at 2.8%, right? You had earlier guided that you're going to bring it down to 2.3 to 2.5% this year in FY26. So let's just begin there, if you'll allow it. Go on, Sudipta.
Yeah, hi, thanks, Prashant, and wish all of you in CNBC TV18 a very happy new year. On the question of the credit costs, if you look at our credit cost trajectory, we have been pairing the credit cost with every quarter. We started at 3.8, went down to 3.43, then 2.98. And this I'm talking about the core credit cost. Now, there's a little bit of confusion on the trajectory of the credit cost because previous quarters, we have been using macroprudential provisions. So what was the reported number last quarter which was 2.49 in credit cost. Actually, the core credit cost was 2.98. Now, this year, sequentially, this quarter, sequentially, the credit cost has come down from 2.98 to 2.83, but which includes a 23 crore of one-time provisions on certain amount of co-borrower linkages. Now, if I were to exclude that 23 crore of one-time provision, actually the core credit cost, the cost from core credit cost from business is about 2.74, which is about a 25 basis points reduction from what it was previous quarter. So obviously, the downward trajectory of the credit costs remains unabated. And I know there is one data point which I would like to give is that on a QOQ basis, our slippages actually have come down by 200 crores. And you will see this manifesting in lower credit costs in the coming quarters. We remain committed to what we have said that, by Q4 FY27, our credit costs will come between the 2 to 2.2% range. And I think because of our various credit initiatives, that particular credit cost of lowering credit cost trajectory will continue unabated.
2 to 2.3% by, Sudipta?
To 2.2% by Q4 FY27. That is, which is the final see, we have been doing a lot of credit initiatives, right? And, our new AI credit engine is working. The microfinance business has improved significantly. Our collection efficiencies this quarter has hit 99.7% pan-India. You will see all this coming and manifesting itself in lower credit costs over the next couple of quarters. Our final guidance obviously has been that in that we will try to get towards that 2 to 2.2% credit cost trajectory, which we will try to achieve by Q4 FY27.
Okay, all right. Hi, sir. Good morning and good to see you, Ben. Give us a couple of details then. I recall in our last chat, we were talking about the gold portfolio. And if you remember correctly, you said by the next year, it goes to that ballpark of around 4,500, around 5,000 crores. Now, with the surge in gold, that space is clearly being eyed. So give us a couple of details. What is the LTV right now? What do you end this year with in terms of a gold portfolio? And by next year, do you want to upscale that earlier target?
See, our gold business expansion remains quite strong. We are setting up almost one new branch every day. So we started the gold business with about 130 branches in the month of June. Currently, we have rolled out about 68 new branches, and by March 31st, we will have 200 new branches, bringing up our branch count to about 330. So roughly, what I can say is that our gold portfolio at the end of this quarter has been about 1,700 crores. We will probably cross 2,000 crores by the end of next quarter. Probably the number will come around between 2,000 to 2,200 crores at the end of this particular quarter. And obviously, the growth trajectory for next year will also remain strong. We will deploy anywhere between 300 to 350 branches next year as well. And the guidance on the gold AUMs at the end of next year remain the same, between 4,500 to 5,000 crores. And our LTV is currently a shade lower than 70%, which we are very comfortable with. Our sort of yields from the auctions that we have been getting have been having about 145% coverage. So we are very comfortable with the metrics of this business and the speed at which it's scaling up. And we will be focusing very strongly on this business, not only in this coming quarter, but also in the coming year.
Okay, all right. What about your return ratios? Because that was, something that the street was tracking very, very closely. The ROAs, you're guiding it, to move closer to around the 3% odd mark, 2.8% odd by next year. So tell us, by when do you hit this number? And also in the ROAs, I think it was early teens, right? Help us with the number for both these two parameters, ROAs and ROEs, for the coming year.
So our guidance has always been that we'll try to, come to that 2.8 to 3% mark by Q4 FY27. And, this quarter it has been 2.37%. Overall, hopefully for the full year, we'll come closer to the 2.4% mark at the end of this particular year. And as sort of our sort of headline AUMs start expanding, and as our leverage continuously improves, we will see an improvement in the ROEs as well. The ROEs actually have been inching up with every passing quarter with the improving leverage. And I do believe that the ROEs, as we hit that 2.3%, 2.8 to 3% ROA levels, our ROEs will come to that mid-teens between that, between the 13.5 to 14.5 levels by the end of Q4 FY27. That is what we sort of look at. And obviously the components of our ROA tree, which we have been continuously monitoring, as you can see, our costs have been pretty stable, this quarter, even with the sort of the one-time impact of the labor code, our costs have been more or less about that, 4.06% of total assets. And we have always guided that our credit costs plus our OPEX will remain at that. And over the next quarter, we will try to push it down from that 7% level to a 6.5% level. So obviously, obviously the efficiencies that will come from that particular line will obviously add to the ROA line. So again, to summarize, we expect our ROAs to come in that corridor of 2.8 to 3% by Q4 FY27.
Sudipta, morning. This is Rima here. On retail growth, how much of the retail growth seen this quarter was an account of the festive boost? Because personal loans, you saw very strong growth there. And you had spoken about, I think, a retail growth AUM of 25% for the full year. Are you on track to achieve it?
See, we had guided a growth between 20 to 25%. So I think we are on track to achieve it. So one of the couple of things, the microfinance business, which had been sluggish for the whole of last year, actually saw a very good growth this year. And with the sort of the near normalization of the collection efficiency in the microfinance business, we are seeing good momentum in that business as well. Our personal loans business continue to grow very strongly. Our sort of digital partnerships together with the big tech partnerships have been working very well. And we have been scaling that volumes in that business quite well as well. In terms of the growth in the two-wheeler business, which saw major growth this particular quarter, was primarily a one-off driven by the GST 2.0 reforms and the strong festive demand. However, what we see is that the demand, because of the rationalized two-wheeler as well as the tractor prices, the demand actually has now settled at a little higher level than than what it was in Q2 and Q1. So we expect Q4 to be a strong quarter as well. Typically, Q4 is a strong quarter for BFSI. So we expect Q4 to be a strong quarter as well. And our gold business is also doing well in terms of the new additions of branches as well as the AUM build-up as well as disbursements. So I do expect that we will end up somewhere between that 20 to 25% growth number for the full year.
Okay, and one final question. NIMS plus fee income was at 10.41%. What number can we expect for Q4?
We'll try to maintain it at that particular point. Obviously our focus is, improving our core yields as well as improving on our weighted average cost of borrowing has gone down by about 7 basis points this particular quarter. And obviously our NIMS and fees also have expanded by about overall 18 basis points on a QOQ basis. So that is quite a bit of a jump driven primarily by weighted average cost of borrowing efficiency, as well as, the rise in lending yields as well. So we'll be happy if we are able to maintain it at that particular level. We have guided that we'll maintain our NIMS and fees between a corridor of 10 to 10.5. And obviously we will try to maintain with an upward bias towards 10.5.
Sudipta, we'll leave it there. Thank you very much for joining us. Always a pleasure sort of having you here with us, and wishing you a good 2026. Stocks, by the way, as Sudipta was talking to us, has recovered about 10 rupees from the day's low and about 291 as we speak. We'll take a quick commercial break here. We'll have Warren Harris of Tata Technologies joining in to talk about their December quarter earnings. Lots to talk about there with regards to not just Tata Tech, the business, but of course industry as well. Stay tuned.
Welcome back. Let's turn our attention to another conversation. Tata Tech came out with their numbers. In Q3, the profits of the company went down very sharply, declined by 96%, but that was on account of the labor code, plus one exceptional to do with an acquisition. But the company's commentary was quite upbeat. They're talking about a 10% plus growth coming through in Q4. We have with us Warren Harris, the MD and CEO of Tata Technologies. Thank you very much, Warren, for joining in. Let's begin with the first one. Profits are down 96%. Can you explain what led to that? There is a labor code, there is an exceptional on account of an acquisition, and will the acquisition-related expense recur?
Yeah, we've obviously taken the adjustment because of the new labor laws that have come out in India. We've also booked the costs associated with the EzTech transaction. But if you put those to one side, the business has grown both sequentially and year on year, and with the one-off impact in Q3 not impacting us in Q4, we are very bullish about a strong finish at the end of the year and our prospects for FY27.
Very bullish about a strong prospect to Q4 and FY27. So about Q4, you've guided for a 10% plus sequential growth in Q4. How much of that is organic and how much on account of the EzTech acquisition, Warren?
Well, we expect to do better than 10%. We're being somewhat conservative when we position 10%, but it's roughly about 4-5% from STech, and the rest is organic. In Q3, we also we took a hit because one of our largest customers was impacted by a cyber attack, and we weren't able to bill for some of our engagements in the month of October. That business has bounced back in November and December, and will flow through into Q4. So again, STech, the growth that we are seeing, the business that we're winning, and the fact that these one-off issues that have complicated things in Q3, they'll not be there in Q4. They're all contributing towards our confidence in terms of, again, a very strong finish to the year.
What was the loss in revenue, Warren, in Q3 on account of the cyber attack at your large client? And will the organic revenue growth in Q4 be well over 5%?
Yeah, the impact related to the cyber attack is about $3 million, just over $3 million. And again, that's one-off. We don't expect that to repeat in Q4 or indeed in FY27. We believe that the sequential improvement that we'll see in Q4, that momentum will sustain into FY27. So we're expecting double-digit improvement in FY27 as far as the top line is concerned, and the volume impact will certainly improve margins. You know, we've made a very deliberate decision during the slowdown in the industry to protect capacity, because we knew our customers were going to come back in terms of investment in new products. And I think that capacity will be able to put to work as the deal signings translate into business that we're executing.
Got that. So Q3 margins, Warren, declined despite revenue growth. Could you explain that?
One, again, we protected capacity for our largest customer, and also the deals that we won in Q3. We also rolled out salary increments, and we've also made the adjustment as far as the labor law is concerned. So we see the impact to margins in Q3 as being the sort of the trough as far as earnings is concerned, as far as the last period is concerned, and we see Q4 as the beginning of the momentum that we're looking to drive as far as margin improvement, not just in Q4, but into the next fiscal year.
You've said that you expect margins to return and exceed the Q2 adjusted levels. Can you tell us what kind of margins are we looking at, and what are the key levers driving this margin recovery in Q4 and into FY27 also?
We in Q2, once you adjusted again for the one-off cyber costs that we incurred, they were about 16.5%. So we certainly expect to get close to that in Q4, and next year our goal is to be where we were in FY25, which is close to the 18% mark. So that's what we are planning for. That's what we are building our order book around, and that's what we're driving delivery excellence and operational efficiency against. So the confidence that we've got is not informed by an aspiration. It's really driven by the rigor that we've positioned inside of the business, and the data-driven planning that we've undertaken in terms of the future quarters.
These are some bullish statement. Q4 revenue growth in excess of 10%. For FY27, also a double-digit revenue growth. Q4 margins to get to 16.5%. 18% is the goal for FY27. Warren, JP Morgan recently came out with a note at the beginning of the year, and they said that the auto ER&D is seeing an improving demand environment over the last 3 months, following the trade deals, tariff uncertainty abating. And this is driving OEM clients to kickstart R&D programs that had been put on hold, albeit it's happening at a very gradual pace. Is that what you're seeing on ground?
That's exactly what we're seeing, and that's what again is inspiring the confidence that we have. The automotive business is a product-driven business, And I think we've seen over the last 18 months to 2 years that the automotive industry has been grappling with headwinds geopolitically. They've been grappling with headwinds in terms of incentives in and around EVs and the regulatory environment, particularly in North America and in Europe. And that has prompted many of our customers to revisit their cycle plans. I think there's now clarity in terms of the environment in which they are going to have to operate, and they are making decisions in terms of the propulsion systems that they're going to invest in, and that's precipitating, commitments to full vehicle projects that we are intersecting with. And one of the big wins that we celebrated in Q3, was our first full vehicle win for the best part of 18 months. And we think that that is the precursor to the type of business that we were consistently winning, FY 23, 24, and the beginning of FY 25. So we are, very confident that the demand environment is improving. And again, given the breadth and depth of our value proposition as it pertains to full vehicles, we're very, very confident that that's going to mean good things for Tata Technologies.
Warren, great chatting with you, and Happy New Year to you. Thank you very much for joining in. That's Tata Tech.
Well, thanks very much, Warren, for that. And that's the conversation on Tata Technologies. Federal Bank is the next one we will focus on, right? Third quarter numbers, net interest margins came in at 3.18% compared to 3.06% sequentially. Asset quality remained strong. We have Harsh Dugar, Executive Director of Federal Bank, now joining in. Harsh, good morning. Great to have you with us here. Prashant this side. And I think this is the first chat in 2026, so wishing you the best for the year, you and your team. And of course, I mean, this is a big one in terms of news developments as well, right? Apart from the numbers on a quarter-on-quarter basis, you've got a new strategic partner, and I think there's a fair bit which is happening across the bank. So let me just flip our conversation today. We start with the numbers and the guidance, etc. Let me just get the strategy part out, if you will allow it, and then we'll circle back to the numbers, because I think that the numbers are, in a way, well understood, Mr. Dugar. So, start with the wealth management piece, Mr. Dugar, at Federal Bank. What's happening? What's the rate of growth which you're seeing there? It's a highly profitable segment across entities that we speak with. Any sort of inorganic opportunities that you see in that segment? Will we hear something on that? So just talk to us about the wealth side to begin this conversation.
Good morning, Prashant, and thank you so much. Wishing you and the viewers a very happy new year. Yeah, let me just start off with just giving a little bit of a broad headline numbers. I mean, the quarter has been good on many fronts. We have had the best ever NII, the best ever operating profit, and the best ever fee income. And apart from that, even the asset quality has stood out with GNPA and NPA both remaining at a decadal best. Three things which I would like to say, which is not on the numbers part. One is obviously Blackstone coming in with the intent to invest 9.99% stake in our bank, totaling to about 6,196 crores. We have got the board approvals and we have got the shareholders approval at CCI. So that is one part. The second one is we increased our stake in our partner, Aegis Federal, on the insurance company to 30%. And we did a brand refresh with Vidya Balan, and we did a brand which is now both has a freshness and familiarity to it. So these are the three broad things which I wanted to cover on the quarter which went by. Coming specifically to your question on wealth part of it, we had guided sometime last year during the analyst meet that wealth will remain as one of the key focus areas, and their inorganic growth in general will remain an integral part of our strategy going forward in many areas, like maybe microfinance, maybe wealth, affordable housing, likewise custody. There are many other areas which we would like to grow, both organically as well as inorganically. It will obviously depend on the price. It will depend on the fitment is what we are looking at. Even organically speaking, wealth is something which we are looking to grow significantly in the years to go ahead. And we are looking at the segment which is the mass affluent. This is the segment and this is strategy for the bank.
Mass affluent. So, I mean, you've got Mr. Somvanshi there heading the business as well. So you were in the market, you're confirming, for acquisitions on this side? I mean, it'll depend on the price and fit, as you said. But that'll be the fastest way to ramp up this business?
So, like I mentioned, that at the right price and the right fitment, we are always open to evaluating things. In fact, at any point in time, we would be evaluating multiple things. And at an appropriate time, because in these kind of cases, until the deal happens, you really never know. So the hit rate can be as low as 10%. But we are in the market in terms of segments which you would like to grow, which I just outlined right now.
Yeah. On the, so that's the wealth side. On the remittance side, right, you've got about a 20% market share in remittances. You've had another transaction, lots of transactions actually, but the Emirates RBL transaction, and there as well, I mean, I spoke with the CEO of RBL, and they've got aggressive plans to gain a larger share as far as the remittance market is concerned. Could you talk to us a little bit about what you're doing here, and what's your share currently? What are aspirations on this side?
You look at it, we have always remained focused on the remittance businesses. In the last 2 quarters, the Q3 data is yet to come out, but even in Q3 data, we feel we have gained market share. So we've been steadily gaining market share over here at above 20% right now, if I look at the Q3 numbers. Yes, competition will definitely heat up. There was something which was there even earlier also. You will have more banks kind of coming in, but a couple of things which we are looking at. We are reasonably well entrenched in this business. We are increasing the number of partners we engage with. We are introducing technology so that it gives customer convenience. Apart from that, we are increasing the corridors of remittances coming into India. Middle East, Kerala was the largest corridor for us. It still remains, but the share of the same has been coming down. So Middle East to rest of India and rest of the world to rest of India is the segment which we are looking at. So this will remain a key focus area for us, and we're looking to increase our market share as well here.
Any roadmap here in terms of numbers, share of the market?
See, we are already 20% plus. So typically maintaining market share 20% plus. And when you have 1.25, 1.3% market share in the deposits and advances, I would think we are pulling well beyond our weight. So we hope to maintain and grow this share.
You know, Mr. Dugar, you earlier mentioned about a return on assets target of, I think, 1.4% to 1.4 to 2.2% by FY28. Could you, we have seen ROAs perk up in the last 2 quarters. Given the pace, it looks like you'd be about 1.5% this year itself. Possible?
So Prashant, you're not giving guidance for that number. What I can tell you, there are 2, 3 things which are playing out, obviously. Many of the things which we are doing, before I speak on the ROA, let me take a step back and speak about the NIM. On the NIM front, we have actually managed to increase our NIM QOQ by 12 basis points and are almost at the pre-December levels, where we were, the pre-repo cut levels, which is honestly heartening because it has come as a function of 2 things. One, on the deposit side, our CASA ratio has actually improved YOY by more than 2%, and that's almost like bucking the industry trend. We're 32% plus. Secondly, on the yield mix, we are shifting more towards the medium yielding assets, which has resulted in a good asset mix, which resulted eventually in a 12 basis points growth in the NIM. Coming down to ROA, obviously it's a function of a couple of other things. We do hope, and we are looking to grow the ROA and the NIM quarter on quarter. But let me also caution you, there are 2, 3 things which we need to watch out for. One is a repo cut, which may happen. I'm not saying it's, well, the inflation concerns are there and geopolitical tension are also there, but we are. So I wouldn't like to guide you immediately for the quarter ahead, but for the medium to long-term basis, if you look at it, the trajectory for both NIM and ROA is upwards, and we look to gain about 5-10 basis points every year.
Okay, 5-10 basis points of NIM expansion every year over the medium to long term. Morning, Mr. Dugar, this is Rima here. Now, gold has been a big growth driver for many NBFCs and banks. Now, you've got a smaller share here. Are you looking to get a little more aggressive in gold? And do you have any sort of targets in terms of what portfolio you would like to capture, what kind of growth contribution it would have to your bank?
So gold is what, in fact, if you look at among the private sector bank, we're the largest player in the gold piece. While I do agree, if you look at the numbers, the QOQ number shows a 9% growth. But let me just highlight a few things over here. We were also in wholesale lending of gold, which involved repledge, which as per regulatory requirements is not required, cannot be done. So we have actually taken a cut over there and degrown that portfolio, which is required as per regulations as well. If I were to eliminate that and look at the pure growth in retail growth, we've grown about 19 to 20% YOY. And I do see, and I'll tell you the reasons why I'm very optimistic on the gold front. One, the regulations announced by RBI provides a level playing field for all players in this. That's one. Secondly, they have consolidated all the surplus into one, which removes ambiguity and interpretation issues by all players. And the third, they have also introduced newer products, income generating, which allows greater leeway to banks like us, who are already well entrenched in this business, to roll out more products to suit the customer requirements. So we are quite bullish and keen to grow our gold business.
Mr. Dugar, we leave the conversation here out of time. Thank you very much for joining in. BCCL, that's Bharat Coking Coal, a subsidiary of Coal India, will be listing today, and it's expected to be a very strong listing. It saw a very strong subscription of close to about 140, 150 times. The issue price, 147 times was the overall subscription, and the issue price was, I think, about 23 rupees. We'll wait by to get the early rates in, but it's a dividend-paying yield. It's a dividend-paying company, and the company is betting on increasing production. Well, it's practically a doubler to begin trade with, 97% up on Bharat Coking Coal. The stock straight away has opened up at 42, 43 rupees. So very, very strong gains coming through. It's one of the first big marquee IPOs of 2026 and a PSU1 after a long time. Coal India will also come up. Coal India sold about a 10% stake via Bharat Coking Coal. So from 100%, their stake now comes down to 90%. So BCCL, very, very strong opening.
It's good to see, right? Listing open with the 80% jump, right? That's quite something. And a PSU company at that. So you've got the top management team. I think the Bharat Coking Coal team will be there. And I think the Coal India team is, of course, also going to be part of it. The bankers, some of them up on your screens as well at the opening bell. Nigel, of course, is going to be speaking with the team at Bharat Coking Coal in a little while from now. But this is a very strong start, Nigel.
Well, that's right. Strong start. Just a quick couple of words. The reason that it saw very good subscription was they priced it reasonably. Remember, it's an Atma Bharat play, actually, because India imports a large part of their coking coal requirement. However, the washery amount of, quantum of coal as a percentage of their total mix needs to go up. For the time being, if you look at it, it's a doubler. So that means it's trading at around 17 times on a PE basis. That's a sharp premium in comparison to what Coal India is trading at. So valuations have gone out of whack. However, the limited float and the hope that they can deliver those numbers, revenues of around 20,000 crores, EBITDA of around 5,000 crores, and net profit of around 2,900 crores. That's the guidance that they've given us. That's the hope out there. Explains why we're seeing this bombastic and blockbuster listing. However, valuations have gone out of whack. But, markets can stay irrational for a little bit longer. So there is a lot of interest and the float is limited. So we'll keep an eye on that. FY26, though, just to tell our viewers, will be a bit of a washout. They have highlighted year-to-date production number is lower, but they're optimistic from FY27 onwards things pick up, both on production and the washery percentage as a percentage of their mix. Because on washery coal, they make 3 times the profit that they make on an EBITDA per ton for normal coal. Currently, it's around 450 rupees per ton, EBITDA per ton. But post-washing, they'll get close to around 1,700 rupees per ton. But as you said, I'll be chatting with the management soon. So we'll try to get some further clarity on that front, guys.
It is India's largest domestic coking coal producer. They had about a 50% market share last year with a total production of 40 million tons per annum, which is likely to go up to 54 by FY30. Thank you, Nigel, for that. Mehul Kothari of Anand Rathi Shares and Stockbrokers is now joining in for a quick technical check on the markets. Indices still down close to about 0.7%. It's gotten weaker. Mehul, we started trade when we opened up for trade, the Nifty was just shy of the 25,600 mark and now closer to 25,500. Have we broken any key levels and what's the trade?
Morning, Rima. Thanks for having me on the show. Well, last time when we were on the show on 14 Jan, we discussed that Nifty is likely to remain in a broad range of 25,500 to 25,900. So now the index has failed to cross the upper resistances and now is approaching the crucial support zone of 25,500 to 25,400. So on the intraday charts, we do see a breakdown, but structurally, there is a possibility of a marginal lower low below 25,480, which could come along with a positive divergence on the hourly RSI. So additionally, there is a significant buildup of open interest in 2500 put options also, so which may act as a support zone. So we had also discussed at that time that India, which currently, which is volatility is around 12 and is in this phase, we expect it to stretch towards 13 to 14, beyond which stability may return near the lower support level. So as long as Nifty holds on to 25,400, the broader view remains intact. A decisive break below this level would negate the setup. So from a strategy perspective, one can look at bull call spreads near the 2500 zone, which offers a limited risk way to play a potential rebound.
What about stocks, Mehul?
Sorry, Rima?
Any stock trading ideas?
Yeah, we do have a stock trading idea. On the stocks front, Bajaj Twins are showing signs of potential recovery. So in particular, Bajaj Finance is taking support near its 200 DEMA and is currently oversold on the lower time frame. So indicating a possibility of short-term bounce. From a trading perspective, the stock can be bought around 960 odd levels with a stop loss of 935. On the upside, we expect a move towards 1010.
We'll take a break. We'll come back in just a bit from now. Markets down about 180 odd points. Manisha will be here with what's happening as far as commodities go. Stay tuned. Coming up. Welcome back. 190 lower on the Nifty. 25,500 is where we are at, which basically means we are at the day's lowest point. The low recently, this is last week, was 25,473. That is on the 12th of January. We're not there yet, but not very far either. So that's a very near-term downside level, which the market's now flirting with again. Now, Sun Pharma is another one that we want to talk about in terms of single stocks. The company plans to expand US operations with a very large acquisition Let's go across to CNBC Awaz's Yatin for details he's picking up from his sources. Yatin, take it away.
Good morning, Prashant. Now, what we are gathering from sources is that Sun Pharma is readying a very big US acquisition, which could be worth nearly $10 billion in enterprise value. Organon is probably the target companies that Sun Pharma has initiated talks with, and talks are in initial phases. As we know that post, the Israeli subsidiary delisting, they have a lot of fungible cash on the balance sheet. I'm talking about Taro Pharma. And US is a very big market for Sun Pharma, and that is the precise reason why they are looking at Organon as an acquisition. Obviously, since the talks are initial, it will be premature to say whether or not if it's a slump sale or a stake sale. But yes, the entire enterprise value for Organon is pegged at close to $10 billion. This helps Sun Pharma increase the presence in the US markets, which are quite important for them. And not only that, we have Organon, which is specialized in women's healthcare, and not only that, they have a very large biosimilar portfolio, which might help Sun Pharma gain the portfolio as well as a new clientele base, as well as manufacturing facilities in the US, especially with the Trump administration really looking at pharma production in the US. When we contacted Sun Pharma for a comment, they said that they'll not comment on speculation. But clearly, it's quite evident that Sun Pharma is looking at this particular acquisition. And if you look at the last one month performance of Organon Pharma, the shares are up almost 28% in US trade, and probably with a 25% US sales exposure and 25% exposure to the EU markets, Organon is probably a best fit for Sun Pharma at this point in time.
Oh, wow. It's a big one. Yatin, thank you very much. The 28% rally in the potential acquisition candidate. Now, that is quite something. So the market perhaps, not here, but even in the US, perhaps got a whiff of the impending transaction. So we'll see how this one goes. But this is, of course, as Yatin told us, all source-based information at this point in time. Commodities in focus. Manisha is standing by with what is on her mind. Manisha, morning.
Morning, and thank you for that, Prashant. And when we're looking at all-time highs yet again, this is a segment or a sector that doesn't just stop at all. Small dip, every dip is getting bought into, and that's exactly what we're looking at as we start a new week in the Asian markets therein. So 46.60 is an all-time high for the gold prices. As you can see, it's a $65 of a jump up, 1.5% of gains, and this is added to nearly 6% of a gain already seen in case of gold prices there. Take a look at the silver prices also, because we're trading at record highs onto that one. 93.5 of an all-time high is what we've done for this one. This comes in on the back of the US president threatening new tariffs on 8 European nations. This is in order to push to acquire Greenland. And we have seen statements coming from Europe as well that they are discussing potential retaliatory measures. This could also mean more tariffs on US imports, etc. So this is still in conversations. That is what is making the markets jittery. Even as there has been a bit of a gain in the dollar index, gold and silver prices have continued to push higher. The other thing that the street has watched out and reacted to already is that the US as of now is not intending to put tariffs on critical minerals. But remember, silver, copper, including various other metals, is what have been in the critical list that has been issued by China and US. So the two major economies clearly safeguarding it and nationalizing perhaps the real critical minerals therein is constantly supporting these prices here. And it's not just about gold and silver. If you look at the base metal prices, they have been trading firm as well. For years, we have seen underinvestment in the mining sector, whether it is about supply issues, policies, export restriction, lower grades of many of these metals. And now, because the demand has started to work very, very strongly, whether it comes in from conventional areas or newer ones like renewables and EVs, etc., the potential numbers and potential demand going forward also has been quite positive, that in turn supporting prices. And then all the Chinese data that we have seen come in for the month of December has been very, very positive. Industrial production at 5.2 is higher than 5% expected and absolutely higher than 4.8% we saw in the last month. Manufacturing numbers at 5.2% are way higher than 4.6% that we saw in the previous month. So a lot of support coming in from these Chinese data as well. Finally, if you look at the kind of moves that many of these commodities have made for 2026 have been on the positive side. Gold up 8% and silver is outperformed yet again with 31% of gains coming in for that commodity. Platinum prices have been up by 14% in this year. And when you look at the base metal prices, well, copper has returned 4%. 5% of gains is what aluminum is given. And tin continues to trade at near record highs with 28% of a return till time.
Okay, thanks very much, Manisha, for that. That's Commodities in Focus. We take a break. We're back. It's the economy on the other side. Lata speaks with Lalit Bise of Bizom and Jignanshu Gaur of Bernstein on whether GST boosted consumption sustained after the festive season period. Stay tuned.
Fly Emirates, fly better.
Welcome to It's the Economy. For a bit, let's move away from results. They don't seem to have had a salutary impact on markets. Let's look at the economy. Last year, the government took two major steps to boost consumption and hence growth. The cuts did show up in the form of a good demand during the festive period. The question we are asking today is, did the tax cuts create a sustained growth in consumption, or was it only an October affair? The GDP data, the advanced estimates that we got, shows that consumption probably slowed in the second half. But what does market data and what do company data show us? Did consumption slow after the festive period? To answer this, we have with us Lalit Bise, co-founder and CEO of market research company Bizom, and Jignanshu Gaur, the consumer companies analyst at Bernstein. Gentlemen, good morning. Thank you very much for your time. Lalit, to start with you, since you cut across companies and cut across geographies, what is the data showing? Is growth sustaining in November, December as well?
Yeah, Lata, absolutely. I mean, the growth has been not only sustaining, it kind of gave a different perspective in a sense that what we are seeing because of this whole changeover to GST 2.0, a lot of inventory in the system got flushed out. So it kind of became like a reset to FMCG, where distributors, retailers could restock basic consumption rather than the previous trend where people were stocking basis supply. Now we are actually seeing a reset over last 3 months where the whole consumption-led growth has come back instead of just inflation-led growth.
But 1 minute, Lalit, in your data you said that the quarterly growth of October, December over October, December last year was not as good as it was in the previous quarters, the year-on-year growth. I mean, October, November, December grew over July, August, September, yes. But you are saying, your data is showing that it did not grow as much over year-ago levels as it did in previous quarters.
Absolutely. Thanks for bringing that up. Lata. I mean, that's the point, right? So this quarter's growth was primarily volume-driven growth. When you are measuring absolute value-driven growth, it offsets the whole parameter about the GST benefit that got passed on to the consumers. So part of that volume-driven growth was also because of the softening of prices, which was enabled by the GST cuts, right? So in terms of value, if you measure, the growth may not be that impressive, but understanding that it happened in spite of the price cuts actually makes that growth really, really impressive because it's purely volume-led rather than a value-led growth like we used to see in JS.
But you're saying there is volume-led growth. Your numbers are saying, let me look at it. Pan-India, July-September was 13.3, in 24. But October-December 2025, it falls to 6.9%. So it's not as good as it was in 2024.
Absolutely. But that's what I was trying to say, that this is primarily driven by what we are measuring is value, not necessarily volume. And value-led growth was never expected to be great because of the GST cuts and the prices going down across categories.
You're saying volume was good. Okay, Jignanshu, first tell us, you're only looking at quick commerce, modern trade and e-commerce data, right? You're not measuring all FMCG companies. What is your data showing?
Sure. Thanks, Lata. So we measure this broader consumption in two ways. One is we have recently started looking at the UPI transaction data, which NPCI gives, which is far more broad-based. It gives only for certain categories and is not perfect, but we believe it is directionally indicative. And then we look at the data across channels and categories from an organized retail perspective. So two takeaways in our view. We, from a value or even in our view from a volume perspective, Q3, the numbers were not as great as we would have expected it to be given the price elasticity that was expected with GST cuts. So the cuts have transferred to consumers in terms of better pricing. And as Lalit said, it would have risen, led to some volume growth. From our view, we are not seeing the price elasticity play out, at least in the short term. Maybe the time frame we are looking at is too small. And I think the industry is hopeful that over 2026, some of that trickle-down effect happens in terms of discretionary consumption, volume going up to compensate for the reduction in the pricing.
Okay.
On the channel side, Lata, I think it's very interesting. What we are seeing is October, November, December were quite disruptive for the channel in terms of pricing. Multiple priced SKUs of the same products, multiple grammages existed. We see that having been normalized in our latest January tracker. So the industry is, I think, stable there. But second, the competition from e-commerce platforms versus modern trade platforms seems extremely high. Of course, late last year, some of the e-commerce, quick commerce platforms had increased their discounting, and we see new players joining the fray as we start January. So the competition is really heating up on the online space.
Okay. Well, Lalit, I wanted to ask you, is there some category-wise difference? Was rural better than urban, urban better than rural? Can you give us some geographical description as to where consumption was stronger?
Sure, Lata. So like we have been discussing, I think urban is typically growing primarily in a premiumization as a clear trend or some sort of indulgence as well. Like something like confectionery has been growing quite good in urban in general. While rural seems to be far more about the basics, like a ghee or a milk-based foods or packaged foods. So the basic, when we think that consumption got reset, I think people started stocking the basic needs in rural. Also, rural had a couple of other reasons for growing. Agri output was, our monsoons being good was one of the reasons. Also, obviously, overall inflation going down was another reason. So rural grew faster than urban. Urban was led primarily by indulgence, while rural was led primarily by rural brands, basic needs, milk-based foods, so VADP foods, as well as packaged foods.
Okay. Jignanshu, can you give us some category-wise geographic, not so much geographic, as much as do you also look at electronics? Since you're looking at quick commerce, e-commerce, modern trade, we shop a lot of electronics, textiles, etc. also. Category-wise, was anything stronger, anything weaker?
So interestingly, the immediate effect of the GST cuts in our view seems to have benefited the higher ticket items, whether it is auto, electronics or even jewelry, versus benefiting the lower ticket items, especially on the discretionary front. So we see that as a clear difference in categories of the last 3 months data, where large ticket items have done well, small ticket items like apparel, indulgent snacking, relatively speaking, seem to have done slightly more poorly. Sets up the year very differently for an apparel player versus a grocery player.
Okay, so actually Lalit also is talking about premiumization. The other thing, Jignanshu, which comes across in your various reports, not just in your consumption report, is that maybe the standard FMCG players are losing a lot more to in-house labels of modern trade e-commerce companies. So while FMCG may show that they are reporting, lower volume, it may not be because of lower consumption, but because they have lost to in-house labels, private labels of e-commerce. Is that what your research is showing?
Yes, Lada. I think that's been the trend for a while, that FMCG players structurally had 2 big advantages. One was a very sizable, very mature distribution landscape. And second was that they had a very strong branding and product development approach. Over the last decade, I would say, and very especially post-COVID, the growth of quick commerce, especially more than e-commerce, has sort of democratized the landscape for both the D2C brands, which are small but growing fast, as well as then the private label company brands of all these players. Okay. So I do believe that at the value end especially, there has been some market share loss potentially for the FMCG players. Again, we don't cover those players, so no target price implications from them. But we do believe that there is D2C brands as well as private labels are growing possibly at the expense of both listed FMCG and probably unorganized players.
Oh, okay. Finally, Jignanshu, you are saying in your report that there is heavy discounting, even more so by the quick commerce companies. And now you are saying that Amazon and Flipkart are joining the fray. And yet, when your stock pick recommendations are there, you are very positive on the quick commerce or the ultimate owners. You're positive on Eternal and Swiggy. You're also positive on Trent in spite of saying that apparels are not doing that well, and positive on DMart. So am I missing something here?
No, I think these are shorter term immediate trends that we are seeing, which will possibly put pressure on, let's say, on the quick commerce side, on the growth for the 2 listed names. What we are taking a call on is from a 12 to 15 month perspective. We don't think this approach is sustainable for that long, and there will be some reversion to normality. Okay. That reversion also supports the DMart thesis because there is some competition effect on the growth for DMart as well. And we believe DMart's thesis for this year is more about revival and surprise on margins than necessarily surprise on very high growth. Okay. So different thesis points and time horizons, Lata, but short term, yes, fully agree, very high competitive intensity. Longer term, we do expect the listed names, the intensity to sort of normalize and the listed names to be able to do well.
Only one word time for from Lalit. Lalit, you said premiumization is one trend. Any particular product or products that did well and those that did badly, as quickly as possible?
Confectionery is the one that did really well last year.
Okay. So, yeah. All right. Good to hear that. Okay. And anything very bad?
Anything very bad is home care as of right now. I think the whole inventory-led growth on the reset has impacted home care.
It may only be a reset. Hopefully, it'll pick up. Okay. Thank you very much, Lalit and Jignanshu, to give us so many nuances and trends in such a short time. Thank you very much for joining us. We have to wrap up on Bazaar. Chartbusters up next.
Weak guidance pulls shares of IT bellwether Wipro down sharply. The stock down 7%. Management's fourth quarter guidance suggests lower conversion of deals into revenue growth visibility versus peers. Morgan Stanley downgrades the stock, a target price at 242 rupees per share. Shares of Reliance Industries too under pressure, even as overall EBITDA for the company comes in at a 7-quarter high. Brokerages continue to maintain their upbeat stance on the counter, citing synergies from Jio and a retail-led recovery. A couple of lenders reacting to their earnings. Sharp spike in credit costs sends shares of RBL Bank in the red, deeply in the red, as in fact higher provisions dent show in the third quarter. Meanwhile, Nifty heavyweight ICICI Bank's net profit falls 4% on annualized basis. The stock under pressure too. Shares of domestic airline Interglobe Aviation higher even as the DGCA mounts a 22 crore penalty on account of the December meltdown. Warnings issued to the CEO, COO and others on account of failures. And Poonawalla FinCorp gains after the company's assets under management spiked about a 77% on a year-on-year basis. NetWeb's revenue too skyrocketed 140% in the third quarter. Shares of state-owned Coal India's unit, Bharat Coking Coal, BCCL, gets a bumper listing on the bourses after stellar subscriptions. Shares list at over 90% premium on the NSE and currently holding with a gain of 82%. Stay tuned. The management joins us in just a bit. You're watching us here on Chartbusters. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu. With me is Nigel as well. I am from the Motilal Oswal studio. Nigel joins in from the NSE. Nigel, not a particularly good day for the frontline indices. We have, the large cap heavyweights. They're weighing down on the index. Now the Nifty back to its earlier range of the lower end of the range at 25,500. Let's see where it goes. The broader market's not looking particularly good either.
Well, that's right, Mangalam. Not a good day for the markets, on the whole, but it's a great day if you got allocation in the Bharat Coking Coal IPO, because you're sitting on a whopping 80% to around 90% returns. So those investors, they are feeling very, very good. There's green on the screen. That said, I have with me Mr. Mukesh Agarwal, Director Finance of Coal India, and Mr. Sanjay Kumar Singh as well, the Director Technical, BCCL. Well, congratulations, gentlemen. What a moment, right? 70 to 80% premium on your IPO price. You all must be feeling very good.
Yeah, we are feeling very good. First of all, I will thanks to my all investors who had posed the confidence into the Coal India and its subsidiaries management. And this confidence gives a lot of confidence to me, also for my other companies which are in the pipeline for the listing.
All right, got that, Mr. Agarwal. But Mr. Singh, now the onus is on you all.
Yeah.
Because the street has, put in the money.
Yeah.
They have put in their faith. But now they'll want to see performance.
Yes.
Share price is one thing, but performance is the next. Now for this year, going by what we have seen year to date, FY26 will be a bit of a degrowth year, which is par for the course. The street has digested that.
Yeah.
But from FY27, on the base of FY26, what kind of a production growth number can you guide for? And also in terms of washery coal as a percentage of the mix, what can it look like?
So you see, this year a little decline because of a natural reason. We had a very high unprecedented rain. It was close to 2 times of a normal rain, which badly heated BCCL operations. But that's not a worry, not an issue. Given a company which is for more than 50 years on the ground, very skilled management and skilled workforce, we will bounce back next year itself. And if you see the growth story of BCCL, we have projected 56 million ton by 2030.
Right.
And we are sticking to that. You can see those numbers tickling up from the next year onwards itself. If you see the washery, which is the main focus of BCCL growth story, currently the washing capacity is around 13.5 million ton. We are going to make it double. Double means we are going to close to 26 million ton. Last year we supplied close to 2 million ton to steel sector clean coal, which will be converted almost 5 times to 9 to 10 million ton. And this basket of product, it will fetch a good revenue to BCCL. If you see in terms of net realization, the net realization per ton of washed product sold to the different customer, to the steel, to the power and the other customer, and the net realization of a raw coal sold to the customer.
Yeah.
You see, it's almost 3 times. So we are going to get a very high net realization when we grow on VASI step by step. And by 2030, we are expecting in excess of 5,000 crore EBITDA and close to 3,000 crore of PAT.
Well, that's going to be a tall ask, sir, but we'll be tracking that, 2,900 crores of PAT and 5,000 crores of EBITDA. Mr. Agarwal, I'm coming across to you. What do you think about the issue? You all could have priced it much higher, right? If there is so much demand, 147 times it got subscribed. What is your thought process from here? And now you have diluted 10%, Coal India. That temptation will be that why to wait for so long, the next 2-3 years? Might as well do it pretty quickly. How do you see that scaling down?
Number one, we had make the price as per the valuation. We had done the price, and we does not want that all the money investors should be happy. That was the principle. Coal India is always having a principle that our investor should be happy investor. For your information, please, I will just remind you that in 2010, when the Coal India IPO has come out, it was 245 rupees. Till now, Coal India has given 291.25 as a dividend, apart from the value appreciation of the share up to the 430. So this is the theory. Question of this regarding listing of other subsidiaries. We are not going to come back with the BCCL right now because we had one more company, very good company, consulting company, CMPDI, which we had already filed a DRHP in the May. We are planning to for the 10 to 15% dilution in the CMPDI. So with this listing, we had got the encouragement, shareholders movement, and we will come with the CMPDI list.
So CMPDI, what is the total valuation as of now? Rough number that you could get for your 10 to 15% at Coal India?
I think it will be around 15,000 crore rupees will be the valuation. I am not perfect, but it is a rough,
approximately. So then another 1,500 crores approximately for Coal India.
For the 10%.
Got it. And other subsidiaries as well will be looking to list, right? BCCL you all have got done. I think MCL, SECL, you all were looking at those as well. So the next year, FY27, you see another subsidiary of Coal India getting listed?
Yeah, board has mandated for the listing of this MCL and SECL.
Yes.
And for your information, these are such a companies which is itself is having a turnover of more than 36,000 crore rupees. Their profit is around 15-16. They have profit more than a Navratna company. And their production is more than 200 million tons. So it is better that these companies should be listed so that their values can be reflected in the market in a proper way.
See, sir, everything has, two sides of the same sword, right? And the problem is, one part of the sheet says, good, there'll be listing, there'll be unlocking of value. But then, Mr. Agarwal, some part will say that Coal India effectively will become a holding company. What is the response to that?
For that also, as you know, that the Coal India is now planning to diversify into the 3-4 areas.
Yeah.
One is the renewable energy, second is the critical mineral, and third is coal to gasification and some thermal power plants. All these companies are coming into the fold of the Coal India. So Coal India is not going to unlock the money and keep in this. We are diversifying the business because coal has also a limited life. We have to see the alternate use. And Coal India is a company where 220,000 employees are directly. And apart from that, 1 lakh is the indirect employees.
Right.
I have a big family. I have to take care. This company should be ready for the next 10 years.
Correct.
So that the people can continue to survive.
So the family is going to expand and there's going to be something for everyone is what you're telling us. Got it. Mr. Singh, coming across to you, I wanted to ask you, if washery was such a big focus area and there's so much of profitability, why we took so long to scale up the capacity? That's the first part. And the second part is we have that labor code changes that have taken place. That will have some kind of an impact, right? Could you quantify that? What could that be?
So, coming to your first question about washery, it's a very natural question. But if you see the history of BCCL, it's a 50-year-old company. We had washeries. We had big washery. We are contributing big to the steel sector. But you see, the deposition of coal is such, as we go deeper and deeper in India, the coal quality is getting inferior. So we need to modernize our washery.
Right.
So on that count, we may be a little delay, but we are right on the path. And what we are doing, we are not expanding Wasri by ourselves itself. We are going for public partnership also, and we are monetizing some of our old Wasris.
Right.
And one of such Wasri is already given to JSW. 2 more are in pipeline. So seeing the growth of steel sector to 300 million ton by 2030, we need to cope up with the requirement of coking coal. So taking both the things together by ourselves and by the public participation, we are going in that direction, and we believe every ton of coal contributed from BCCL will substitute the import, and it will little step towards the Atmanirbhar Bharat.
Okay.
Number 2, coming to the labor code.
Yes.
It's this labor code, I believe, it's simplification of the things. It will make the things easier for the employee as well as for the company also. And at the same time, as you see, right now we have a number close to 31,000, our own people. By 2030, we are going to 22,000. These all are going by natural retirement only.
Right.
So this will help us in spreading the fixed cost among the larger volume from 40 to 56, as well as the number is also getting reduced. So in fact, what will happen? Our fixed cost will reduce. Our variable cost will remain almost same.
Okay.
So ultimately, it will give the impact on NR. It will move on the north direction.
So you don't see it as a big impact because of the number of employees itself will be will be coming down from 30,000 to around 22,000. Also,
Yes.
you don't believe that will be a big impact.
Yes, yes.
Well, thanks a lot for giving us some color with regard to BCCL as well as what it means for Coal India. Congratulations, gentlemen. It's time for celebrations for all of you all at the family of Coal India as well as BCCL. Wishing you all the best, and we'll track you all to some of these numbers. But today, the big takeaway is BCCL has had a blockbuster listing. Well, Mangalam, that's it from me here. You heard the management of BCCL as well as Coal India. Back to you in the studio.
That point, Nigel. Well, BCCL has done extremely well for the ones who got actually the allocation here. Can't say the same for the market, though a couple of these stocks are doing extremely well. Polycab, after having fallen about 4% post its numbers, has bounced back a little bit, up around 3%. Volume data as the street was expecting. And we are seeing decent moves on CG Power, Tata Tech and Federal Bank as well. But though the mood of the market is fairly somber, what we'll do is take a short break, come back, add a little luxury to it. Maybe we have the management of Leela Palaces and Hotels. Anurag Bhatnagar, who's the CEO, joins us now. Their third quarter performance, which was fairly strong, at least on the revenue and operational side. Bottom line further boosted by lower finance costs. Anurag Bhatnagar joins us to give us an outlook into 2026. Stay with us. Welcome back. Let's get chatting with the management of Leela Palaces and Hotels. Reported a steady performance in the third quarter. Anurag Bhatnagar, who's the CEO, joins us now. Obviously, we'll be discussing the outlook for 2026, further debt reduction, overall expansion plans for a brand that has been doing extremely well, especially on the luxury side, doing almost 2.5 to 2.7 times growth than the overall luxury market in the country. Thanks a lot, Anurag, for joining in. Congratulations, a decent set of numbers that you got. Over 20% revenue growth in a seasonally strong quarter, and on an absolute basis as well. This has been your best ever quarterly performance. But the street wants more. Ye dil mange more, as they say it, right? If you could give us a sense on what the outlook for 2026 is. Obviously, the first 9 months of this year, very good. The fourth quarter likely to be even better because you have a lot of weddings and, meetings, incentives, all of that. So typically, the second half of a year, you do about 65% of the overall year's EBITDA. If I back calculate those numbers, this year you should be closer to 650 to 700 crores in terms of EBITDA. Is that a fair calculation?
Absolutely, and you're right on all counts. Second half of the year is typically much stronger, and 65% of the EBITDA comes in H2 of the year. On the back of a phenomenal, I would say the best ever quarter 3, we're looking forward to another strong quarter in Q4. Mid to high teens growth in Q4 as well, based on the guidance that we have always been given. If you look at the fourth quarter of this year, this is a quarter because of seasonality. There's a lot of inbound business coming in. And if you look on the back of what we have done in quarter 3, where the growth was very broad-based, all elements of luxury ecosystem fired in quarter 3, and they continue to fire in Q4. So overall, a very strong and a robust close to FY26. And like I said, our guidance, we stick to it from mid to high teens in terms of growth over the year.
Right. What's interesting is that this year will be the first full financial year post-listing. Easy pickings have been done. A lot of the debt has been reduced. The last time you joined us, you said that net debt was close to 400 crores. So if you could give us an updated number on the debt as well. And any early inkling into what FY27 looks like? Because that will also be a bridge year before all your new properties come on stream, and maybe, FY28, 29, 30 onwards, where you get a real scale up. So FY27, what should the street expect, along with what your current debt numbers are?
So we have been able to reduce our net debt today is around 800 crores.
Okay.
We have 600 odd crores on our balance sheet approximately. So we have been able to pare down our debt significantly, and we continue to do so. This year, we were able to, in this first full year since our listing, actually, we've been able to sign 3 more deals to our portfolio. We've been able to complete our first international acquisition in Dubai, an extremely value-accretive acquisition. We are able to sign a very strong management contract in Jaisalmer, plus progressed in the BKC, where there's going to be a Leela Palace. So overall, with very limited use of our balance sheet, we are able to add, on a stabilized year, on an attributable basis, nearly 350 crores of EBITDA. Going forward in 2027, we expect 3 hotel openings. We expect to have a first foray into luxury branded residences opening in Mumbai. We expect the Leela Jaisalmer to open, again, exotic location. And we also expect our members only clubs to open in Delhi, Chennai, and in Mumbai. So very strong and exciting year in FY27, with lots happening both on the same store as well as our new value drivers. So all the investments that we made into our portfolio in terms of food and beverage and wellness, they will all pan out in 2027, and we expect them to get stabilized.
So mid-teens sort of growth would be a fair estimate for FY27, or maybe higher than that because of the new openings, etc.?
No, absolutely. I mean, this is going to be both. We are likely to grow both same store, like to like, as well as, in addition, the value drivers that I spoke about in terms of new F&B venues, new banqueting venues, the new spa ecosystem, as well as the new addition.
And this is with margins of 49 to 50% that you've been maintaining in the past?
Absolutely, absolutely.
Right. You said your net debt number was close to 800 crores. What's the gross debt number? Because the September number that you had reported was close to around 1,460 odd crores. What is the updated number?
We're on the same numbers, so around 1,400 odd crores for gross debt.
Okay, gross debt stands at 1,400 crores. On ARC itself, I wanted to understand, because this is a high margin property, right? You would have a comparable in the form of what, say, something like a Chambers does for the Indian Hotels Group. So what is your expected target revenue coming in from ARC and all the other value-added services that you're speaking about? Because this proportion, while small in revenue contribution, could be higher in EBITDA contribution because of its high margin component.
No, absolutely. I mean, we have already launched the first ARC by the Leela in Leela Palace, Bengaluru. The second one gets launched in New Delhi in the month of March, the third one in Chennai, and the fourth one in Mumbai by the end of the year. So this is absolutely not just a members-only club, which creates a very high networking impact for the brand and the company. It also creates a unique value proposition for all the guests, and it's extremely value accretive and high margin. So we currently have a very strong funnel of members. It's by invite only. These are the memberships that compound the value proposition of Leela across our 14 existing hotels and is expected to contribute meaningfully to our pipeline as well. This is absolutely not just in terms of the value accretiveness, in terms of margin contribution through the fee structure, as well as the run rate membership charges that we'll have every year, but also in terms of the membership utilization through our extensive and exciting programming that we have created across all our hotels.
What about revenue from international tourists? I remember, it was around 47% in FY25. How has FY26 been? Because so far the data that we have, the public data that we have, it's not back to pre-COVID levels. We haven't seen a massive jump in inbound tourism in the third quarter itself. Would you agree with that?
So if I talk about, see, you are partly right. I see its needle has moved, but not to the extent that one would have envisioned for the obvious reasons. If I talk about the Leela Palaces in Q3, our international mix in our city hotels was 57%, which was a bit short of what one would have expected in this quarter. But that gives us a long runway ahead in terms of growth. In our resorts, our international mix was 28%. Now, this international business is also very value accretive because in terms of the margins, in terms of the higher ADR, they're likely to contribute, plus the holistic spending as well as the length of stay. So we are very confident that once, in going forward in Q4 as well as the next year, we really feel a long runway ahead for the international business to catch up. And Leela is very uniquely positioned to get an outsized market share.
All right, just a final question before we let you go. Mr. Bhatnagar, you have about 9 to 10 properties which are likely to come on stream over the next 3 years. If I'm looking at Hotel Leela in 2030, if you could give us a sense on what the revenue, the EBITDA, the ADR, margins, and perhaps the number of keys that we're looking at, and if you can, also throw in a revenue mix.
Fantastic. That's a very interesting question. So I'll try to keep it pointed as well. In FY30, we are looking at this point in time, let me remind you, at this point in time, we are looking at 23 operating hotels. We are expecting at over 5,100 keys. We are expecting to have an EBITDA of over 2,000 crores. We are expecting to have a very good balance of both ownership hotels as well as managed hotels. We expect to have a very wide distribution in terms of both city center hotels as well as exotic resort destinations. We expect to create new revenue streams as well through these hotels, through heritage, wildlife, skiing, resorts, and so on, as we have declared. So this is going to be very, very exciting next 3 years for us. And we are very much on track in terms of our greenfield hotels, which we are building from ground up.
All right, take that point. Wish you good luck for the next couple of years. Exciting phase for you. Let's hope, the macro tailwinds also support a sustained growth in the luxury segment, which anyway does not get severely impacted by a big dent in the macro sentiment either, but definitely positively impacted by a mild positive trend as well.
Market on the luxury side, and we are very uniquely positioned in that space. Yeah.
Take that point. Thank you. Good luck for the next full year and the financial year as well. Take a short break. Come back, get you more of the markets and a lot of stock-specific action. Welcome back. The Nifty's made a slight recovery. In fact, the recovery is led by the IT pack. So from lows of around 25,500, the Nifty is actually recovered to around 25,550. Let's see where the remainder of the day takes the frontline index. The broader market still in a deep shade of red with 2,100 stocks in the red for every 750 which are in the green. Take a short break, come back on the other side. The team of Trading R with Ritu comes up next. You're watching us here on Trading Hour. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu. With me is Ritu Singh. Good morning, Ritu. We are, after testing the higher end of the range sometime last week, we're now back at the lower end of the range for the frontline index, around 25,500, buoyed lower by a lot of these big results, the likes of ICICI Bank, Reliance and Wipro. Not to mention the mid-cap index as well. While at an index level, we've seen some recovery from the lows. We have 2,100 stocks which are in the red for about 780 which are in the green, though there has been a formidable recovery from the lows for the mid-cap index. The Nifty too is just about hanging around the 100-day moving average of 25,570. So that's an important level to track because we haven't closed below that level. In fact, last Monday as well, when the market saw a sharp decline, whereafter we saw a recovery from those oversold levels. The question is whether that happens today as well or not. Good morning.
Good morning, Mangalam. That's right, Nifty around the 100-day moving average. So we'll have to see whether it's able to make any meaningful uptick from here. The earnings, which is where the markets are also taking cues from, has been a bit of a mixed bag over the weekend. The heavyweights, like you said, have been a bit of a disappointment. ICICI Bank, for one, dragging the index down. You have others like Reliance also, pulling pressure on the Nifty. HDFC Bank, Wipro, Infosys, all in the red as we speak. In fact, if you look at the packs, Nifty FMCG is the one that's holding up a bit. Metal as well, just up about 0.3%, but pretty much everything else is in the red, from banking, realty, media, pharma, IT, all of it dragging the markets lower. But as always, let's get you some stock-specific action, and Hormaz is here as he puts the spotlight on some of the top movers in trade today. Hormaz.
The first couple of hours have been dotted with earnings casualties more than stocks that have been bucking the trend in terms of earnings reaction. So we'll start off with some earnings casualties. One such name is RBL Bank, and still 7% lower. Wipro at one point was down 9.5%. So there has been a marginal recovery from the lows, still 7% lower on the stock. And L&T Finance at one point was also down around 4.5%. So still a marginal recovery from the lows there as well. But contrary to the earlier trends when stocks used to fall on not so good volumes, today's stocks are declining on strong volumes. Look at RBL Bank. It had almost 1.5 crore shares traded. The 20-day average is just 14 lakh. Same is the case with Wipro as well. There's almost 4 crore shares have been traded. The 20-day average is just 22 lakh shares. Same is the case with L&T Finance, almost 5x its 20-day average. So all of these names declining on very, very strong volumes as well in today's session. A name that is bucking the trend and earnings reaction as well is Jindal SAW. And this name up around 12% now in today's session. It snapped a 3-day losing streak. It has been an underperformer before results were announced. 7 out of the last 8 sessions were in the red going into today's trade. This is the biggest single-day gain since May of 2023 for the stock. Volumes are the highest in the last 7 months in today's session already. And at this point of the day, close to 3 crore shares have been traded on Jindal SAW. The 20-day average is only 4 lakh shares. And the stock has moved above its 50-day moving average, and the 100-day moving average on the upside comes up to 182. So that's the next level to watch on the upside for Jindal SAW. It had a very forgettable year in 2025, had almost halved in that calendar year. And the other news flow driven reaction is CG Power, and after 9 days of underperformance, the stock is now up 6.5-7%. There's snapped a 9-day losing streak. It is only the second day in 2026 that the stock has gained, and volumes though in today's session are still lower than the recent fall that the stock had seen. Close to 95 lakh shares have been traded on CG Power today, 9x of its 20-day average, which comes up to around 11 lakh shares. Despite this, the stock remains below its key moving averages and had declined in January of 2025 as well, was down 13% on the same month last year, and the same time around the stock is down around 6 to 7% this month as well.
Take that point, Hormaz. Thanks a lot for that. So those are a bunch of buzzing stocks that we have, but tech stocks, they are the ones that are actually, impacting the market on the downside. Though there has been a fair amount of recovery from the lows on the frontline index, not so much for Wipro, about 2% of the lows. Tech M as well. Rima joins in with the updates. Rima.
Thanks so much for that. Let me start with Wipro, where the street is disappointed with the Q4 guidance. For Q4, that's the Jan to March quarter, the company is guiding for 0 to 2% growth. But analysts say that this includes a 2-month contribution from an acquisition that they did, the Harman DTS acquisition, which according to some estimates could contribute 150 basis points. Which means if you strip out the benefit of the acquisition and look at the organic revenue growth, it would stand at minus 1.5 to plus 0.5%, which is lower than the growth the company had in Q3, which is why the street is so disappointed with the guidance. The management attributed the guidance to fewer working days and delayed ramp-ups in certain deals that they had won earlier in the earlier quarters of FY26. Also, FY26 would mark perhaps the 3rd consecutive quarter of a decline. Morgan Stanley today downgraded the stock to an underweight. In fact, 47 analysts track Wipro, and out of them, 36 of them either have a hold or a sell rating, according to Bloomberg. Tech Mahindra, on the other hand, is having a good session led by a beat on revenues and on margins. Margins for the company have been a very solid story. From a low, a trough of 4.7%, they now stand at 13.1%. This is the 9th consecutive quarter of a margin expansion, and the company remains on track to achieve its guidance of 15% margins by the end of FY27. And the company's aspiration is also to achieve industry-leading revenue growth. JP Morgan has upgraded Tech Mahindra to an overweight. Back to you.
All right, take that point. So those are a couple of these IT names. Tech Mahindra up 3.5%, Wipro down 7%, but ICICI Bank, that's the one that is lower today following its third quarter earnings. The bank's profit fell due to provisions after the RBI directed the bank to make a standard asset provision of nearly 1,300 crore rupees. The key positive, however, was the reappointment of Sandeep Bakshi as the MD and CEO of the bank for 2 years. Ritu.
Well, yes, the suspense is finally over. The board of ICICI Bank finally approving that 2-year extension for Sandeep Bakshi to continue as the MD and CEO till 2028. And that ends months of speculation over whether the man who was credited with turning around the bank is going to stay on at the helm or not. Now, Sandeep Bakshi took charge of ICICI Bank in 2018 following Chanda Kochar's controversial exit at a time when the bank, if you remember, was battling very high NPAs, volatile earnings, and of course, governance concerns. Now, since then, he's kept a very quiet, low profile. You hardly ever see him on TV. He stayed away from the headlines as well. And cut to the present, the bank is now among the strongest performers in the private banking space. It is, in fact, outpacing peers in profitability and return ratios as well. Now, he is an ICICI Group veteran, joined in 1986, went on to lead ICICI Lombard, then ICICI Pru Life Insurance. He was brought in as COO of ICICI Bank in mid-2018 when Chanda Kochar proceeded on leave following the Videocon controversy, eventually took over as CEO in October that year. Now, during his tenure, he's made quite a pivot from the previous regime, exiting the aggressive bulk corporate lending we saw under Chanda Kochar, shifted to risk-calibrated growth, a term which the bank has grown to be associated with, focused more on retail, MSME, granular loans overall. And the result of this pivot has been quite visible because in the 7 years under Sandeep Bakshi, ICICI Bank's return on assets has jumped 6-fold, while the return on equity has risen nearly 5 times, from 3.2% to 15.8% as of the 9 months completed in FY26. The annual profits have also surged annually from about 3,300 crores to 47,000 crores now, which is a 14 times jump in 6 years and continuing to grow. Now, this growth has also been very disciplined. Advances and deposits both have expanded 2.5 times during his tenure. Deposits stand at about 16.59 lakh crore rupees, up from 6.62 lakh crores in FY19. But one of the clearest improvements under Sandeep Bakshi has been in asset quality. Gross NPAs falling very sharply from 6.7% to just 1.5%, and that is a 4-fold cleanup of the loan book as well. No wonder then shareholders have also rewarded this transformation. ICICI Bank's stock climbed from barely 300 rupees in 2018 to more than 1,400 rupees as of the last close on Friday, and that's a 365% gain under Sandeep Bakshi. So from cleanup to compounding, the board is once again trusting the architect of the bank's turnaround to keep the momentum going, and the numbers surely are making a strong case for him.
All right, we take that point, Ritu. Thanks a lot for that. Another stock on our radar, this one on the way down, a lot lower, is RBL Bank. Gaurav joins in to tell us what exactly went down with RBL Bank, down 7% right now, Gaurav.
Well, as if you look at RBL Bank and if you look at the pre-provisional updates, there as well, we saw some kind of weakness. And the reason being that the numbers were not as good as what the street is expecting from RBL Bank at least. And at the same time, now when we look at the results, there also we saw a fall in profit, and that is the reason why the stock is down. Let me take you through the numbers first. First, if you look at net interest income, that increased almost by 5%. PPOP growth was actually degrew by 9%, but both these numbers were actually higher than the street's expectation or in line with the street's expectation. Now, what happened is that even net interest margins, they increased almost by 12 basis points. Again, it was a positive for the bank. But if you come down to credit cost, now we saw credit cost increasing once again for this quarter. And the reason being that there was some heightened pressure from the credit card segment. If you look at credit cost, it has now inched up to 2.5%. It is up almost by 40% on a sequential basis. And this is specifically because of the credit card segment. And this also led to profit that came in at around 214 crores versus street's expectation of 260 crores and more than that. That is the reason why why, if you look at the overall estimates, the results were actually lower than the street's expectation. Now, what management is saying is that they will see this heightened pressure in credit card portfolio at least for the next 2 to 3 quarters. In MFI, they are not seeing any pressure, but this is something which is a pain point for the bank, and as a result, we are seeing some kind of fall in the stock price today.
Yes, down by 7.2% almost as we speak. Gaurav, thanks very much for taking us through those numbers. We have to slip into a short break, but don't go anywhere. When we're back, we'll focus on the bond market with Manisha Gupta.
You want to talk business? Meet me in the On-Board Lounge.
Welcome back. You are watching India Bond Street, and look at the bond prices in the Indian markets, and we've seen a bit of a slippage come in for that one, and this is on the back. As you have seen a rise in the 10-year US Treasury yields, that really seems to be doing work there. Having said that, it is also support coming in from the lower than estimated supply of state bonds, which seem to be putting some support in the markets there. Well, actually, when you look at the state bond or treasury auctions, rather state bonds, today's issuance, that stands at around 130 billion versus earlier estimate of 386 billion. So the pressure in the Indian markets is going to be slightly lesser on back of that there. Interestingly, a bigger name, that is Kerala Infrastructure Investment Fund, is looking to raise 15 billion rupees. This is via a 10-year bond issuance that comes into the markets today. The last week was quite a buzzing one. This week, we are still waiting for some more names to come in. But when you look at the last week, all heavyweight names is what we saw. Torrent Pharma, for one, was looking at an issuance of 110 billion rupees. Remember, it's a AA plus rated bond as per CRISIL ratings there. Sammaan Capital put out an issuance of 1.15 billion via NCDs. You had Muthoot Finance, yet another big name, looking at 3 billion rupees therein via way of bonds. It was NCDs that was, as a way of issuance, that Bajaj Housing Finance looked to raise 5.08 billion. And then you had PNB Housing Finance as well, looking to raise 3 billion via NCDs there. So strong names coming in, and the markets do believe that you could be looking at bigger names coming in this week as well. Remember, it's a big part that the corporate bond markets now seem to be falling in within the debt market as well. 2024 and 25 numbers have been quite on the stronger side, with markets believing 26 could perhaps build on that as well. And Part Finance Corp is the last one on your screens. 50 billion issued closes on 30th of Jan is what they're looking at. Axis Bank should come in on your screen as well, because they have seen 1.5 billion of issuance by the way of perpetual bonds as well. Well, with that, let's go for a short break. Up next, we'll focus on all the things that are markets and stock specifics.
Well, no respite for the market yet. The Nifty hovering around the 25,500 mark. Prestige Estates, that's the one that posted a strong third quarter update, with collections rising 40%, pre-sales surging about 120% during the period as well. To discuss business demand, more importantly, the outlook going ahead, and is there any stress in particular geographies? Irfan Razak, who is the chairman and managing director of the Prestige Group, joins us now. Thanks a lot, Mr. Razak, for joining in. It's a strong update, you know, unlike a lot of your other limited to a geography peers. And that really is the first question, where, you know, you have earlier indicated that diversification allows you to, you know, not be impacted by short-term fluctuations in a particular geography. Are you facing any sort of, impact in any particular geography? And we say that because one of your peers in the northern part, Signature Global, indicated weakness in demand and its inability to meet its earlier given guidance. Are you facing something like that in similar geographies? What is offsetting that, if at all?
See, now we are spread across the country. We have business going across from Bangalore, the entire south, and then NCR, as well as Mumbai. And the business has been quite strong. And of course, NCR, we are still a small player in the sense we have got only one project which is very significantly large. It's a 12 million square feet development, and that has sold very, very well. And we see that the momentum is still on. And similarly, in all other geographies also, the business is pretty strong. We did a launch of a project in Bangalore called Evergreen at the Prestige Raintree Park on the weekend, and that has met with an amazing response. And the teams are pretty jubilant at the type of response it has got from the customers. So I think business is there if you have the right product at the right location, and of course, at the right pricing. Now, if you overprice a product, then there is trouble, and that could lead to some slowdown. But I believe if you've got the inventory and the right inventory, and you have to balance your need with your greed, and if the need is proper and the pricing is proper, customers are still willing to commit themselves and buy.
Well, Mr. Razak, let me pick up on the pricing then, because your average realizations have risen 6% over the previous year. Although earlier in your commentary, you said that price hikes rather may be calibrated to protect volumes. But, is this realization growth driven more by the kind of micro market mix you're seeing and the launches you have? Or are you now seeing room for selective price increase without really impacting absorption? Do you have that comfort?
Now, if you look at my average price realization, it's a function of an average across all geographies. Now, you also have Mumbai, you have NCR, you have Bangalore, you have Hyderabad. Now, each market has got a different pricing. And if you take the entire contribution that has come, like in the last quarter, Mumbai has given me 36% contribution of the sales that have happened. And that, if you combine that, of course, Mumbai, if I'm in central Mumbai today, the pricing is all about 100,000 plus on the carpet area. Similarly, in Bengaluru, the pricing is around 12, 14,000, maybe 15,000 in certain areas. And in Hyderabad, it's around 10, 12,000. So the whole thing changes. So the average goes up because of the mix of the micro market. And I think that's a distinct advantage now we have. So I'm glad that we are spread in all regions, and that gives us the strength.
And the Mumbai thing, really boosts the average in your favor, because your Ocean Tower building is just about a 2-minute walk from where I stay right now. And prices are out of whack out there, I must say that to you, But be that as it may, it's fairly well sold as well. Sonal, who tracks the sector closely, tells us that office occupancy has been fairly strong. If you could give us a sense on what the total, area under management is, what kind of leasing can you see in FY26? And do you think this year the REIT comes?
The office has done extremely well. We have this year, I think India as an office market, I think has done its maximum in the year 2025. And out of which Prestige share has been pretty significant. We completed in December a very large development in Outer Ring Road in Bangalore, 2.3 million square feet. And I'm happy to say the entire space is leased out. So the thing is, we have about 96% occupancy levels. So that shows that the office market is pretty strong. Rentals also pretty healthy. And that will only give us confidence to do more. Even in Mumbai, we are building almost 6 million plus square feet of office in 2 different locations. That's in Mahalakshmi as well as in BKC. Even those locations, we have actually pre-leased. So the pressure is on us now to deliver. Even in Delhi, NCR, we've got the Aero City, our building is getting ready. And we have to deliver in this quarter and hand over the premises, which is 600,000, which is fully leased. So I think overall there is demand, and demand is quite strong. And I think it's only better times are still to come. You mentioned REIT. Yes, we are trying to get REIT ready, but there has to be a scale. And I think that scale will come when all the assets that are under construction just now are ready and leased out. So that will happen probably in the year 28, 29.
Okay, so REITs only by 28, 29. But what is that scale, Mr. Razak, you want to get to before you get to the REIT and also the IPO for the hospitality segment? Is that something we'll see in this calendar year?
Now, the scale that we want to get to is about we need to have at least 45 million square feet of space, which is ready and leased out. So I think we'll get there. We'll get there pretty soon. And that's why I gave you the year 28, 29. That's when, because this is not something which is futuristic I'm talking about. It's where we are already pouring concrete. Some assets are ready. Some assets are under construction. And these are all slated to get ready by then. And there's a strong demand on leasing. So we should get there. On the IPO, on hospitality, you asked me, yes, we are fully set. It's only a question of the health of the market, is the type of valuations that you look at. So we don't want to undersell ourselves. Now are we in a position to, sort of ask for more? We are only looking at seeing how the market can reward us for the type of work we are doing. So we're looking at a decent valuation. And whenever that happens, we will definitely look at doing the transactions as soon as possible.
Take that point, Mr. Razak. Always a pleasure speaking with you. Out of time, not out of question. So maybe, we'll reconnect at a later date to get your outlook on what you plan to do with Mumbai. How do you plan to fund your expansion and maybe, give us a sense of your launch pipeline and geographies going forward as well. But that conversation for another day. For the time being, thank you so much for joining in. We'll take a short break, come back, get you more on the earnings front. We have the management of Canfin Homes lined up after this short break for their third quarter numbers. Suresh Iyer joins in.
Welcome back. Canfin Homes is the next management on our radar. The stock is trading lower post its third quarter numbers. Suresh Iyer, the MD and CEO of Canfin Homes, joins us now to discuss the quarter gone by and the way forward as well. Mr. Iyer, thanks very much for being with us here. Let me start with that AUM growth guidance you had given us the last time around of 12 to 13%. In the third quarter, you're running at about 10%, against your guidance. What gives you the confidence you'll be able to close this gap in the one quarter that is left for the year?
Good morning, first of all. See, last quarter, at the end of the September, we had about 8.4% as the AUM growth. And Q3, we've had a much better Q3. And in terms of disbursement, there's been a 45% growth compared to Q3 of last year. So that's why our growth has picked up. And in Q4 also, we are looking at positive numbers because now across our geographies, we have stabilized in terms of disbursement. So in Q4 also, we are expecting somewhere in the tune of about 3,200 to 3,300 crore of disbursement, which should help us at least come closer to 12%. In fact, slightly there has been higher prepayments, which has affected our AUM growth, because while on the disbursement front, we have been able to keep up with the numbers that we had been guiding. But in terms of prepayments or loan closures, BT outs, there have been almost 200, 250 crores for the last couple of quarters that we've seen an increase. So that's what is slightly affecting our AUM growth. But definitely we are looking at 3,200 to 3,300 crore disbursements, which will help us inch up the AUM growth further to closer to 12%.
Okay, closer to 10%. But, in terms of the full year disbursement target, again, I think the number you'd given us earlier was 10,500 crores. In 9 months, you've done about 7,200. So could you easily do above 3,000 in the fourth quarter? Is that the right deduction, or could you be slightly lower?
No, in fact, we are confident. In fact, we are closer to 7,300. So we require about 3,200, and we are targeting that kind of a number. Yeah. In fact, the momentum is also positive. And normally also it's in the first half, we have about 45% of the business happening, and in the second half, about 55. So going in the same trend, we should be able to touch 3,200 to 3,300 and maintain our disbursement target of 10,500 crores for the year.
Right. Your NIMs have expanded about 10 to 12 basis points quarter on quarter. The last quarter con call, the guidance was about 3.75. Are you raising your guidance here? That's point number one. And secondly, on competition, we've heard that a lot of these housing finance companies are facing competition from state-owned banks. Are you facing similar challenges as well?
First on the NIMS front, actually we have guided for 3.75. At least in terms of the guidance, we would like to hold on to the same guidance of 3.75 for NIM and 2.75 for spread. And actually, the benefit that we have got from the rate cuts that the RBI has announced, we have also passed on to our customers. So we would like to, so therefore we believe we should be around 2.75 to 2.8 in terms of spread and 3.75 to 3.8 in terms of NIM. We have in fact passed on 10 bips to all our existing and new customers, housing customers in December. And effective January, we have passed on a further 15 basis points cut. So effectively, that takes it to a total of 50 basis points that we have cut for our existing customers also. So in terms of, that is in terms of the NIMs that we would like to maintain the guidance of 3.75. As for competition, well, there is some pressure, as you can see in the terms of the BT outs and loan closures. But I wouldn't say it's as much from the nationalized banks, because our average ticket size is about 26 lakhs now for housing. And in that, we are a little below the radar of banks, where they prefer to, they are mostly in the 40 lakh plus segment. But yes, we do have competition from the likes of a couple of other NBFCs and HFCs, which is resulting in a slight increase in our prepayments.
Okay, in that case, Mr. Iyer, what are you doing to increase your share of the non-housing loan portfolio? Do you see a meaningful uptick from here? That's one. And the second, on your asset quality as well, your guidance was 15 basis points for credit costs. You've actually done better. Credit costs have moved up to 10 basis points in this quarter, but it is still below your guided range. What is the sort of target you have for the close of the year? And any pockets of stress that you're seeing you'd want to highlight?
The stress, actually, we have for the last 4 quarters consistently been able to reduce our delinquency pool. So right from, we've consistently from December 24, when we had a regulatory change and the SMA 0 had gone up, since then we have consistently on a quarter-on-quarter reduced our absolute value of delinquency. And you're right, in fact, our credit costs have been much below our guided number of 15 basis points. In fact, normally in Q4, we also see, in fact, a reversal. So it is quite possible that in Q4 of this year also, we might see a slight reversal because NPS tend to come down in Q4. And as for the SMA pool, we do expect that SMA 1, SMA 2, that is our stage 2 assets will also further come down a little bit. There is a bit of a scope. So we don't see much of a problem in terms of our credit costs. In fact, it will be probably below 10 basis points only, the current level that is there. It could be below that for the entire year. And across geographies, we are seeing stability now in terms of the delinquency. Last couple of quarters, we had guided that our delinquency slightly has gone up in Telangana. That also, in fact, this quarter has been positive. In fact, this quarter, we have been able to have a reduction in our NPA in Telangana also. So there also, in fact, now seems to there seems to be a stability in terms of the delinquency. So we don't see in Q4 any major area where there should be any problem.
Take that point. Thank you. Sub 10% credit cost, the street would like that. You're holding on to some of your guidances on disbursement as well as AUM closer to 12% as against the 12 to 13% mark, along with NIMs holding on to that 3.75% mark as well. Thanks a lot. We wish you good luck for the next quarter and the remainder of the next financial year as well. But as we do that, don't lose sight of the market. The market's lower. Perfect time to actually get you an update on what's taking place in the F&O space right now. We have the Nifty Bank as well as the mid-cap index, all of them in the red, though the mid-cap index has recovered from the lows, still mildly in the red. We have, the Nifty as well as the Nifty Bank down 0.2%. What is it that's weighing the market lower? Look at the contribution chart. That tells you the story of the day. It is heavyweights. You have Reliance, which is dragging the Nifty by 87 points, and ICICI Bank about 73 points. The Nifty is down 160 points. Add Reliance and ICICI Bank, you have 160 points lower. That exactly is the story of the day. Wipro, by virtue of its lesser weight on the index, is dragging it lower by just around 12%. But that stock too is down by 7%. Advanced decline tells you again that your portfolios are bleeding. 2140 stocks in the red for 735 in the green, and no attempt by either of these lines to come closer to each other. And all of that is actually, compounded by a higher VIX or the volatility index that tells you that there is fear. Is there any silver lining? Yes, the fact that today's low has been slightly higher than the Jan 12 low. Remember, Jan 12, same time last week, we saw a big spike sometime around this time itself in the market from the lows, and the Nifty actually, after hitting a low of 25,473, closed closer to that 25,800 mark. Today's low is 25,494, though for a sustained up move, we have to actually close above the 100-day moving average, which is 25,570. The put-call ratio at 0.7, lower end of the range, but is not screaming oversold yet. So let's monitor that one as well. And a large part of the decline also has led to those 25,700 put writers be on the wrong side. So they've covered their positions. There you can see the premiums up, the open interest is down. But we continue to see some writing at the 25,500 put, which tells you that support is near. So 25,450 to 25,500 is an important support zone. 1.5 crore shares written on that one for a premium of 50 rupees. Though on the way up, there is resistance at 25,650. Why do I say that? Because 25,600 call writers are equally active as well. So near-term range, 25,450 to 25,650 on the frontline index. Take a short break, come back. On the other side, we focus on the consumption space in India. We've, brought out, a piece last week on how multiple parameters tell you that at the lower end, consumption is recovering. We will delve into greater detail with K. Ramakrishnan or Ramki of Kantar on the other side.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. You're watching us here on Trading Hour. The important part is that last week we did a piece on whether policy has met behavior when it comes to consumption in India. The anatomy of consumption told you that after the income tax cut, GST cut, lower interest rates, easing inflation, we did see some improvement in sentiment. Was it crawling, walking? Perhaps yes. Was it running? No. So let's get chatting with Ramki of Kantar, who tracks this data on a more granular, deeper basis to tell us how exactly consumption sentiment was in the third quarter itself. Ramki, thank you so much for joining us in the studio today. And that really is the first question, because, you know, when we look at the auto sales, two-wheelers are doing well, three-wheelers are doing well, not so much the high-end private, personal passenger vehicles, credit card spends as well. The average ticket size has come down. And even if you look at the FMCG updates, yes, volumes have come, but prices are lower. Discretionary is doing a lot better. From the data that you have so far, what have you made of the consumption sentiment with the kind of impact that we've seen on the government's push over the last 8 to 9 months?
Okay. Thanks, Mangalam. I think you captured the essence quite well. You mentioned consumption sentiment. I'll actually split that into two, consumption and the sentiment. Okay. I think the sentiment has been good. In what you refer to as Q3. The sentiment has been good because of various actions by the government. The first action was on the taxation front, second was on the GST front. Taxation front, from an FMCG perspective, does not move the needle at all because maybe 5% of the country does actually file a return and stuff like that. But let's come to the GST part. In FMCG, there's a really long tail when it comes to the channel and how much can be filled. Even today, if you go into any city, not even a rural area, and go to a supermarket or anywhere and pick up a stock and check the dates, you're likely to find even September, October kind of thing. So therefore, the impact of GST in terms of actual pricing and reaching the consumer has not really happened well enough. But the sentiment, like you rightly said, has been positive. These announcements right at the festive season have made it a little positive. So to that extent, what we see is...
Secondary offtake, have you seen that?
Yeah, so we track tertiary, what comes into a household. So from an household perspective, starting September itself, we are seeing numbers on a quarterly basis, which is higher than the same period in the last quarter.
By how much?
But if you actually look at annualized numbers, it is still not above the previous year. But if you look at quarter by quarter, up to September, October, even up to November, if you see, the numbers were in the range of 3.75 to 4.2 kind of growth rate for FMCG as a whole. And that number has gone up to somewhere between 4.75 and 5, right? Now, will the annualized touch 5? We strongly believe it will, at least in the Q1 of the next financial year, which is because the stocks has to find its place. there's a lot of action from marketers and brand owners who have changed the pricing or changed the grammage so as to pass on some of the GST benefits. So we will see annualized basis in Q2, but on a quarter-to-quarter basis, it's already seeing a move, which is positive, which can be much more positive when the actual behavior starts.
So when you track everything that comes into a house, you also track what is branded, what is coming from the legacy players, what is coming in from the private label players, and what is coming in which is unbranded. What does that mix tell you about the sentiment right now?
Oh, it's actually a funny behavior, if you ask me. I mean, it's not something which is intuitive in terms of the consumption basket, if you see. A lot of companies would have told you, or you would have also perhaps reported, that the urban is actually being a little tight, and rural is perhaps recovering more. That's fundamentally because we have to isolate consumption as listed company products and non-listed company products. If you look at the listed company products, yes, it is lesser. But the unlisted companies and smaller brands have definitely grown in the quarter, which is I'm talking about the last quarter of last year. Smaller brands and also unbranded. Both of these have seen a growth in urban. So therefore, urban consumption has grown, but it's not grown for the listed. But the extent of penetration of the unlisted companies as well as unbranded together is surprisingly even lesser in rural than compared to urban. So all I have to say is that while rural is showing signs of positivity, it's more a macroeconomic phenomena, whereas urban, it's fundamentally people readjusting between listed companies, smaller brands, and unbranded stuff. So what we can look forward to is a comeback of the branded.
That's a wonderful headline that you've given to us, that urban recovery is not visible in FMCG players, the listed FMCG players, largely because they're losing market share, whereas the rural recovery is led by them largely because the rural economy itself is doing well and they have their reach out there as well. But Ritu also joins us from Bangalore. Ritu, you want to know a little more about the consumption space?
Well, yes, in fact, what Mr. Ramakrishnan is pointing out about urban recovery lagging, you see it in the jobs data as well, by the way. The monthly updates that have come in, urban very much lagging rural, so to speak. And that's the data we're getting from credit as well. Mr. Ramakrishnan, the GST cuts have happened. The effect has been very crawling, if at all. The tax cuts have already happened. The fiscal space seems to have shrunk. On the monetary side as well, we've already seen 125 basis point rate cut. If you look at the personal loan data as well, it has come off year on year. Since the budget is coming up as the next trigger for consumption from here on, what will meaningfully, cause an uptick here? What are the cues you look out for?
No, I think the in terms of inputs, what has to be done is kind of done. We just have to wait for its impact to be seen. There isn't anything more that can be done now before the budget or in the budget for us to see a spurt, because we haven't even seen what the GST can really do to an FMCG space. Yes, the sentiment is good. Now the behavior has to show itself, and we are pretty confident that it will reach a number of 5% plus in terms of growth in end of this quarter, which is I'm talking about on an annualized basis. On a quarter-to-quarter comparison, it is already at 5. So annualized will happen. So in my view, the inputs that have to come have already come. So to that extent, I don't think anything more needs to be done on that space.
Just a final question before we let you go. You've been tracking this space for a fairly long time. Earlier, it was very easy. It was a 1:1 correlation. Okay, this is what the government has done and this is what the FMCG sales have come by. So there is obviously that impact that has come. But now it's become extremely dynamic, right? The traditional FMCG players have their own challenges. Then there are these pockets of consumption which are not captured by the traditional metrics.
Correct.
And then you have something like gold prices which are increasing. So obviously incremental savings go there. You have the need for data which has increased. So obviously incremental savings go to telecom as well. So what is a good consumption basket now for one to track the sentiment really?
I think it's always going to be a combination. There is no single basket that you can look at. Our basket is entirely the FMCG, which is a composite of unbranded, unlisted players, listed players, online, private labels, all of those put together. So for FMCG, this can give you a good basket. The rest we have to look at multiple sources.
Has the R-square come down?
Actually, if you see, India is one of the few countries where if you track the GDP growth and the FMCG growth is lagging behind the GDP growth. And that money, where is it going if the question is being asked? It's going to gold, it's going to telecom at the moment.
All right, take that point. Thank you so much for joining in and, being in on the consumer sentiment and giving us more updated data right now. Really, it was insightful to know that in the urban spaces, it's not consumption which is actually coming down. It's the listed players whose share is coming down. Now, with that, we'll take a short break. Come back, more market talk on the other side.
Welcome back. It's time to get you a quick check of all the macro signals for the day. And let's start with the markets. It's down 150 points on the Nifty and down about 490 points on the Sensex as we speak. The Bank Nifty also in the red on the back of those earnings coming in from heavyweights like ICICI Bank, dragging the index lower. The rupee, let's take a look at that as well. It was under pressure in the Friday session. It is just finding little relief today as well. It closed at 90.86 on Friday, and currently it slipped to 90.91 against the dollar. Keep an eye out on that one. Despite the pullback in the dollar index, because of the Greenland dispute, there is some pressure here. And rupee now just 10 basis points away from hitting the previous low of 91 that we had seen in December. The 10-year benchmark, though, that settled at 6.67% on Friday, now trading at 6.68. So it is up now for a third, consecutive day because of supply worries and, missing the bus on that global index inclusion. Traders are expecting the yield to move in a very narrow range of 6.63 to 6.7 or so because of, RBI's liquidity action. The focus will continue to be there, now trading at 6.68 as we speak. Oil prices, meanwhile, holding up steady after unwinding that Iran premium that had driven prices to a 12-week high, now at about 63.78 as we speak. On that note, we're going to wrap up this edition of Trading Hour. From Mangalam and me, it's a goodbye, and the team of Halftime Report is going to take all the action forward.
Cool.
Indian equities sulk as global markets react to Trump's Greenland tariff threats. Realty and energy are the big drags, while capital goods and power stocks eke out gains.
Reliance Industries posts its highest operating profits in 7 quarters, with O2C and Jio delivering strong performance even as oil and gas exhibits weakness. The consumer business is spun off from a retail even as work on Jio's IPO progresses. Analysts maintain an upbeat stance on the stock.
Tech Mahindra gains after it beats street estimates on most counts, while Wipro takes a drubbing as it falls short on growth expectations, even as profitability shows a marked improvement.
Bharat Coking Coal makes a stellar debut on the bourses with the stock listing at an over 95% premium to its offer price of 23 rupees a share. The country's largest coking coal player has given a strong guidance for FY27.
And the stock of Interglobe Aviation climbs after DGCA slaps a small fine, calls for a bank guarantee, cautions the CEO and issues warnings to key executives. The focus now shifts to reform measures and normalization of schedules. Hello and welcome to Halftime Report live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra and with me Sonal Putra and Vinny Motiwala. Well, it is turning out to be a day where we've started on a defensive footing, you would have to say, for the market. So currently the Nifty is reeling under pressure because of the global cues on one end, where we do have the uncertainty with regards to what is taking place with Greenland and the intentions that Trump has there. But separately, we do have the earnings which have weighed on sentiment at this point in time as well. Yes, a few positives coming in from the likes of ICICI Bank with regards to the extension of Sandeep Bakshi, but overall the profit decline has probably stirred the markets on the negative side. We do have HDFC Bank also, which was marginally lower along with Wipro and Reliance. But on the upside, we do have a couple of stocks which are managing to hold up with the likes of TechM. But nonetheless, BHEL also currently down around 1.5%, just came out with numbers maybe around 30 to 40 minutes ago. Lot of results to watch out for today. We have LTI, Mindtree from the IT space, Hindustan Zinc, which would be important considering the stock price run-up that we've seen, Seat, Havells, Oberoi Realty, PNB, a whole host of interesting numbers from different sectors to give you a sense in terms of what is taking place there. Hi, Gab.
Hey, Vinny. It's going to be a busy day and a busy week as well. We are getting so much commentary coming in from the World Economic Forum in Davos as well. For now, it's the metals index that continues to be on the front foot. Nifty has again seen some fall from the highs of the day, so we continue to track that. For now, most of the indices are in the red as we speak. It's just the FMCG, metals and PSU banking index which is at least attempting to be in the green as we speak. Realty continues to be under pressure. That's down another 2%. And now this index is down 21% from its 52-week high. So we'll watch out for management commentaries and the outlook going forward. But for now, majority of the market reeling with some red today, Vinny.
Absolutely. Majority for the market is reeling with some red today. And, you know, what we'll keep an eye out on is BHEL also. It just reported its numbers just a short while ago. Overall, it seems like an okay set of numbers in terms of the performance versus what the street was expecting. Standalone basis, however, there was a bit of a miss. Consolidated basis, it was fine. Revenues have seen a good growth at this time. Operating margins, some sectors have done well, while overall, we're seeing a bit of muted performance that came in from the power segment, especially in terms of the EBIT margin. So that is something that we'll watch out for. But yes, BHEL, we have some commentary that is coming down there as well for you all on the screens. So keep an eye out on that. As of now, it's trading in the red. But let's move on, and what we have in store for you all on the show today, we will talk about the banking stocks that are reacting to their Q3 earnings. We'll also put the spotlight on Q3 earnings of Rossari Biotech with their management. And later on in the show, we will discuss the capital goods sector and furthermore what to expect with PL's Amit Anwani, who will bring a special discussion on that front as well. And more, apart from that, we'll discuss on the sidelines of Davos as well with the management of Suzlon. Stay tuned in for that. Okay, now let's move on and bring in the first element for the show today, that is about the bank earnings. Gaurav is here to take us through the Q3 bank earnings. HDFC Bank, ICICI Bank, a whole host of numbers that came in over the weekend, Gaurav. But how were they looking like?
Well, as weekend was actually busy for me because all the heavyweight banks like HDFC and ICICI came with the results, and throughout the result, one thing was consistent is that some weakness was there in the result. So first, let's talk about HDFC Bank. When we look at HDFC Bank, on the positive side, we saw net interest margins that increased almost by 11 basis points, higher than the street's expectation. At the same time, credit costs that declined to 41 basis points, and the reason being that there was 140 crores worth of write back in the contingency provisions. But on the flip side, what was negative is that Mr. Bhavesh Jhaveri, who is the executive director, has requested not to seek reappointment. That is number one. And second is that the bank reported 500 crores worth of additional provisions due to regulatory requirements. And this was because of the non-compliance with their agri PSL portfolio. Now, bank said that there was no need for any additional one-off provision. But again, at the same time, we are seeing some kind of weakness in the stock. Second, let's talk about ICICI Bank. Now, the biggest disappointment came in terms of credit cost here. And the reason being that here as well, we saw on the back of the RBI's request, bank created additional provision worth of 1,283 crores because they also had some problem with the classification of agri PSL portfolio. Now, that led to credit costs increasing to around 74 basis point versus street's expectation of 50 basis point. Other than that, because of this higher credit cost, we saw profit decline almost by 4% on a year-on-year basis for the bank. On the positive side, we saw a reappointment of Mr. Sandeep Bakshi, who is an MD and CEO for the next 2 years. But again, if you look at the stock performance, management and overall commentaries, it looks like street is not focusing on the positives. They are actually biased more towards the negative in terms of credit cost. Third, let's talk about RBL Bank. Now, we are seeing one of the biggest falls in RBL banks today. And the reason being that if you look at the positive side, net interest income, that increased and net interest margins improved almost by 12 basis points. But on the negative side, we saw credit cost increasing once again for the bank. And this time it was because of the credit card segment. Now, credit cost increased almost by 40 basis points, and management said that over the next 2 to 3 years, they will see some stress in the credit card segment. That is the reason why profit, that was also below street's expectation. And as a result, we saw some fall in the share price. For Yes Bank, let's look at some of the positives first. Now, asset quality has been good for Yes Bank in this quarter because slippages have come down. Second is that if you look at net interest margins, they improved almost by 10 basis points. But on the flip side, what was negative is that if you look at ROAs, now the expansion in ROAs, that was specifically because of the 555 crores of the gains that they reported in the security receipt sale. If we exclude that, the ROAs still come between 0.5 to 0.6%, which will be stable on a quarter-on-quarter basis. Now, management did say that in FY27, they will bring ROAs towards 0.9%. But second thing that was disappointment was that if you look at the growth comments from the management, they said that they will be clocking 8% growth in terms of loan book for FY26. Remember, in the last quarter, management had called out for double-digit growth, somewhere in the tune of 10% for FY26. So that is something which was another disappointment throughout the results. And lastly, let's also not forget about IDBI Bank. If you look at ROAs, they have declined, and at the same time, net interest margins, they have declined almost by 19 basis points for the bank. And as a result, we are seeing some pressure in this bank as well. So all in all, throughout the result, if we look at all the banks who have reported, except for UCO Bank, all the banks are currently under pressure.
Yes, big pressure there. Thank you so much, Gaurav, for summarizing all these major bank results that came over the weekend. That's all about the banking space, but let's talk about Rossari Biotech, the first management on the show. The company reported a muted growth when it comes to their profits. They said that there's some demand concerns in their domestic market as well. Joining us now to talk more about the earnings and the outlook going forward is Sunil Chari, the co-founder and managing director at the company. Mr. Chari, good afternoon. Thank you so much for joining in. In your commentary, you spoke about weakness in the domestic environment. Can you give us a sense of what the volume growth was? Because ground surveys also suggesting that now consumer companies or other companies are moving from oleochemicals to crude-based chemicals. Did that not benefit you in the domestic market? Can you give us a sense of demand concerns and the pricing environment?
Good morning. We had a good quarter as far as, in spite of all the volatility and uncertainty in the markets. This is the quarter 3 is normally the weakest quarter in our year, and you should see at the year-on-year the growth which is there. We had October, which was a little slow in the domestic market, but December the markets have come back. In fact, we don't see any change too much in the shift from oleo to the crude base. We have a portfolio based on oleo and also on crude. So we don't see much change in the demand from the customers. Products where oleo can be used, there are some products where we cannot change to crude base, and hence the oleo base will continue. For us, it doesn't matter whether it's oleo or crude, because a surfactant is a surfactant, and it will do. The textile and aviation also have done well. Exports is strong at nearly 27-28% of our sales, and inching towards the 30% growth mark. And also, we have been, able to now get approval from the board for greenfield facilities in Saudi Arabia.
Okay. Mr. Sunil, if you could just narrow down a little more on exports. You touched upon it briefly. You said it's almost 30% of your business now?
Yes, 27 to 28% and inching towards the 30%. It's every quarter since the last, 6 quarters, exports have been continuing to grow.
Yes, but could you just give us more details in terms of how much growth the exports did record this quarter, and where exactly are you seeing it come through from, and what might your guidance be for the remaining part of the fiscal in terms of exports?
So this quarter also we are expecting to be in the range of 27-28% of our sales to be exports. But then in the next year, we are expecting that we should be 30% of our sales as exports.
Okay, and how is the segment doing in terms of performance?
The HPPC is still 77% of our sale. HPPC is our home personal care and performance chemical segment, which is holding strong. And we see in the next 5 years in our internal budget, it to rise to nearly 90% the HPPC segment. And this is on growth of where we are expecting nearly double growth in sales and EBITDA in the next 4 years. And in that context, the percentage of HPPC is continuously growing.
Okay. Hi, sir. Good afternoon. Just wanted to know also in terms of your cleaning as well as the B2C business, right? Still reporting a bit of a loss there. So any strategy in terms of that? What should we watch out for going forward?
The board has shared the views that we should look at exiting the consumer businesses. So this is something which we plan to do, make steps in this quarter.
Mr. Chari, one on this business that Vinny just spoke to you about, by when will you be exiting the consumer business? And second, on the domestic business itself, what was the volume growth or decline this quarter? When do you expect to see complete recovery come by? Because while export, of course, is 30%, 70% is still domestic, right? So I'm trying to understand what the demand trends are here.
So, as I said, October was very weak for us in the domestic. I think it was primarily because the Diwali month is always slow and we have a lot of holidays with our consumers. December has been very strong. So I think for us, this quarter, we see the domestic demand picking up again.
You taken any price cuts to retain the market share? And there was some partial commissioning that came by in second quarter as well. So in third quarter, what was the capacity utilization there? How much did it contribute to revenues?
So we have continuously, increasing utilization of the capacities. As you know, our ethoxylation capacity is at 100% usage. We have no capacity built left in ethoxylation. Now we have a new MDA plant, which we should start seeing results, full results where we are expecting 70-80% capacity utilization from April onwards. This is where we have already got a lot of approvals for our methyl diethanolamine plant. This is the new capex which we did. And in this quarter also, we should have, commissioning of our animal nutrition trace mineral plant, which is a vitamin premix plant, and also our fermentation facilities for manufacture of biosurfactant.
Okay. All right, Mr. Chari, always a pleasure speaking with you. Have a lot more questions, but out of time, but we'll pick it up next time. Thank you so much for joining us with the outlook on the business going forward. With that, we'll do one thing. We'll slip into a short break. When we come back, Vinny will focus on capital goods sector in our special QSQT segment.
Fly Emirates, fly better.
Welcome back. Well, for the markets, it's under pressure at this point in time, but just want to point out one particular stock, Sun Pharma, where we have CNBC Avaz has also reported that Sun is evaluating an acquisition of Organon, which is worth around $10 billion in terms of a total size, inclusive of the debt. But as you can see, the stock, which was under pressure at the start of trade, has now turned into the green. So it's up around 0.6%, holding up. Maybe the street is quite sanguine about this particular acquisition, but let's see, considering it's a large size, but maybe the street is confident of Sun Pharma's capabilities at this point in time. But nonetheless, let's tell you on our What's Trending segment today, the focus is on capital goods. In the spotlight after BHEL's numbers, which just came out, the company reported its earnings just about an hour ago, and the stock is under pressure post its results as it was a top-down miss. Joining us now is Vinny, who will take us through what to expect from capital good companies this quarter in our QSQT segment. And shortly, we'll quiz Amit Anwani of PL on his view on BHEL and the capital goods space. Let's go across to Vinny. Vinny, over to you.
Hi. So firstly, overall, in terms of Q3 expectations this time, it is expected to be a better quarter versus Q2 FY26 for most of these capital good companies. And obviously, what is going to be leading the growth is the post-monsoon season recovery, strong order inflows, execution on high voltage power OEMs as well. The rest of industrial plays will be a bit of a mixed bag result. Now, robust order book is what we'll start with. We start seeing that conversion coming in into higher revenues and selective margin expansions for some of the companies. Talking about order inflows, they are expected to drive this quarter's main narrative. Now, when you talk about GE Vernova T&D, they're expected to see a strong order inflow, mainly obviously aided by that big prestigious order that they got from Khandwa, which was to South Olpad. Now, this was a very big order. So, obviously, order inflow for GE Vernova is seeing a sharp jump up. With Hitachi Energy also, the order inflow is expected to see an 84% decline this time. And this is mainly due to the HVDC order that came in last quarter. So, last base was higher. So that's why Hitachi Energy is seeing a decline. On the other hand, ABB India is expected to see a steady order inflow of 26%, followed by KC International as well as Siemens. Now, the important drivers of capital goods companies, what is it going to be in Q3 FY26? Healthy execution momentum across the T&D sector and play for project companies and product companies. That will be leading the growth. Other than that, execution is expected to be robust given the outstanding order books that these companies have. Also, given the healthy industrial demand and robust execution, they expect mid-teens revenue growth for the sector. Now, let's talk about particular T&D related product companies that are there. They're expected to see better growth versus other segments. 18% overall growth as one could see. GE Vernova T&D, good growth over there. Siemens Energy and Hitachi Energy is expected to 17% growth. Now, other than that, when you look at it, what is leading the growth for these T&D players is going to be the execution parts and the domestic business that has been doing well for these companies. Moving on, industrial machinery part. What is expected over the industrial machinery companies? Revenue growth is expected to remain moderate, 7 to 8% overall growth, largely mainly impacted by the sluggishness that one has seen coming in for the export market, and likely delay in dispatches amid some tariff-related uncertainty is a concern. For project companies, revenue is expected to see around 17% growth this time overall. On an average basis, that we're seeing healthy execution, strong order book, strong traction in the international market for these project companies will lead the growth there. Now, let's talk about margins. T&D EBITDA margins are likely to see an improvement on a year-on-year basis. GE Vernova, we are estimating an EBITDA margin of around 22%, which is implying a 530 basis point increase on a year-on-year basis in terms of margins. Healthier gross margins is also what we're expecting. Operating leverage is something that will lead the growth there. Industrial machinery side companies, EBITDA margins are likely to improve owing to better operating leverage. We expect a 390 basis point YOY decline in ABB specifically, and EBITDA margins are lower. Pricing power for ABB is impacting their margins. Further, in Q3 FY26, rupee depreciation was there versus USD. So that could impact ABB's margins. So sharp impact coming in and decline coming in for ABB margins. Siemens, according to CNBC poll, indication is coming in around 40 basis point expansion there. Keep an eye out on that. While gross margins may be contraction, but operating leverage is something that will offset that for the company. Cummins, Thermax, maintaining the steady margin that we're seeing, and slight improvement on a year-on-year basis. Project companies' EBITDA margins are likely to see an expansion led by better operating leverage and favorable mix. Now, key commentary or key highlights that triggers that we'll watch out for from this sector include improvement in execution pace, pickup in private capex. Is that there? Demand for power T&D, nuclear data centers. How is that shaping up? Impact of geopolitical tensions on the export business. While in terms of valuations, when you're looking at it, valuations seem like a bit muted versus the average. So we will watch out for that. Capex spend is there, something that is continuing. So keep an eye out on all the valuations for the companies as well. But BHL today, after the numbers, we're seeing a bit of a decline.
Okay, all right. Take that.
Sonal, just before that, I just want to point out Torrent Pharma, which is in focus. There's an important flash which has come in, where I'm assuming it's the Indian government which has accepted the company's phase 3 clinical trial study report on semaglutide, and what they've said is that they've recommended permission to manufacture and market semaglutide tablets. Remember, that is basically the generic version of Wegovy and Ozempic, which is Novo Nordisk's blockbuster drug, and that is going off patent in March anyway in India. But the committee has recommended permission to manufacture and market the semaglutide tablets. So one will need to see when exactly they can probably start manufacturing it, or start manufacturing it for the Indian market without any kind of patent issue. So that'll be interesting to see. As you can see, the stock is up around 1.8%. But it's important to remember, March onwards, there'll anyway be a lot of competition when it comes to semaglutide. They might just have some kind of runway for growth, but you also have a lot of competition coming in from big drugs such as Mounjaro.
We've been discussing, you've been explaining all of it to us since the word go, so keep an eye out on this one. But let's get back to capital goods to talk more about what to expect in the sector, and most importantly, BHEL just reported numbers. We have with us Amit Anwani, research analyst at PL Capital. Amit, good afternoon. Thank you so much for joining in. Before I speak to you about the entire sector, and it has been in focus, right, because of whatever is happening with China, the imports, exports, and there's been a lot of source-based news that has come by there as well. And we've seen a sharp decline in stocks over overall. But BHEL in particular, them talking about the capex plans in Varanasi that they have pushed because they need more cash. They're still talking about the impact of labor code. What did you make of the numbers? You have a hold rating right now. Have you been able to see the internals and talk about it more?
So thank you so much for having me. So I think first of all, BHEL has been execution focused company from past 2-3 quarters. There has been a lot of order intake which they have already won upward of more than 1,50,000 crore in past 24 months. And even H1 intake, including one state order which they won upward of 15,000. I think H1 intake was again more than 32,000. So I think the more granulated focus was there on the execution. Current quarter, as I can see, versus our estimate for PET of 415, I think the stock is slightly lower than the estimate, and even for overall street estimates, it is much lower. I think the focal point also, as you already talked about, shifting of the production facility, is that in terms of capital allocation and execution, we have been seeing this company having substantial contract assets and facing issues with respect to execution delays in the past. And I think the gradual recovery was expected. So still, for me, the numbers should be better versus what they have been delivering, considering the very strong order book, which is not coming. So for me, the focus definitely is execution, and we have the hold rating. For me, the re-rating point would be when there's a very strong execution coming in, which will provide a leverage also on the margins.
All right, Amit, we have to let you go on that note. Thanks very much for joining in and giving us that brief call in terms of BHEL and the capital goods space. We now need to cut across to Shireen from the World Economic Forum, speaking to Suzlon's management. Shireen, over to you.
Hello and welcome to our continuing coverage here from Davos 2026. It's a very cold morning. The sun is just about rising here. It's still very early in the morning. And while the headlines here at Davos 2026 at the World Economic Forum are dominated by what President Trump has done and is likely to do, there are, of course, serious other complex issues that one has to deal with. The energy trilemma is one of them. Clean, affordable and secure sources of energy. That is what the world is also grappling with as we enter a new era of geo-economic confrontation. Joining us now to talk about the plan and the road ahead for Suzlon in its 31st year is Girish Tanti. Mr. Tanti, always a pleasure. Many thanks for joining us here in Davos. As I said, you know, a lot of the conversation is around the energy transition, continues to be around that, but also around AI and the kind of power demand that electrification as well as AI are going to lead to.
Correct. Yeah, I think if you see just the year that we finished, 25, almost 92% of new energy that got installed globally has all come from renewable energy. In India too, around 80% of what we constructed this year in the country has come from renewable energy. As we look ahead also, I think, with the electrification of the entire value chain, the EVs as well as the AI, for the first time we are seeing globally huge pickup in the electricity demand worldwide. And I think within that today, both for wind and solar and battery systems now, for the first time we are seeing a convergence of all three technologies where, the cost of energy is amongst the cheapest that you can get today. So I think with that, the adoption of renewables is expected to significantly pace up from here.
You know, talking about significantly pacing up the move towards renewable energy, and to talk about specific to what's happening in India, the 10 gigawatt annual target, how close are we now to that? We're about 6 gigawatts today, but when do we get to 10? How confident do you feel about that?
Yeah, so today if you see, as a country, we have just crossed 54 gigawatts. That's the halfway mark to over 100 gigawatts by 2030, the first review period that we have set for ourselves, and the targets that PM Modi has set for the country. I think with the 6 gigawatts crossed this year and the manufacturing capacity strength almost 20 gigawatts annually that we have with good export demand, we are expecting that in next 2 years we should cross the 10 gigawatt mark. And by 2030, we should be closer to about 13 to 15 gigawatts.
Okay, you talked about the export opportunity, so let me double down on that. We're dealing with a fairly volatile and uncertain world. I know you're yet to finalize your export plan, but lay out for us what we can now expect from here on as far as your export strategy is concerned.
Yeah, so today if we see, effectively with the electrification and the demand that we are seeing across the world, almost all nations, there's a good portion of green energy adoption that's happening. So we've kind of looked at the key markets where we believe that in today's new organized world of multipolarity that we have, but still we see that I think there are excellent opportunities for renewable energy and wind energy in specific. So we've targeted Europe as one of the key markets.
Okay.
In fact, today itself we've just announced our CEO for Europe.
So that's the headline that is being broken here on CNBC-TV18. Suzlon appointing a new CEO to look at the European opportunity, the European export market opportunity.
That's correct. So we have also kind of looking at the Southeast Asia market. I think a lot of countries there in Southeast Asia also adopting renewables very fast. Australia is another important market, and Middle East is the other market. So these are the markets that we are looking at, and with the current forecast we've seen also from GWAC from India exports, close to about 10% of India has the potential actually to meet 10% of wind energy globally.
Okay, so what could this potentially mean in terms of export revenues, say 5 years on?
Yeah, I think it's
too early.
It's too early to state numbers, but I think the idea is that as you've known historically, we've had significant revenue coming from the international markets, and the idea is to rebuild. And in the new world today, where from a product technology and the performance, especially with close to about 6 gigawatts of wind turbines that we have supplied to 17 countries globally, there is a good track record and acceptance, and customers are looking forward to having Suzlon back again.
What about the US? Is that an opportunity at all that you're going to consider, given President Trump doesn't like wind?
Yeah, I think if you see even in the US, I think the growth of wind sector has been good. And in fact, our largest market outside India has been the US historically. So it has very good potential. And I think we are also actively looking at how the trade relations pan out. And from a product and technology, we are geared up to serve the US market also.
Okay. One of the concerns, and it is of course not official, but it has been speculated that the government may look at tweaking policy and allow Chinese companies to participate in government tenders. Now, I understand that as far as renewable energy is concerned, the domestic requirement is already built into the policy, so that offers you protection. But is there any concern on that front?
Not really, because I think today if you see both for wind and solar, the manufacturing capacity that the country has is more than double of what the country is installing annually. So we are reasonably Atmanirbhar as far as wind and solar is considered. And from that point of view, I don't see any challenges in that areas. I think it's more to do with specific sectors where India does not have the capabilities and would need import to kind of meet its
So have you heard
demand.
anything about that? Is there a plan at this point in time to review and allow the participation of Chinese companies, for instance, in thermal?
I do not have any specifics of that, but I think there's just a general discussion that likely in some components where we are laying back, there could be some permissions that may be granted, but renewables doesn't seem to be the case.
In terms of the current order book and the expectations from here on, as well as the tenders that have been cancelled and the retendering process, what's the view on that?
Yeah, so I think today if you see both, if you look at the solar trajectory from now, so it's just crossed about 130 gigawatts, and the target is to reach 300 by 2030. With the kind of projects in pipeline, almost 80 gigawatts of new installations are happening, and the tendering also for 30 gigawatts that's there. So effectively, we have a reasonably good visibility of about 235 gigawatts of solar already today for getting on track. And for wind, if you see, with 54 gigawatts already installed, and close to about 30 gigawatts under implementation, and about 2-3 gigawatts under tendering. So we already have visibility about 85 gigawatts plus on that. So I think broadly, there is alignment to get to those targets. What's happening right now is that, we've seen the change in the, we had the planned reduction in ISTS charges, and therefore effectively now the states, we'll see more development within the states.
Okay.
And so interstate relationships from a transmission point of view, the charges will have already kicked in now. So with that, we are seeing that all the 8 states, if you today just for wind, if you combine the total demand that has come up from the state itself for 2030, it's already 107 gigawatts. So I think there is a natural good demand for that. And India is in a way blessed that the demand curve of India, we see a peak in the morning and peak in the evening, and we see pre-monsoon peaks. All these 3 peaks, wind actually has a similar weather pattern for India. Morning we see higher winds, evening we see higher winds, pre-monsoon we see higher winds. So there is a good fitment of the wind demand curve of India and the wind generation curve. And therefore today in the new situation, we'll see an energy mix in India where it's going to be hybrid projects.
Right.
Wind, solar, battery together.
So how well positioned are you for this hybrid future?
Yeah, so of course, I think the market has shifted and we too are kind of gearing up ourselves for Suzlon 2.0, where the idea is we would like to move from a pure wind play to a renewable energy solutions company. And already we are working with customers in making their plans in terms of how we can provide a full integrated solutions. What we've seen is also to build up capacity, we are seeing that customers are looking for a full project from us, right from concept to full commissioning and lifetime service. So we are now building a portfolio of projects of FDRE or hybrid projects as you call, right from development to installations. The EPC business is something that we are building up in a bigger way, and then we of course have a strong service arm. And across all of these, other element that we are putting in is the whole digitization. So leveraging automation, AI, robotics across the value chain, we are kind of making all the processes and systems more smart in a way.
So Suzlon 2.0, as you said, you're ushering yourself into this hybrid future. Is this largely going to be driven by organic opportunities and organic growth? You've already looked at acquisitions recently, you've concluded some recently as well, or will it also be driven by inorganic opportunities?
So I think in today's world, partnership is the mantra. So I think the way we will be looking at the new wave of, preparing ourselves for the hybrid market is to go both inorganic, organic, as well as partnership models. And I think also with clienteles now, there is a much long-term planning. I mean, today with some of our utility clients and industrial clients, we are already working on year 3, 4, 5 long-range planning for all of them. So because this project development takes a while. So with the strength that Suzlon has in project development, we are expanding that for full FDRE for the hybrid projects and also on the EPC front. Primarily to ensure that we de-risk, all the elements of construction for the customer. So customer can get in at any point in time, depending upon the risk appetite, either from the beginning, or we could give them almost ready projects to use.
You've clearly charted out a new path as far as Suzlon is concerned in your 31st year, from a wind-only operator to a hybrid player. Lay out for us the milestones that you hope to achieve, for instance, as you usher in this new future over the next 5 years.
Yeah, so effectively, the idea is that, when we look at the whole market, if you look at the segments, so we have the first segment, which is the India Inc. All the Indian large corporates are all charting out their plans for decarbonization. And with that, really, we're working very closely with almost all the large groups to see how we can help them in the 5-year journey. So we're working on developing their long-range planning on that. We are also working closely with the Indian utilities, almost all the private sector utilities, to also chart out their energy mix for the future on that. Likewise, the PSU segment, both at the center and at the state level, are also looking to kind of decarbonize over there. So effectively, the transition which is going to happen now, the idea is that we would like to, gear up to be that partner for anyone who wants to go green, to be the first choice. and kind of have that leadership position in that space.
17 facilities already, 3 more, 2, one in Gujarat, one in Karnataka, and the third one yet to be decided?
Yes, we are yet to just form that up. So I think in the
where are you likely to be?
I think, if you see today, almost all the 8 windy states, starting from Rajasthan, Gujarat, Maharashtra, Andhra Pradesh, MP, Karnataka, Tamil Nadu, almost all the states where we have good windy states, we have presence. So I think the reason these new facilities are also built up, because now the blades, the turbine size blades, I mean the new product that we have, if you see the size of the blade when you kind of install it, the wingspan of that is actually larger than an A380.
Wow.
So these are huge, and therefore you need to be closer to where the windy sites are. So as the wind development is happening across the country, where we have large segments, we kind of getting the factories closer to those plants.
Well, wingspans as wingspans mirroring almost the A380 or larger, in fact, than the A380. And that seems to be the nature of your ambition going forward as well. Mr. Tanti, always a pleasure. Many thanks for joining us here in Davos. And we wish you the very best of luck with 2026 and beyond. And look forward to hearing more from you as you finalize your export plans. We will take a break here, but the conversations will continue. Don't go anywhere. More headliners and newsmakers coming up for you. Right from the World Economic Forum's annual meeting in Davos 2026.
Welcome back. Joining us on the show now is Kishore Runwal. He's CEO at Anmol Jewelers. Mr. Runwal, hi. Thank you so much for joining in. I remember last year we talked about silver prices crossing 1 lakh and then 2 lakhs, and This year, at the beginning itself, and we are still in the month of January, and we've crossed 3 lakh rupees a kg, and we are trading at around $93, $94 an ounce for the international markets as well. How are you looking at silver prices from here on? Because for the recent past, whenever I have spoken to you, the kind of levels that you have given in for silver, we've seen all of that getting achieved.
Thank you, Manisha ji. As of now, if you see exactly from 1 month before, silver has rised by 1 lakh rupees. So 2 lakh was the rate, and today we are seeing somewhere near 3 lakh 2,000 rupees in the Indian markets. It is looking very bullish as of this. The present trend which I am seeing, the patterns of what we have seen from 2 lakh to 3 lakh, it is going the same way. And from here, again, I see a bullish trend from 3 lakh 25,000 to 3 lakh 30,000. I am seeing a volatile market where it may touch 3 lakh 30,000 rupees.
All right, so some more bullishness coming into the market. Mr. Ranwal, also when I look at, and we've been speaking to some silver representatives in the Indian markets today, they tell me that if it is 3 lakh rupees, you could buy silver in the physical markets at a discount right now. MCX prices in the meanwhile are trading at a slightly premium right now. At these 3 lakh plus kind of levels, are there lesser buyers? Is there a lot of availability of silver in the Indian markets? And is the reason we've seen a discount come in?
Due to very high pricing, I think investors as of now presently are very less. There are no big buyers, but if you compare to US and China, there is a premium rate going in the US markets and in China. China, it is getting sold at 10,000 rupees premium, and Indian markets, if you see, it is getting sold at somewhere near 7 to 8,000. That 7 to 8,000, I don't see a very big difference because the demand is little slow. But as prices will shoot up, I am very sure, because always people give an entry at a very high rate. The common man comes at a very high rate. So I see that again, this gap will get closed. If we see somewhere silver near 320, 330, we will see a lot of investment coming in India again by the investors.
How are you also looking at the overall demand there? And I mean, as you said, investors are kind of on the sidelines right now. Has silver ETF, silver jewelry buying, silver articles, all of that also taken a bit of a hit?
Definitely, silver article markets has taken a very big hit. The volumes are gone down. We can valuation, if you see, we are touching the turnovers at the same ratio, but volumes have drastically gone down. It is not, it has become, silver articles has become now expensive. Now, if you go to a market and buy a glass, it comes near 50,000 rupees, which is very expensive for the common man range. So the common man market is gone. The middle market is gone. Now we have entered the rich segment, the upper rich segment for the silver taste. So the silver article market is down. Silver jewelry market will do better because as gold rises, we will see a very good opportunity for the silver jewelry market. If you see ETFs has done tremendously well in Indian markets. Very good investment have come in ETFs, and compared to last year, if you see the imports in India, it is somewhere near 7,158 compared to 7,669 tons of silver, which was imported in 2024 to 2025. So a similar, in spite of the surge, in spite of that rise in the market, we have done imports very good in silver. If you see in gold was somewhere touching near 812 tons in 2024, and 623 tons has been imported in India this year. So gold is done little low, but silver is done drastically. Imports have done good in India.
Okay, absolutely. Going from strength to strength only, and considering the geopolitical issues, that's the key catalyst for gold and silver prices at this point in time. Manisha, thank you very much for taking us through that conversation. Just wanted to highlight that there is a comment which is coming from Sun Pharma with regards to the news or the reports with regards to the possible acquisition of Organon, which is with an enterprise value of around $10 billion. They have said that as of now, this is speculative in nature and that there is no material event or information that requires disclosure. So that's the comment coming in from Sun Pharma at this point in time. We'll take a short break. More on the markets once we're back. Stay tuned.
Welcome back. We've seen some more fall from the highs of the day. The metal index has turned into the red. So let's try and understand what's the F&O setup looking like. Mangalam is joining in now. Mangalam?
Well, the market is lower and the levels don't suggest that we're oversold yet, just the way we were, same time last Monday. But having said that, there's no taking away from the fact that, the heavyweight indices are being impacted by the earnings. So if you look at, ICICI Bank, Reliance and Wipro, all of them are the top 3 contributors to the Nifty on the downside. The Nifty is down almost 200 points, 190 points to be precise. If you look at the points with which Reliance is dragging the frontline index, along with ICICI Bank, add Wipro to that, that will account for the entire decline. What's actually worrying right now is the mid-cap index, where the market breadth is still in favor of over 2,100 stocks which are in the red, for about 750 which are in the green, and those two lines don't look like they are coming closer. So that's something that we need to monitor as we go along. The other thing that we need to monitor, and that perhaps could prove as a bit of a silver lining, is that today's low on the Nifty, 25,494, it's a good 20 points above the low that we saw on Jan 12th, which was 25,473. Thereafter we saw a big bounce from those levels. So till such time that panic low is maintained, it'll be important for the market to consolidate and buy time around these levels. The other thing that I'll be monitoring very closely is whether the Nifty goes ahead and actually towards closing crosses past that 100-day moving average of 25,570. Why do I say that? Because the Nifty hasn't closed below that level in a while, and breaking below the panic low on Monday, the previous Monday, and staying below the 100-day moving average opens the door to the 200-day moving average, and that would be a bigger fall from current levels. But that may not happen so long as the Nifty Bank is holding on to the 20-day moving average and the 50-day moving average. So the Nifty Bank, a large component of the weight on the Nifty, will obviously see some support at the 20 and the 50-day moving averages. So those are important levels to track. The put-call ratio is at 0.7. Again, lower end of the range, but nothing to suggest that there is panic or oversold market. So what is it that the option writers are doing? They're writing the 25,600 call and the 25,500 put. Put together, what this means is that they are looking at a Nifty range between 25,450 to around 25,650. So this 200-point band is where the market is likely to buy in time in the near future.
Okay, Mangalam, thank you so much for that. We'll keep an eye out on all these cues in the world of F&O. But also BHCL, that's trading at the day's low, down 3% after its Q3 FY26 numbers. On that note, we're going to sip into a very short break. We'll get you more on the markets and stock-specific action on the other side.
Welcome back. Well, it is a sea of red today on the markets. We have the Nifty, which is currently 143 points lower. We have the Bank Nifty, which is down around 0.4% as well. And the mid-caps, which are step in terms of the Nifty and the Sensex losses that we're seeing, with the mid-cap index down around 0.5%. The advance decline ratio on the declining side, around 1,200 stocks advancing to over 3,000 stocks declining. That's the setup at this point in time. It's a wrap from all of us on Halftime Report. Business Lunch takes all the action forward.
Indian markets sulk as global equities react to Donald Trump's Greenland tariff threats. Realty and energy are the big drags, while capital goods and power stocks eke out some gains.
Reliance Industries posts its highest operating profit in 7 quarters, with O2C and Jio delivering strong performance. Even as oil and gas exhibits weakness, the consumer business is spun off from retail even as work on Jio's IPO progresses. Analysts maintain an upbeat stance on the stock.
Tech Mahindra shares are trading with gains today after the company beat street expectations on most counts for the third quarter, while Wipro has taken a drubbing as it falls short on growth expectations even as profitability shows a marked improvement.
Bharat Coking Coal makes a stellar debut on the bourses with the stock listing at an over 95% premium to its offer price of 23 rupees a share. The country's largest coking coal player has given a strong guidance for FY27.
And shares of Interglobe Aviation have climbed after the DGCA slaps a small fine, calls for a bank guarantee, cautions the CEO and issues warnings to key executives. The focus now shifts to reform measures and normalization of schedules. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormas Vatakia. With me, as always, Arundhati Ramanan. Arundhati, good afternoon.
Hi guys, good afternoon, Hormaz. I mean, we're starting the week off on a weak note. All of those indices languishing in the red, Nifty managing to stay around that 25,550 mark.
Indeed, and it's been that kind of a day for our markets, right? We've been in this range of around 50 points for the last couple of hours now. Every time the Nifty goes towards 25,550, it faces some selling pressure, moves down towards 25,500 and then sees a recovery again back towards that 25,550 mark. It has not moved anywhere in the last couple of hours ever since that move towards 25,600 got sold off earlier in the day. But we are counting down to some bigger broader market earnings. But before we get to that, the index heavyweights not doing well today, and that has had an impact. Of course, the global markets being in risk-off mode has a bigger role to play in this. But with the index constituents, be it the likes of ICICI Bank or be it the likes of Reliance, not doing well, and that has had a bigger impact on the Nifty today. ICICI Bank now down 3%, Reliance now down 3.5% as we speak. So both of these names together contributing to around 130 points to the Nifty downside. But the broader markets have been fairly okay. There's a lot of stock-specific activity and more earnings reactions to track in today's session.
Absolutely. And let's look at some of those sectors, right? We got that metal index, which was actually doing really well at the start of the day. It was leading from the front, but it's coming for some profit booking right now. It's about 0.1% in the red. However, Hind Zinc is still gaining momentum. It's nearly 3% higher. It got an upgrade from HSBC, and all eyes are on the company's earnings that should be out in just a bit. We've got Hindalco also doing quite well. Nalco also in the green. The other sector that's managing to stay in the green and is now leading from the front is that FMCG pack. We've got HUL, ITC and Britannia gaining in trade today, helping the Nifty stay in the green, helping the Nifty go higher. On the downside, you have that realty index, which is the top losing index. Godrej Properties, Brigade and Prestige Estates all falling over 3% in trade. Private banks also in the red on the back of some weakness that was seen in its earnings. We've got ICICI Bank and HDFC Bank, all of them falling in trade.
But let's begin the show by getting a brief of the big earnings that were released over the weekend. We just spoke about a lot of them, but Upasana has a lot more on her list. Upasana, good afternoon.
Good afternoon, Hormas. Certainly. Now, Reliance Industries is in focus as the stock is under pressure in tandem with the market despite reporting strong set of numbers. The revenue saw an uptick of 4%. Operating margins stood at 17.4% versus 18% sequentially. Now, JP Morgan has given an overweight rating with a target price of $16.75 per share, and it says that the company's PAT is in line, but the internals tend to be weak according to the brokerage. Now, Wipro also reported its number. Q4 guidance of 0 to 2% is what disappoints the street. Overall, the IT revenue has seen an uptick of 3.3% sequentially, and margins stood at 17.6% versus 16.7% sequentially. Tech Mahindra is the next one. Revenue and margin beat on the stock. Margins have expanded from the low of 4.7% in Q2 FY24 to as high as 13% in the current quarter. Now, JP Morgan has given an upgrade with the overweight rating, and the new target price is 2,100 per share. Tata Tech reported a weak set of numbers. The total operating revenue has seen an uptick of 3.2%, and EBITDA margin stood at 14.1% with a downtick of 160 basis points. NetWeb Technologies is the next one on our radar. The strong beat on revenue as compared to the analyst estimations. Now, revenue has seen an uptick of as high as 1.4 times on a YoY basis. And lastly, coming to BHEL, just reported its Q3 numbers just a while ago. The revenue has seen an uptick of 16%, but overall it misses the street estimates. And lastly, the margins are at 6.4% versus 4.2% on year-on-year basis. So overall, it's a miss.
All right, overall a mix over there. All right, Upasana, thank you so much for those details. But we've also got in some big banking earnings over the weekend, right? Gaurav joins us with those details. Gaurav, it was a busy weekend for you?
Whereas if you look at the weekend, all the banks except for UCO banks are currently under pressure, and the reason being that first let's talk about HDFC Bank. Now there were some positives and negatives. When we look at positives, net interest margins that increased for HDFC Bank, and at the same time if you look at credit costs that came down almost by 10 basis points. Let's also not forget about the LDR ratio commentary that management gave, that they believe that in the fourth quarter of FY26 they will see LDR ratios coming below and around 95% levels. But at the same time, on the negative side, one of the executive directors, he has chosen not to seek for reappointment as he's looking out for other opportunities. And at the same time, bank also reported 500 crores worth of additional provision because of the regulatory inspection in this quarter. As a result, we saw some pressure in this counter. Other than that, let's talk about ICICI Bank. Now, big negative factor here was the credit cost, and the reason being that bank reported around 1,283 crores rupees worth of provisions because regulators asked them to do so. And this is linked to the agri PSL portfolio, which was non-compliant with the regulatory actions and requirements. And that is the reason why, if you look at credit cost, that inched up around 0.74% versus the street's expectation of 50 basis points. And that is the reason why, if you look at profit also, that declined by 4% and it was 9% lower than the street's expectation. On the flip side, Mr. Sandeep Bakshi, he got reappointed for the next 2 years as MD and CEO, but it looks like market is not taking that positive news, and that is the reason why we are seeing some pressure in this counter. It is down more than 2%. Let's talk about RBL Bank now. We are seeing a sharp fall in this bank, and the reason being that on the last trading session, we saw the bank actually inched up higher because of the high expectations. But when it comes to results, now credit costs disappointed in this quarter as well. What happened is that credit costs increased almost by 40 basis points. And that is the reason why, if you look at profit, that came in at around 210 crores. Now, this was lower than the street's expectation of the profitability, which they were expecting at around 260 crores, and that is the reason why we are seeing some pressure in this counter. Remember, management commentary was also not that positive because they say that credit cost pressure will remain in the credit card segment over the next 2 to 3 quarters. Let's move on to Yes Bank now. Now, what was positive is that the gross slippages that came down, and at the same time, net interest margins, they also improved almost by 10 basis points. But on the negative side, we saw ROA expansion, which was supported by the security receipt gains, and that is the reason why market has not taken it in a positive way. The stock opened in a positive move, but now it is under pressure.
Every weekend, one weekend every quarter where Gaurav is possibly the busiest man on the planet, with swarmed with bank results. Gaurav, thank you for summarizing that for us in brief. Mind you, some flashes on your screen. The Power Minister has just mentioned that there is no change in the government's policy about market coupling, and this comes on the lines of the APTEL hearing today. The electricity amendment bill will be introduced in Parliament during the budget session. That is, of course, a lot of things that the Power Minister has highlighted other than the market coupling bit, but that's the main line to watch out for. The market coupling bit, no change in the government's policy with regards to that, and you can see the reaction now on IEX. This has been one of the major overhangs on the stock. From levels of 200 plus, the stock had declined to levels of 130, still languishing at those levels. There have been multiple hearings with regards to this market coupling overhang on at the Electricity Appellate Tribunal, one of which is scheduled today as well. It'll be interesting to see what transpires there. But for now, IEX 3.5% lower, extending its losses. The Power Minister has made it very clear that there is no change to the government policy with regards to market coupling. We'll get you more on this in just a bit. But the other major news bit is from Sun Pharma, and the company is now planning to expand its US operations with a large acquisition. CNBC Awaz's Yatin Mota is joining in with more on this. Yatin, tell us, what are your sources telling you?
Well, sources at this point are indicating that Sun Pharma is readying a very big acquisition in the US markets and is in talks which are primary in nature with Organon. Now, Organon is a very large enterprise in the US markets, focusing on women health as well as biosimilars and specialty drug portfolios, which probably seem to have interested Sun Pharma. Organon market capitalization is close to $2 billion, and they have close to $8 billion in debt. So that takes the enterprise value of the entire acquisition close to $10 billion. As of now, things are not clear whether or not it will be a slump sale or a full acquisition of Organon. However, when we contacted Sun Pharma, they said that they will not comment on speculative stories. However, if you look at Organon's portfolio, as I mentioned earlier, it is necessary for Sun Pharma to have exposure to the US markets. Organon currently has 26% sales coming in from the US markets, and a similar sales figure comes in from the EU market, and that is where it becomes a strategic fit for Sun Pharma. which has currently nearly $4 billion of cash on its balance sheet, which can be utilized, for such acquisitions. But as I mentioned earlier, the talks are, primary in nature and may not be conclusive at this point in time. But mind you, Organon shares in the US markets are up nearly 28% in the last 1 month.
All right, Yatin, many thanks for taking us through those details. Now, Bharat Coking Coal, India's largest producer of coking coal, has enjoyed a stellar debut, listing with gains of over 90%. Earlier, we spoke to the management to understand what the company's growth trajectory could look like. Take a look.
If you see the Vasri, which is the main focus of BCCL growth story, currently the washing capacity is around 13.5 million ton. We are going to make it double. Double means we are going to close to 26 million ton. Last year we supplied close to 2 million ton to steel sector clean coal, which will be converted almost 5 times to 9 to 10 million ton. If you see in terms of net realization, the net realization per ton of vast products sold to the different customer, to the steel, to the power and the other customer, and the net realization of a raw coal sold to the customer. If you see, it's almost 3 times. So we are going to get a very high net realization when we grow on Vasri step by step, and by 2030 we are expecting in excess of 5,000 crore EBITDA and close to 3,000 crore of PAT.
Boy, what a start this has been for Bharat Coking Coal, 82% higher still in comparison to its issue price. Of course, at one point was up 97%, listed at around 45 rupees, still at 42, and made some money for those who received an allotment in the IPO. Of course, the first main board IPO of 2026, so it's been a good start to primary market activity for the new year. But the other stock that's doing well today is Interglobe Aviation, Indigo's parent, and this is after DGCA had imposed a 22 crore penalty on the company for flight disruptions last month, which has been interpreted as a relief as the street was expecting a larger hit. Shivani is here with more details on this. Shivani, tell us more.
Well, yes, Hormaz, the aviation regulator DGCA has finally taken the enforcement action against Indigo, imposing a total penalty of 22.2 crore rupees over the massive flight disruptions that we saw in early December. Now, this includes 20.4 crore rupees for 68 days of continued violation of flight duty time limitation norms, levied at a maximum permissible rate of 30 lakh rupees per day, along with an additional 1.8 crore rupees one-time systemic penalty for broader operational and management failure. Beyond this, the monetary fine, DGCA has also directed Indigo to furnish a 50 crore rupees bank guarantee with phased release linked to DGCA monitored systemic reforms across leadership, oversight, crew rostering and digital systems as well. Now, the financial impact might seem mild at this point, but let's look at the broader picture. It is significant. Indigo had already said that it has paid over 500 crore rupees in passenger compensation for cancellations and long delays and has processed around 610 crore rupees in refunds till December 7. Mind you, refund outgo is expected to rise further from here. Taking together the penalty, compensation and refunds and the compliance-linked safeguards, Indigo's total financial exposure now stands at 1,180 crore rupees. So the 22 crore rupees penalty might seem mild, but the overall exposure stands at 1,180 crore rupees. Back to you.
All right, and Interglobe Aviation is the top Nifty gainer there, over 4% in the green. Thank you so much for those details, Shivani. On that note, it is time for us to head into a short break. The annual World Economic Forum is underway in Switzerland's Davos. We get you a roundup of all the action. On the other side, stay tuned.
Fly Emirates, fly better.
Welcome back. You're still with us on Business Lunch. CNBC-TV18 Shireen Bhan is in Switzerland's Davos, where top world leaders will gather for the World Economic Forum amid U.S. President Donald Trump's tariff threat on NATO and European allies. She joins us now to give us a roundup of what we can expect this year. Shireen?
Focus is clearly on what President Trump is going to say here in Davos, and he's almost lit a match even before he arrives here in Davos. I think his decision to impose tariffs on NATO allies ahead of his Davos visit is strategic. It's a conscious move, it's a conscious decision, and of course that has rallied European leaders who are also going to be here in Davos together. You've seen statements coming in from the EU Commissioner Ursula von der Leyen, you've seen comments coming in from the German Chancellor, from Keir Starmer. In fact, Keir Starmer, the UK Prime Minister, will be addressing the nation today. But let me show you the USA House. Right behind us, that is the USA House. This is the very first time that the US has actually set up a house here. Of course, this is where US government officials will be stationed through the course of this week. Now, as the WEF President Jorge Brender was telling me in our exclusive conversation yesterday, President Trump has been a regular in Davos. Last year, he made an appearance, but that was virtual. This time, he's possibly going to be here for more than 24 hours, in Jorge Brender's words. There's a whole host of bilateral meetings lined up. Also, meetings with business leaders. The World Economic Forum is expected to host a special reception where Trump is going to get an opportunity to meet global business leaders. Now, this USA House used to be where our colleagues at CNBC for many, many years had set up their lounge. This would be the CNBC lounge. This has now been taken over by the US. And of course, Trump is arriving with the largest ever US delegation of secretaries. Luptik is going to be here. Bessent is going to be here. Jameson Greer will be here. Chris Wright, the Energy Secretary, is going to be here. Steve Witkoff, Jared Kushner, a whole bunch of other U.S. officials will be here. And now, as I pointed out, this is about Greenland. Venezuela figures nowhere in the conversations. It's moved to Greenland and Trump's ambitions. He's not backing down at all. In fact, if anything, he's doubling down on the U.S. ambition to take Greenland, tweeting just a short while ago, or Truth Socialing just a short while ago, saying Europe has done nothing to ensure the safety and security of Greenland, and so the U.S. is going to go all in. Separately, there's also a talk around the Gaza peace plan that President Trump has put together. Remember, countries like India, Prime Minister Modi, have been invited to join the peace board, so to speak. And of course, that has run into its own set of controversies. Tony Blair kind of distancing himself from the plan that the Trump administration is putting forward of a paid membership. Of course, we will possibly see comments coming in on that as well. Now, the threat of retaliatory tariffs from the EU. Reports suggest that the EU is putting together a bunch of retaliatory tariffs, and that could be pretty significant as well. Will we see an announcement happen here as Davos kicks off with President Trump being here? We don't know, but the mix, the environment is anything but conciliatory. Davos, the theme this year is dialogue in a contested world. And at this point in time, what we're seeing is unilateral actions with little space for discussion and dialogue.
Bringing you all the hot headlines from a very, very cold Davos. Shireen Bhan there of CNBC TV18. Stay tuned for all the live coverage from there through the course of the day. Take a short break. More news and updates on the other side. Stay tuned. Welcome back. Now the markets are dealing with yet another bout of geopolitical uncertainty this year as US President Donald Trump aggressively eyes the acquisition of the self-governed territory of Greenland from Denmark. The US President has announced a 10% tariff on nations that do not support Washington's stance on Greenland, leading to concerns over the future of NATO and European security. European countries are also debating potential retaliatory measures to counter such tariffs. Precious metal prices have surged in the 19 days of 2026 so far as uncertainty has hit a new high. Gold prices have rallied over 8%. Silver is up already 30% so far this year, while platinum has seen a rise of around 5% so far. Not to forget tin, that's also up nearly 30%.
And moving on to the latest on the geopolitical developments in Greenland, which could potentially disrupt transatlantic relations. Here's a CNBC report for more on this.
U.S. President Donald Trump escalating issues on Greenland, vowing to slap more tariffs on 8 European countries if they do not allow the United States to take control of the Danish territory. Countries including Denmark, Germany, France, and the United Kingdom will face an additional 10% tariff in February, and that will increase to 25% in June. U.S. Treasury Secretary Scott Bessent was on NBC's Meet the Press overnight, where he reiterated Greenland is a point of national security.
President Trump strongly believes that we cannot outsource our security because, Kristen, let me tell you what will happen, and it might not be next year, might not be in 5 years, but down the road, this fight for the Arctic is real. We would keep our NATO our NATO guarantees, and if there were an attack on Greenland from Russia, from some other area, we would get dragged in. So better now, peace through strength, make it part of the United States, and there will not be a conflict because the United States right now, we are the hottest country in the world. We are the strongest country in the world. The Europeans project weakness. The U.S. projects strength.
Europe, though, has vowed to support Greenland and Denmark and is now looking for a way to push back. As European leaders, EU leaders, that is, get ready for an emergency summit this Thursday. According to the Financial Times, retaliatory tariffs are on the table, targeting nearly $110 billion in U.S. goods. Now, the other option is the Anti-Coercion Instrument, or ACI, which has never been used before, but would limit American access to public tenders, investments, or service exports. This could be a big blow to big tech firms located in the EU. And overall, it could be the most serious rupture of transatlantic ties in decades.
Mind you, the US markets are shut this evening on account of a holiday, but the Dow futures are down over 400 points. So keep an eye out on those as well. Meanwhile, Donald Trump has also invited India to join his Gaza Board of Peace initiative, which aims to resolve global conflicts. Starting with the Gaza conflict, Trump has sent a letter to Prime Minister Narendra Modi that was shared on social media by the US ambassador to India, Sergio Gore. The president said it was his great honor to invite the Prime Minister to join him in a critically historic and magnificent effort to solidify peace in the Middle East, and at the same time to embark on a bold new approach to resolving global conflict.
And with that, it is a wrap on this edition of Business Lunch. Midcap Radar takes all the action forward.
Good afternoon. Welcome to Mid-Cap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra and with me as always is Vivek Iyer. Continues to be a down day. A lot of things happening. What's happening globally. Plus, our own markets have seen weak earnings coming in and some of them are heavyweight. So that's something which is weighing on the markets. Across the board, it's a red-looking screen.
That's right, Sonal, starting off the week on a very muted note. And like you mentioned, it was an earnings-heavy weekend, which is why you're seeing so much of volatility, especially as far as the broader end of the markets are concerned. FMCG stocks managing to make some amount of recovery. But a lot lined up on the show, so let's start off with the top headlines. Indian equities sulk as global markets react to Trump's Greenland tariff threats. Realty and energy are the big drags, while capital goods and power stocks eke out some gains.
CG Power shares rally after the company bags a large order worth nearly 900 crore rupees from Tallgrass Integrated Logistics Solutions for a large-scale data center project in the US.
RBL Bank shares slip up to 9% intraday as a sharp spike in credit costs and higher provisions tend to show in Q3 for the bank. The net profit misses estimates by nearly 20%.
Netweb Tech shares surged nearly 12% in trade following its Q3 numbers. The company's revenue of 804 crore rupees grew by 140% from the same quarter last year and was a strong beat on expectations.
Shares of state-owned Coal India's unit, Bharat Coking Coal, gets a bumper listing on the BOSE's share list at over a 90% premium on the National Stock Exchange.
Okay, all right, those are the top headlines, but a lot of action happening at the World Economic Forum. So let's go across to Davos, where Shireen Bhar is in conversation with Mohit Joshi, MD and CEO, Tech Mahindra.
The conversations continue here from Davos 2026. I'm Shireen Bhan, and while the focus continues to be on tariffs, on trade, let's talk a little bit about technology now. And AI, of course, is the buzzword, continues to be the buzzword. But perhaps the messaging so far has been a little bit more subtle in comparison to AI that was screaming at you last year through the course of the Davos week. Joining me now to talk a little bit about the future and the fate of Indian IT services is Mohit Joshi of Tech Mahindra. Mohit, always great to have you. Thanks very much for joining us here in Davos, and congratulations. You head to Davos on the back of a very strong quarter, in fact, the strongest quarter in the last 3 years for you.
Yes, thank you, Shireen. I'm really happy that our sort of plan that we announced to the markets back in 24 is going to plan. This most recent quarter, very strong 1.7% sequential growth, large deals at a 5-time high, 9-quarter expansion in margins, and really supported by, I believe, the best team in the industry. So feeling very positive about the company and really proud of what we've accomplished within a fairly short span of time.
Yes, that 3-year plan that you articulated and put forward in 2024. But Mohit, let me go back in time to Davos 2025. And, I wanted to make sure that my memory served me right. So I have pulled out what you said to me in Davos last year. And you said that while it may not necessarily be explosive growth, data modernization initiatives should pick up. And so if not explosive, at least close to double-digit growth for the industry is what we expect. What do you have to say now?
It's a clear mea culpa, right? A clear mea culpa. But to be fair, I think when January started out last year, it did look like spend would be quite strong. And then obviously you had the whole tariff issue in February in the US, and the sentiment went down after that. Obviously, relatively, we have performed very well, but clearly the overall spend pattern was hugely different from what we had foreseen. And again, it just goes to show that the future is very hard to forecast.
It is very hard to forecast. So let's talk a little bit about the near term. And, you talked about the Fortuous plan. 15% margins, that is the target, that's the expectation that you're working with by March 2027, already at 13%. Possible for you to advance that, get to 15% earlier?
No, I think we're going to stick to the 15% because the 15% is the average for the year, Shireen. It's not really a starting out point. So we have to, get to 15 and then maintain that or have a 15% average for the year. I do feel that we have enough levers still to pull to deliver the margin, but equally we also want to focus on growth because the second part of the plan is about achieving higher than peer average growth, which actually we already have.
What does that mean in percentage terms?
Well, it depends on whatever the peer average is going to be, right? Sadly, I do not want to be caught out twice in a row with forecasting very high growth rates for the industry. But whatever the PR average is, and I feel that the consensus just now is for somewhere between 3 to 5 to 4 to 6% for the industry, so higher than the average is what we're aiming for. But I just want to take you to the starting point, right? Look, at the starting point when we had announced this plan, we were at a margin of 6.4%. So we've gone from 6.4 to 13.1% at a time when industry margins are compressing. We're talking about us being really at the bottom of the plate in terms of growth in FY23, rising to higher than peer average, significantly higher than peer average in the most recent quarter. So it has been a remarkable journey. However, having said that, we really don't want to accelerate any commitments beyond what we have already promised.
Okay, let's talk a little bit about the environment. You know, you talked about how the expectation on spends was impacted on account of the Liberation Day tariffs. And today, we're talking about a new set of tariffs, this time President Trump imposing new tariffs on Europe and the likelihood of Europe retaliating. A large part of your revenue is Europe, 25%. How concerned would you be on account of this?
Well, look, Europe is a very important market for us, and within Europe also we have exposure to the auto business, for instance, which is a global business. But the largest part of our business is telecom, which is more of a national and a domestic business. Obviously, trade wars don't really help anybody. Massive swings in the currency don't really help anybody. But it's too early, I feel, to forecast. Hopefully, they come to a solution in the next couple of days just here in Davos. So far, the currency markets haven't really reacted very much. The pound pretty much stays at the 134, 135 level. The euro is still at 116, 117. So I feel that the market is hoping that this most recent issue, like the threat of the extra tariffs on countries doing business with Iran, should hopefully smooth over the next couple of weeks.
January is when we actually see budgets being decided. What is the indication that you're getting from clients at this point in time in terms of appetite for discretionary spends, in terms of risk appetite, in terms of incremental budgets, for AI-specific projects as well?
So again, after having been wildly optimistic
I shouldn't have brought it up.
I should only be cautiously optimistic this year. So I do feel, look, I think, as we said during our earnings call, the sentiment does look better than it did the previous year, for most of the previous year. And if you look at it over a multi-year period, right, look, I think 24 was better than 23, 25 was better than 24. So it is a slightly improving sentiment. I don't think there will be a sudden V-shaped recovery, but at the end of the day, clients have realized, which is what we'd always said, that to really get the benefits of AI, you need to, again, do the data modernization programs, the simplification programs, the modernization programs. So I do feel that that spend will come back, and people are sort of reverting back to the fact that AI is not going to be a silver bullet to transform the enterprises, and that a lot of work should be done. And even with the analyst community, I feel the sense that AI will now be a tailwind for the IT services industry is gaining hold as compared to sort of the view, 2 years back.
That it was all gloom and doom.
That, it's sort of borderline suicidal, right?
You're absolutely right, and that's what I wanted to actually, you preempted my question, because we've gone from, is it the end of the Indian IT services industry yet again, to now saying that this could potentially be a tailwind. Now, I've heard many comments coming in about this is an opportunity to move up the value chain, or this is an imperative to move up the value chain. What are we talking about? Where are we at the chain today, and where are we expected to be in this quest to kind of de-risk this model?
So look, I think if you again take the longer term perspective, right, I joined this industry back in 2000. In 2000, the industry was pretty much only in the application support space. And from there it moved to, to the development space, and now is very firmly in the transformation space. So I do feel that there is one more level we need to go. We need to move from transformation to innovation, which is helping clients understand how AI can truly transform their business from a revenue perspective, right? And I feel that is really the opportunity for the industry. The largest pool of trained AI manpower is really in India at this time. The deepest understanding of industry verticals. If I take telecom, for instance, which is such a central business for us, how will AI transform networks? How will AI transform customer relationships? How will AI transform the B2B landscape? And I feel that is the opportunity for us, whether it's through building small language models or working with the hyperscalers and the AI providers to transform our clients' businesses. That is really the opportunity. Because if we don't do that, right, then the work at the bottom of the pile, which may be pure support-related work, that will keep getting compressed. But it has been compressed anyway over the past couple of years. It is just that the compression will be sped up even further.
Okay, to avoid that compression and commoditization, which we're already starting to see, and this attempt to move up the value chain, so to speak. Now, what does that mean for you in terms of inorganic opportunities, in terms of acquisitions to actually bolster those capabilities to really dive in to the innovation side?
I feel that a lot of this will have to be done organically, right? I feel that what really needs to be done from an AI perspective, for instance, the first is making sure that we have our tooling right? At the end of the day, what is the AI SDLC tooling that we're providing for our teams? And we've given a lot of focus to that. What is the agentic AI tooling that we're providing for our teams? And whether it is through TechM, Orion, or Swifter.io, that has been a core focus area for us. The sort of related focus area is building out the use cases by industry. Then it's the relationship with the hyperscalers, the work that we're doing from a pure R&D perspective, right? Look, I think the work that we're doing for the National AI Mission, we are on Wednesday being recognized by the WEF for our Indus program as part of the WEF Minds initiative. So that's the second piece of it, right? The relationships and the R&D piece. And the third piece, which I think is really important, is how does the commercial model change now with AI, right? See, the thing is that just now, you go to a client and you say, I will use AI and give you 20% productivity. Where that 20% productivity is coming from, what tools you will use, what AI consumption patterns will you see, that is not very clear. So a huge amount of our focus has been on making the pricing for AI a lot more transparent to our clients. And if we're doing a significant project that is utilizing AI tools, how much of the benefit the client is getting is really coming from the use of digital labor, and how much is really the traditional tools like offshoring and greater productivity.
So when you talk about this pricing change and this commercial model change that is expected on account of more adoption of AI as well as more transparency, on the part of companies like yours on the use of AI, what does that mean and what are we talking about? What could this potentially look like in the next 3-5 years?
So I think over the next 3 or 5 years, what you will have is for every kind of program, right? Let's say you're doing a data migration program. For a data migration program, I can go and tell the client, this is the human labor I will be using to deliver this program, right? This is the, the subject matter expert, the program manager, the analyst, the developers. On the other hand, this is the digital labor I'll be using, right? These are the models I'll be using, and therefore this is the token consumption that will result from these models. Some of these models will be, the client's models, some of them will be ours. Some of them could come from a Snowflake or a Databricks, right? Okay. And the combination of the two is the price. See, just now we're just giving one price to the client, which is largely based on labor.
Labor, right? Yeah.
Exactly.
So what does this also then mean in terms of human labor? I mean, we've seen, your peers, some reducing headcount quite significantly in comparison to others, some actually adding headcount. Yeah. How do you see this mix change over the next 5 years?
Look, I feel that the overall size of the pie will expand, so this should still be a growth industry from an employment perspective as far as the overall industry is concerned.
What about you specifically?
I feel if I look at TechM, for instance, right, look, we have one big advantage in the sense that all of our clients are talking about the fact that now with AI coming in, the premium for experienced talent has gone up even further, right? Because experienced talent can pick up AI tooling a lot faster. And so given that our average experience is 9 to 10 years, that's a huge plus for us, and I see most of the industry migrating to, to that model. Having said that, if there is going to be indeed an AI tailwind for the industry and a significant amount of modernization and transformation programs, that should allow for an expansion in the industry size. I do feel that over time, the demand for, for experienced talent in this industry will continue to go up.
I think one of the other questions that's being asked today is the ROI question and how are your clients dealing with that question? You talked about productivity gains as well, and that debate continues as well. What are we really talking about in terms of, the average per employee in terms of productivity gains today?
Look, I just feel that the whole productivity question is, the way the productivity sort of paradigm has been rolled out, right, it's not really based on data. Because clearly nobody has a baseline. You can talk about the fact that your revenue per employee has gone up, but your revenue per employee can go up for a number of reasons, right? It can go up because of the reduction of your bench, it can go up because of a change in your on-site offshore ratios, it could go up because of a change in your mix, right? So until we get to a baseline, which is what I spoke about and which is what we have done, we actually published a paper with Forrester on that, which is about how much human labor, how much digital labor using what, what models, how much token consumption. Until we get to that sort of a baseline, measuring productivity is very, very hard because otherwise it goes back to the same issue, right? That everybody claims they're seeing a lot of productivity, but there is no revenue growth and there is no margin expansion. So it's very hard to see where productivity is going to come in. And that is because the baseline has not been established. And the commercial models for how AI will result in a change in pricing for IT services, that hard work has not been done except by us.
Okay, touche. But we've now started to see individual companies give us a breakup of their AI-related or AI-driven revenue. What do you make of that? And it's still minuscule in comparison. So what are we talking about realistically?
I just feel that any attempt, see, this goes back to the same thing, right? Because for those of us who've been in the industry long enough, this goes back to the 2010s when this whole what percentage of your revenue is digital question came up, right? And the same question again, what proportion of your revenue is AI? And at that point of time, some people insisted that everything was digital, right? And some people said, no, digital was these specific things. I think with AI again, if you have a very narrow aperture, then you're saying my AI revenue is really just the sort of work I'm doing in model building or the work that I'm doing in AI consulting, right? But that will be, honestly, a fraction of your overall revenue. On the other hand, you can have a very wide aperture, which is my AI revenue is everything which is influenced by AI. And I'd be hard-pressed to find any project in any company which is not using AI in some form or fashion, right? Either some tooling for developer productivity or some tooling to help the contact center agents. So I do feel that unless it is very clearly defined, right, it is a number that you will get which will constantly keep moving up, right? So for this quarter, our Chief Operating Officer, our CFO and I, we're very focused on working out to come to the market with some sort of metric to measure AI, which is transparent, but it equally is credible, right? It will have a credible impact on the company's performance.
So how will you define it?
Well, that's the big question, right? We will hopefully figure it out over the next couple of months. But I do feel that the way it has been defined is just too broad, right? 95% of our clients are using AI. 100% of our clients are using AI. I'd be hard pressed to find a single human being in our industry who is not using AI.
Yeah. So your point of view at this point in time is it's probably a little bit of clever marketing because, as you said, the number is only expected to increase.
The thing is, it is clever marketing. You're absolutely right, but it is because people are forcing us to give a number, right? And so people are giving very sort of broad-based numbers. I do feel the need to get precise over this is important because otherwise the number loses credibility.
So let's talk about something where we do have more credible numbers and deal wins. And it's been strong for the industry, including you, your best quarter in terms of deal wins. What's the expectation there? Is this sustainable? Is this replicable?
Well, I do think the pipeline looks good. I think the pipeline looks good. Obviously, large deals are lumpy, and so therefore you may see a variation quarter on quarter. But if I look at our own numbers, we had about 1.1 billion last quarter. And we only report net new deals, right? We don't report any renewals. So in that sense, it is much more closely tied to our revenue outlook. We do feel across the board, there is still a lot of consolidation opportunity that is coming up in the industry. And hopefully in this year, we will start to see the simplification and modernization programs kick in as well. So I do feel that the outlook going forward will continue to be strong. For us, we have gone from, let's say, the 300 million odd in large deals, maybe about 7-8 quarters back, to 800 in the quarter before the last, to 1.1 in the most recent quarter. So the momentum is forward.
Well, if the momentum is strong, let me end by asking you, not for a forecast, but really for an estimate in terms of where you believe you're going to be able to drive margin expansion, because you said you do have room for you to be able to do that at this point in time, but you're still sticking with 15% by 27. But where do you believe, what are the levers that you could optimize? What are the levers that you could use?
Sure. So I think this is something that the entire team has been working on. Obviously, the effort has been led by Atul, our Chief Operating Officer, and by Rohit, our CFO, but all the sort of business unit heads and the service line heads have contributed meaningfully. I do feel that the real opportunity for us over the next 12 months is A, to continue the work that has been successful, which is increasing our pricing, changing our portfolio mix to more of the higher margin and higher revenue productivity offerings. This year, we're going to focus a lot on productivity within our fixed price portfolio, right? Look, if you look at it, for our time and material portfolio, our margins already are above 15%. It is in the fixed price portfolio, which is about 50% of our company, where the margins are lower. And there is the opportunity again, to use AI, to use training, to use better requirements to be able to drive the margin expansion. So a combination of what has taken us from 6.4 to 13.1, plus the new focus on fixed price initiatives should get us to 15 for FY27.
So let me, wrap this up, Mohit, with the big questions that are being asked of the Indian IT services industry. You've, of course, got the H1B cloud, which continues to linger. You have, the uncertainty that the world is experiencing, and that's not specific to the IT services industry. And, of course, then there's the big AI question. As a CEO today, what are you most sort of focused on?
So look, I feel that there are obviously, a huge amount of demands on, on a CEO's time, right? I think for me, having a really world-class team has helped address these issues. In the medium to long term, you're always focused on revenue and margins. What really sort of nothing keeps me awake at night, but if something was to keep me awake at night, it is the threat of cyber, right? We are seeing a ton of our clients face cyber issues. Obviously, we have spent a lot of time strengthening our own defenses to a point where, knock on wood, I'm very comfortable that Tech Mahindra is probably the best protected among our peers. But I feel that the cyber issue remains quite paramount. A lot of our peers have been hit by it very badly in the past year. So on a day-to-day basis, cyber keeps us awake. In the medium to long term, it's obviously, the commitments that we've made from a revenue and from a margin perspective that we need to meet. At the same time, making sure that we're building the industry for the future, training our people adequately, investing as we are through Mahindra University in long-term training and long-term relevance.
So Plan Fortuous, that is underway at this point in time. Is a new plan being worked on? Is that being given shape as well as you close this one out?
Yes. Obviously, we have to deliver a new plan. I feel that we will deliver it once the FY27 plan has been successful, because there's no point in declaring a new plan when the old one is still some ways to go. I do feel that for the new plan, we will try and do the same thing, right? Which is make it, sort of aggressive and credible at the same time. I do feel that with this 3-year plan, right, we had a very aggressive plan and we had very little time. And I feel that that really helped us get to, that's helping us on the path. For FY30, we are giving some thought, and I feel that the plan will largely be about continued margin expansion, but a much more focused direction on growth.
Much more focused direction on growth as well as margin expansion. Well, we wish you the very best of luck as you close out this plan and start work on the next one. And you've been more careful this time around. So we're going to have to wait to see how the year pans out. But Mohit, always a pleasure. Thanks very much for joining us here on CNBC-TV18. Look forward to more conversations with you. Well, the issue of how do you actually measure the use of AI and how Indian IT services companies are going to build that in is the big question. And I think Mohit Joshi has given us a clear indication of how Tech Mahindra intends to do that. We are going to take a break here on our coverage here live from Davos 2026. Don't go anywhere. More headliners and newsmakers coming up right after this short break.
Okay, all right. That's a break on the Davos coverage for now. But of course, we have markets to talk about as well. Punjab National Bank has just reported numbers. The net profit is higher than the CNBC-TV18 poll, but it's the NII, which has come in 200 crore rupees lower than the poll at 10,533 crore rupees, which compares with the poll of around 10,700 crore rupees. Net profits are higher too as well. And if I look at the NPA number that the company has reported on the exchanges, the gross NPA this time has come at 3.19%. 3.49%, which compares with 3.45% on a quarter-on-quarter basis. Even the net NPAs have reduced to 0.32% versus 0.36%. The net interest margin is an important number because that is something which was expected to be range-bound. But the stock has seen a sharp, it is a sharp fall from the highs.
Almost 4% lower, and it's taking down quite a few of the PSU banks along with it. Once we get out of this particular show and come back, we will address the results of PNB down almost 4% even as we speak. But with that, it's all the time we have on this edition of Midcap Radar. Finding Alpha when we return.
Well, hello and welcome to Finding Alpha. I'm Nigel D'Souza from the Mumbai News Center. Well, what are the top sectors, stocks to watch in 2026? We have with us Nikhil Khandelwal, Managing Director at Systematics Group, who joins us on the show to share the big bets across PSU banks, SFBs, the recycling theme, as well as Pharma. We'll get the clear rationale behind each stock that Nikhil wants to talk about. Well, Nikhil, thanks a lot for coming down to our studio. And we're interested to know about the top themes that we're going to be talking about. But before we talk about that, I just want your sense, in terms of the market mode. 2025 was definitely a difficult year. But 2026, what a rocky start to the year. What is the feedback that you're getting on ground?
Right. No, thank you for having me on the show. 2026 was anticipated to be a rocky year, given what all has been happening towards the fag end of the last calendar year, and also what all happened through the entire 2025. I think we all are driven by data, and from our perspective, when we look at what's happening as far as numbers are concerned, within the entire Nifty 50 basket, when we look at about last 10 quarters of on sales growth for companies in the Nifty 50, the number is close to about 6%.
Okay.
Right. This is while accounting for all the benefits which has come in from the government as far as Indian economy is concerned, whether the GST rationalization, the income tax rationalization, etc. And on ground as well, when we talk about the consumption as a space, within the consumer theme itself, when we look at the volume demand across the larger consumption bucket, our data is pointing to a number around 3 to 4% growth. So, this data about the overall sales growth among the larger companies, and especially in the consumption basket in India, is something which has been top of our mind, and which is top of the mind of the government as well, as far as their action on ground is concerned, which they were trying to correct. But whether it is having the larger effect, I think it is taking much longer, and it will be a much harder ride. I think that is what is, one of the big factors playing into as we enter 2026. Second is our GDP data. I think the tax collection, the tax collection data, I think we are a gross tax collection over this year is about 3% or so in the first half. So to make up for the government target of about 10 to 11% in the second half, we have to have a tax collection upwards of 20%. So it's a number which is, we all know, is difficult to come by. So the data show that we are going to have a hard run as we enter into 2026 and we develop into this year.
Okay.
And on top of that, the export businesses are all, kind of suffering from what's happening on the tariff front. So a combination of these factors, we believe that 2026 will be a hard-fought year as far as equities is concerned.
Okay, all right. You're highlighting a couple of soft points out there with regard to the top-line growth as well as the tax collection. That's why we have you, Nikhil, on the show, and we want to understand some themes. The theme that you're focused on first up is on banks, and the system-wide loan growth, that's expected, I think, to be early to mid-teen in the coming year. That's going to be driven primarily by retail as well as MSME leading. But now there's hope that even the corporate books gradually starts to seeing some book. In this sort of a backdrop, I think you prefer the PSUs. Give us the rationale out there, because some of these big names, in comparison to their historical averages as well, are doing pretty okay. But you prefer PSUs. Why?
No, I think we are looking at businesses which are balancing growth and have sufficient room for valuation. I think, as I said, as I started, the markets are such, then you need to have a right balance of growth and valuation on your side. And as far as growth is concerned, PSUs over the last 18 months have been on top of their execution. If you look at the overall system-wide advances growth, the PSUs have surpassed their own history as far as the market growth by growing at close to about 13% in FY25 on advances. The PSUs, in terms of their credit quality as well, have improved significantly. Now the credit quality of most of the large PSUs is on neck to neck with the large private sector banks. On top of that, PSUs in the market where the rates cycle is on a downtrend and the NIMs of the banking sector are generally under pressure, the PSUs are actually stepping up on their other revenue, other income growth, driven by distribution income, driven by credit card growth, etc. They are stepping up. A lot of that data is something which we are seeing live on ground
over the last 6, 12, 18 months perspective. And we believe that the PSU pack, driven by the top 3-4 companies, will drive 13 to 14% advances growth, will provide very strong protection on margins, maybe even improvement on margins in certain packs, have very strong balance sheet, and are available at price to book from as the highest, probably the highest quality bank is available at 1-time price to book for a period where their ROAs, return on assets, is likely to be between 1.1 to 1.5%. So a combination of these factors, PSU has been our top pick as far as markets and in general in financials for the last 6 months, and we continue to remain.
All right. So you like these PSU banks. You believe they've upped their game. They're eating to market share, and their books as well are in far better shape. We got that. The two stocks, I believe, from the PSU basket that you like are Bank of Baroda as well as Union Bank of India. And both of them, one of the points are, both of them have that valuation discount. But that's been the trend, right? They trade at less than 1 times. And as you mentioned, the return ratios are improving. So then it should deserve a better multiple. Give us a little bit more color on particularly these two names that you like.
No, I think Bank of Baroda in particular is showing probably amongst the entire PSU pack the fastest credit growth, so advances growth. So advances growth in this bank, we are expecting that this year will be upwards of, and for the next couple of years will be upwards of 14.5–15%. The bank, according to us, besides SBI, among the larger banks, has been the most diversified in terms of its book, whether it's presence in India, its ability to provide loans to companies for their overseas investments, acquisitions. So when we talk about the overall banking space, and you touched the point about the corporate loan book as well, and we are seeing that while the retail and MSME is one category which is growing at about 9 to 10%, the corporate loan book for most of the banks and the entire sector has been a laggard. It has been growing at 1–2%. We believe it is trending in the range of now 4 to 5% as we end this year. And one of the banks which we believe will benefit the most out of this piece of growth is going to be Bank of Baroda.
All right. Bank of Baroda, and the other pick I think you have is Union Bank of India. So got that. I think we should just pull up a query because we have a query that's coming in from Shashank Taneja, who writes to us from Noida. And the query that he's giving us is basically he holds close to around 20 shares of SBI at around 393 rupees since 2021. He wants to know what is the long-term outlook on the stock. On SBI, what's the view? I mean, the gentleman from Noida is dancing his way to the bank. What would your advice be? Better times ahead, given that you're positive on the entire PSU pack?
Yeah, no, definitely SBI, even at these prices, definitely is a big positive. SBI amongst the PSUs is probably has the best mix of the levers to drive margins up. Their credit card business, while it is housed under a different subsidiary, their subsidiaries run one of the largest life insurers and mutual funds. So the bancassurance and the distribution business income, all that is continuing to kick in, and they are going to be one of the strong wealth creators in our view, even in difficult markets. So stay put with that.
All right, stay put. That would be the advice. Shashank, I hope that's helpful. But let's stick to this financial and banks theme as well. You're bullish, Nikhil, on some small finance banks. They constitute a very small proportion of the lending system. But you believe they're placed to give good returns in the next few years? Tell us the top 3–5 reasons that you believe that these small finance banks that obviously have various regulations on their lending as well as on their borrowing mix. But give us the rationale first in terms of this theme. How has it evolved?
Right. No, SFBs, as you rightly said, constitute a very small percentage of the overall banking sector. If you look at the entire credit book in the Indian market, SFBs are just about 1.5%.
Okay.
Having said that, in the last 7 years, they have grown from 0.5% to 1.5%. So they have actually taken a significant share, although with a small base. The data also is quite interesting as far as credit growth advances growth is concerned. SFBs have grown at about 35% CAGR over the last 5 years, compared to private sector banks which have grown at about 16–17%, PSUs at about 9–10%, and the overall sector growing at 12%. The entire SFBs as a pack were also, were actually created with the concept of, banks which were making a significant investment in microfinance or were very strong regional leaders. So they had a significant overhang of having their book being significantly microfinance heavy, which is unsecured loans.
Correct. What have they done about that, if you have a number?
So just to give you in terms of numbers, in 2018-19, across the top 5-6 SFBs, the microfinance book constituted between 80 to 90%, except for AU and Capital SFB, who didn't come from the microfinance background. The rest of the people, at 80 to 90% of their book was microfinance, which today is below 20%. Okay, so unsecured book has gone down from 80 to 90% to about 20%.
Got that.
Secondly, in terms of geographic presence, most of these were centered around a certain geography. AU around Rajasthan, Capital SFB around Punjab, Equitas around, in the southern market. So they have all diversified their geographic presence also. And as a result of that, now incremental, if you see the last 3 years of data, the incremental 70 to 90% of the bank branch expansions for these banks is happening outside of their core market. So they are diversifying across geography, making more secured lending book. And thirdly, in terms of the ability to sell new products, they have gone into high yield products like home loans, gold loans, etc. That piece of the book is also beginning to become more material. So combination of these factors, growth, the secured book driven lending, I think the whole pack is due for re-rating. They will be the strongest growing pack in the entire banking space. They are getting universal banking licenses. AU has already received. Ujjivan is next in line, where they have applied in Feb, and they are due to, hopefully will receive in due time. And next year, possibly Equitas will also file for the universal bank. So these banks are graduating into universal banks, which has huge trigger effects on their overall ability to grow faster. So yeah, combination of these reasons, SFB is one very interesting pack.
Well explained, well explained. We take that on board then, Nikhil. And AU Small Finance Bank and Equitas, those are a couple of names that you mentioned, but we've got a query on Ujjivan as well, which we'll address in just a bit. But on both these two stocks, AU Small Finance Bank has been quite strong actually. And I think, y'all were bullish for some time. It's closer to your target price or around those levels. You still believe the bank is well placed from here? And also the other one that you were talking about, Equitas. What kind of returns do you think these stocks can give from here, say in a couple of years from here on?
No, so I think AU is a small finance bank due to become a universal bank, but is run like a universal bank all through. The key thing which AU differentiate itself is almost close to about 90% secured book and a growth which is unprecedented in the industry at upwards of 30% over the last 5-7 years. We believe that even at this high base, AU with its strategy plan, which they have shared with the market in general, we believe that they will still grow at upwards of 20%. And with the book quality amongst the best in the entire banking space. So as a result of that, we believe that the bank will continue to get valued at somewhere between 3 to 4 times a book on a 1 year forward basis, and hence we continue to remain quite positive on AU in general. This bank will get compared with the top of the line players in the private sector, and that's how this bank will get valued.
And the other one, Equitas?
And Equitas, on the other hand, has actually runs, other than AU, I think this is the second largest SFB by loan book size. And 90% of their book also, about 85% of their loan book also is secured. But they had significant provisions over the last 12 months or so, which has all started to come off. And but the market is yet to see the benefit of low provisioning and the growth built within the entire book of Equitas. And as a result of that, the stock is trading at close to about 0.9 times book for a bank which will probably grow, in our view, at close to about 40-45% CAGR over the next couple of years. So it is basically the end of the painful period as far as provisioning is concerned, and significant growth and deep value.
Got it.
Hence Equitas.
Take that on board. Let's talk about some of those fancied sectors. Metals, they continue to twinkle. You have that melt up that's taking place. But now you believe there's another way of playing it. You're seeing a good opportunity in the recycling theme. Explain this to us.
No, so recycling as a space is something which has been catching investors' attention. There are not many listed companies. There are only about 3 or 4 large listed companies. While we look at the recycling space, we like the non-ferrous metal recycling space. And we believe that this is probably the most organized and the large-scale opportunity as far as India is concerned. And within that pack, this space, if you talk about, it's about a $30 billion industry today, growing at about 8 to 9%. But what's happening is that while we look at companies in this space as recyclers, they are becoming, they are changing their tack from being recyclers to actually recycled metal producers.
Okay.
So if you see the overall non-ferrous metal space, we have been seeing the prices of copper, aluminum, lead. They've been extremely volatile, right? And what this volatility of this non-ferrous metals has led is created a significant problem for the end user industries in terms of their procurement prices, their overall, the processing cost. Also, the energy consumption when you use the primary metal to produce the final products is extremely high.
So this is ESG compliant?
So this brings to the topic of recycled metals, and the government realized this as a very important aspect of the entire manufacturing ecosystem. So they have actually created significant mandates as far as using recycled metal for producing, for user industries like electronics, automotives, to produce their final products. They have also provided significant import benefits for importing scraps, of importing used batteries. And on top of that, there is ESG mandate, because for corporates, they need to use as much as recycled product, which leads to lesser use of energy and provides similar to better yields. Hence, recycling as a space has been, and the demand for recycled products has been on a tear. Companies are, the leading players are growing anywhere from 20% to 30-35%.
Right.
And hence, this is an area which we like a lot. We believe this is a extremely efficient way to play the entire non-ferrous metal space, and as well as the entire ESG compliance theme. Within the manufacturing ecosystem.
Got it. But the poster boy has been Gravita. But I see that on your radar, you have Jain Resources as well as Pondy Oxides. I think you like both those two. So tell us why.
No, so from our perspective, we have been looking at this industry from which are the companies which are investing in creating a global supply chain.
Okay.
Global supply chain in this industry means strong procurement globally, strong ability to sell globally. So both Jain Resource Recycling and Pondy sell about 60 to 65% of their sales is to global markets, is exports. Right. They are both LME registered sellers, resellers, and that provides them a significant premium as far as selling any recycled products is concerned.
Okay.
Thirdly, in terms of the value-added products across the copper value chain, across the tin value chain, across even the lead value chain, aluminum value chain, these two companies are ramping up capacities at the fastest pace.
Okay.
So a combination of these few factors, we believe that these two companies will provide the strongest earnings growth over the next 3 to 4 years. The one very macro picture within this recycle space is about the use of technology.
Right.
And these companies have also been have at least been talking about and exhibiting in their data as well about very strong yields as far as their recycling processes are concerned. So I think these companies are well placed, will provide significant earnings momentum over the next 3 to 4 years.
Got it, Nikhil. So we have PSU banks, small finance banks, and some of these recyclers that you're quite bullish on. I'll tell you what, we want to hear about your take on Pharma. And we've got a few queries that have come in as well. For the time being, we take a short break, come back. We'll continue the discussion. We'll also answer some of the queries that are coming. Don't go anywhere.
Fly Emirates, fly better.
Welcome back. You're tuned in to Finding Alpha, and we have with us Nikhil Khandelwal, Managing Director at Systematics Group. Nikhil, we've gone through a few sectors, but another interesting one is Pharma. And our next query actually is coming in from this sector, so I'd like to know what you like from this pack. Venkatesh Iyer, he writes to us from Andhra Pradesh. He holds around 60 shares of Sun Pharma at around 926 rupees since 2015. He wants to know the future prospects of the stock. What's your view? Pharma is an interesting space because there is still some pricing pressure in the United States, but some of them on the domestic front are doing pretty okay. So what would your advice be with regard to Sun Pharma, and what do you like from this pack?
No, I think in general, the entire pharma pack has been significantly derated. It is probably at the, from a price to earnings perspective and PEG perspective, price to earnings driven by the growth perspective, they are at one of their lowest phase. Having said that, in the entire pharma pack, I think Sun Pharma stands out as not just the largest pharma company in India, but also the fastest growing pharma company. And they continue to deliver, in our view, 10% growth on their domestic business, while having the least percentage exposure to US generics, which is actually the most riskiest piece of the portfolio of any pharma company. So within that, while they have 30% of the business from US, 10% is only exposure is to the generics part.
So the larger part is to
the specialty. So as a combination of that, we believe that Sun Pharma will it should be a must-have in your portfolio. And if somebody owns it, I think they should continue to own it going further. Also, Sun Pharma has probably the largest percentage of cash in their books as a percentage of their market cap. So almost 10% of their market cap sits as cash. So their ability to buy growth in a market which is globally so volatile, I think it is going to be a very important piece which people are missing, and that is actually going to create a lot of positive triggers as far as Sun Pharma.
But what if they are too adventurous and that cash in their books, they go to buy it very big? or they go to take a very heavy dose of the medicine, because there are those rumors. They have denied it, but will that be viewed negatively, or do you think it will fit well into the scheme of things?
No, see, all of these pharma companies are big buyers and big contenders of acquisition globally. And Sun Pharma, what we understand is they are looking for more specialty product businesses, and that is a way to go. Time will tell what they finalize on, but definitely having the ability to acquire without leveraging your balance sheet is something which Sun Pharma has. They have the ability to scale businesses. So combination of these two factors, I won't be too worried at this point of time.
Okay, all right. So positive on Sun Pharma, but you have to throw in another pharma stock as well. I believe Cipla, you believe prospects are good from there. If you could quickly run us through the rationale.
Now, Cipla also from, I think, just those two factors about very strong domestic market growth and having the right levers to grow globally. Their Indian business, we believe their business ex-US will, in our view, will grow about 9 to 10%. And their exposure to the US market is also close to about 30%. Okay. But they have a huge right to win in the inhaler, the entire category. And they have been ramping up their product basket across that value chain. And we believe that from an ROE, from a PEG ratio perspective, Cipla will give us between 15 to 20% earnings growth. So hence, it's available at quite an attractive value and should be in the portfolio.
All right, Nikhil, it's been a pleasure having you on the show. Thanks a lot for joining in on Finding Alpha, giving us those themes with the stocks backed by rational. It's been good having you. Well, on that note, though, we'll wrap up on this edition of Finding Alpha. Thanks a lot for watching.
Cool.
To understand the reasons for the day's movers and shakers.
and get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Most of the indices on the Asian market front are trading in the red.
EBITDA at 46,018 crore rupees, which was higher both on a quarter-on-quarter and on a YOY basis.
ICICI Bank actually disappointed with profit numbers because it was 4% below street's expectation.
That he likes it because he also meets a lot of business people here.
We are still on the Nifty at the 20-weekly moving average of 25,643.
Wipro could be under severe pressure. Tech Mahindra, little bit of green.
But 1,200, 1,250 lower as opposed to about 500 names which are higher.
So we think this 20% is the base case for this topping pattern that we've seen in the dollar index.
With the 80% jump, right? That's quite something. And a PSU company.
Coal India is always having a principle that our investor should be happy investor.
Indigo had already said that it has paid over 500 crore rupees in passenger compensation.
Our own markets have seen weak earnings coming in, and some of them are heavyweight, so that's something which is weighing on the markets.
Okay, well, that is the day so far. Markets down 100 points on the Nifty. From the lows, of course, I think there is a bit of a recovery which is set in. It was looking pretty down and out. 25,494 was the low. That 25,500 was the low basically, and we are about 100 points off the day's lowest level, but still off 100 from Friday's close. So that's the picture so far. Just put up the mid-cap index, which is down 0.6, and the small-cap index, which is down over 1%. And I think that is the part of the market which has got a fair bit of issues. That's the mid-cap index, small-cap even larger fall. And market breadth is, some 2.5:1 in terms of declines to advances. So 2,000 down and about 800 stocks which are higher on the NSE. So that's the NSE advanced decline. So, I mean, it's a poor trading session, but it's less poor as compared to how things were looking, about at least on large caps front than compared to where we were 2 hours back when the market itself was down. The Nifty itself was down about 200 odd. Real estate as a space is seeing pressure. And by the way, real estate has not had a great 2025. Last week, the real estate index lost 2%. Friday to Friday, it's down another 2.25% today, just in a single trading session. Oil and gas, of course, I mean, that's largely thanks to Reliance and the 3% cut there, which is under pressure. And you've also got the capital market space, which is reversing some of the gains from last week. So that's the overall sense of things. Global news flow, etc. I mean, at a peak, really at a peak, but I'm not sure that is having so much impact with what we're seeing here. It's more local. Earnings over the weekend and on Friday have not really helped. And I think all of that coming together for what has been a weak market, and that kind of sort of trend continuing on the downside once again. So 25,600 as we begin the last 60 minutes this Monday. Nigel, hi.
Well, that's right, Prashant. The broader market pain, that's something that's actually hurting portfolios. But just a few stocks, actually, I was just looking at a few stocks that have seen a very, very sharp correction. They're actually pulling back today. Hitachi stock had a one-way move from 3,000 to, I think, around 21,000 odd. That pulled back a goodish bit. Today, the stock is up 5%. Welspun Corp as well. Good numbers, good earnings trajectory. But the stock from 1,000 came down to around, I think, 720, 730 rupees odd. Today, that one as well is doing well. It's up close to around 5.5%. So big up move is what we're seeing on that name. Aurum PropTech, a small company, came out with a set of numbers. That as well has popped up in trade. And Hudson Agro, that's another stock actually that's up. Some of the top gainers, that are coming up, not Aurum PropTech. That's the stock that we're talking about. A bit of an uptick out there. But few stocks, Prashant, that are in the green. If you have some of these, you'll be happy. But a difficult, trading screen, I think so.
Absolutely. And, the probability of owning some of this, right? If you have it, great. But otherwise, I mean, it's a tough kind of screen across the board. I mean, something in the other in your portfolio is taking a knock. We'll talk more about direction broadly. But let me just quickly run you through what's coming up here. PNB reported numbers just a while back, and Gaurav will join in just a bit from now to talk about the Punjab National Bank results. Stocks, of course, I think slumped about 4% or so. We got Nifty heavyweight Reliance, which I think is a large part of the reason why the Nifty is down. It's still sort of treading water around that 1,400 rupee level, off the lows a little bit. Wipro, Tech Mahindra, some of the others, which are, of course, also moving. On the other side, you've got Tech Mahindra, which we'll talk about in a bit. And you also have the big listing, right? Bharat Coking Coal. And that's a super duper fantastic listing, day one for that Coal India subsidiary. And we'll get you excerpts of our conversation with the management in just a bit. Well, what should you do in the last hour? That's the question. Mitesh is with us to answer that question. Mitesh, good afternoon. Good to have you here. Down to 25,600 once again, and not very far away. I mean, of course, at the low point, we almost got to the low on the 12th of January, which is about 25,473. That was a big candle day, 4 or 5 days back, right? We didn't break it. We managed a bit of a bounce, but do you think, what's the direction of travel from here?
Prashant, I think, one, I maintain that the structure is on the weaker side. Till we cross 25,900 thereabouts, it might be difficult for us to get past those levels to get into some kind of a sustained uptrend. So that's one. And two, I think, very clearly, this is a market, which possibly, could see some more consolidation. But if we start breaking 25,400, 350 zone, then I think we might get into a negative or a declining kind of movement. As of now, I think I'm not sure of either direction, though the structure is weak, which means that there's a chance of at least testing this 25,400, 350. So that kind of view remains open. But for the time being, we are treating this as a range, trying to sell close to about 25,900, trying to, buy once you're close to about 25,400, which has not happened as yet, but I think it will most likely happen. So in that sense, I think, just for the timing on the index, not doing much, but, trying to see if we can get close to any of the range, and then, there's some kind of a reversal sign to take a trade. On the stock side, for the time being, I have a buy on LTIM. As I said, I think, tech is one space which is looking decent. We had a buy on HCL Tech in the morning. LTIM is a buy with a stop at about 63.30 or thereabouts, and a target of around 6,500 is what I would look for. And RBL Bank, some negative kind of pattern has happened with the gap down today. The breakdown has happened. So RBL Bank in the short term is a mild negative. So sell with a stop at about 308 for targets of around 294, 293.
Thank you very much for that, Mitesh. Lots of stocks recovered intraday, but not RBL Bank, still down 6.5%. And even Wipro nursing a cut of about 8%. LTIM, the stock that Mitesh likes, reports numbers later today, and it's expected to be a pretty decent quarter with a top-line revenue growth of more than 2%, with margins being maintained at 16%. But let's talk about Punjab National Bank. That slips after missing estimates on the net interest income and margins in the third quarter. Gaurav joins in with the fine print. Gaurav?
If you look at Punjab National Bank, it looks like there is a lot of pressure building up in the yield of advances. And the reason being that if you look at net interest margins, they are actually lower than the street's expectation. So let me take you through the numbers first. Net interest income, that actually declined almost by 4.5%. It was a bit lower than the street's expectation. And as a result, if you look at net interest margins, now it slipped down almost by 8 basis points. On a sequential basis, now it stands at 2.52%. Remember, management had actually cut their guidance with conversation with us to 2.7 to 2.8%. But even if you look at that, a 9-month FY26 net interest margins figure, it is at 2.6%, still lower than the guidance. Other than that, it was expected to see some better other income, and the reason being that they sold their stake in Canara HSBC, and actually they concluded this deal in third quarter. And as a result, if you look at PPOP, which is pre-provision operating profit, we are seeing that reflection only. We are seeing 13% increase on a year-on-year basis in terms of PPOP, and the same is reflected in profit, where we are seeing 13% growth. Another factor to consider here is that the credit cost. Now, if you look at the number, credit cost has spiked up sharply to around 78% on a sequential basis, and the reason being that bank actually created 955 crores worth of floating provision in this quarter. So two things which are required to be known from the management. First is that their view on net interest margins, as there is a lot of pressure building up, and second is that the nature of floating provision that they have created in this quarter, is it a conscious call or is it something that was asked by the regulator? So these are the two things that we will definitely watching out for. But all in all, in terms of number, because of these factors, we are seeing some kind of pressure building up in Punjab National Bank at this moment.
Okay, all right. Thanks a lot for that, Gaurav. Deepan Mehta, Director of Elixir Equities, joins us on the show. Deepan, what do you make of this set of numbers? Stock has moved to the low point of the day. What would your preference be from the banking pack, and in particular, Punjab National Bank?
I think broadly we were quite positive on the PSU banks. And if you see the banking numbers which have come through so far, there was a time when the likes of HDFC and ICICI Bank were reporting numbers which were significantly better than the PSU bank and the overall banking industry. But that's not the situation just now. And so I think one has to be very selective when it comes to banks. And more than the banks, Nigel, I prefer to go with the NBFCs. I mean, see the numbers which came from Poonawalla Finance, L&T Finance also, pretty decent set of numbers. What I understand and what I can kind of fathom over here is that there's intense competition in the banking space, and that's affecting the growth rates, affecting the net interest margins, and a lot of the profits generated are not because of, say, lower provisioning. But once the NPA cycle comes, again, that'll cause a problem. So by and large, I think so far banking results have been disappointing. But I would still go with the PSU bank because there's a good arbitrage between low P stocks and high P stocks, and that gap can still get covered.
Got that. Let's get back to Gaurav just to get a quick snapshot of HDFC Bank and ICICI Bank. These were the big numbers over the weekend. Stocks are still reacting. Gaurav, run us through the big numbers here and the highlights.
Yes, if we look at overall banking or across the market, we are seeing this trend that market is being a bit sensitive in terms of surprises. Last week we saw Federal Bank actually came up with a good set of numbers and market reacted very positively. But now over the weekend we saw HDFC Bank and ICICI Bank reported the numbers and we are seeing some kind of reaction on that. First is let's talk about HDFC Bank. If you look at the numbers, the key positives were that first is net interest margins. We saw 11 basis point of increase in net interest margins. Now they stand at around 3.51%. Second is that if you look at credit cost, now the reported credit cost that came down to 41 basis point versus what it was at 51 basis point. Street was not expecting this to decline, but there was a reason that in this quarter they actually reduced their contingency provisions worth 1,040 crores, and that is the reason why this credit cost number comes down. Apart from that, if you look at the LDR ratio, now management's commentary on LDR ratio was a bit positive. They said that by the end of fourth quarter, LDR ratio will be brought down to 95%. But what was negative is first is that if you look at the management changes, Mr. Bhavesh Zaveri, who is executive director, has asked not to seek reappointment going ahead. And second is that bank also reported 500 crores worth of additional provision because of the regulatory inspection. Now this was something that was not expected from HDFC Bank, and that is the reason why we are seeing some kind of pressure here. Apart from that, when it comes to ICICI Bank, we saw the same trend here as well in terms of credit cost. Bank reported 1,283 crores worth of extra provision because RBI found their agri PSL portfolio which was not in compliance with the regulatory requirements, and that is the reason if you look at credit cost that inched up sharply almost to 74 basis point versus the street's expectation of 50 basis point. Other than that, that is the reason why if you look at profit as well, that declined by 4%, which is 9% lower than the street's expectation. On the positive side, we saw reappointment of Mr. Sandeep Bakshi, who is MD and CEO for the next 2 years, but it looks like because of the negative surprise that we saw in terms of provision, which was not expected from ICICI Bank, given that a strong track record that we have seen for the bank so far, it looks like market has taken it in a negative way. As a result, as we speak, the stock is down more than 1%.
Thank you very much for that. Let's just quickly run through some of the other big movers today. One of them is Reliance Industries. Stock is now down 3%, 10% lower since the start of the year. This has been one of the toughest starts for Reliance Industries. With respect to the Q3 numbers were fine. The street perhaps is just a bit disappointed on the retail side. Retail revenue growth went up by 8.1%, lower than the growth rates we've seen in the past. Part of it is on account of the shift of the festive season from Q3 festive season took place in Q2 and the demerger of the FMCG business. And secondly, even the profitability. EBITDA margins for the retail business at 7.1% was also lower on account of the investments made in the quick commerce. Stock, after the fall of 3%, is trading below the 200-day moving average of 1435, so that is also impacting. Oil to chemicals was fine. Geo was in line with expectations, but here the street is awaiting the trigger in the form of tariff increases and the IPO. Dipan, you want to quickly comment? This is one of the worst starts, perhaps, to Reliance Industries. I mean, start from the year. 10% lower year to date.
Yeah, Rima, I think that Reliance is becoming increasingly a complicated company, and with no clarity coming on how the value is going to be unlocked, I think that is kind of an overhang on the investors. Like if I had the choice to buy Geo, then I would just buy that, and if I want to buy retail, I would just buy that. And there are investors who prefer old economy, oil to chemical business. They are the value investors, but they can't buy that because they're getting other businesses. So it is basically three businesses rolled into one, and then there are smaller businesses like oil and gas exploration, and then there are the new energy businesses which they're getting into. So it's a very complicated company, and somewhere one division is disappointing. It drags the overall earnings down. So I think that this underperform is sustained for some more time unless there is clarity on how the businesses are going to be split, so that investor can take a call on a particular investment theme and then select any of the Reliance divisions or then listed companies. So nonetheless, I think that's the position that Reliance is in just now. Need to take a call on how to unlock all these businesses because it is getting too unwieldy and complicated for investors to track and value.
All right, Dipan, I wanted your view on BCCL. The stock listed today with massive gains out there. Just to revise a few quick data points, the issue was oversubscribed 147 times. The grey market premium indicated that it'll be 50 to 60% higher. Well, it's 75 to around 80% higher. The reason that it was oversubscribed, it was recently priced at around 5.5 times EV upon EBITDA. It was also, priced around 8.5 times on a PE basis. So the street liked that. And that's why the most brokerages was talking about buy it for listing gains. In addition to that, it's a, it's a self, the Atmanirbhar theme as well will be playing out here, because as of now, most of the coking coal that's used is imported. So, and they have been indicating that the higher proportion of that is going to be produced by BCCL. If you look at the offtake, year to date, it's been disappointing. So FY26 is a washout. The first half of the year, the production numbers that we have. However, the street is looking ahead, and that's why they're giving it a bigger multiple. So as of now, post this listing gain of around 75%, the stock trades at around 15.5 times. That's not cheap when you have Coal India, which is its parent, that's trading at around 8 times. So that's, the kind of valuation. However, for the time being, the float is limited, and the management is promising a very beautiful outlook from here on. They're talking about a production target of 54, 56 million tons. They're talking about washery capacity going double from around 13 million tons. And remember, washery coal is important because it gets 3 times the EBITDA per ton in comparison to raw coal. And finally, the management gave us 3 big numbers with regard to 2030. Revenues of close to around 20,000 crores, EBITDA of around 5,000 crores, and net profit of around 2,900 crores. Delivery of these numbers are going to be important for the time being. Those that got in the IPO, they're dancing away to the bank. Let's hear out to the management. I spoke to them earlier today.
If you see the washery, which is the main focus of BCCL growth story, currently the washing capacity is around 13.5 million ton. We are going to make it double. Double means we are going to close to 26 million ton. Last year we supplied close to 2 million ton to steel sector clean coal, which will be converted almost 5 times to 9 to 10 million ton. If you see in terms of net realization, the net realization per ton of vast product sold to the different customer, to the steel, to the power and the other customer, and the net realization of a raw coal sold to the customer. If you see, it's almost 3 times. So we are going to get a very high net realization when we grow on washery step by step. And by 2030, we are expecting in excess of 5,000 crore EBITDA and close to 3,000 crore of PAT.
Dipan, what to do with BCCL? Those who have the stock, hold on to it. You made some quick returns, or do you believe that they're going to deliver those big numbers?
Nigel, I would flip it. I mean, we analyzed this company. And
you remember, did you get Coal India, Dipan? Because that was a far larger issue and many people got it.
Coal India is avoidable.
No, I'm talking about 2010.
No, thankfully no. So I don't want to get into any of these coal companies. But there's one point, I've analyzed this company. In 2016, their output was 36 million ton. And 9 years later, it is 38 million tons. And that's when I just stopped, and this is the problem with Coal India also, that there's just no growth rate in the overall volumes. Also, another data point, less than 10% of the coking coal is sold in the open market by Bharat Coking, So a lot of it is just, prices which is set by Coal India or by the ministry. So I'm not enthused by such businesses. And I thought 8 times was decent. It was aligned with Coal India. Now at 14, 15 times, I don't understand. And sure, I think management has got great targets, but I would get positive on this company only when I see real improvement in terms of volume growth quarter after quarter, because these PSU companies, mining companies, have disappointed a lot in the past. We have seen it with NMDC also, Coal India as well, Manganese ore also, GMDC also, that they talk about volume increases, but that never happens over a longer period of time and on a consistent basis. And you can add ONGC also to that list.
Dipan, lots of other big movers today. So you've got a JSW Infra on the way up 6.5%, on the way down RBL Bank, weak in trade. You've got a Tata Tech, NetWeb reacting to numbers. Any of these which you've analyzed and makes for an investment case?
For NetWeb, certainly I think numbers were phenomenal. And now if you look at just the quarter's PE, it is at 60 times. So it is not out of whack. I mean, if you look at trailing 12 months, it's 135 times or so. And it's been on our watch list as a measure of disclosure. And these are, I think, great new age businesses, which, you want to try and get into at the right price point where there's margin of safety and risk return profile looks interesting. And the company is also expanding its capacity. It's the only manufacturer of supercomputers, and that's in great demand because of the investment the country is making in AI and data centers and increased their AI capacity. So in fact, that's the only company, and there I think E2E Networks, that's the other company, which is L&T as a small holding. These are the only two companies, if you want to have a direct play on AI, that you can buy in the Indian market. So I think it's a special case, and certainly I would look at it more closely.
The IEX order-related moves have started. But I mean, I think, but last time we saw frenzy, absolute frenzy, right? Stock went up 10%, then ended down sharply from there. I don't think you have that kind of a move now. I'll just quickly read out what the APTL is, the Appellate Tribunal is saying. So APTL is observing the CERC Council says won't implement coupling order without regulations. I think this is, of course, something which we got from them last time also. I mean, then the usual stuff, regulators' house must be in order, must be above suspicion, something we've heard from the tribunal earlier. But the stock's not budging. It's absolutely flat, slightly sideways. I don't think there's anything new. If you go back and read what the observations, etc., and what went on in the courtroom, it's so far what we have is largely similar, unless, of course, something else comes through. We'll be on top of it and update you with information. Deepan, thank you very much for joining us. Good speaking with you here on CNBC-TV18. Thank you. Well, time for a quick commercial break here. Ronak Onkar of PPFAS Mutual Fund on the other side. Stay tuned. Coming up. Okay, well, Welcome back. About 60, 70 points lower on the Nifty. So there's a bit of a attempt at a rebound, recovery, etc. The IEX case, of course, observations from the court, etc., still coming on. And they're all there. Stocks, of course, still sideways in that sense. I think there are one or two additional lines apart from what we sort of referred to earlier. And we'll just quickly read those. Parameters for passing the coupling order are wrong. Of course, that is the IEX lawyers telling the tribunal, but that's, of course, their position, which is well understood. We have Ronak Honkar of PPFAS Mutual Fund now joining us. PPFAS, of course, is also perhaps the only institutional shareholder, the largest institutional shareholder in IEX, I think with about a 9% stake. Ronak, good afternoon. Good to have you here. So how own all of it? All of the 9%? Have you done anything with that position? And how are you viewing all of this, the case which is ongoing?
Shashank, good afternoon. Thank you for inviting me. So again, IEX is the same old story that I have been repeating whenever we have spoken. We'll wait for the actual legal proceedings to conclude. I don't want to preempt those. But we bought when we realized that the coupling order may not be coming in very soon. And as IEX has a very dominant market share in the power trading business, in the power exchange business, I think that network effect of IEX so far still remains intact. And we will see how the network effect actually changes when there is the actual regulation of market coupling and how these new platforms come up and how the market coupling is actually implemented. So far, all we have seen is the consultation paper and a lot of discussions. But yet to see something actually on the ground and affecting this business. So we'll wait and watch.
Okay. No, so the thesis will work if the market coupling order will not, I mean, doesn't come into effect. I mean, that's the call, or at least not. It'll happen slowly over a period of time. Is that the call?
There are two things here. So once the coupling regulation comes in, we'll have to see how it actually impacts the business. That is number one. Right now, we are talking hypotheticals. And the second thing is the overall volume of renewable energy or energy being traded on the exchange, that increasing over a long period of time. So we are in no hurry to judge on IEX's business prospects over 1 year, 2 year period. We are looking at the overall energy market, and IEX plays a very important role as an energy exchange. And in the long run, I think any exchange along with IEX should benefit as the volumes catch up.
Weren't this coupling supposed to happen on a phased manner from January itself? January 2026, I went back and read, right? Now, what is being said in court is that we will not implement it till regulations are in place. I am not very sure what it means. Sorry.
Neither do we know what it actually means. So we will wait for all the proceedings to conclude, and we'll see what the actual regulations are, which parties are involved. Is there a coupling software? Who is the coupling authority? How the market share gets divided? We don't know anything yet. So we are discussing hypotheticals, but meanwhile, IEX has to function the way it functions, and it has to service the exchange participants as well. So far, the business is as good as it was before.
All right. Hi, Ronak. Good to see you in. What about the cash positions? Still at 20% plus?
So we have marginally reduced it. So last time when we spoke, it was 24% last month. It's close to 23% this time.
Okay, interesting. So you'll have deployed some money. And I believe TCS is one such stock where you had a decent chunk. I think there is some lightening of position on Infosys. You could correct me on that one. But on TCS, you'll have clearly added between December as well as November. So are you all going contra now into tech? And as a percentage of your total portfolio, what would tech be? And TCS, right? I think that would be the largest chunk.
Yeah. So in the IT services piece, in the flexi cap, we have HCL Tech, Infosys, TCS. And if you see the global tech giants as well, which provide a different exposure to the global technology ecosystem, we have Microsoft, Alphabet, Amazon, as well as Meta. So we have different gamuts of technology exposure across the portfolio. IT services in particular is very interesting. Is because over a period of time, people have been on the other side where AI will take up jobs, AI will take away services revenue. Some of those things definitely will happen eventually. But at the same time, I think most investors or participants may not understand the real complexity of a lot of these projects. And some of them are people heavy. Some of them have a lot of legacy technology involved. So transformation from legacy technology to modern technology services does need IT services. So we will see how IT services as a business also scales over a period of time. But I think the valuations were very attractive at this point in time.
Okay, all right. Just a quick word on Hindustan Zinc's numbers. They're up for you on the screen. Remember, the total traded float is very limited. But first, look at those numbers. It looks like it's better than what we were estimating. We already had the volume numbers with us. That was a little bit disappointing. But clearly, if you look at it on the top line, on the EBITDA front, as well as on the profitability front, they've done very, very well. They gained because zinc prices moved up by more than 10% on a sequential basis. And the silver prices, from quarter to quarter actually effectively doubled. Though they won't get the full benefit of the silver prices because they had hedged it at a lower price. But quarter 3 is looking better than expected. The valuations are at the upper end or above the upper end. However, quarter 4 could be promising as well, going by the solid move we have seen in the prices of both zinc as well as on silver. We'll wait by for further details, but otherwise, those numbers on expected lines, a thumbs up, a little better than expected.
Ronak, hi, Rima here. Overall, what is the market mood? So far, it's been a very cautious, risk-off start to the calendar year. Since you've marginally brought down your cash holding, what does it tell us about the way you view the market?
So if you see overall, last year has not been very great for the market. Valuations have been trending downwards. And wherever stocks were very, very expensive, you are seeing a lot of time correction happening in those names. But over the period of time, whenever we find some stocks in our grocery list, they look attractive, we do tend to add on to those positions. And that's what has happened. So existing stocks got a little bit of top-ups. Even a couple of new stocks we have added in the last few months. So I think that's a little bit of marginal addition. But again, overall, it's still expensive. We are not finding great opportunities. Wherever we found good ideas, we have deployed.
REITs, is that an area which interests you?
Yes. So we have a REIT portfolio. We have 3 REITs in our Flexi Cap fund. But again, REITs are now considered as equity. So most of the REITs came in even before the regulations came in. We have enabled the provision to add REITs to the Flexi Cap portfolio. And the yields have been quite reasonable. And over there, you have a little bit of capital appreciation possible as the value of the portfolio goes up. And at the same time, you have some rent escalation, which protects you a little bit of inflation over a long period of time. So it's a fascinating hybrid kind of a play where you invest in REITs.
All right, we'll leave the conversation here. Thank you very much for joining in, Ronak. We will slip into a break. On the other side, we'll get you a check on what dealing rooms are saying in our segment D Street Chatter. Also, a few BTST calls lined up with our technical expert. Welcome back. Let's get a handle on what's happening in the futures and options space. Nigel has moved over to the F&O world.
Well, Rima, yet another sluggish trading session. But if you look at a couple of positives, when the Nifty at least has defended the 100 DMA mark. So we've seen a bit of a bounce from there. And in line with last week, well, we've seen a bit of a bounce from those levels itself, at around 25,500 or thereabouts. So the Nifty defends the 100 DMA. The Nifty Bank, that's the important one, because that's seen a big bump up actually from the lows. It's defended the 20 DMA. Moving to the options data, the PCR has moved to around 0.86. Remember, that had gone down to around 0.75 earlier today, and that's popped up a little bit. And there's action on both the sides, whether you're looking at the put sides or the call side. But it appears that just in the near term, the bulls and the bears, they are preparing for a bit of a range. And tomorrow, these contracts will expire. So the writers are making money, actually. 25,500 put. The more or less flattish, earlier, just a few minutes ago, it was actually in the red. Though you're getting the direction right, you're not making big money if you're buying a put. Similar is the case on the call side as well, the 25,600 call. The premium out there was down close to around 50%. So writers, they're making the money. Individual stocks, though, they're doing a thing of their own. And you shouldn't lose sight of that. Because yes, the market's in a bit of a sluggish phase. But individual stocks are doing very well. Bank of India, that stock has been holding strong all through the trading session. There's a short covering bounce that's played out there. ITC, that's the other big heavyweight that's corrected from 400 to around 325. That as well has come in for a short covering bounce. While on the flip side, a couple of earnings reactions, Yes Bank, RBL Bank, fresh shorting being seen on those counters. And Wipro as well is seeing some fresh shorting out there. So net on the index, the recent low is very important. Otherwise, you could drift another 400 points to around the 200 DMA. More or less, we're in that band, but tomorrow, the weekly expiry could give some kind of volatility yet again. Back to you.
Okay, thanks very much, Nigel, for that. Let's go across to Nimesh now with what he's got on D Street Chatter and what he's picking up about the market. Nimesh, what do you have? Markets first.
Hi, Prashant. A decent recovery from the intraday lows today. But I guess there is a bit of nervousness because of the geopolitical risk. And also the earnings have not been too supportive. Over the weekend, most of the large cap names slightly came as a bit of a disappointment. So ICICI Bank is down, Reliance is down, so is SDFC and some of the RBL banks of the world as well. So that leg has not been firing as far as earnings are concerned, which had an impact on the Nifty as well in today's market. I guess from a flow perspective, again, a mixed day, not very aggressive selling. In fact, there is a bit of buying interest in the PSU names, so the oil PSUs as well as the PSU banks is where I understand there is a bit of bid interest from larger institutions. Technically, 25,450 is a level to watch on the downside. I've been saying this for a while. That's a big support level. If that gets broken down, you will see further selling on the Nifty and the large cap names. So that's the level to watch on the downside. And also, if you look at the PCR, it actually recovered from an intraday low of 0.7, now back to 0.86 odd level. So even Stevens in terms of PCR. But I guess from a market direction point of view, there is a bit of nervousness because of geopolitical risk and the earnings have not been supportive.
Okay, Nimesh, but as the markets are sideways and generally thanda, more than thanda in the freezer, there's enough happening on the deal side, right? I mean, fundraise, M&A, you name it.
Well, absolutely, Prashant. So, a couple of names which will be in focus tomorrow. The first is part of my chatter list, Bazaar Style. That stock has been a big mover in the last couple of days. Friday, the stock was up 15-16%. Even today, the last one I checked, the stock is up 10% and good volumes as well. There is a board meeting scheduled for tomorrow for fundraising. And I understand there is going to be a strategic investor who's going to put in money via preferential warrants. In fact, it's a listed entity who's going to buy nearly 12-13% stake in Bazaar Style. So it's something to watch out for. And there is a board meeting scheduled tomorrow. So that's the first name. The second stock is Kalyan Jewella. It's been under pressure for the last couple of days. There is selling pressure is what I understand. And also now there is a chatter that maybe a large block is around the corner in Kalyan Jewellers. Remember, the promoters can't sell because they're in a cool-off period. So the non-promoter entity could be a seller in this block. So that's the buzz there. The third name is Polycab. We saw a big reaction on Friday towards the end because of earnings. But seen a recovery in today's market. A couple of reasons. One, the street was short. There is a Morgan Stanley tactical buy today morning. And also, it seems like the selling pressure from the domestic mutual fund is largely over. So that led to a bit of a pullback in Polycab today. And last couple of names where there are block offers, REC as well as Samudra Motherson. Looks like there is selling pressure. It has recovered from intraday lows, but there are offers from larger institutions, both the names. So could be, there is high delivery, but that could be largely on the sell side.
Nimesh, Style Bazaar listed entity. It's a retail company.
It's a retail company, Prashant. Largely they have a presence in say Bihar, UP, Northeast, Calcutta, and those places. So and what I understand is the entity which is going to buy a 10-12% stake via preferential warrants is basically an FMCG company. So a unique deal wherein an FMCG company is going to buy a stake into a retailer. Basically for the front end. So let's see what the official announcements come, but looks like that's the deal. And actually the stock is reacted because the 6-month average was on the higher side. So My guess is the warrant which the company is going to put in is going to be close to today's market price of around 320, 325. So that's the range which has been indicated. So let's see. The board meeting is tomorrow, so obviously the announcement should come by end of tomorrow's evening, but tomorrow's close.
So imminent, basically. We don't have to wait very long. Thanks very much, Nimish, for that. Mitesh is joining in with a quick. Sorry, go on. Just to reiterate what we've been reporting earlier as well. Tomorrow there is a board meeting for Restaurants Branch Asia as well, and Vivek has reported few times in the past as well. Even there, it looks like there is the deal is quite imminent and might get announced as well. Also, I highlighted a few days back that maybe watch out for UPL. There could be a filing for the Advanta IPO. I mean, that looks like it's around the corner. So, while the market have been quite sideways and subdued, there is a lot of deal activity happening in the listed space. Yeah, no, absolutely. And I think on Friday you had mentioned Sun as well as Street being a little worried about a large acquisition, and that, of course, story coming in today. Thanks very much, Nimish. More later. Mitesh is here with what to buy, sell today for a reverse trade tomorrow. Mitesh, what do you have?
I think, Prashant, on the buying side, I'll stick with the tech team. Tech Mahindra is a buy, or BTST with the stop at 1714 for targets of 17.50 or 17.55 on the upside. And the other stock is SCVT on Uno Minda with the stop at about 1162 and a target.
And Uno Minda. Thanks very much, Mitesh, for that. Let's cut across to my colleague Shireen, who's in Davos at the World Economic Forum in conversation with Kenneth Rogoff, Professor of Economics at Harvard University.
The conversations continue here at Davos 2026. As I've been pointing out, this is a Trump Davos. President Trump is going to be here. He's going to be speaking at the World Economic Forum. He's going to be meeting with leaders from Europe, and he's doubling down on his ambition to get Greenland. That's just one of the issues up for debate and contention here. What about the global economy? 3%, 3.2%, that's the expectation that we're working with. And so far, the economy has been resilient. Stock markets have been fairly resilient as well. Joining us as always here in Davos for a global check and a pulse read is Kenneth Rogoff. Professor Rogoff, always a pleasure. Many thanks for joining us here on CNBC-TV18. It's great to have you back in Davos.
Yeah, great to be here and a pleasure to see you again this year.
So let me start with the Trump question. This is a Trump Davos, as I pointed out. What is the expectation? What do you anticipate he's likely to say?
I mean, I live in the United States. Every day he comes up with something new. When he invaded Venezuela, I woke up and said, well, I'm glad he didn't invade Harvard. You know, you just don't know what's
Venezuela,
next.
no one's talking about here.
That's incredible. I mean, he invades, he sort of says he's going to run Venezuela, and they've moved on to the next issue. It's remarkable. And I think there will be a next issue. I mean, I wouldn't be surprised if he announced the new Fed chair here. That would be possible. Who knows? I mean, he'll find something. But I think he's come here to buy Greenland. I mean, that's what his ambition is.
He's doubling down on it.
Yeah, absolutely, absolutely. I don't exactly understand the purpose or the dynamics around it. I mean, that's another story. But I've been coming to Davos for 25 years now. I have never seen the Europeans so upset. I mean, when Putin invaded Ukraine, they were very upset. This is a whole nother level. He's invading Greenland, and there are 56,000 people. I mean, then he's going to take Switzerland. Then he's going to let Putin take the Baltics. Then he's going to let Putin take Poland. Then he's going to, take Spain. I mean, it's just, an absolute frenzy. They're hysterical.
Well, I would imagine that that the reaction is, in your words, as you point out, hysterical on the European side. But the tariff question at this point, and we don't know which way the Supreme Court is going to rule, or whether we will have a Supreme Court ruling that coincides with Davos. Irrespective of the way that the Supreme Court rules, do you believe that tariffs are here to stay in some form or fashion?
Oh, yeah. I mean, there's no question about that. If the Supreme Court rules strongly against Trump, and I think it will be more mildly against Trump, but even if strongly against Trump, there are other things he can do. But I will say that this is a very clever move by Trump at the Supreme Court, because the whole debate there is that Congress has the right to set taxes. What are you, President Trump doing? Setting tariffs, which is a tax, even if he denies it. And he says, his lawyers say, tariffs are an essential tool of foreign policy. Foreign policy is presidential first. And by doing this Greenland maneuver, I need tariffs so that I can take Greenland, which we need for national security.
Yeah.
This is also directed at the Supreme Court.
Well, we cannot preempt what the court will do, but you talked about the Fed chief, and you're one of the signatories of a letter that's been written by all central bankers, including, of course, central bankers outside of the U.S., talking about the need for central bank independence. This DOJ investigation into the central bank's operations in the U.S., I mean, we saw the markets react to that, but what do you believe will be the medium-term to long-term implications of how this plays out on central bank independence?
I think it's important to understand that both sides in the U.S., the progressives, the left, the Democrats, and I want to call MAGA Republicans, neither of them like central bank independence. The Biden administration was pushing the Federal Reserve to do social justice, the environment, inequality, far outside its remit and distracted from its main problems. And I think they were, if I teach at Harvard and I talk to these progressive intellectual leaders, and they would like to bring the Fed back into the Treasury and be able to control it. And Trump does for completely different reasons. I mean, Fed independence is a pretty new thing. I actually think I wrote the first paper on it 40 years ago, and there weren't independent central banks. And I think it's worked very well, but it's fragile. And so the central bankers are defending it fiercely. I think the DOJ investigation of Powell, it's not just about Powell. He's going to be able to appoint Powell's replacement. Powell will no longer be chair. But the new chair, whoever it is, needs to get other votes. He can't command the Fed by himself. So I think Trump is showing all the governors, I can find something on you also. You want to vote against me? This is what's going to happen. So I think it's meant to provoke other resignations sooner than otherwise. This is part of a process of taking over the Fed. And needless to say, sorry for the politically incorrect phrase, but this is banana republic stuff. I mean, this is what you see in an emerging market with weak institutions. Erdogan in Turkey tried this for a long time. He fired one central banker, then another central banker, and another central banker every time they tried to lower interest rates. And of course, inflation went through the roof. I don't think inflation is going to go through the roof under Trump. Let me be clear. It's a slow crawl that'll go up. But it's a big mistake. But I will say he's not stupid. I think he understands it. I really do. But in Trump's mind, it's a small price to pay for winning the midterms. Near term, getting interest rates down probably helps him for a little while, maybe even a couple of years. In his mind, winning the midterms is all about, controlling the borders, DEI, foreign policy, and he thinks he's the best, and the Democrats are awful, and you need to give him power. If we have to have some extra inflation, I don't care. I mean, dare anyone read into his mind. But I think he understands it's a risk, and he thinks it's a reasonable risk given the stakes in his mind.
Speaking of the Fed, we don't know, but it's being speculated that perhaps an announcement could be made here in Davos or even right after President Trump departs from Davos. Do you have a guess on who could replace Jerome Powell?
I mean, I had thought it was 80% it would be Kevin Hassett, who I think is a very good economist, by the way. A lot of my colleagues don't like him because they think he's too Trumpy, but I think we're going to get someone Trumpy, and Hassett is actually quite a good economist, and I think he'd be fine in the job. But that said, Trump made this announcement, I love you, Kevin. You're so good on TV. But when you're in the Fed, you're never on TV. I want to see you on TV. I'm sorry. But, this is what you just never know what he intends. But it could be Kevin Warsh, who...
I was going to ask you, one of the Kevins.
Yeah, I mean, Kevin Warsh would be a very strong appointment. Also, there's one or two other names. I have no idea. I mean, look, Trump is the master of theater. This is one of his big announcements. He's making the most of it. But I may be wrong. I still bet on Hassett.
On Kevin Hassett as the next Fed chief. But let's talk about rates, because you said that it is in his interests to ensure that rates are lower than where they are currently. But what does that signal then to the market if he does in fact kind of impinge on the independence and drive down rates further?
So a very basic point that is hard to explain, but I'm going to do my best, is the Federal Reserve controls the one-day interest rate. That's all it controls. It doesn't control what mortgage rates are. It doesn't control what car loans are. Those rates depend on the market. The market thinks about, well, you're cutting rates today, but you shouldn't. Eventually, inflation's going to go up. I'm not going to make a 10-year loan at a lower interest rate if inflation's going up. So when he pushes rates down too hard, too fast, the longer rates that we care about actually go up. And so that's the tension. But that can take time. He's looking at the midterms. For Trump, this is, an existential threat. My goodness, if the Democrats won big enough in the Senate and the House, they could really impeach him for real. I don't think that's going to happen.
Welcome back. Last few minutes left for today's trading session, but Ambrish Balika, independent market expert, joins us on the show. Hi, Ambrish. Good afternoon. Good to see you. Been In times like these, you go back to some of those quality names that have given returns in the past. I believe one such name is PI Industries. It's on your radar. Tell us more why.
It's a leading agrochem company, also a biologics and CRDMO player in pharma. R&D again is a focus area, about 700 scientists. They have 70 live projects currently, 210 patents, 8 new molecules went into commercial production in the last 6 months, and they have 90 molecules in the pipeline. Domestic agri brands business is decently large, about 15,000 distributors, more than 1 lakh retail touch points, and Q2 earnings were a bit muted, but the pharma revenue showed extremely good growth. So Q3 and H2, both I think should be better. Management has guided a EBITDA margin of about 26 to 27%. Revenue growth CAGR expected over the next 3 years is about 10%. PAT CAGR is expected to be about 11% to 12%. So expected EPS for FY28 is 128, and my target price is 4,480, which is about 30% more than where we are right now.
Interglobe Aviation looks like is going to be the top Nifty gainer, ending with a gain of about 4%. Street seems to think it got away lightly with respect to a DGCA penalty, just 22 crore. So in light of the chaos and the crisis that took place in December, Street seems to be saying that it got away okay. Ambrish, thank you very much for joining in. What about ICICI Bank? It's been reporting stellar quarters. This quarter, of course, there is that provision that the company is, the bank has had to take. But then the overhang of Sandeep Bakshi not being there, I mean, that has also cleared out for the next 2.5 years. Is ICICI Bank a buy at this juncture with the 2.5% fall?
See, looking at the market weakness and the correction which you're seeing in ICICI Bank because of that additional provision as stated by RBI, I think we can see slightly more lower levels, maybe about 1275 to 1300 levels. I think at those levels, it could be bought from a longer-term perspective.
And Reliance Industries, it was anyway down 7%, but it's taken another knock, 3% lower post numbers.
Yeah, but I don't know why the Street was so disappointed because more or less, the earnings were as per expectations. Yes, this time, Reliance did not surprise majorly on the positive. So maybe that's a disappointment. But again, Reliance is a stock which can be bought at the current levels. Again, if you're talking of a long-term investment, say the next 2 or 3 years, 1400, 1425, goodbye.
Just a quick word on CG Power, right? Ambrish, any thoughts here?
No, CG Power, I don't track it very closely, so it's a bit difficult for me to really comment on that.
Anything in that space you've had coverage on? Transformers and the likes?
Not really. Not in transformers.
Okay. CG is up, Hitachi is up. But of course, CG's got a bit of help with that order for data center in the US, and Hitachi is just, I think, just a one-way fall, and now a bit of a recovery there coming through. It'll be interesting to actually speak to some of these companies and ask them about the big copper price impact, right? What is the impact? How are they dealing with it, etc. So that's the other issue, and of course enough to talk about with actually companies in this space. But there's a fair bit which has happened today in terms of individual moves. So maybe just a bunch of names, right, before as we wrap up things. Ambrish, stay with us. We're going to just come back to you after a quick wrap out. Grow was the big loser in the broader space. RBL Bank, of course, down sharply. Cupid will come up on your screen. Big correction. IDBI down. HBL down. Prime Focus back at about 220-ish levels. MRPL, Fed FINA, Kernex, Dredging Corporation. Just a few names which, not HP, that's HBL engines, which saw a sharp correction. Prime Focus, MRPL, Fed FINA, Dredging, etc. are some of the others. On the upside, Indigo, we were talking about CG Power, Hitachi, we discussed. Polycab, a bit of reversal after Friday's sell-off. Style Bazaar is the other one. There's Welspun Corp, which of course has sold off quite a bit from 900 to 700 levels, but I think a bit of a bounce coming through on this one as well. So that's the overall picture. By close, about 140 odd points down, 25,560 is where we finally end at. The low was just under 25,500, so not a 100-point bounce from the lows by close, but I mean, some 40, 50 odd points off the low is where the Nifty finally closed at. It's a wrap on this edition of Closing Bell. From all of us here, goodbye. Thanks for watching. Markets Forward will pick up on all the action. Ambrish, of course, will weigh in as well. Stay tuned.
Markets end with sharp cuts, but off intraday lows. Nifty closes below 25,600, dragged down by heavyweights. Over 30 Nifty stocks close in the red, with most sectors ending lower, while FMCG manages to buck the trend.
Sun Pharma is eyeing US-based Organon in a potential $10 billion deal, sources tell CNBC Avas. The drug maker is looking to acquire majority stake in Organon Pharma or purchase select assets.
Tech Mahindra gains after beating estimates on most parameters, while Wipro takes a drubbing as it falls short on growth expectations. Tech Mahindra management tells CNBC-TV18 while the third quarter was strong, it is currently hard to forecast the future. However, maintains 15% margin target for the year.
Bharat Coking Coal makes a stellar debut on the bourses with the stock listing at over 95% premium to its offer price of 23 rupees. The country's largest coking coal player has given a strong guidance for FY27.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all of the key data points to gear up for the next trading day. I'm Ritu Singh. With me is my colleague Vivek Iyer, and what a volatile day we've had. The markets under pressure recovering from some of those lows, Vivek, but still ending with cuts of about 108 points on the Nifty and 324 points on the Sensex. The pain in the mid-cap and small-cap especially stands out, Vivek.
Absolutely. Good afternoon, Ritu. And, like you mentioned, a very volatile trading session. Remember, we had a lot of cues coming into trade today morning, especially given the fact that it was an earnings-heavy weekend. All of the banks, majority of the banks that were heavyweights as far as the Nifty Bank were concerned, came out with their results. So we expected them to react. And as expected, ICICI Bank, HDFC Bank were sharp movers today. Even Reliance Industries and some names from the IT pack, names like Wipro as well as Tech Mahindra, actually saw sharp moves. On the back of that, like you mentioned, a very volatile trading session is what we witnessed.
Yes, banks, IT pack, all of those names were in focus today. But here's a lineup of what we have in store for you today. We start with the top movers and shakers of the day with Hormas. Tech Mahindra surged after beating estimates in most parameters. Wipro, however, slipped on the back of weak fourth quarter guidance, while CG Power edged higher after securing an order that was worth nearly 900 crore rupees. Last but not the least, we will delve into the key market events to watch out for tomorrow's trading session.
Well, thanks so much for taking us through our viewers of what exactly we have lined up on the show. But we can now kick off the action on Markets Forward with the wrap of today's market action. Over to Hormas, who's standing by the wall.
Well, it was an impressive recovery, if you could call it that, from the lows of the day. But the day was dominated by earnings reactions, and earnings reactions both on the banking side and on the non-banking side. One of the major reasons for the Nifty fall is on this list. That is Reliance Industries, ending 3% lower today. But take a look at Hindustan Zinc. Numbers were out just before market close. The stock ended 3.5% higher. The accident of the day was Wipro, an 8% lower on the stock. Multiple downgrades coming in. Price target cuts coming in. JSW Infra as well had an impressive session, almost 5.5% higher, and Jindal saw the top gainer on the Nifty 500 today, almost 16% higher in an otherwise volatile and wobbly market. These were the non-banking earnings. You take a look at the banking earnings and you will understand the second major reason for the Nifty fall. That's ICICI Bank, still ending 2% lower. As a recovery from the lows of the day as well, but Reliance and ICICI Bank both played their part in dragging the Nifty lower today. RBL Bank was 7% lower. PNB at one point was down almost 5%, still ended 3.5% lower, and IDBI Bank too ending almost 6% lower in today's trading session. Beyond earnings, there were a lot of other newsmakers as well. Interglobe Aviation, of course, after the DGCA action, 4% higher on the stock. Polycab, after brokerages raised their targets to as high as 9,500, ending 4% higher after its results. CG Power, after that big order win, ending with gains of around 5%, and Bazaar Style Retail, that fundraising plans in the works, ending almost 14% higher in today's session. A sector that has been sulking all through the last few weeks has been real estate, and today was no different. Godrej Properties is now at multi-year lows. Brigade is at 52-week lows. Signature Global is at 52-week lows. All of them ending with losses anywhere between 3 to 5%. And Aditya Birla Real Estate too, not having a very good day at the office either. And some of the other names that ended at a 52-week low in today's session, Tejas Networks continues to underperform. 4.5% higher in today's session as well, in lower actually. Sapphire Foods and EMS also ending at 52-week lows, as did Indegene, losses of around 4%. So more red than green, but the index managing to hold on to some key levels in today's session.
All right, Hormas, thanks very much for taking us through that list. But we're going to zoom in on the IT pack. There you had Tech Mahindra, which surged after beating estimates in most parameters. But on the flip side, you had Wipro, one of the top losers today, slipping on the back of weak fourth quarter growth guidance. Reema Tendulkar is here to wrap up all of the action from the IT space when it came to earnings. Reema.
Thanks so much for that. Let me start with Wipro, where the street is disappointed with the Q4 guidance. For Q4, that's the Jan to March quarter, the company is guiding for 0 to 2% growth. But analysts say that this includes a 2-month contribution from an acquisition that they did, the Harman DTS acquisition, which according to some estimates could contribute 150 basis points. which means if you strip out the benefit of the acquisition and look at the organic revenue growth, it would stand at minus 1.5 to plus 0.5%, which is lower than the growth the company had in Q3, which is why the street is so disappointed with the guidance. The management attributed the guidance to fewer working days and delayed ramp-ups in certain deals that they had won earlier in the earlier quarters of FY26. Also, FY26 would mark perhaps the third consecutive quarter of a decline. Morgan Stanley today downgraded the stock to an underweight. In fact, 47 analysts track Wipro, and out of them, 36 of them either have a hold or a sell rating, according to Bloomberg. Tech Mahindra, on the other hand, is having a good session, led by a beat on revenues and on margins. Margins for the company have been a very solid story. From a low, a trough of 4.7%, they now stand at 13.1%. This is the 9th consecutive quarter of a margin expansion, and the company remains on track to achieve its guidance of 15% margins by the end of FY27. And the company's aspiration is also to achieve industry-leading revenue growth. JP Morgan has upgraded Tech Mahindra to an overweight. Back to you.
Well, thank you so much, Rima, for taking us through two of the top moves in the session today. Wipro seeing a sharp fall, while Tech Mahindra doing quite well despite the market volatility. But it's a good time to go across to our guest, Amrish Balika, independent market expert, and Jay Thakur of ICICI Securities. Good afternoon, gentlemen, and thank you so much. Well, Amrish, let me come across to you first. You just heard Rima talk about both Wipro as well as Tech Mahindra. Divergent trends across both of these names, divergent results as well. Within the IT space, where does your top pick lie? And do you believe that the worst is over for the IT pack?
See, the worst may not be over for the IT pack. Although the commentary which is coming is slightly on the positive side, but I would still wait for a quarter or two more to see the consistency before really jumping in. But in the pecking order, clearly among the larger ones, it will be TCS, then possibly HCL Tech. And among the ones which we spoke, Tech Mahindra surely would be there because of the sort of earnings they are showing. So I think the upside for Tech Mahindra could be about 1900, 1925 possibly. But something like a Wipro, I think should be ignored because, if you look at the last 8-12 quarters, I think most of the quarters they have disappointed than surprised. So I think Wipro clearly is, off the table.
Jay, is it the same for you? Is Wipro completely off the table? It's been underperforming and, the guidance has been lowered quarter after quarter. That performance is really not coming back on track. So on Wipro, what are you going to do? And on Tech Mahindra and some of the other IT pack as well, very bullish and very bearish.
Hi, good afternoon to you, Ritu and Vivek. Absolutely. IT pack is quite mixed, I would say. A couple of months ahead, when overall IT pack was correcting, Ritu, the mid-cap IT names were relatively outperforming the large-cap IT names. And there came November, December short covering in the overall IT pack, mainly the large-cap stocks, wherein even the stocks like Wipro, in fact, had seen a good short covering, and we saw index bouncing back from 34,000 to 40,000. Now, after 40,000, after index hit those levels, where it previously had reversed from, I think now it has become very selective, very stock specific, and post results that's coming out very clearly. So if you see then Infosys, HCL Tech among the large cap stocks are clearly the outperformers, not only from the result point of view, from the price action as well. So I think there has been a good amount of shorts out there in Infosys, and post results we have seen some short covering happening. So my preference would be HCL Tech, Infosys, and thereafter TCS. As a disclaimer, I would say that TCS we have recommended to our clients as well from the medium to long term perspective. After 4 quarters, there has been a positive close. So TCS has a good room to see some short covering going forward, at least until the levels of 3,500. So these are the 3 stocks which we like. Absolutely not Wipro, because we have seen the results as well as the price action and the derivative data is not at all supportive. However, from the mid-cap stocks, Tech Mahindra has provided a fantastic breakout today with a long build-up clearly. So that is one stock which can be looked in, along with LTI Mindtree. I think these are the 2 names which I like, and are likely to outperform the other IT names. Stocks like Tata Tech, Tata LXI are still not showing that kind of a momentum or a price action. But LTI Mindtree and Tech Mahindra, these should be the good bets within the mid-cap IT names.
Right. Well, thank you so much for that, Jay. One pocket of the market that was in focus on the back of earnings was IT, but the Nifty Bank too was in focus. Remember, over the weekend, especially on Saturday, you had a whole slew of large private banks declaring the results. Gaurav joins in with more details on how exactly banks fared as far as Q3 is concerned.
Let's begin with Punjab National Bank, the latest one. We saw a fall after their Q3 results, and the reason being that if you look at net interest margins, they declined by 8 basis points. And not only this, if you look at net interest margins, they are still lower than their own guidance. Other than that, let's also talk about big names like HDFC Bank. We saw net interest margins actually improved here. Second is that credit cost, that also improved, and at the same time, LDR ratio, now management said that it will be brought down to 95% in the next quarter itself. But apart from that, there were two negative news and which came in as a surprise. First is that Mr. Bhavesh Zaveri, who is executive director, said that he will not be seeking for reappointment. And second is that bank reported 500 crores worth of additional provision because of the regulatory inspection. As a result, we saw some pressure in this counter. When it comes to ICICI Bank, the same set of number is what we saw in terms of provision, because they reported 1,283 crore rupees as an extra provision because RBI asked them to do so as their agri PSL portfolio was not in compliance. As a result, their credit cost increased, profit declined almost by 4%, and this was not taken in a negative positive way by the market. The stock was down more than 2%. Other than that, let's talk about RBL Bank. This saw one of the biggest falls in this year so far, and the reason being that although net interest margins they improved by 12 basis points, on the flip side, credit cost increased almost by 40 basis points, and the key reason was credit card segment. Now, management also said that in the next 2 to 3 quarters, the stress in credit card segment will remain, and as a result, we saw market did not take it in a positive way. When it comes to Yes Bank, we saw asset quality improved, and at the same time, net interest margins also improved. But on the other hand, ROAs, although they reached 0.9%, but this was because of the 555 crores worth of the gains that they reported because of the security receipt sell. And if we exclude that, the ROAs still remain flattish on a sequential basis. Apart from that, management also indicated 8% growth for FY26, which they were earlier indicating to be in double digits. So that was something which was not taken in a positive way. And lastly, let's also focus on IDBI Bank. Now, this bank was in focus because of the stake sale from the government. But in this quarter, if you look at net interest margins, they declined almost by 19 basis points. And after that, we also saw some pressure in this counter. So all in all, throughout the weekend, except for UCO banks, the banks which reported numbers, we saw some pressure in that. And even for Punjab National Bank, because of the net interest margins that declined, we saw some bit of a pressure after its results in a day-to-day.
Wow, Gaurav, that was exhaustive and comprehensive. Thanks very much for taking us through all of those numbers. Ambrish, your view on the banking pack, specifically ICICI Bank now, typically it's been an outperformer in the private space, but, this additional provision that RBI seems to have asked the bank to make has dampened spirits, despite the fact that, Sandeep Bakshi is getting this 2-year extension, which the street was looking forward to. Your view on stocks like that, as well as HDFC Bank with the lingering high LDR concerns?
Both these stocks have fallen more due to their provision than anything else. And the way I see it is possibly it's a one-time sort of a provision, may not get repeated. So ICICI Bank, I really don't see it going below that 1275, 1300 levels. So because of this weakness, it comes to those levels, could be a good time to buy. At the same time, I would be more bullish on the PSU banking space. May not be PNB after the sort of earnings they have announced, but something like a SBR or Bank of Baroda, surely I'll be more bullish than the private sector space.
So more bullish on the PSU banking pack, especially some of the larger PSUs versus the private banking space is what you mentioned. But moving on, the shares of CG Power rallied after the company bagged a large order worth nearly 900 crore rupees from Tallgrass Integrated Logistics Solutions for a large-scale data center project in the US. Winnie joins in with more details on this large order win.
Well, thanks for that. Yes, CG Power was a stock that was in focus today. The company has won a 900 crore order. This is for US data centers. They won these power transformer orders, which they'll make for Tallgrass. Now, the execution period for this is 12 to 20 months. The transformers will be designed, manufactured and tested in the manufacturing facility in India. The order backlog, when you look at it for the company, is at around 13,500 crores. This was as on 30th of September. Power segment accounts amounts to around 40% of their total revenue. Now, why is this important? Because it's an important big data center order, that's an export order that they have, and a big one that's coming for the company. This aligns with CG Power's strategy that they've been talking about, opens long-term opportunities for the company in the international market as well, in the data center projects segment, especially US as well as worldwide. Now, analysts expect power as well as OSAT to be a high growth segment for the company, margin accretive business as well, and this is something that they expect will outpace industrials in terms of overall growth for the next 2 to 5 years, and that is why CG Power was buzzing in trade.
You're absolutely right, Vinny. CG Power, one of the sharp movers in an otherwise lackluster market, you could say. Well, Amrish, if I could come across to you, shares of CG Power, shares of other capital goods stocks, especially a name like BHCL, saw significant selling pressure, multiple worries. They spoke about possible Chinese competition as far as domestic tendering is concerned. Do you feel some of the concerns are overdone, or do you feel these stocks could still correct further, especially as far as valuation multiples are concerned?
No, valuation multiples I'm not really too bothered about, but then I think these stocks are correcting because of the Chinese competition which is being talked about. But even that, I think, is being overdone. It could be basically, you could have the Chinese companies coming in basically for the goods and items which are not being manufactured in India. But then as far as the Indian companies are concerned, I don't think one should be too worried. So, I would surely utilize this correction to buy into the capital goods space because clearly, if we're talking about the next 3-4 years, the spends are going to increase, no doubt.
Any view on CG Power from you? And also this new listing we had today, Bharat Coking Coal. Strong listing for the company. Is that something you're looking at as well? Jay, if you can hear me.
Yeah, sure. Ritu, well, see, CG Power, as that is concerned, I would say that recently the kind of fall which we have seen since past 3 months, almost we have seen this stock falling, and it had provided a monthly negative close. In fact, the month prior to that, the 4th month was almost flat. So since past 4 months, we haven't seen this stock performing, and whatever fall we have seen coming in this stock was mainly on account of long unwinding. We did not see any short build-up here. However, since past 1 week, what we have been seeing is that at the lower levels, there has been a good volume activity. There has been a good increase in the volumes, better than this past 1 or 3 months average. And with today's up move, there has been some long build-up as well in the F&O data. So for the short term, I think that there could be a good bounce till 640, 650 levels, which could be another 10% until 570 levels are held. So in the short term, it could be a buy on dips. It could be a good long trade. But from the medium term perspective, Ritu, I believe that the stock may continue to trade within this range of 650, 700 on the upside to 550, 500 on the lower side. So short term, it's a good buy. But from a medium term, I think it could see some consolidation as the momentum is not that supportive from a medium term point of view. As far as the new listing is concerned, it is not in the F&O, it's in the equity cash segment, so I would not be able to comment on it.
All right. Ambrish, do you have any view on the new listing we had today, BCCL?
The Bharat Coking, I think your listing was much better than what was expected. We were expecting a listing at about 35, 36 levels, but then the sort of a listing was really huge gains. So I think because of that, we saw some correction post-listing. I would suggest that one should look at buying this maybe only at levels of about 35, 36. At the current levels, I'm finding it a bit expensive.
Well, thank you so much, Ambrish, as well as Jay, for joining us on the show today, giving us a view on the markets, individual stocks, as well as technical levels. Well, with that, it's time for a quick break on the show. On the other side, we get your key market events to watch out for tomorrow's trading session.
Welcome back. You're watching Markets Forward. Now, third quarter FY26 is expected to be a better quarter compared to the second one for India's capital goods players. Now, this is led by post-monsoon recovery, strong order inflows and execution by high voltage power OEMs. The rest of the industrial plays is to be a mixed bag. The important drivers for capital goods companies in the third quarter was healthy execution momentum across T&D-led projects and product companies. Second, execution of robust outstanding order books, on the third quarter estimates. That's as far as your capital goods space is concerned. But Vivek?
Well, no, we had CLSA's Lawrence Bellangco today, and he believes that the dollar weakness could continue in 2026. He adds that a weaker dollar setup is constructive for broader emerging markets. Further, he's quite cautious on silver at the current levels and says aluminium has seen breakouts from a key level. He also anticipates a breakout in Indian mid-caps after a 24-month consolidation period. Let's listen in.
If you look at the mid-cap sector, that's probably the one that we're most constructive about for 2026. We've been consolidating there for nearly 24 months. And I think a meaningful break through the 62,000 area for the mid-cap space gives us upside of over 30%.
All right, and before we wrap, we'll bring you some of the key market events to watch out for. As always, Gaurav Javalkar is standing by with the key events for tomorrow's trading day. Gaurav?
Yes. If you look at the Indian market result, third quarter's result is something that we will be closely tracking, and we have got a couple of companies which will be in focus. First is Persistent System, Gujarat Gas, EU Small Finance Bank, Cyan DLM. All of these will actually come up with the results. Apart from that, ITC Hotels, Jammu and Kashmir Bank, Mastec and Supreme Petrochem. Now, if you look at these companies, some of them, they have already reported good set of numbers in pre-quarterly updates like EU Small Finance Bank and the J&K Bank. So let's watch out for these. Apart from that, World Economic Forum's annual meeting is happening in Davos, and we at CNBC will be bringing you exclusive interviews from some of the top managements. Apart from that, core data, that is something that we will be tracking because the index of 8 core industries, they will release their data for the month of December. Remember, this is actually important to see how the trends are happening at an industrial level. Restaurant Brands of India. Now, this company is going to be in focus because tomorrow is a day when they will be having shareholders meeting and they will be discussing, actually board meeting, where they will be discussing the fundraising issue. Apart from that, from the global fronts, first is that the US market will be in focus because US Supreme Court is expected to issue the next ruling for several major cases, which can also include the legality of Mr. Trump's global tariffs that he has put on all the other countries. Other than that, the ADP employment change weekly data, that is something that we will be closely tracking from the US market, and from the Chinese market, we will be tracking the loan prime rate for 1 year and 5 year mortgage. So let's watch out for all these events and see if they have any grip on the Indian market tomorrow.
Well, thank you so much, Gaurav, for joining in and giving us all the key and important events to watch out for in tomorrow's trading session. Earnings killer, it looks like. But with that, it's all the time we have on this edition of Markets Forward. From Ritu and myself, we will be back with more news and updates on the other side.
Welcome back. You continue to watch our coverage here from Davos 2026, the World Economic Forum's annual meeting. As I've been pointing out, this really is a Trump Davos. What is President Trump going to say? What is he going to do? What is the European response going to be? To answer all of those questions, I have with me a man who did predict, as part of his global risk, the fact that we are going to see a U.S. political revolution as the #1 risk, and of course the Don Roe doctrine as another key risk that the global economy was faced with, and what happens to Europe. Ian Bremmer, thanks very much for joining us here on CNBC-TV18. It's great to have you back.
Sure. Yeah.
Well, all of those risks even more amplified today.
Yeah, it is that way, and the United States is driving global uncertainty today. It's not conflict in the Middle East. It's not what Xi Jinping is up to. It's what's happening in the White House domestically in the U.S. in a political system that's much more divided and dysfunctional, and internationally in a global system where the United States is ripping up the old rules, whether it's collective security or free trade or rule of law, all the things that the Europeans really need, all the things the Europeans rely on. And now today, this week, they feel like they can't get them from the United States.
Is it the end of NATO?
If Trump persists in requiring control of Greenland, it is the end of NATO, if he does that.
He's doubling down on it.
It's
so
very
far.
unpopular in the United States. It's unnecessary for U.S. national security. The Danes are a very close ally, or have been, and they're willing to provide whatever national security access the Americans need. But Trump has decided that's not what he wants. What he wants is his name on the territory. And look, historically, he has been very successful putting his brand on many things, on TV shows, on buildings, on the Kennedy Center in Washington, D.C., but on foreign territory is not one of them. And Denmark and their European allies strongly oppose this, and Trump's going to have to back down. If he doesn't back down, he's going to have a big fight in his hands, and he's going to have the end of the transatlantic alliance. Yeah.
You know, there's no sign or indication of him backing down just yet. What do you expect the Europeans to say when they do meet with him here in Davos? We saw that joint statement coming in, and it was, you know, as opposed to the commentary that came in the previous week, this has been a very different tone that Europe has taken now with this Greenland threat. What do you expect the Europeans to say to Trump here in Davos?
Look, the conversation that the Danish and Greenland foreign ministers had with J.D. Vance, the vice president, Marco Rubio, last week were actually quite constructive. And the Danes explained the red line of sovereignty and territorial control, and the meeting did not break over that. They said, okay, let's find a constructive way to move forward. That is not what we've heard from Trump. It's not what we've heard from Stephen Miller. So, I mean, the question you're asking is, you know, how to predict what Trump is going to say on any given day. He's a unilateralist, and his interests are not always aligned with those of the United States of America. That's a problem, right? The Americans have this core issue where they've elected somebody who frequently is more interested in his personal enrichment and his personal embellishment than he is in what's good for the country. And the CEOs won't say that, but I'm not a CEO, so it doesn't really matter. That's a reality. And privately, everyone is concerned about this. How can you find a way to assuage Trump's ego the way Nobel Prize winner Maria Machado did when she visited him for lunch and gave him her own Nobel? Thank you so much for helping us in Venezuela. What can the Europeans do? What are they willing to do to make Trump look like a winner, but also maintain control over Greenland? And is there a way to navigate that? If you were negotiating with Marco Rubio or J.D. Vance, no problem. But you're not. The President of the United States is a different animal.
Well, we'll see what happens on that front. But, you know, you brought up Venezuela. Nobody's talking about Venezuela at all. It's almost as if it never happened.
Well, maybe in India. In the United States, people are talking about Venezuela every day. In the United States, every day. It is a big change in the Western Hemisphere. It puts a lot of pressure on Nicaragua, on Cuba, as countries that are adversarial to the U.S., puts pressure on Mexico and Colombia, allies that aren't doing enough from the U.S. perspective on interdicting drugs, on dealing with the narco cartels. And, of course, there's the question of what's going to happen with the world's largest proven oil reserves. They aren't U.S., not Saudi Arabia, Venezuela. And the Americans have said they're taking control of that oil. But the oil companies aren't ready to invest. So how is that going to work out? all of these things are very big questions, and this is still getting news every day in the United States, I promise you.
No, it is getting news in the United States. I'm saying that it's probably not top of mind here in Davos because Greenland is, and that's more topical and relevant to Europe. But what do you see as the next steps as far as the U.S. strategy for Venezuela is concerned? You're right in pointing out that oil company CEOs are apprehensive about putting down top dollars at this point in time, given the uncertainty around the situation.
Well, it would take a very long time to actually recoup those investments, as we saw from Darren Woods, the CEO of ExxonMobil, talking directly to Trump in the White House just over a week ago. We're talking about $100 billion necessary over 10 to 15 years to get Venezuela back to 3 million barrels of production a day. They're at about 600,000 barrels of production a day right now. That can happen with support from the World Bank. That can happen with proper investment and with proper governance structure. None of those things are certain today. And the thing is, if you're the CEO of an oil company, your expected timeline of investment is a lot longer than Trump has in office. So you can't just rely on what President Trump is telling you. You have to actually think about what's going to happen beyond that. That creates an asymmetry in the conversation, very different than the 6 months of planning that went into the very successful military operation to remove Nicolas Maduro from power in Venezuela.
What about Ukraine? You know, again, no breakthrough. We were talking about it when we met last year. What's the read now on Ukraine in light of what is happening with Greenland?
The fact that the United States is demanding territorial control of Greenland and that is taking up most of the oxygen in Davos this year means that the Russians don't want to sit down and discuss anything on Ukraine. They can hope that American pressure on Europe breaks the NATO alliance, breaks the transatlantic alliance. And if that were to happen, support for Ukraine from the United States would probably go away. And the Europeans are paying all the money, but the Americans are selling the weapons, and the Americans are providing the intelligence. So ultimately, that's a big win for Putin. If you are Russia right now, even though you've lost 1 million soldiers, 1 million casualties in this war, even though you're not taking very much land, it's not going the way you want it to go, the broader direction of Trump is very much aligned with what Putin wants to see strategically. It's good for him, it's good for China, it's bad for American allies, so you keep fighting. You keep fighting and you make life a lot worse. You increase the pressure on Ukraine, you increase the pressure on frontline European states, and you make the other European states like Italy and like Spain, the southern Europeans, you make them wonder, their publics wonder, why are we doing this? Why are we supporting the Ukrainians? Why are we going against the United States? That's not a good idea for us.
So a breakthrough in 2026, or do you believe that this war is going to continue?
There is increasingly capitulation from Ukraine. The Ukrainians are now saying that they are willing to accept a demilitarized zone in some of the territory that they occupy. Their troops would pull back even though they're not ready to renounce sovereignty. They're willing to talk about even holding elections while the war is still going on. Those are things that Zelensky just a month ago was not willing to consider because of the pressure from the US, from the Europeans, and the pressure from having to continue to fight Russia for almost 4 years now. They're a much weaker country, a much smaller economy, much smaller population. So if there is going to be an end to the fighting, I fear it is because of Ukrainian capitulation, not because the Russians are coming to the table and they're accepting European, American, Ukrainian terms.
If you're China today, what do you think Xi Jinping is thinking at this point in time?
Well, he just had a day with Mark Carney, the Canadian Prime Minister. That was a relationship that was considerably worse a year ago than it is today. Most of the reason for that is because of the breakdown in the U.S.-Canada relationship. We are seeing India. Modi has stabilized his relationship with China to a significant degree. I think he would have done that anyway, but certainly the fact that the U.S.-India trade relationship still is not done, the Indians are feeling that the Americans are less reliable, is a motivating factor to stabilize the relationship with China. Long-term, America's tactical unilateralism is a benefit to the Chinese. America is the most powerful country in the world. That's true. But a return to the law of the jungle does not work for America because Trump is not the most powerful leader. Xi Jinping is. Xi Jinping does not have midterm elections in November. He doesn't have to worry about term limits. He doesn't have an independent judiciary. He has a communist party that he has a monopoly of control over. Trump has none of those things. So long term, the ability of China to articulate a strategy and follow through on it and be reliable for other countries around the world is significantly greater than that of Trump's United States. And of course, that is something the Chinese intend to profit from.
So do you see a big reset even between Europe and China?
Not yet, but I think that if the Greenland crisis explodes and undermines the transatlantic relationship to the point that it breaks, I think China will be a beneficiary in Europe as well.
So, you know, the odds of that happening, how high are they today, as of today?
I think the odds of that happening today are maybe 1 in 3. I think 2 weeks ago they were maybe 1 in 10. But I think your level of confidence in those odds, very low. And they're low because Trump has the ability to change his mind tomorrow. There was a period of time when Trump was talking about making Canada the 51st state. I never thought that was credible. He never had a military option on the table, but he stopped talking about it. You know, Trudeau was gone, Mark Carney came in, Trump said it a couple times, and then Carney came back and he said, we will not accept this, and we don't care what the costs are. Trump backed off. But the point is that the Europeans need to stand up to Trump on this issue. It's easier for them to do because it's not popular in the United States to vote loser, right? Red land and blue land, a lot more popular in the U.S. than Greenland is, right? So they need to back off. But they only back off if the Europeans are seen as strong by the Americans, right? I mean, Trump has 2 different modes of foreign policy. He's got the FAFO mode, fool around and find out, which you get if you're Venezuela and Ukraine. He's got the taco mode, Trump always chickens out, which you get if you're Russia or you're China. Right now, Trump believes that the Europeans are FAFO. And the Europeans need to convince Trump that they are actually taco. And that is going to require both military response and economic response that is strong, unified, and credible. We will see this week what we get.
Retaliatory tariffs?
Certainly that should be a component of that if the Europeans want to be treated credibly by the United States.
So let me end by asking you, Ian, as you know, we deal with the geo-fragmentation, the geo-economic confrontation, the spirit of dialogue clearly, as the World Economic Forum would like us to believe, you know, that's not evident. Do you see space for any kind of discussion or dialogue?
Well, you've been talking to me about the geopolitics, and the geopolitics are in recession. It's a G0 world. It's not a G7. It's not a G20. It's not a G2, as Trump said after meeting with Xi Jinping. Not at all. But of course, the multinational corporations here, the big banks, the crypto companies, the AI companies, they're having a completely different Davos. And for there, the spirit of dialogue and investment and raising capital has never been stronger. So let's not forget that there's a completely second Davos going on that has virtually nothing to do with all these concerns that you're raising.
Well, that is correct. Yeah. And that Davos is, as you point out, in a super cycle of its own. But yes. Ian, always a pleasure. Thanks so much for joining us. And we look forward to seeing more of you. And hopefully, if there is, in fact, a breakthrough here in Davos, look forward to having you back with us on CNBC-TV18. Thanks very much for your time. We are going to take a break here, but the conversations will continue. We're going to be back after this short break. Don't go anywhere. Stay tuned.
The alpine town of Davos feels the chill as the World Economic Forum kicks off with US President Donald Trump putting Europe on notice. Doubling down on his Greenland annexation ambitions, President Trump had over the weekend threatened to levy additional tariffs on 8 European nations opposing his plans. A spirit of dialogue is the key theme at the annual huddle of the global elite, something Trump has made a mockery of ever since he returned to the White House for a second presidency. The US president is also leading the nation's largest ever contingent to Davos. He will be accompanied by Treasury Secretary Bessent, Commerce Secretary Lutnick, among other top officials. He is scheduled to address the gathering at Davos on Wednesday. Leaders of 8 European nations slammed President Trump's tariff threat over Greenland and hinted at retaliatory measures. French President Emmanuel Macron has called for activating a trade bazooka against Washington, while British Prime Minister Keir Starmer called for a calm discussion. Washington, however, is confident that Europe will come around on Greenland.
European leaders will come around and they will understand that they need to be under the U.S. security umbrella. What would happen in Ukraine that if the U.S. pulled its support out? The whole thing would collapse. That the U.S., Kristen, to be clear, since 1980, the U.S. has spent U.S. military spending versus NATO military spending. We have spent $22 trillion more dollars than the Europeans have. That we are peace through strength. And the Europeans now are only trying to play catch up. And that is only through President Trump. President Trump believes in NATO, but he does not believe in the American people being dragged in.
On Greenland, the right way to approach an issue of this seriousness is through calm discussion between allies. And let's be clear, the security of Greenland matters. The use of tariffs against allies is completely wrong. It is not the right way to resolve differences within an alliance. Nor is it helpful to frame efforts to strengthen Greenland's security as a justification for economic pressure.
I think you must follow more than one track. I mean, we have been asking since the very beginning of this to have a constructive dialogue with our American ally and friends, free from social media and headlines and strong words. And we opened that dialogue last week. We will not give up on that.
We're concerned about this escalation. To be absolutely clear. We always will support sovereignty and territorial integrity of countries wherever their geographic location is.
Top economists and officials from the World Economic Forum also weighed in on the tensions between the US, President and European countries. Speaking to Shireen Bhan, Harvard professor and economist Kenneth Rogoff said that European leaders have never been this upset at Davos. Meanwhile, WEF President Borge Brende expects both EU leaders and US officials to have tough dialogues at Davos this year.
I've been coming to Davos for 25 years now. I have never seen the Europeans so upset. I mean, when Putin invaded Ukraine, they were very upset. This is a whole nother level. He's invading Greenland, and oh, you know, there are 56,000 people. I mean, then he's going to take Switzerland. Then he's going to let Putin take the Baltics. Then he's going to let Putin take Poland. Then he's going to, you know, take Spain. I mean, it's just, you know, in absolute frenzy. They're hysterical.
Denmark, Finland, France, Germany, Netherlands, Norway, Sweden and Britain saying that they stand in full solidarity with the Kingdom of Denmark and the people of Greenland. Tariff threats undermine transatlantic relations and risk a dangerous downward spiral. So how do you now see this reshaping and redrawing fault lines in 2026?
I think there will be tough dialogues between these European leaders. All of them are here in Davos in the coming days, and President Trump. So there will be very interesting for also the media to follow this. I think there will be candid discussions.
The International Monetary Fund has revised India's growth forecast to 7.3% for the current fiscal year. The IMF has also projected global economic growth to moderate to 6.4% in FY27. Ritu Singh joins us now with all of those details. Ritu, take us through what the report says.
Well, the IMF's latest World Economic Outlook shows India leading the growth story. India's GDP growth has been revised up to 7.3% for FY26, driven by a stronger than expected third quarter and solid momentum in Q4 as well. Growth is then projected to moderate to 6.4% in FY27 and remain there in FY28 as cyclical factors ease. Now, globally, growth is holding steady. The IMF now sees 3.3% global GDP growth in 2026, which is up 20 basis points from October, and 3.2% in 2027. But these steady headline numbers are masking the divergent forces that are at play. Trade policy shifts are a headwind, but AI and tech-led investments provide a strong tailwind, particularly in North America and parts of Asia. Advanced economies are expected to grow 1.8% this year and emerging markets by 4.2%, with China and India driving much of the momentum. Inflation is projected to ease globally from 4.1% last year to 3.8% this year and 3.4% next year, while world trade growth slows down before recovering. A key driver of global resilience, though, is US's investment in information technology, particularly in AI, now at its highest share of GDP since 2001. Now, this surge, IMF says, is boosting business activity and also spilling over to Asia's tech exports. The IMF says that on the upside, faster AI adoption can lift global growth by 0.3 percentage points, but on the downside, any AI correction can also shave off 0.4 percentage points. Overall, risks to the outlook are to the downside. Besides AI, any renewed trade tensions, geopolitical shocks that could drag growth. And the report even makes a reference to what seems to be the ongoing tensions between the US president and Fed chief, warning that any political interference in independent economic institutions can raise the risk of policy mistakes and erode public confidence.
All right, Ritu, many thanks for those details. But going back to all the action from Davos, Tech Mahindra MD and CEO has said that the company is confident of beating the industry's average growth. Speaking to Shireen Bhan, Mohit Joshi said that the gloom and doom around the IT services sector has been lifted. He added that the company will announce a transparent and credible metric for pricing the use of AI into deals.
I do feel that we have enough levers still to pull to deliver the margin. But equally, we also want to focus on growth, because the second part of the plan is about achieving higher than peer average growth, which actually we already have.
What does that mean in percentage terms?
Well, it depends on whatever the peer average is going to be, right? Sadly, I do not want to be caught out twice in a row with forecasting very high growth rates for the industry. But whatever the peer average is, and I feel that the consensus just now is for somewhere between 3 to 5 to 4 to 6% for the industry, so higher than the average is what we're aiming for. And even with the analyst community, I feel the sense that AI will now be a tailwind for the IT services industry is gaining hold as compared to sort of the view,
that it was all gloom and doom.
That, it's sort of borderline suicidal, right?
And speaking of Davos, Suzlon's Girish Tanti has announced the appointment of a new CEO for Europe on CNBC-TV18 Live. Tanti has chartered a hybrid future for the company as it hopes to transition from being just a wind energy player. Take a look.
Effectively, with the electrification and the demand that we are seeing across the world, almost all nations, there is a good portion of green energy adoption that's happening. So we've kind of looked at the key markets where we believe that in today's new organized world of multipolarity that we have, but still we see that I think there are excellent opportunities for renewable energy and wind energy in specific. So we've targeted Europe as one of the key markets.
Okay.
In fact, today itself, we've just announced our CEO for Europe.
And we'll continue to bring you all the action from Davos. But for now, let's shift our focus to the day's market action. Dalal Street ended with cuts after Nifty heavyweight slipped after Q3 earnings results. Nifty failed to hold levels above 25,600. More than 30 Nifty stocks ended in the red. Barring FMCG and auto, all sectoral indices also closed in the red. And from equities to commodities, oil prices softened as Iran's deadly crackdown on protests reduced market fears of U.S. intervention that could disrupt crude supplies. A rise in U.S. crude inventories also pushed prices lower. Remember, oil prices touched multi-month highs last week after tensions in Iran escalated. Meanwhile, both gold and silver prices climbed fresh peaks today as investors flocked to safe haven assets amidst intensifying geopolitical tensions. This after Europe will retaliate to US President Donald Trump's threat to impose tariffs over the control of Greenland. Optimism that the US Federal Reserve will cut rates also supported prices. And with that, it is a wrap on this edition of Business 360. More news and updates continue right here on CNBC TV 18.
Davos continues to be the focus here in Davos continues to be on AI adoption, but more importantly, from an India standpoint, what AI is going to do to transform the Indian IT services industry. If last year there were question marks and some amount of, in the words of some of our speakers, gloom and doom around the India IT story and what AI could potentially do as a disruption, today the mood has changed. In fact, Indian IT services companies now talk about AI as being a big tailwind. One of the companies that's at the forefront of saying that, and in fact calling it out independently by way of revenue as well, is HCL Tech. In fact, let me just throw some numbers your way. It's the fastest growing large cap tech services company for the 4th year running, reported 148 million in advanced AI revenue, one of the first companies in the Indian IT services pack to do so. CVK, always great to have you join us here in Davos. Thanks very much for your time. You're speaking to me after a very strong performance, not just for the last quarter, but for the year. You continue to be industry leading in terms of growth. How confident do you feel about being able to better that?
First of all, thank you, Shireen, for taking time to talk to us. Of course, we are very happy with the performance. But what we are truly excited is the opportunity that's ahead of us. while AI is a big inflection point in the industry, we've been very proactively looking at how to transform our services without worrying about any potential deflation or cannibalization of existing revenue streams. And I think that proactive approach has helped us really land very well with our clients in transforming the existing services. But what's even more exciting is a lot of completely new opportunities. Like in the tech vertical, there is close to $1 trillion of capex, which is, some of it is already done, some of it is in the anvil. Now, every one of these big programs will need significant services in terms of planning out data centers, the professional services, the GPU infrastructure, and the managed services around that. I think that's what we call as AI factory. That's a brilliant, very big opportunity. It could very easily be $1 billion revenue stream for us in the coming years. And there are many such revenue streams that we've identified, and it's still early days, but we have some head start, and that's why we're calling out our advanced AI revenue.
So let's double down on that. You said that these could potentially be $1 billion revenue opportunities for you in the coming years. Could you give me a more definitive timeline? And you also said that you've identified a bunch of these opportunities. What would those be?
So I started with talking about AI factory. I think it's a very small service line within the whatever 150 million, which is about $600 million annualized revenue. It's probably less than 100 million. We think it can get to $1 billion kind of revenue stream in 3 to 4 years. And similarly, physical AI is again a very, very big theme. It's about, while a lot of things have talked about in agentic and AI in software development operations, physical AI is all about AI's ability to understand, sense, understand, and act with respect to the physical objects, whether it is warehouse management, port management, vision, all of that is what we call as physical AI. It's robotics plus AI infused workflows. I think that's very well placed into our engineering heritage because a lot of these companies, we've been working with them on their mechatronics and a lot of other areas. Now it logically extends itself. I think physical AI, it's actually $1 trillion industry by 2030. Okay. That's what the analysts talk about. But if I take the services, the places where we can play, that can also be another $1 billion opportunity. So I think we are just identifying these completely new areas. These are not where the traditional IT services we were constantly focused on. So while existing business will see some deflation, you can grow your wallet share and continue to offset that. But I think these new opportunities are really exciting.
So, this 145 million revenue number for advanced AI that you've reported, on the back of what you've just explained to us, what could this number, because this is still very small, a proportion of your overall revenue, what could this number look like a few years down the line?
I think we are thinking of at least in the next 2 to 3 years, we should get to $2.5 billion in size on this completely new service lines. These were not existing. This is not about modernizing existing services through AI. These are completely new discretionary spend areas.
Okay, so $2.5 billion over the next few years.
It's an aspiration, but of course, we have to see where it goes.
That's what you're working towards. So I want to then understand from you how things are also changing from a commercial model point of view, how things are changing when you talk about pricing as you bring more AI into the fold, between humans and agents. I mean, how does the pricing model change, for instance?
I think it's still evolving, and there is no one silver bullet as to how do you price it. But at a conceptual level, moving all the work to outcome-based engagements, that's really where the value is. And instead of really looking at time and material or even output-based, can we focus on an outcome? Like a simple thing, like if you're really focused on a business operation where employee claim settlement, right? For example, somebody puts in a claim, it gets reimbursed after a week or so. But everything can be completely, the receipt can be read automatically. It can figure out it is for food or hotel or any other expense, put it in the system, validate it, and the payment can be done the same day or next day. So you're really focusing on end-to-end value chain and focused on an outcome. If you can commit to a client that you will deliver all their claims within the same day or next day, then I think that takes out so much of clutter in the entire system. So I think it's more outcome-based constructs.
So
which will work.
in this pivot and transition to outcome as a service, what is it going to mean in terms of the kind of capabilities that you need to double down on? What does it mean in terms of hiring? And also I wanted to bring your view in on the impact of the labor code and whether this is a one-time or we are going to continue to see some impact of this as it plays out.
Yeah, specifically on the labor code, a significant part of it is a one-time provision. Ongoing basis, it will have a hit into our cost structures. I think we called out about 10 to 20 basis points kind of impact on an ongoing basis. And coming to your earlier question on outcome as a service, here, of course, it's not just the technology capabilities, right? It's not about just agent take or infusing AI. It's again understanding the business process and really reimagining the business process so that it really becomes a seamless, which truly leverages the AI capabilities to deliver a superior experience and much better cycle time and things like that. So I think a good amount of process and business understanding in addition to the technical understanding and capabilities is what is going to help.
So, you know, speaking of capabilities, will you be looking now more actively at acquisitions to try and bolster the capabilities that you believe are going to be required in this new world?
Certainly in areas like physical AI, in agent take and some of the AI-led services, we're always on the lookout for either hiring the top talent or even acquiring capabilities, which is going to strengthen our overall offering.
What seems more likely?
Both. I mean, there's enough things to be done, and it's like how this whole space is now about the speed, right? How can you get the maximum speed in terms of scaling up your AI talent as well as capabilities? So there's really no time limit. It's really urgent, and we're always looking.
So what happens from a workforce point of view if Indian IT services companies are moving up the so-called value chain? What does it do to the kinds of people that you're going to be hiring, the specialized workforce that you will perhaps need to kind of hone in on? What does it do to the entry-level jobs as well?
I think it's really the emphasis is shifting from quantity to quality. This year, so far, in the 9 months, we've hired over 10,000 fresh talent. And here we are really focused on more elite engineers who have much higher aptitude and much more faster in learning and kind of ambitious about how to use these technologies. So we're really looking for high aptitude elite engineer cadre. I think that's where there is going to be a lot more traction as we see.
You know, let's talk about some of the risks, and I think the global uncertainty and of course, you know, the geopolitics of it continues to be a concern at this point in time that weighs on investment decisions. But what we've seen happen for not just for you, but for the sector at large is the deal wins have been very, very strong for every company. What do you make of that? Is that on account of the fact that we're seeing this pivot and this transformation to AI and so on and so forth? I mean, what do you account for the strong deal wins that everybody's seen and registered?
I think AI is significantly accelerating the urgency with which our clients or enterprises need to look at what they want to do, right? Even in the traditional services like an application development and modernization, can they significantly reimagine their application landscape using AI? Then they have to do it as soon as possible. So we are seeing large opportunities where we take over a large application landscape and completely modernize it with an AI-led approach. And those kind of large opportunities are there. And in fact, we announced a mega deal with a global apparel retailer, which is we become the AI technology partner for them in completely modernizing their landscape.
You know, so what are clients asking of you when we talk about outcomes, and we were just discussing that? What are they asking you to do for them with the use of AI?
I think the most common ask is the software engineering. how can you deliver it 30-40% more efficiently, right? While there are tools available today, like coding assistants and things like that, they help deliver some level of efficiency. But if you look at the software development, there are many elements. So how can we give them confidence that we deliver value in every part of the software development lifecycle, from requirements to coding to testing to deployment and sustenance and all of that. So I think it's the existing tools do not necessarily address the end-to-end life cycle. So that's where the AI Force Agentic 2.0 platform that we've launched, it can underwrite 30% efficiency in the entire software development life cycle. And we feel pretty confident. There are very good use cases. And some of the deals that we have won are very large deals. Are the key differentiator has been our AI Force 2.0 platform.
So, help me understand, when we talk about large deals, and as you pointed out that we're seeing much more of that, what can we anticipate in terms of the deal size itself, the frequency as well as the deal size itself changing perhaps in the foreseeable future?
Yeah, usually very large deals tend to be a little bit more driven by cost optimization and efficiency driven. But transformative deals, I would think anywhere starting from 50 to 200 million. That's the space. If you are focused on G2000 or even G1000 companies, if you want to take over a landscape, fully transform it with AI as the primary driver, so that's the kind of deal sizes we should be looking at.
You were talking about coding. How much of the coding within HCL Tech is now being done by Gen AI?
I would somewhere put it between 25 to 35%. That's what we think is happening of all the development work that we do.
And is there a plan is there a number that you're targeting, if at all?
Eventually, everything needs to have AI infusion. It's about, some clients are a little slow in adopting. I mean, to even adopt all the right tools, there are a lot of constraints, right? Whether they're risk and compliance, security, all of them will have to kind of really bless the entire program. So I think some of them are stuck at the pilot level, but some forward-looking clients are moving forward very aggressively.
So in terms of spends, and again, when you talk to your clients at this point in time, how much of new spending is being done on AI-related projects or AI-related pilots that hopefully they intend to scale?
I think, a big part of what was the traditional discretionary spend has really pivoted towards AI-led spend. Today, of course, there are some foundational blocks which enable AI, like data and cloud. They continue to be there. But SaaS and a lot of other things, that money is already shifting towards AI-led transformation. And that's in the enterprises. But in the tech sector, there is huge CapEx, and that is hardware, software, and services. So that's a completely new spend.
We're going to be closing out this decade in another few years now. And given the pace of accelerated growth that you have seen, what are the levers that you now intend to prioritize and focus on as you look at the next 5 years?
Our ambition remains to be the best AI solutions company in the world, and which means all these new solutions.
Not the biggest.
No, biggest.
That's already been taken.
No, we were always wanting to be the best AI solutions company. And it's not just services, right? The world has moved on from just services. It's services plus software. And that's where we are looking at being the best AI solutions company. And we have extremely good recognitions, very, very good client wins and proof points to really scale this journey.
I rattled off some numbers, but which are the metrics that you're proudest of?
I think, of course, revenue per employee is one very important metric. I think among the industry, at least if you compare the India peer group, we have the highest revenue per employee.
What is it today?
It's roughly around $70,000 per person, and it increased roughly 4.5% year on year.
And is that the rate of change that you expect?
Yeah, I think our objective is if we can deliver at least 5% growth without having to add people and really amplify the capabilities of existing talent to deliver a 5% growth. And if you're growing above 5%, then you add more talent.
Which also means then that there is a larger problem as far as hiring of people is concerned. The jobs market is going to be constrained.
Yes, but if somebody is able to really crack all these new opportunities, I think there is an explosive growth opportunity available. It's going to take some time, but you have to pivot to all the new spend areas, and that could be another big S-curve that we are beginning to see.
And how prepared or focused are you on being able to optimize on that S-curve that you just spoke of?
Absolutely. We're already at the tip of the 4 or 5 S-curves. If we can really kind of execute to that, we will definitely see a good momentum. And when you asked about what other metric, right? It's just not revenue per employee. It's also how much of your revenue is coming from IP, right? Software products and solutions, that is our own, right? Today we already have a $1.5 billion software business, and there are at least 7 or 8 products that we are building in the AI domain, and they all could become a big growth drivers as well.
So what could that $1.5 billion look like 5 years on?
It's a little early because many of them are just about incubation and their early days. I mean, we think if we can even generate $100 million product revenue out of each of the products that we are building, it'll be a fantastic accomplishment.
So what are you most looking forward to? What are you most excited about in 2026, CVK?
I think it's just the AI opportunity and how can we really scale, get the right talent, execute to what our clients are expecting. That's really what it is.
Your message on the promenade is supercharging. So
yes, absolutely,
what are you supercharged about?
Supercharged, I mean, actually bring the best of people and technology to supercharge progress for our clients, whether it is AI, whether it is cloud, data, all of that.
Well, CVK, always a pleasure. Many thanks for joining us here in Davos and taking us through the AI roadmap for HCL Tech and, more importantly, the bets that you intend to focus on in the years to come. Thanks very much for your time. Well, you heard it from the man himself, advanced AI and the opportunity that HCL Tech intends to double down on. A bunch of pillars that they have identified that they intend to chase after. It could be a very different company in the next 5 years if those bets pay off. But for now, from all of us here, we're going to take a break. The conversations will continue. Stay tuned to us. We're coming to you live from Davos 2026. The conversations continue here from Davos 2026. I'm Shireen Bhan, and while the focus continues to be on tariffs, on trade, let's talk a little bit about technology now. And AI, of course, is the buzzword, continues to be the buzzword, but perhaps the messaging so far has been a little bit more subtle in comparison to AI that was screaming at you last year through the course of the Davos week. Joining me now to talk a little bit about the future and the fate of Indian IT services is Mohit Joshi of Tech Mahindra. Mohit, always great to have you. Thanks very much for joining us here in Davos, and congratulations. You head to Davos on the back of a very strong quarter, in fact, the strongest quarter in the last 3 years for you.
Yes, thank you, Shireen. I'm really happy that our sort of plan that we announced to the markets back in 24 is going to plan. This most recent quarter, very strong 1.7% sequential growth, large deals at a 5-time high, 9-quarter expansion in margins, and really supported by, I believe, the best team in the industry. So feeling very positive about the company and really proud of what we've accomplished within a fairly short span of time.
Yes, that's a 3-year plan that you articulated and put forward in 2024. But Mohit, let me go back in time to Davos 2025. And I wanted to make sure that my memory served me right. So I have pulled out what you said to me in Davos last year. And you said that while it may not necessarily be explosive growth, data modernization initiatives should pick up. And so if not explosive, at least close to double-digit growth for the industry is what we expect. What do you have to say now?
It's a clear mea culpa, right? A clear mea culpa. But to be fair, I think when January started out last year, it did look like spend would be quite strong. And then obviously you had the whole tariff issue in February in the US, and the sentiment went down after that. Obviously, relatively, we have performed very well, but clearly the overall spend pattern was hugely different from what we had foreseen. And again, it just goes to show that the future is very hard to forecast.
It is very hard to forecast. So let's talk a little bit about the near term. And you talked about the Fortuous plan. 15% margins, that is the target, that's the expectation that you're working with by March 2027. Already at 13%. Possible for you to advance that, get to 15% earlier?
No, I think we're going to stick to the 15% because the 15% is the average for the year, Shireen. It's not really a starting out point. So we have to, get to 15 and then maintain that or have a 15% average for the year. I do feel that we have enough levers still to pull to deliver the margin.
Okay, let's talk a little bit about the environment. You talked about how the expectation on spends was impacted on account of the Liberation Day tariffs. And today, we're talking about a new set of tariffs, this time President Trump imposing new tariffs on Europe and the likelihood of Europe retaliating. A large part of your revenue is Europe, 25%. How concerned would you be on account of this?
Well, look, Europe is a very important market for us, and within Europe also we have exposure to the auto business, for instance, which is a global business. But the largest part of our business is telecom, which is more of a national and a domestic business. Obviously, trade wars don't really help anybody. Massive swings in the currency don't really help anybody. But it's too early, I feel, to forecast. Hopefully, they come to a solution in the next couple of days just here in Davos. So far, the currency markets haven't really reacted very much. The pound pretty much stays at the 134, 135 level. The euro is still at 116, 117. So I feel that the market is hoping that this most recent issue, like the threat of the extra tariffs on countries doing business with Iran, should hopefully smooth over the next couple of weeks.
January is when we actually see budgets being decided. What is the indication that you're getting from clients at this point in time in terms of appetite for discretionary spends, in terms of risk appetite, in terms of incremental budgets, for AI-specific projects as well?
So again, after having been wildly optimistic
I shouldn't have brought it up.
I should only be cautiously optimistic this year. So I do feel, look, I think, as we said during our earnings call, the sentiment does look better than it did the previous year, for most of the previous year. And if you look at it over a multi-year period, right, look, I think 24 was better than 23, 25 was better than 24. So it is a slightly improving sentiment. I don't think there will be a sudden V-shaped recovery, but at the end of the day, clients have realized, which is what we'd always said, that to really get the benefits of AI, you need to, again, do the data modernization programs, the simplification programs, the modernization programs. So I do feel that that spend will come back. And people are sort of reverting back to the fact that AI is not going to be a silver bullet to transform the enterprises, and that a lot of work should be done. And even with the analyst community, I feel the sense that AI will now be a tailwind for the IT services industry is gaining hold as compared to sort of the view, 2
that
years
it was all
back,
gloom and doom.
that, it's sort of borderline suicidal, right?
You're absolutely right, and that's what I wanted to actually, you preempted my question, because we've gone from, is it the end of the Indian IT services industry yet again, to now saying that this could potentially be a tailwind. Now, I've heard many comments coming in about this is an opportunity to move up the value chain, or this is an imperative to move up the value chain. What are we talking about? Where are we at the chain today, and where are we expected to be in this quest to kind of de-risk this model?
Yeah. So look, I think if you again take the longer term perspective, right? I joined this industry back in 2000. In 2000, the industry was pretty much only in the application support space, and from there it moved to to the development space, and now is very firmly in the transformation space. So I do feel that there is one more level we need to go. We need to move from transformation to innovation, which is helping clients understand how AI can truly transform their business from a revenue perspective, right? And I feel that is really the opportunity for the industry. The largest pool of trained AI manpower is really in India at this time. The deepest understanding of industry verticals. If I take telecom, for instance, which is such a central business for us, how will AI transform networks? How will AI transform customer relationships? How will AI transform the B2B landscape? And I feel that is the opportunity for us, whether it's through building small language models or working with the hyperscalers and the AI providers to transform our clients' businesses. That is really the opportunity. Because if we don't do that, right, then the work at the bottom of the pile, which may be pure support-related work, that will keep getting compressed. But it has been compressed anyway over the past couple of years. It is just that the compression will be sped up even further.
Okay, to avoid that compression and commoditization, which we're already starting to see, and this attempt to move up the value chain, so to speak. Now, what does that mean for you in terms of inorganic opportunities, in terms of acquisitions to actually bolster those capabilities to really dive in to the innovation side?
I feel that a lot of this will have to be done organically, right? I feel that what really needs to be done from an AI perspective, for instance, the first is making sure that we have our tooling right? At the end of the day, what is the AI SDLC tooling that we're providing for our teams? And we've given a lot of focus to that. What is the agentic AI tooling that we're providing for our teams? And whether it is through TechM, Orion, or Swifter.io, that has been a core focus area for us. The sort of related focus area is building out the use cases by industry. Then it's the relationship with the hyperscalers, the work that we're doing from a pure R&D perspective, right? Look, I think the work that we're doing for the National AI Mission, we are on Wednesday being recognized by the WEF for our Indus program as part of the WEF Minds initiative. So that's the second piece of it, right? The relationships and the R&D piece. And the third piece, which I think is really important, is how does the commercial model change now with AI, right? See, the thing is that just now, you go to a client and you say, I will use AI and give you 20% productivity. Where that 20% productivity is coming from, what tools you will use, what AI consumption patterns will you see, that is not very clear. So a huge amount of our focus has been on making the pricing for AI a lot more transparent to our clients. And if we're doing a significant project that is utilizing AI tools, how much of the benefit the client is getting is really coming from the use of digital labor, and how much is really the traditional tools like offshoring and greater productivity.
So when you talk about this pricing change and this commercial model change that is expected on account of more adoption of AI as well as more transparency, on the part of companies like yours on the use of AI, what does that mean, and what are we talking about? What could this potentially look like in the next 3-5 years?
So I think over the next 3 or 5 years, what you will have is for every kind of program, right? Let's say you're doing a data migration program. For a data migration program, I can go and tell the client, this is the human labor I will be using to deliver this program, right? This is the, the subject matter expert, the program manager, the analyst, the developers, On the other hand, this is the digital labor I'll be using, right? These are the models I'll be using, and therefore this is the token consumption that will result from these models. Some of these models will be, the client's models, some of them will be ours, some of them could come from a Snowflake or a Databricks, right?
Okay.
And the combination of the two is the price. See, just now we're just giving one price to the client, which is largely based on labor.
Labor,
right?
yeah.
Exactly.
So what does this also then mean in terms of human labor? I mean, we've seen, your peers, some reducing headcount quite significantly in comparison to others, some actually adding headcount. How do you see this mix change over the next 5 years?
Look, I feel that the overall size of the pie will expand, so this should still be a growth industry from an employment perspective as far as the overall industry is concerned.
What about you specifically?
I feel if I look at TechM, for instance, right, look, we have one big advantage in the sense that all of our clients are talking about the fact that now with AI coming in, the premium for experienced talent has gone up even further, right? Because experienced talent can pick up AI tooling a lot faster. And so given that our average experience is 9 to 10 years, that's a huge plus for us. And I see most of the industry migrating to, to that model. Having said that, if there is going to be indeed an AI tailwind for the industry and a significant amount of modernization and transformation programs, that should allow for an expansion in the industry size. I do feel that over time, the demand for, for experienced talent in this industry will continue to go up.
So Plan Fortuous, that is underway at this point in time. Is a new plan being worked on? Is that being given shape as well as you close this one out?
Yes, obviously we have to deliver a new plan. I feel that we will deliver it once the FY27 plan has been successful, because there's no point in declaring a new plan when the old one is still some ways to go. I do feel that for the new plan, we will try and do the same thing, right, which is make it, sort of aggressive and credible at the same time. I do feel that with this 3-year plan, right, we had a very aggressive plan and we had very little time. And I feel that that really helped us get to, that's helping us on the path. For FY30, we are giving some thought, and I feel that the plan will largely be about continued margin expansion, but a much more focused direction on growth.
Much more focused direction on growth as well as margin expansion. Well, we wish you the very best of luck as you close out this plan and start work on the next one. And you've been more careful this time around, so we're going to have to wait to see how the year pans out. But Mohit, always a pleasure. Thanks very much for joining us here on CNBC-TV18. Look forward to more conversations with you. Well, the issue of how do you actually measure the use of AI and how Indian IT services companies are going to build that in is the big question. And I think Mohit Joshi has given us a clear indication of how Tech Mahindra intends to do that. We are going to take a break here on our coverage here live from Davos 2026. Don't go anywhere. More headliners and newsmakers coming up right after this short break.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Davos feels the chill as the World Economic Forum kicks off, with President Trump putting Europe on notice, threatens additional tariffs on nations opposing his plans to annex Greenland. Trump also tells Norway he no longer feels an obligation to think purely of peace after the Nobel Prize snub. Leaders of 8 European nations slam Trump's tariff threat over Greenland and consider retaliatory measures. French President Macron calls for activating a trade bazooka against Washington. British Prime Minister Starmer denounces the tariff threat but calls for a calm discussion. International Monetary Fund raises India's growth outlook for this fiscal to 7.3%, also raises the forecast for global growth to 3.3%, flags tariffs and a potential market correction due to AI as key risks to growth. Sensex and Nifty decline in trade after earnings from heavyweights failed to impress the street. All sectoral indices end in the red, barring auto and FMCG. Rupee weakens against the dollar and moves closer to the 91 mark. Sun Pharma is looking to acquire US-based biosimilar firm Organon Pharma, valued at $10 billion. CNBC reports the deal is likely to involve acquisition of stake or purchase of select assets of Organon. Indigo's stock is a top Nifty gainer today after government imposes a 22 crore rupee penalty over mass cancellations of flights in early December, which left nearly 9 lakh passengers stranded. Pilots Association says the penalty is not commensurate with the chaos caused by the airline. Indian IT CEOs are upbeat at Davos. HCL Tech's Vijay Kumar expects billion-dollar opportunities thankful to artificial intelligence. Tech Mahindra's Mohit Joshi expects his company's growth to beat the industry average and says gloom and doom around IT has lifted. Suzlon's Girish Tanti announces the appointment of a new CEO for Europe on CNBC-TV18 live from Davos, charts a hybrid future for the company as it hopes to transition from being just a wind energy player. That's an exclusive. At least 39 people are dead after 2 high-speed trains collide in southern Spain. More than 100 people injured and 12 are critically wounded. All right, the top story first. The alpine town of Davos feels the chill as the World Economic Forum kicks off with US President Donald Trump putting Europe on notice, doubling down on his Greenland annexation ambitions. President Trump had over the weekend threatened to levy additional tariffs on 8 European nations opposing his plans. A spirit of dialogue is the key theme at the annual huddle of the global elite, something Trump has made a mockery of since he returned to the White House for a second presidency. The U.S. president is also leading the nation's largest ever contingent to Davos. He will be accompanied by Treasury Secretary Bessent, Commerce Secretary Lutnick, among other top officials. He is also scheduled to address the gathering at Davos on Wednesday. Leaders of 8 European nations slammed President Trump's tariff threat over Greenland and hinted at the retaliatory measures. French President Emmanuel Macron has called for activating a trade bazooka against Washington, while British Prime Minister Keir Starmer called for a calm discussion. Washington, however, is confident that Europe will come around on Greenland. Trump also linked his plans to annex Greenland to the Nobel Peace Prize Committee, snubbing him. In a letter to the Prime Minister of Norway, Trump said, and I quote, "Considering your country decided not to give me the Nobel Prize for having stopped 8 wars, plus, I no longer feel an obligation to think purely of peace. Although it will always be predominant, but can now think about what is good and proper for the United States of America." End of quote. Here is the war of words between US and Europe on Greenland.
European leaders will come around and they will understand that they need to be under the U.S. security umbrella. What would happen in Ukraine that if the U.S. pulled its support out? The whole thing would collapse. That the U.S., Kristen, to be clear, Since 1980, the U.S. has spent U.S. military spending versus NATO military spending. We have spent $22 trillion more than the Europeans have. That we are peace through strength. And the Europeans now are only trying to play catch up. And that is only through President Trump. President Trump believes in NATO, but he does not believe in the American people being dragged in.
On Greenland, the right way to approach an issue of this seriousness is through calm discussion between allies. And let's be clear, the security of Greenland matters. The use of tariffs against allies is completely wrong. It is not the right way to resolve differences within an alliance. Nor is it helpful to frame efforts to strengthen Greenland's security as a justification for economic pressure.
I think you must follow more than one track. I mean, we have been asking since the very beginning of this to have a constructive dialogue with our American ally and friends, free from social media and headlines and strong words. And we opened that dialogue last week. We will not give up on that.
We're concerned about this escalation, to be absolutely clear. We always will support sovereignty and territorial integrity of countries wherever their geographic location is.
Now, top economists and thought leaders also weighed in on the tensions between the US president and European nations at Davos. Harvard professor Kenneth Rogoff said that he's never seen European leaders this upset in all the years that he has been coming to Davos. Eurasia Group founder Ian Bremmer explained how Trump essentially alternates between two modes of foreign policy.
Trump has two different modes of foreign policy. He's got the FAFO mode, fool around and find out, which you get if you're Venezuela and Ukraine. He's got the taco mode, Trump always chickens out, which you get if you're Russia or you're China. Right now, Trump believes that the Europeans are FAFO. And the Europeans need to convince Trump that they are actually taco. And that is going to require both military response and economic response that is strong, unified, and credible. We will see this week what we get.
I've been coming to Davos for 25 years now. I have never seen the Europeans so upset. I mean, when Putin invaded Ukraine, they were very upset. This is a whole nother level. He's invading Greenland, and oh, you know, there are 56,000 people. I mean, then he's going to take Switzerland. Then he's going to let Putin take the Baltics. Then he's going to let Putin take Poland. Then he's going to, you know, take Spain. I mean, it's just, you know, in absolute frenzy. They're hysterical.
Right. The International Monetary Fund has revised India's growth forecast to 7.3% for the current fiscal year. The IMF has also projected global economic growth to moderate to 6.4% in FY27. Ritu Singh joins us now with more details. Ritu, please take us through this report.
Well, the IMF's latest World Economic Outlook shows India leading the growth story. India's GDP growth has been revised up to 7.3% for FY26, driven by a stronger than expected third quarter and solid momentum in Q4 as well. Growth is then projected to moderate to 6.4% in FY27 and remain there in FY28 as cyclical factors ease. Now, globally, growth is holding steady. The IMF now sees 3.3% global GDP growth in 2026, which is up 20 basis points from October, and 3.2% in 2027. But these steady headline numbers are masking the divergent forces that are at play. Trade policy shifts are a headwind, but AI and tech-led investments provide a strong tailwind, particularly in North America and parts of Asia. Advanced economies are expected to grow 1.8% this year and emerging markets by 4.2%, with China and India driving much of the momentum. Inflation is projected to ease globally from 4.1% last year to 3.8% this year and 3.4% next year, while world trade growth slows down before recovering. A key driver of global resilience, though, is US's investment in information technology, particularly in AI, now at its highest share of GDP since 2001. Now, this surge, IMF IMF says is boosting business activity and also spilling over to Asia's tech exports. The IMF says that on the upside, faster AI adoption can lift global growth by 0.3 percentage points, but on the downside, any AI correction can also shave off 0.4 percentage points. Overall, risks to the outlook are to the downside. Besides AI, any renewed trade tensions, geopolitical shocks that could drag growth. And the report even makes a reference to what seems to be the ongoing tensions between the US president and Fed chief, warning that any political interference in independent economic institutions can raise the risk of policy mistakes and erode public confidence.
Right, thank you, Ritu, for that. Shifting focus now, Harvard professor and economist Kenneth Rogoff expects that either White House economic advisor Kevin Hassett or former Fed Governor Kevin Warsh will head the Federal Reserve next. Speaking with Shirin Bhan at Davos, he also said that Fed independence remains fragile.
DOJ investigation into the central bank's operations in the US. I mean, we saw the markets react to that, but what do you believe will be the medium-term to long-term implications of how this plays out on central bank independence?
I think it's important to understand that both sides in the US, the progressives, the left, the Democrats, and I want to call MAGA Republicans, neither of them like central bank independence. The Biden administration was pushing the Federal Reserve to do social justice, the environment, inequality, far outside its remit and distracted from its main problems. And I think they were, if I teach at Harvard and I talk to these progressive intellectual leaders, and they would like to bring the Fed back into the Treasury, be able to control it. And Trump does for completely different reasons. I mean, Fed independence is a pretty new thing. I actually think I wrote the first paper on it 40 years ago, and there weren't independent central banks. And I think it's worked very well, but it's fragile.
Do you have a guess on who could replace Jerome Powell?
I mean, I had thought it was 80% it would be Kevin Hassett, who I think is a very good economist, by the way. A lot of my colleagues don't like him because they think he's too Trumpy, but I think we're going to get someone Trumpy, and Hassett is actually quite a good economist, and I think he'd be fine in the job. But that said, Trump made this announcement, I love you, Kevin. You're so good on TV. But when you're in the Fed, you're never on TV. I want to see you on TV. I'm sorry. But this is what you just never know what he intends. But it could be Kevin Warsh, who
I was going to ask you, one of the Kevins.
Yeah, I mean, Kevin Warsh would be a very strong appointment. Also, there's one or two other names. I have no idea. I mean, look, Trump is the master of theater. This is one of his big announcements. He's making the most of it. But I may be wrong, I still bet on Hassett.
Tech Mahindra MD and CEO has said that the company is confident of beating the industry's average growth. Speaking with Shirin Bhan on the sidelines of the Davos summit, Mohit Joshi said that the gloom and doom around the IT services sector has been lifted. He added that the company will announce a transparent and credible metric for pricing the use of AI into deals. Meanwhile, HCL Tech CEO and MD C. Vijay Kumar believes AI is at an inflection point. While he's excited about new opportunities in the tech vertical, he sees billion-dollar opportunities in AI in the coming years.
I do feel that we have enough levers still to pull to deliver the margin, but equally we also want to focus on growth, because the second part of the plan is about achieving higher than peer average growth, which actually we
What does that mean in percentage terms?
Well, it depends on whatever the peer average is going to be, right? Sadly, I do not want to be caught out twice in a row with forecasting very high growth rates for the industry. But whatever the peer average is, and I feel that the consensus just now is for somewhere between 3 to 5 to 4 to 6% for the industry, so higher than the average is what we're aiming for. And even with the analyst community, I feel the sense that AI will now be a tailwind for the IT services industry is gaining hold as compared to sort of the view,
that it was all gloom and doom.
That, it's sort of borderline suicidal, right?
We've been very proactively looking at how to transform our services without worrying about any potential deflation or cannibalization of existing revenue streams. But what's even more exciting is a lot of completely new opportunities. Like in the tech vertical, there is close to $1 trillion of capex. Now, every one of these big programs will need significant services in terms of planning out data centers, the professional services, the GPU infrastructure, and the managed services around that. I think that's what we call as AI factory. That's a brilliant, very big opportunity. It could very easily be $1 billion revenue stream for us in the coming years. And there are many such revenue streams that we've identified, and it's still early days.
Right, time for a short break. Coming up next, the Indigo stock was the top Nifty gainer today after government imposed a 22 crore rupee penalty over mass cancellations of flights. Details in just a bit. Welcome back. Bharat Coking Coal made a stellar Dalal Street debut, listing at a premium of over 96% on the bourses. The coal mining company's market capitalization rose by 360 crore rupees. However, profit booking pulled the stock slightly lower before the end of trade today. The PSU's IPO was subscribed 147 times, driven by strong demand from institutional and high net worth investors. In earnings, Hindustan Zinc has reported a strong set of numbers in the third quarter, beating street estimates across all parameters. Net profit rose over 46%, while revenue jumped more than 27% on an annual basis. Margins expanded significantly during the quarter. And staying with earnings, Bharat Heavy Electricals has reported a strong set of numbers in the third quarter, with net profit rising 190% to 390 crore rupees. Revenue also rose over 16%. EBITDA soared 79% on an annual basis. Now, Interglobe Aviation was the top Nifty gainer today after the aviation regulator DGCA imposed a 22.5 crore rupee penalty on the airline as a probe found regulatory lapses behind the massive flight disruptions in December. The airline cancelled over 4,500 flights in the first week of December, which left 9 lakh passengers stranded in airports across the country. Shivani Bajaj has more. Shivani, please tell us more about the DGCA's directions to Indigo.
The aviation regulator DGCA has finally taken the enforcement action against Indigo, imposing a total penalty of 22.2 crore rupees over the massive flight disruptions that we saw in early December. Now, this includes 20.4 crore rupees for 68 days of continued violation of flight duty time limitation norms, levied at a maximum permissible rate of 30 lakh rupees per day, along with an additional 1.8 crore rupees one-time systemic penalty for broader operational and management failure. Beyond this, the monetary fine, DGCA has also directed Indigo to furnish a 50 crore rupees bank guarantee with phased release linked to DGCA-monitored systemic reforms across leadership, oversight, crew rostering and digital systems as well. Now, the financial impact might seem mild at this point, but let's look at the broader picture. It is significant. Indigo had already said that it has paid over 500 crore rupees in passenger compensation for cancellations and long delays and has processed around 610 crore rupees in refunds till December 7. Mind you, refund outgo is expected to rise further from here. Taking together the penalty, compensation and refunds and the compliance-linked safeguards, Indigo's total financial exposure now stands at 1180 crore rupees. So the 22 crore rupees penalty might seem mild, but the overall exposure stands at 1180 crore rupees. Back to you.
Right. Thank you, Shivani, for that. Shifting focus now, US President Donald Trump has invited Prime Minister Narendra Modi to join the newly created Gaza Board of Peace. This international body is tasked with overseeing Gaza's demilitarization, humanitarian relief and rebuilding infrastructure. The invitation was shared by US Ambassador Sergio Gore and has come as part of the second phase of the Israel-Hamas ceasefire. Similarly as well, however, Trump has said that participating nations will have to shell out $1 billion to have a permanent seat on the board. UAE President Sheikh Mohammed bin Zayed has arrived in India for a day-long visit. The Ministry of External Affairs said the visit will allow the President to speak with Prime Minister Modi about the comprehensive strategic partnership between the UAE and India. This will be Sheikh Mohammed bin Zayed's third official visit since assuming office as UAE President and his fifth in the past decade. At least 39 people were killed and more than 150 injured after a high-speed train derailed and collided with an oncoming train in southern Spain. The crash happened yesterday and emergency crews raced to the scene immediately. The disaster has also crippled Spain's rail network, forcing the cancellation of more than 200 train services and severely disrupting key routes between Madrid and southern cities. And with that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC-TV18. Thank you for watching.
Welcome back. You're watching our continuing coverage here from Davos 2026 as we come to you live from the World Economic Forum's annual summit. As I've been pointing out, no surprises, AI continues to be one of the focus areas that has people talking here in Davos. And joining us now to talk about his plans for the future is Umesh. He leads Uniphore, one of our young Turks. Thanks very much for joining us, and congratulations, you closed 2025 on a very strong note, bringing the likes of NVIDIA, AMD, Snowflake and Databricks on board as investors in your Series F round.
Great to be back here again with you, Shireen. Yes, we were pleased with the Series F, not only because of the size of the round. We ended up raising $260 million. There were financial investors, sovereign wealth funds came in. But these 4 tech companies who happen to be close partners of Uniphore, it was a huge validation of Uniphore's position in the business AI space.
So let's talk a little bit about what this $260 million now does for Uniphore, as well as your appetite for risk and growth.
Well, so look, the last 2 years, the business has inflected. We grew more than we wanted last year. We grew a little over 100%. And we are likely to double this year as well, which should cross $1 billion of total revenue bookings for us. The demand in big businesses for AI agents, small language models, but in a way that's secure with governance, meets the regulatory requirements, that's insatiable. And yes, there are models out there, there are GPUs out there, but what large businesses need, they need a secure, governed platform. That's what Uniphore provides today in a sovereign and an open manner, and that's what's driving our growth. So this fundraise, more than the capital infused, it's a validation.
Of course, it is a validation. You not only have the marquee names, but also marquee competitors coming in on this round. But, you know, I was walking through the promenade and you're quite prominently placed right next to the Belvedere Hotel. So you're making a splash here in Davos this year.
Well, clearly, every time technology changes, leaderboards of companies change. And AI, just like the internet did, is beginning to cause new leaders emerging, and Uniphore clearly is one of them. And it was about time that we had a presence at Promenade and let the world know that we're growing, and we're happy that our presence is here today.
You know, so let's talk a little bit about what we are seeing now in terms of enterprise adoption. Are there new industries, new sectors that are now coming on board to say, look, we want to move this beyond the pilot stage? What are you now starting to see in terms of adoption trends?
The big theme, Shireen, for 2026 that I see is there's probably no industry left which is now not thinking about AI agents or driving efficiency with AI. The key difference is people have moved past the POC or pilot mentality to production mentality. And that's bringing some old-fashioned things like what's the cost of the solution back into fore and a conversation, that not everything needs a large language model. Some of the use cases can be done with small language models. Not everything needs the biggest GPU from NVIDIA. Some of the use cases can be supported by older generations of GPUs. And so as enterprises are getting more real about scaling this up across the enterprise, cost, openness, not one size fits all, that's beginning to become an architecture decision. And so that's why I feel like while last year MIT's report, which said 95% of agentic will fail, became viral, this year similar reports will be pointing to something very different.
What are they going to be pointing towards?
We should expect large-scale agentic deployments in large enterprises, which are already happening. We have large financial organizations, insurance companies, telecom companies. We just this morning announced a strategic partnership with KPMG. So it's all across. Consulting firms, system integrators, enterprises are rolling out agents as we speak. And the first domino to fall would be a Fortune 500 company in their earnings beginning to report efficiency gains because of AI. And I feel like this year, AI is going to be the driver of big growth for all the companies that we work with.
You know, that's interesting, because I was just having a conversation with the tech CEO of one of the Indian IT services companies, and he said, you know, while there's a lot of talk around productivity gains and so on and so forth, we don't really have a transparent or a credible metric of how to measure that. And I'm wondering how you see that, that point of view.
Well, first, some examples. The way this will start to play out at a micro level, an insurance client of ours runs claims processing, okay? it's not like they're reducing headcount because AI agents are now processing claims. They just went from a 27-minute process to a 3-minute process.
Okay.
So the same team, their throughput has gone through the roof. Okay. We are now working with all the major Indian IT services firms. I would say they were probably slightly slower to get to the party, but each one of them, I can say, has caught on. And watch for the Indian IT services growth rates accelerating this year. So
you believe that to be the case? Because they talk about this as being a big tailwind versus what was the sort of consensus view last year that this was going to pose another existential crisis for the Indian IT services model?
I think had we spoken about this last year, and we did, I would have said, I am concerned for them. But right now, almost all of them have very good strategies in place. Like I said, they were slow to get off the mark, but they've all put good strategies in place. They're all doing what's being called asset-led services model, which means the assets are these industry solutions, pre-trained models, pre-built agents. They're all going to their clients and saying, we are now in a position to bring our assets and deliver outcome as a service. Okay, and so that's putting the IT services firms firmly in the middle of this AI economy. And that's what, over the next 4 quarters, watch their growth rates. It's going to be very different from last year.
Well, that's interesting. So, Umesh, you're saying that we are going to see those tailwinds accelerate growth for the Indian IT services companies. They'll be very happy to hear that. But, you brought up the issue of headcount in the reference to that insurance company that you spoke of, that they haven't actually downsized. They've just used AI to enhance efficiency and optimize. What is that going to mean, though, in the next few years when we talk about headcount addition, when we talk about workforce restructuring? We have seen, at least as far as the tech sector is concerned, we've seen a lot of jobs being displaced and being disrupted. A lot of jobs have gone. What does this mean now in the near term?
What's really important, Shireen, is let's look at the macro. AI absolutely is going to be a growth accelerator for the entire enterprise sector globally, starting 2026. We're beginning to see US GDP numbers come out. And there was a 5 print, and there's likely to be a 6 print on the US GDP. We are beginning to see large companies are beginning to report earnings, and growth rate is accelerating. Now, how much of that is because of AI? We're going to have more firmer evidence of that during the course of this year. So overall, at a macro, companies are growing and countries are growing much faster with the effect of AI. What does that mean in terms of jobs? It is true that in traditional job terms, we'll need lesser number of people as these companies grow, because the linearity between headcount growth and revenue growth, that's been broken by AI. But at the same time, newer types of jobs are emerging. Newer companies, I mean, look at the LLM companies, OpenAI, Anthropic, XAI are adding headcount like there's no tomorrow. Unifor is growing headcount. May not be in the same way as we used to 2 years ago, but newer jobs are emerging. So in the near term, could we see some disruption in the job numbers? Likely. But in the medium term, am I worried? I'm not, because the growth coming because of AI will just even it out for us.
You brought up companies like OpenAI and Anthropic and others. Will 2026 be the start of the IPO cycle in the US, and specifically for some of these companies?
It's always hard to predict, but look, all the friends in Silicon Valley that I talk to, large bankers, investors, and CEOs, the air is pregnant with the anticipation that some big IPOs will occur in 2026 in the US. It could be an Anthropic, it could be a Databricks, it could be a Stripe or a Canva, and that will kick open this IPO cycle that we've all been waiting now for almost 4 years to kickstart. But it is very, very likely, and I would put my money on the fact that in the second half of 26, we'll see some big IPOs in the US.
What does that mean for your own IPO plans? You've raised, but I would imagine that an IPO sometime down the line is something that you're working towards?
Well, 2 things. We'll let these bigger companies, which are almost ready to go public, to kickstart the IPO process. We're going to wait and see how the markets perform. For us, 2026 is all about, again, delivering a doubling of the growth year, crossing $1 billion of revenue bookings, continuing to grow our customer count, delivering value, helping our partners and customers like the services firms deliver increased growth because of our products. So we are very heads down in that. As the IPO markets open, as our numbers keep looking very good, we'll start to think about our plans in the future as well.
Well, as an insider, let me ask you how you look at this debate on whether we are already in bubble territory. Are we heading into bubble territory? Are we close to the bubble bursting territory? I mean, how do you make sense of the conversations around this?
My most likely scenario is there's no bubble burst at all. Are there pockets of the AI economy which are being overvalued? Sure, as it always happens. We've seen time and time again in every tech economy, internet, Bitcoin, cloud, SaaS, and now AI, that when a new trend occurs, there is venture investor exuberance, there are pockets of the market where there is overvaluation. But by and large, the public markets are staying very, very disciplined. If you look at the price to earnings ratio of NVIDIA, it's a very cheap company to own, the way it's growing. So at the macro, it doesn't feel to me that there's this, a major bubble that we should all worry about. So my, prediction is there's no bubble that we're going to see bursting at all.
At all. But, the kind of spends that we're seeing on AI infrastructure, do you see that continuing? I mean, massive just last year.
We have to see what is that spend going towards. Look, we used to say the TAM for enterprise software, when the SaaS economy was hot, I was pitching to investors, the TAM for enterprise software was $450 to $500 billion, okay? If you take enterprise software as $500 billion, and there's $1 trillion of AI build out, it looks like overspending. But if you say, what's the TAM for enterprise AI? That's not $5 trillion, because AI is not just replacing software. As we just discussed, AI is replacing manual work, which used to require only human beings. Now, human beings will go on to do other things, but those type of jobs are now being given to AI. So if the TAM is 5 trillion and growing, and if we all spent about $1 trillion last year in the build out of data centers and this and that, it seems that it's investment well made.
Okay, well, we'll have to wait to see how the returns on that investment also play out. And that brings me to the question of monetization, especially for some of these companies like OpenAI, etc. I mean, they've just announced testing ads in the US market. What's happening on the monetization front? And which kind of models are we likely to move to?
Well, the big thing we have to watch for is that these models, the switching cost between models, the switching cost between compute like GPU versus CPU, that's trending to zero. What our major customers, Fortune 500 companies, are telling us is they're done worrying about which GPU am I using, which model am I using. They're all trending to do the same thing. So what customers want to hear is, let's talk about the outcomes, the transformation that I want to do. And someone like a Uniphore or someone like a Cognizant, you take care of what the underlying infra is. So that's putting some pressure on the growth rates that these model companies have enjoyed, because they were in a near monopoly. And that's changing because the switching cost is now trending to zero. And the novelty of those models is no longer what's driving the value. So the key thing we're going to see on monetization is this emergence of outcome as a service model. And the best firms positioned to do that are the consulting firms or the global system integrators, including the Indian IT services. So it's almost a shift of the narrative back that AI could have killed these consulting firms, AI could have killed the system integrators, but they've got, again, a wind in their tails. And these outcome as service models is what will be the tip of the spear of monetization of AI, and everything else, which is the picks and shovels, the compute, the data centers, the LLMs, they're going to be part of that puzzle.
So explain to me how this is going to be different, this outcome as a service model. How is it going to be different from the model in existence?
So think of it this way. Partnering with Uniphore, a system integrator says, I'm going after two industries, life sciences and financial services. And for those two industries, we're going to pre-train small language models because we've had years of data. And we're going to pre-create agents because we understand what processes run in these companies. Having pre-created these assets on the Uniphore platform, these companies are able to go to their clients and saying, look, we know what you spend on current process, end to end. We are willing to take on the entire process. You don't pay us until we save you, call it 30%. And from that saving, we'll take a share of the gain here.
Okay.
Okay. And so what it's doing is it's telling the Fortune 500 client that let's not talk about is OpenAI better than Anthropic, because it changes every 6 weeks. Let's not talk about what's the best GPU, should it be run on a CPU. We are experts, we'll take care of all of that. Let's talk about you have a process if you're an insurer in claims. Your telecom company billing is a big process. You're a bank, credit underwriting is a big process. Let's deliver efficiency to you, and through that outcome, there'll be gain share to the entire ecosystem. That business model is what we will see a lot of happening, because these AI agents, as they're entering the enterprise, they can't be monetized like human beings were, all right? And also, people are tired of trying to think about how many tokens per second am I using? What's the correlation of token per second to a claim issued? And so anyone who's saying, let's just focus on your business, let's increase the number of claims you could have done within an hour with the same people, and that's an outcome that we will underwrite.
So the pricing of deals is going to change as we move into much more of this AI era.
It is already changing. Some of the biggest transformations that we are beginning to see, and we'll hear about through the course of the year, are now on outcome-based models.
Well, Umesh, finally, before I let you go, you are, of course, part of the US-India Strategic Partnership Forum. We still don't know whether we will have a deal or not between India and the US, but is there concern building on the relationship per se?
What I'll say, Shireen, is this. As Unifor, we do business globally. We sell our sovereign and open AI platform to customers around the world. Customers outside of US, Europe, Asia, are beginning to raise concern about how does a US technology fit their stack? And what if someday the access is blocked and they want more protections? And that's why being a sovereign AI platform helps Unifor in its position. There is no doubt that US is in the lead across the world in AI. And I, as a CEO of a Silicon Valley-based company, I'm just happy that US is having a dialogue this week at Davos with the rest of the world. Because this is, with the strength of US in AI, geopolitics is getting mixed. And I think dialogue is the only way. So I'm glad that there's dialogue happening this week.
Well, we hope the dialogue results in some sort of an understanding on issues that have become very, very contentious. And whether we see a breakthrough or not, we will have to wait to see. President Trump, of course, is on his way to Davos. We'll be speaking here on Wednesday. Umesh, always a pleasure. Thanks very much for joining us here at the World Economic Forum. We wish you the very best of luck as you roll out your plans for 2026 and beyond. Thanks very much for your time. Well, with that, we are going to take a break, but the conversations will continue. We've got plenty more lined up for you. Don't go anywhere. We're back in a minute with more.
That was Umesh Sachdeva of Unifor speaking to Shireen Bhan at Davos. You're watching CNBC-TV18. I'm Arundhati Ramnan. And here are the headlines at this hour. Davos feels the chill as the World Economic Forum kicks off, with President Trump putting Europe on notice, threatens additional tariffs on nations opposing his plans to annex Greenland. Trump also tells Norway he no longer feels an obligation to think purely of peace after the Nobel Prize snub. Leaders of 8 European nations slam Trump's tariff threat over Greenland and consider retaliatory measures. French President Macron calls for activating a trade bazooka against Washington. British Prime Minister Starmer denounces the tariff threat but calls for a calm discussion. International Monetary Fund raises India's growth outlook for this fiscal to 7.3%, also raises the forecast for global growth to 3.3%, flags tariffs and a potential market correction due to AI as key risks to growth. Sensex and Nifty decline in trade after earnings from heavyweights fails to impress the street. All sectoral indices end the red, barring auto and FMCG. Rupee weakens against the dollar and moves closer to the 91 mark. Sun Pharma is looking to acquire US-based biosimilar firm Organon Pharma, valued at $10 billion. CNBC Avas reports the deal is likely to involve acquisition of stake or purchase of select assets of Organon. Indigo stock is the top Nifty gainer today after government imposes a 22 crore rupee penalty over mass cancellation of flights in early December, which left nearly 9 lakh passengers stranded. Pilots Association says the penalty is not commensurate with the chaos caused by the airline. And with that, it is a wrap on this edition of Business 360. More news and updates coming up on the other side.
The conversations continue here at Davos 2026. As I've been pointing out, this is a Trump Davos. President Trump is going to be here. He's going to be speaking at the World Economic Forum. He's going to be meeting with leaders from Europe, and he's doubling down on his ambition to get Greenland. That's just one of the issues up for debate and contention here. What about the global economy? 3%, 3.2%, that's the expectation that we're working with. And so far, the economy has been resilient. Stock markets have been fairly resilient as well. Joining us as always here in Davos for a global check and a pulse read is Kenneth Rogoff. Professor Rogoff, always a pleasure. Many thanks for joining us here on CNBC-TV18. It's great to have you back in Davos.
Great to be here and a pleasure to see you again this year.
So let me start with the Trump question. This is a Trump Davos, as I pointed out. What is the expectation? What do you anticipate he's likely to say?
I mean, I live in the United States. Every day he comes up with something new. When he invaded Venezuela, I woke up and said, well, I'm glad he didn't invade Harvard. You know, you just don't know.
And Venezuela,
next.
no one's talking about here.
That's incredible. I mean, he invades, he sort of says he's going to run Venezuela, and they've moved on to the next issue. It's remarkable. And I think there will be a next issue. I mean, I wouldn't be surprised if he announced the new Fed chair here. That would be possible. Who knows? I mean, he'll find something. But I think he's come here to buy Greenland. I mean, that's what his ambition is.
He's doubling down on it.
Yeah, absolutely, absolutely. I don't exactly understand the purpose or the dynamics around it. I mean, that's another story. But I've been coming to Davos for 25 years now. I have never seen the Europeans so upset. I mean, when Putin invaded Ukraine, they were very upset. This is a whole nother level. He's invading Greenland, and there's 56,000 people. I mean, then he's going to take Switzerland. Then he's going to let Putin take the Baltics. Then he's going to let Putin take Poland. Then he's going to, take Spain. I mean, it's just, absolute frenzy. They're hysterical.
Well, I would imagine that that the reaction is, in your words, as you point out, hysterical on the European side. But the tariff question at this point, and we don't know which way the Supreme Court is going to rule, or whether we will have a Supreme Court ruling that coincides with Davos. Irrespective of the way that the Supreme Court rules, do you believe that tariffs are here to stay in some form or fashion?
Oh, yeah. I mean, there's no question about that. If the Supreme Court rules strongly against Trump, and I think it will be more mildly against Trump, but even if strongly against Trump, there are other things he can do. But I will say that this is a very clever move by Trump at the Supreme Court, because the whole debate there is that Congress has the right to set taxes. What are you, President Trump, doing setting tariffs, which is a tax, even if he denies it? And he says, his lawyers say, tariffs are an essential tool of foreign policy. Foreign policy is presidential first. And by doing this Greenland maneuver, I need tariffs so that I can take Greenland, which we need for national security. Yeah. This is also directed at the Supreme Court.
Well, we cannot preempt what the court will do, but you talked about the Fed chief, and you're one of the signatories of a letter that's been written by all central bankers, including, of course, central bankers outside of the U.S., talking about the need for central bank independence. This DOJ investigation into the central bank's operations in the U.S., I mean, we saw the markets react to that, but what do you believe will be the medium-term to long-term implications of how this plays out on central bank independence?
I think it's important to understand that both sides in the U.S., the progressives, the left, the Democrats, and I want to call MAGA Republicans, neither of them like central bank independence. The Biden administration was pushing the Federal Reserve to do social justice, the environment, inequality, far outside its remit and distracted from its main problems. And I think they were, if I teach at Harvard and I talk to these progressive intellectual leaders, and they would like to bring the Fed back into the Treasury and be able to control it. And Trump does for completely different reasons. I mean, Fed independence is a pretty new thing. I actually think I wrote the first paper on it 40 years ago, and there weren't independent central banks. And I think it's worked very well, but it's fragile. And so the central bankers are defending it fiercely. I think the DOJ investigation of Powell, it's not just about Powell. He's going to be able to appoint Powell's replacement. Powell will no longer be chair. But the new chair, whoever it is, needs to get other votes. He can't command the Fed by himself. So I think Trump is showing all the governors, you know, I can find something on you also. You want to vote against me? This is what's going to happen. So I think it's meant to provoke other resignations sooner than otherwise. This is part of a process of taking over the Fed. And needless to say, sorry for the politically incorrect phrase, but this is banana republic stuff. I mean, this is what you see in an emerging market with weak institutions. Erdogan in Turkey tried this for a long time. He fired one central banker, then another central banker, and another central banker every time they tried to lower interest rates. And of course, you know, inflation went through the roof. I don't think inflation is going to go through the roof under Trump. Let me be clear. It's a slow crawl that'll go up. But it's a big mistake. But I will say he's not stupid. I think he understands it. I really do. But in Trump's mind, it's a small price to pay for winning the midterms. Near term, getting interest rates down probably helps him for a little while, maybe even a couple years. In his mind, winning the midterms is all about, you know, controlling the borders, DEI, foreign policy, and he thinks he's the best, and the Democrats are awful, and you need to give him power. If we have to have some extra inflation, I don't care. I mean, dare anyone read into his mind. But I think he understands it's a risk, and he thinks it's a reasonable risk given the stakes in his mind.
You know, speaking of the Fed, we don't know, but it's being speculated that perhaps an announcement could be made here in Davos, or even right after President Trump departs from Davos. Do you have a guess on who could replace Jerome Powell?
I mean, I had thought it was 80% it would be Kevin Hassett, who I think is a very good economist, by the way. A lot of my colleagues don't like him because they think he's too Trumpy, but I think we're going to get someone Trumpy, and Hassett is actually quite a good economist, and I think he'd be fine in the job. But that said, Trump made this announcement, I love you, Kevin. You're so good on TV. But when you're in the Fed, you're never on TV. I want to see you on TV. I'm sorry. You know, but you know, this is what you just never know what he intends. But it could be Kevin Warsh, who
I was going to ask you, one of the Kevins.
Yeah, I mean, Kevin Warsh would be a very strong appointment. Also, there's one or two other names. I have no idea. I mean, look, Trump is the master of theater. This is one of his big announcements. He's making the most of it. But I may be wrong. I still bet on Hassett.
On Kevin Hassett as the next Fed chief. But let's talk about rates, because you said that it is in his interest to ensure that rates are lower than where they are currently. But what does that signal then to the market if he does in fact kind of impinge on the independence and drive down rates further?
So a very basic point that is hard to explain, but I'm going to do my best, is the Federal Reserve controls the one-day interest rate. That's all it controls. It doesn't control what mortgage rates are. It doesn't control what car loans are. Those rates depend on the market. The market thinks about, well, you're cutting rates today, but you shouldn't. Eventually, inflation's going to go up. I'm not going to make a 10-year loan at a lower interest rate if inflation's going up. So when he pushes rates down too hard, too fast, the longer rates that we care about actually go up. And so that's the tension. But that can take time. He's looking at the midterms. For Trump, this is, you know, an existential threat. My goodness, if the Democrats won big enough in the Senate and the House, they could really impeach him for real. I don't think that's going to happen. But he certainly couldn't get everything he wants. I mean, right now in the tariffs, let's take that as an example. If Congress was saying, wait a second, this is our right to raise taxes, you can't do this, we object to this, they would be able to rein him in. but the Republicans control Congress. They're not doing that. So for him, the midterms is just everything. Does he have 3 more years or does he have 1 more year? And so for him, lowering interest rates, it's probably going to boost the economy. In fact, I would say confidently, near term you boost the economy, longer term painful to get rid of the inflation. Trump says, look, I'd rather be getting rid of the inflation but have Greenland, take the Panama Canal, close the border, et cetera. Who knows?
But let's talk about the impact of tariffs on growth. And so far, we actually haven't seen that play out on inflation or as far as global growth is concerned, or even, in fact, growth of the U.S. economy. Now, is this something that we still have to wait to see how this plays out? Or do you believe that the threat of what this would mean both for inflation and the economy have been overstated?
So you'll probably play some tape from what I said last year. But what I thought I was saying last year in answer to this question is that the tariffs are not so bad in the short run. The U.S. isn't that open an economy. India's not that open an economy. It's not the end of the world. And they don't have that big a short-term effect. But over the longer run, it does start to build up and hurt growth. I used to be at the IMF, and we were always putting in much hated structural reforms, which would, be things to make the economy work more efficiently, but sometimes break up the political hold that some groups had. So why countries don't like doing it, they go, yeah, we know we'll grow faster if, let's take India, we lowered our tariffs even faster. We understand that. But you have no idea how difficult this is for us politically in the short term. And there's no big gain. It's going to make us grow faster in 5 years. Our government won't even be here. What do we care? This is the reverse, where I'm going to call it a negative structural reform. And just like it's not right away that you get the effect. So I absolutely think in the long run, economists will prove right. This is what we were saying. We were saying, look at a few years ahead when it starts to build up. But then it's also true that Trump, I would describe, instead of 2 steps forward, 1 step back, I would describe him as more like 5 steps forward, 3 steps back. So the tariffs went to here and then to here and here and here, but they ended up lower than he was saying. That's also why they mattered less.
of the big tailwinds for the global economy and specifically for the US economy is, of course, this massive AI infrastructure build out. How are you seeing what that's doing for growth? How do you see what this will possibly do for growth? And what do you make of the issue or the question of whether we are in bubble territory or we're heading into bubble territory as far as AI is concerned?
I confidently say I don't know. I mean, when we have these new inventions, it's very typical the stock market doesn't know where to go, and it's going to overshoot. Has it overshot already? I don't know. I'm very concerned about the many, many ramifications that are coming. So one thing Trump did when he came in is just said, I'm just going to take away all the checks and balances on AI. Don't worry about copyrights. Don't worry about intellectual property rights. Don't worry about anyone suing you. I'm going to protect you. And so they invest with confidence. But on the other hand, there's not a lot of attention being paid to safety, all these existential threats, and then the job losses that are going to come. I mean, Trump came into office saying he was going to produce better middle-class jobs. And I think, in fact, we will see his presidency shedding by the millions, maybe tens of millions, middle-class jobs. I look at the broader world. The World Bank released a report not long ago saying, it's hard to imagine this, 1 billion new workers net. In other words, even counting the ones that leave, 1 billion new workers will need to be employed in the next 25 years. Yeah. A number in India, 600 million in Africa. Where are the jobs? What are they going to be doing? So, I mean, AI is utterly profound. They're cheerleading it here, but I'm not quite sure where it's going. But yes, it's producing growth. But if the stock market were to collapse, and that certainly could happen, it would cause a recession.
You know, so far the indication is that the spending is likely to continue, but let's also talk about what's happening as far as currencies are concerned and what the view now is as far as the dollar dominance is concerned.
Well, I mean, I'd say the same as I did last year, that dollar peaked 10 years ago. Trump is complicated, but on the whole, he's not going to stop that. China needs to break away from dollar dominance. It not only gives us control over banking, the ability to hate it even more. So the U.S. had colonized the whole world, and it's going to shrink, and it's going to cost the U.S. a lot. We're going to end up having higher interest rates, less ability to use sanctions. I mean, Trump would say the dollar is greater than ever, and probably is going to put his picture on the new $200 bill or something like that. But I think dollar dominance isn't going to go away right away, but I think it's gradually happening. And you see this in many, many measures.
Mm-hmm. China, the reset that's likely on account of what President Trump is doing with tariffs on Europe, and perhaps there will be a new Europe-China reset as far as economic engagement is concerned. But how do you read what's happening in China today and what it could potentially be doing in 2026?
Well, for sure, the real estate problem that I've been talking about for years and years, and in my book, that's there. China said it would never be Japan. It would never run into those problems. It has. So for the average Chinese, a lot of their wealth, 80% almost, is held in real estate. And real estate prices have been collapsing, and they don't want to spend. The export sector, electric vehicles, tech, it's doing well. That is small compared to infrastructure, real estate, things like that. So China's growth has held up. I don't know what real numbers are, but the official numbers of 5% we just saw. But they're massive surplus. It's not going to the US, but it's going to Europe, it's going to Africa, it's going to Asia. If we have a China-Europe reset, is Europe still going to want all those exports and losing all those jobs? I mean, China has to rebalance its economy. The world doesn't just want to eat Chinese exports.
Well, yes, that massive trade surplus that you spoke of in the Chinese context. Let's talk a little bit about India. The Prime Minister making it very clear that the government intends to continue to double down on deregulation, on the ease of doing business, to try and draw in foreign direct investment. We've got a whole bunch of Indian states here, the largest ever representation in Davos, trying to draw in investors. What do you make of the India story?
Well, I don't think there's any question that India has been the most successful country, large country, the last several years. It's had the highest growth rate. I think those numbers are real. On the other hand, the challenges are profound. I mentioned all the workers coming into the labor force. I mean, India has not been able to employ them all. A lot of them, young men, young women, are still forced into subsistence farming. But on the other hand, you know, there are parts of India that are growing very well. I mean, the relationship with Trump has been disappointing. I mean, India is our ally, and so why are we, you know, putting on punitive tariffs on India?
Not the only ally that he's putting punitive tariffs
no, but
on.
worse, I think, than a lot of countries. So, but no, I mean, I think India benefits from countries want to protect themselves against China. So I think the India story continues, and it's great. Some of the deregulation, excuse me, some of my Indian scholar friends complain and complain and complain that there's never enough. But I think compared to 10 years ago, things are really looking brighter.
Indian chess, and I know you've been following that story very closely. What do you make of the rise of Gukesh?
No, I think it's wonderful what's happened to India in chess. And India's become a dominant power in chess. It's one of the top 1 or 2, no question about it. The world champion now is from India. It's wonderful. There's one ultra talent. But I think what it also shows me is there's a lot of talent there for AI, for tech, for biotech. I mean, the pools of talent. I see it at Harvard. I see it in academics. Geeta Gopinath is my colleague at Harvard, but there are incredible pools of talent to be channeled into many things. But it's a wonderful success story. When I was playing, there were no Indian grandmasters, and now I don't know 100. I don't know what it is. I mean, they must have a tenth of the world's grandmasters are in India now.
Well, yes, that leadership board has changed quite significantly. But let me end by asking you, as we leave Davos at the end of this week, you know, the 2 or 3 things that you're going to be watching closely, and also perhaps things that could surprise us through this year that don't seem very obvious today.
Let me tell you the #1 surprise from last year. What I always say about Davos, and they don't always like me saying this, is that whoever is the hero in Davos, bet against them the next year. You know, if it's oil prices are going to go down. If it's tech, there's going to be a collapse. Finance, there's going to be a financial crisis. Last year, no question, the 2 heroes were the United States, everyone wanted to be the United States, and AI. And they're still the 2 heroes this year. That surprised me. But if I had to bet on what we're going to see next year, I'll take the same bet again, that somebody's going to run into trouble.
But the United States and AI will continue
together,
to be the predominant themes.
Obviously, they're the predominant theme. No more environment inequality. It's the United States and AI. But I'll make the same prediction that I would at the end of last year, that somebody is going to crash between AI and the United States, maybe both.
Maybe both. Well, we will hold you to that prediction and be back with you here in Davos in 2027 and hopefully see you in India as well.
I look forward to both.
Thank you so much, Professor Rogoff. Always a pleasure. Appreciate you joining us here on CNBC-TV18. Kenneth Rogoff there on the way that the world is shaping up, the tariff threat, President Trump and what he is doing, and of course what the world looks like in this reimagined situation. We are going to take a break here, but the conversations will continue. Don't go anywhere. We're back in a moment with plenty more right after this. Welcome back. You're watching our continuing coverage here from Davos 2026. Joining us now to talk about the state of the Indian economy, more importantly, the fate of India's banking sector, is Amitabh Chaudhary of Axis Bank. Amitabh, many thanks for joining us here in Davos. Always a pleasure to have you with us. Let me start by talking to you about both global growth as well as the growth of the Indian economy. In fact, IMF has just put out its report. They've hiked the outlook for 2026 to 3.3%. It's up by about 20 basis points for 2027 global growth at 3.2%, which is steady. And for India, again, there is an upgrade by 70 basis points to 7.3% for FY26 and then 6.4 for FY27 and FY28. What do you make of both where global growth is at as well as the Indian economy?
Well, I mean, in spite of what is going on geopolitically, I think you have seen that a couple of large countries around the world have started demonstrating growth. Even the US has produced better numbers than what people thought when the whole tariff war started. As far as India is concerned, I think this forecast is catching up with what the local economists have been saying for quite some time, that India should be able to do 7 to 8%. I'm sure this 6.4% also should get upgraded over a period of time, obviously, if we keep performing well. India has done a lot of work on easing some of the fiscal, monetary and the regulatory constraints. They realize with the net FDI situation where it is that something has to be done done urgently. So they have been taking pretty radical steps over the last 6 to 9 months, but I do believe more need to be taken if we have to upgrade this forecast of 6.4% to more than where it is today.
I'll come to the measures that the government can or should undertake to try and draw in more foreign direct investment. But let's talk specifically about the banking sector. I mean, you know, it's been the clear outperformer from a market standpoint. It's also been the big sector where FDI has actually come in. We've seen both financial as well as strategic deals in the banking sector. What do you make of that?
So yes, almost $15 billion have come in across quite a few deals, and you have seen investment in both the NBFCs and banks, mid-tier banks and obviously large-size NBFCs. Great for the sector. The fact that they're seeing Indian financial services market as a place to invest in, I think is just a tick in the box for what the opportunity presents. A lot of these players maybe are seeing lesser growth in some of the markets they operate in, and they see India as a long-term opportunity. Great that they've got this capital, they've got this big brands behind them, so you know they don't have to worry about capital going forward in the future. But financial institutions are the most leveraged institutions in the world. You get the capital in, but the real balance sheet growth comes only if you get the deposits in. So given the size of some of these institutions, getting the deposits in will remain the tough thing they need to execute on. And while a lot of these brands might be well known outside of India, they're not necessarily that well known in India. So that brand per se is not going to help you. Yes, you have more firepower now. Yes, you have more staying power now, but ultimately getting the deposits in India is going to be a hard grind all the way.
Well, you know, I'll get to the hard grind on deposits in just a second, but if I were to read between the lines of what you're saying, you're not really worried about competitive intensity increasing on account of these banks being able to get in the kind of cash that they have?
Well, we have to worry about the competitive intensity in India, so this will just add to it. Are we extremely worried? Well, we have had cases where some of the foreign players have come in and invested in India in the past, and I don't have to say more. I mean, it's very evident in terms of what they've been able to do. That does not mean that's exactly what will happen in the future also. We have to watch them closely. I'm sure one or two institutions might be able to kind of, you know, get over the hump and really create a large global bank or large Indian bank. I do believe if Indian economy has to grow to the ambitions it has, it needs not 5, 6, but at least 10 very, very large banks. So I hope some of them do upgrade themselves, but it is not going to be easy.
Well, you know, let's then talk about the hard grind for deposits. How much has changed on that front? Because the last time that you and I spoke here in Davos, this was the big story, this was the big theme, that it was getting harder and harder to mobilize deposits. It's showing up in the numbers. You know, how much of a hard grind is it likely to be going forward?
So since the last time we talked, obviously RBI has very openly stated that they will provide durable liquidity in the system, but I think they do need to do a little bit more. We have had cases where the liquidity has kind of almost gone away because RBI has intervened in the markets. So durable liquidity means constant, continuous liquidity, and the market should be able to buy into it and act accordingly. That's one. Secondly, you know, the credit growth has picked up, but let's also realize that Government balances with RBI remain extremely high. They're at some of the highest we've seen in the recent past. So the deposit growth is still taking more time to come through. If you look at some of the numbers that have been published, they remain in the 10 to 12% range. People have started talking about credit growth of 15 to 17% for next year. Well, as I've said in the past, if credit growth is 15 to 17, deposits need to get there at some point in time. Both cannot diverge. So obviously, RBI...
But do you expect this divergence to widen?
I don't think so. I'm just saying that RBI, if they want the economy to grow, if a lot of measures are being taken to ensure that, this 7.4 is a given and you kind of, deliver some similar number next year, the economy has to grow. That means it has to be funded, which means the credit growth has to come back, which means that at some stage deposit growth do need to catch up, which means that RBI obviously has to do more than what it's doing today.
But forget what the RBI has to do. What about banks?
Well, when the deposits come in the system, will get our fair share. The problem is not that, deposits are lying somewhere and we are not able to capture it. The problem is twofold. One, the deposit growth is where it is. Secondly, the nature of deposits for sure are changing. Because as Indian retail investors go and invest in the stock market more and more, the deposits that are coming back in the banking system are in the form of wholesale deposits rather than retail. They have a price attached to it.
So you're saying even if you were to hike deposit rates, it wouldn't really make a big dent or a difference as far as deposit mobilization is concerned?
Yes, just hiking deposit rates for retail depositors necessarily does not make much of a difference. Because the wholesale deposits are priced at the market and the increment all the time. They literally, the large ones bid it out. And so the market pays what the market is willing to pay at that point. And there will be some banks who will always be desperate, so they might pay more than what the market is. So that is something which is pretty much a given. But yes, the overall deposit growth is still a bit of a worry. And we do need to get it up. Obviously, RBI is aware what they need to do, so they're working on it.
That brings me to the question that I last asked you here on the LDR ratio. And at that point in time, the RBI was asking questions of banks. Has there been a pullback on that front?
So
yes, system level
RBI has stated again openly that LDR is a question they're not asking that much. Our experience is that yes, the number of questions being asked on LDR has come down. Anyway, we have maintained the LDR at the same levels for the last 7-8 quarters. But I hear from the banking system that RBI is not pushing as much on LDR as before. You're also seeing that the public sector banks, which had much more headroom on LDR, have gradually been increasing their LDR ratios. There was a recent article about how we've hit a peak LDR. Given the nature of deposits, given the kind of balance sheet a lot of us have created, LDR might not be the only way to look at the liquidity in the system or how deposits are linked to the amount of credit you're giving, because we do refinance, we do infrastructure bonds and all of that, and they don't necessarily get counted in deposits. So I think my view is that RBI will be watching it closely, but that will not be the only parameter they'll be watching.
You talked about credit growth inching towards 15 to 17%. But we've been talking about this private sector investment capex cycle picking up and the green shoots. Where are the green shoots today? Are they bloomed or not?
So if you look at the private sector, I mean, just the overall growth, if you look at the numbers on a nominal basis, the numbers seem to have actually come off because maybe there was a bit of a front loading which happened before the tariffs kicked in and the prices of some of the goods were reduced. You also have the last year base effect of telecom and energy. But on the real basis, the growth continues apace. Are we seeing the private sector suddenly coming out and saying, I'm going to now invest at a completely different level? Not seeing that as yet.
No. Any stress, any vulnerabilities in any pocket that you're starting to see at this point in time?
No. I think the overall, actually, asset quality on the retail side is turning around and it is stabilizing. I think the results of the banks continue to exhibit that. People were a little bit worried about on the SME, broadly the SME sector. Right. I think the banks are not seeing it as yet. And obviously, all of us are watching our portfolio very, very closely. The wholesale side has been quite benign. Wholesale side has not been borrowing that much either. So in that sense, wholesale is benign, SME being watchful, but no signs as yet. And the retail side is actually really turning around.
So what's the outlook then as far as margins are concerned for you?
Well, the net interest margins, as we have stated in our various calls, we're in the silent period. Interest rates have been cut by 125 basis points. We have to pass on the entire interest rates benefit to the customers. We haven't got the, we have not been able to recoup the entire amount from our customers in terms of passing on the cost of deposits. So it will take some time. But you are seeing NIMs stabilizing, or they will stabilize soon, and hopefully from there on they should start inching upwards. So for some banks it has already happened. Some banks in the process of it happening, but hopefully in the next 1 or 2 quarters, the graph should start moving up.
Let me also ask you about what you make of the currency movement, and we've seen a very, very rapid move as far as the rupee is concerned, almost at 91. You know, how are you what are you factoring in as far as the currency move is concerned?
So, you know, there is a concept of real effective exchange rate, and as per that, rupee should be closer to 85 rather than 1991. Obviously, what the current currency rates reflect is the fact that FDI in India is not coming in, so there is a pressure, and as a result it has gone to where it has gone to. That's why RBI has also intervened, because they're happy for rupee to slide, but they don't want these sudden spikes. You know, what the real rate would be 10 or 12, 18 months online, I don't know. But the effective exchange rate is 85. Whether rupee will appreciate, difficult to predict, but I would say hopefully it will stabilize from here on.
At these levels?
Yes.
Okay, FDI, and you said that there is a lot more that needs to be done. The government has taken measures, but a lot more can and should be done. What specifically would you like to put on the table?
Well, government has already done a lot in terms of GST, and they have talked about large amount of investments. They've done the PLI scheme. They've done the GST cuts. So there's only that many things which are left in the armor of the government. But end of the day, if private capex is not going to come into, government has to continue to scale the capex on the government side. I think we have to do much more on the R&D side than what we've done as a country. I think we are lagging behind some of the other players. And if we want to come out of the mid-income trap, that is a specific investment on a sustained basis that has to happen. Private sector, if you look at the R&D numbers, we don't compare with any country out there, right? We're in the 0.6, 0.7% of GDP range. Others are 2.5% above and above. So in that sense, R&D would be one area. And one more area would be that MSMEs also need PLI-like schemes or credit support in form of credit enhancements. My view is that, again, government should scale that to a completely different level to support the economy differently.
Rates?
Interest rates?
Yeah.
Oh, I would say interest rates would have stabilized. If you look at inflation, it is inching up to 4%. My view is that somehow we are caught into this, it has to be between 2 and 6, so it is at 4. I think India should allow a slightly higher inflation, because if we want to support our economy, we can afford a little bit higher inflation. So my view is that interest rates are pretty much done with.
So that's the end as far as the cutting cycle.
I hope so. I wish so, yeah.
You hope and you wish so. It's very rare that you actually hear somebody say that. But let me end by asking you, so much of the conversation here in Davos, of course, when you're not talking about Trump, it's about AI. How much of that have you been able to incorporate within the bank? How much of agentic AI are you using at this point in time?
Well, it has been a huge area of investment for us over the last 18 months. Investment first in terms of looking at what AI can do and how we can take advantage of it. So real dollars have not gone in, but in terms of thought process, management, bandwidth, and so on and so forth, we are working across the entire enterprise on enterprise-wide AI projects and business-wise AI projects. I do believe it will make a huge difference on the cost side, but I'm more hopeful and looking forward to actually AI making a difference in terms of how we can increase our revenues differently can I find pools of customers which we've not been able to cater to this point in time? Can I reach them more effectively? So on both the sides of the P&L line, we do believe AI will be huge. And as any large institution, we need to be investing even more than what we're doing today. And that's exactly what we're up to.
How much? Give me a number that you can leave us with in terms of what you intend to invest on AI.
Well, we spend about 8 to 9% on our IT cost.
Okay.
That number will remain quite large.
Amitabh, always a pleasure. Thanks very much for joining us here in Davos, giving us a lay of the land of what the banking sector is looking forward to in 2026. Our conversations will continue here at Davos. Don't go anywhere. We're back in a moment. We'll be joined by the global CEO of Franklin Templeton, Jenny Johnson, right after this break. Welcome back. You're watching our continuing coverage here from Davos 2026 of the World Economic Forum's annual summit. We've been bringing you global business leaders to present an outlook for 2026 on the most pressing issues. Joining me now is someone who is one of the most respected, influential voices in the world of finance. Jenny Johnson of Franklin Templeton, the global CEO, also, of course, a big supporter and a believer in the India story. Jenny, it's great to have you back here. Thanks very much for joining us on CNBC-TV18.
Thank you for having me.
Well, let's start about, with the global outlook for growth. At this point in time, IMF pegging it at 3.2%, so it's pretty steady. And India, of course, 7.3 for this year and 6.4 for FY27 and FY28. On balance, with all the uncertainty and volatility and the tariff threats and so on and so forth, what do you make of where the global economy is and what that would mean then as far as markets go?
So first of all, I'm bullish on the U.S. I do think that President Trump, we have midterm elections coming in, and he is going to make sure that that economy stays strong through the midterms. So you have that tailwind. I also think, AI, and we haven't seen any real benefits yet from AI in the broader sectors, right? The investments have all been about the picks and shovels, the NVIDIAs, the Microsofts, others. That's just at the very beginning. People say, well, the energy next is going to be the next big investment. Yeah. But what's really going to be differential and meaningful is as companies start to leverage AI to improve their business. And so I'm bullish on that. India, of course, I mean, the big benefit, honestly, India has is it's very much a domestically driven economy, right? So you kind of, with all the geopolitical issues going on, India's kind of isolated. Yeah, tariffs affect you a little bit, but really the India story is all about your consumer. And I've been a fan of India. I lived in Hyderabad in 2005 with my family. My kids went to school there. My daughters managed to get into a Bollywood movie, so I've got the full
plenty of India connections. Did she enjoy that, by the way?
Oh, she loved it. Of course, she loved it. But it's a country where 56% of the population is under the age of 25. I tell people when I talk about the India story, and I say, you got to understand this is a British-based legal system, so it's a legal system that people understand. It's from an education system. I think Americans are surprised when I tell them that Harvard is a safety school to IITs. Unbelievable graduates that come out, engineering and others. So the India story is so powerful. There is a saying that India grows at night while the government sleeps. Yeah. But I think your current government has done a really good job of actually being supportive of growth in the environment. So I'm very bullish on India.
Well, it's 30 years for Franklin Templeton in India. So, what is the plan for Franklin in India in terms of assets under management and the kind of growth that you anticipate?
Well, actually, it's been... we launched 4 products. We had one of our best years ever in sales. We've had 8 consecutive quarters of positive sales. We actually launched one of the first private credit funds. So we're excited about that. And we have a license in Gift City. So we're going to take advantage of that. Our view is it's such a great dynamic market. We have clients in 160 countries. We have local asset management. We're sort of unique of a multinational manager that has local asset management. I think a lot of Indians look at Franklin Templeton as a local company. And it's because we spent the time, we brought the SIP to India.
My first SIP was Franklin Templeton.
There you go. And to give you an idea of how significant they are, SIPs, I think in the last 5 years have grown from something like 800 million a year, or it might even be a month, to 3.3 billion. I mean, in India, it's such a great story, and it's a great way to save. So we're very bullish, fixed income equities. We love the India story.
But what about fund flows? Because FIIs have kind of been reluctant in investing in India, especially in the last year or so. And we've seen FIIs pull money out of India. And FDI has had its own issues, but that's not just India specific, but it's also the global environment. What do you anticipate as far as fund flows are concerned?
Look, I think, so it depends if you're talking about external fund flows into India.
Yes.
I think that there were a couple things. I think some people thought maybe it got expensive, but you see a little bit of correction there. You still have pretty supportive monetary and fiscal policy. I think there's a lot of pro-growth initiatives that are going to be positive for the India story. It's the fastest growing economy of all the large economies. So those are amazing tailwinds. Now, sometimes, depending on the currency, the dollar has been weakened, and so it depended on sort of where you were investing from, whether or not you saw it as it was going to be positive or negative. But again, I look at it and say just fundamentally the demographics and the dynamics of India are such that it is a really attractive place. And that's why we wanted to set up a license in Gift City. We're going to tell the India story. We have a local asset management team, and to be able to attract the foreign
So what are you
dollars.
going to do from Gift City exactly?
Well, so we're building products that foreign investors will be interested in. It's a way to actually get access to the Indian market. So we are launching several different, some global equity products. You also can have investors send money out. So it allows us to take our broader suite of products and be able to offer them to Indian investors as well.
Well, you've come to Davos fresh off a crypto conference, Jenny. What's that world looking like?
So it's interesting. So Franklin Templeton has been very, I think, forward on tokenization, probably before most traditional asset managers. We actually started our journey probably in 2017. We had a tokenized money market fund approved by the SEC in 2020. It's one of the, I think it may be the only one that's natively on chain. Others are what are called digital twins, which means they're copied onto the blockchain. Well, if you're a digital twin, you don't get the benefit of the blockchain, which is we can run this. We actually calculate the yield every second in the money market fund. So if you're a hedge fund and you use this as collateral and you only own it for 4 hours, 22 minutes, and 32 seconds, you will actually get paid that yield. You will be able to transact within the next few weeks, be able to transact on a Saturday and move into a stable coin. Now, why do I love tokenization? It is simply a programming language that does some really cool things. So one is it has a record of who has ownership. Huge cost in financial services, reconciliation of your own data across your systems. Then you have to reconcile with your counterparty. It eliminates that. There's only one source of truth. It has the ability to to program a smart contract. So whatever types of investment agreement that we have, we can actually program that in. And then finally, it has a payment mechanism. So you're going to have atomic settlement. You're not going to have to wait to get your money after your transaction settles. And my favorite example of that I think highlights what the opportunities are is Rihanna. It didn't really work, but it still gives you, I think, insight in what is coming. So Rihanna created NFTs where if you bought one, you got the royalty rights to 0.00033% royalties to one of her biggest songs. So why can she do that? Because when the streaming service plays her song, the smart contract kicks off and it says, oh, you're a Rihanna fan, you have the token in your wallet. I owe you this fraction of a cent for that one stream. Think about how that opens up other types of investment opportunities. So we think it's going to be really exciting to see how this space evolves. And when you combine AI and the smart contract, it's going to be hugely powerful.
So, will 2026 then end up being some sort of an inflection year as far as tokenization is concerned?
So my view is yes. I mean, we've been in this journey for a while at Franklin Templeton, but I can tell you, number one, having come from this crypto conference, talking to a lot of the crypto exchanges, they're looking to bring traditional products on to be able to deliver to their clients. So their clients are looking to say, I want to diversify from crypto. I'd like a tokenized ETF. So you have demand on that side. And then I have to tell you, the TradFi, traditional finance firms, are now starting to talk. Everybody's nervous because there's a lot of probably bad investments in crypto, but there's a lot of really good ones. And so their clients are saying, hey, I want exposure to that. And so they're now trying to understand, what does it take to build the wallet infrastructure? You have to have a wallet. Again, it's just a programming language to hold that token. And so they're now talking, and we built those capabilities when we built our tokenized money market fund, because it didn't exist in the market, about trying to add it to their environment. So this is where I think, and I have to tell you, there were more. I've been attending crypto conferences for the last 5 years. This one had the most traditional financial people that were in them. A lot of market makers are starting to get in as people talk about democratizing alternatives. I always say to people, that's not a technology problem. That's a market maker issue. You need liquidity. Well, they're now starting to be interested in moving into that space. So that's why it feels like 2026 is going to be the convergence of these two worlds, the beginning of the convergence.
The beginning of the convergence of these two worlds. But 2026, the return of IPOs in the US and possibly AI IPOs?
Yeah, so here's what I'd say about the IPOs. So I think that the good news is the current administration is really focused, and Chairman Atkins at the SEC, it is on his agenda. He wants to make it easier. There's a huge cost from trying to go IPO. I do think that one of the issues is some of the private equity firms are holding the asset at a mark. They'd have to mark it down if it goes into the public markets, and there's a resistance to doing that. So I think that the bid-ask spread is probably not allowing a trade to happen, but you're starting to see that warm up. So I think we'll see more.
But, you know, on the question of asset bubbles and whether we are in the midst of one as far as AI is concerned, and I know everyone's talking about the tailwinds that the AI infrastructure build-out is providing to specifically the U.S. economy, but from an asset point of view, you know, what's the take? Are we in a bubble territory or not yet?
So here's what I'd say. Like, we talk a lot about market concentration. That's why I'm actually a big believer that the most important decision people make about their portfolio is diversification. Because one thing we've learned, there's just another surprise that's coming along. Diversify by geography, diversify by sector, diversify by asset class. But here's what I'd say about the AI. So the Mag 7, as we look at them today, and you say, oh, they're so concentrated, and you compare it, a lot of people compare it to the dot-com boom. The reality is, the current Mag 7 have earned their right to those multiples, right? They've shown those types of earnings growth. I think in the 5-year period, it's been something like 445%. So, you know, can they continue to sustain that growth? That's a question that, you know, we'll sort of see. But certainly they've earned it. What I think is really exciting is that within sectors, I mean, the pace of this AI, just technological advantages, is so fast that the companies that figure out how to leverage it in their environment, both to reduce their costs as well as to figure out how to have it generate revenue, are going to leave behind their peers. Because if you don't get it right early, I think you're going to not be able to catch up. That's just my instinct on this. And so I don't think any of this, there's been huge productivity gains in the US and companies. I don't think any of that's from AI. I think everybody's sort of figuring it out. We're kind of doing experiments and cost cutting, or maybe like our investment teams have built a platform and they're doing some really interesting things, our distribution teams, but they're not yet really translating into revenue, but it will happen soon.
Well, you know, as an asset manager today, and we'll be talking about global risks and geopolitical and geoeconomic confrontation continue to be some of the top risks that CEOs are watching out for through 2026. What would you put on that dashboard?
Well, this is again where I say, like, volatility and risks is what makes active management really important, right? And so this is where I'd say our job is to educate our clients on, as you can see, you take big trends. U.S. and China are probably going to always be frenemies, right? They're going to be friends and enemies. There's going to be areas where we have to work together. The U.S. needs China and China needs the U.S. But on the other hand, if you're a U.S. pension fund, you're probably not going to be able to invest in Chinese technology. There's probably going to be real bifurcation there. If you're a European company, a Middle East company, or Asian company, you're going to want to take advantage of that investment. So our job, you know, again, with clients in 160 countries, is to be able to have research on the ground where we're finding those opportunities and constructing portfolios that our clients want to invest in, and to guide them on what we think of, hey, if U.S. and China have tension, that means there's going to be shifting in supply chains. If there's shifting in supply chains, let's figure out which countries are going to be the beneficiaries and which sectors are going to be the beneficiaries in those countries. So our job is to guide our clients through these geopolitical volatility, and most importantly, to remind them diversification is really important.
So besides the convergence of crypto with traditional finance, which you expect to be a big trend through 2026, what are going to be some of the other trends that you believe will shape the way the markets move?
Well, for sure, the private markets and bringing that to the wealth channel, right? I mean, this has been an issue, which is, if you think about it, I described my grandfather started Franklin Templeton, right? So I'm third generation. When my grandfather got into this business, the average person didn't have access to the equity markets, right? So you were left out of the growth of the equity markets. We have that same issue today. Do you know 87% of the companies in the U.S. that earn $100 million or more in revenue are private? And so if you can't invest in private markets, you're left out of 87%. That's not really fair. But they're illiquid. So I think what you're going to start to see is creativity around the vehicles where we can responsibly bring private markets to the average investor. And there's a lot of different ways that I think that will happen. And by the way, that's a global trend. I mean, you really hear this about private. It comes, honestly, it stems from, I think, the GFC, where banks aren't lending the way they used to lend because capital rules have changed. Companies don't want to go public as much, and there's plenty of money to stay private. And so that's not going to reverse. And so being able to bring those investments to the average person, I think, is one big trend. The second is personalization. Technology is enabling personalization of portfolios. I think that people's portfolio is not going to be just, this is my investment portfolio. It's going to be like, here are my goals. Manage these portfolios based on my goals. And the technology is going to enable that kind of personalization.
Well, you know, I want to talk to you about your time in Hyderabad. What are some of your memories from that time?
Oh my gosh, it was a great time. It was a great time for the family. My kids went to a school there and dressed up in their uniform every morning and took the bus. And I laughed because my youngest was 5 years old, and he'd say they all learned that the bus driver never waited till you got in your seat. He just took off. So the key was when you got on the bus, you had to just grab hold and hold
whatever. Yes,
to whatever was there. It was an amazing family time, and we loved it. And we took the time to go each weekend to go. We went to Kerala, and we, of course, went to Agra and Goa. So we just go traveling all over and experiencing different parts of India. It was a lot of fun.
So what are you most excited about for Franklin Templeton in 2026 and beyond?
So I'm excited. You know, we've done in the last 5 years, I think probably 11 acquisitions. It's been all about positioning the company with the capabilities. And so today, we're a top 10 alternatives manager. A lot of people don't realize that. We have $270 billion in alternatives. We have $100 billion in private credit. We have about, I think it's probably 70, almost $80 billion in secondaries, and about $80 billion in real estate and some venture. And so having that breadth of capabilities, I actually think that traditional managers who haven't gone on the journey of acquiring alternative managers are not going to be able to do it. They've become too expensive. And so really proud of what we put together. That gives us, I describe it as like our clients are like a chef, and they walk into our kitchen, and it's the best stock kitchen out there. And you can build whatever types of capabilities you want. So that makes me really excited. The work that we're doing in tokenization, which I genuinely believe when you combine that with AI, is going to be hugely disruptive. We have a core team of, I think it's, there's probably over 60 people that are on just working on digital assets. And, you know, I think that's going to become more and more relevant, similar to, honestly, the journey that ETFs kind of brought in, how it changed sort of the mutual fund, SMAs, separately managed account, those types of things. And so this is another vehicle, and it's going to open up really interesting investment opportunities. And most importantly, it's going to actually create financial inclusion. So when we launched our money market fund, the SEC required us to run our old record-keeping system and our blockchain system. The old record-keeping system, we ran about 50,000 transactions, and it was about $1.50 a transaction. The entire cost of those 50,000 transactions on-chain was $1.13. So you can invest in our Benji money market fund with $20. Our traditional money market fund, you have to have $500. And we can actually reduce that number. And it's simply because this technology is so efficient in how it operates. And so that gets me excited, because I actually think in India, tokenization, you know, again, people get nervous by the crypto word, but tokenization in a country like India is going to be really important to be able to reach out in all the secondary cities and villages and things, because it's going to enable financial inclusion.
You know, you talked about financial inclusion. Let's talk about inclusion in general. You know, are we likely to see more women coming into this world? Or?
I sure hope so. Isn't it a great business to be in? It's a great industry. And so, you know, to me, it's a natural one for women. And I think sometimes we don't do a great job of describing what this business is. You know, I tell people that I asked my kids, are any of you going to join me in this industry? And my daughter says, no, Mom, I want to do something that helps people. And I'm like, are you kidding me? And I thought, I must be terrible at how I describe this. This is a business that helps people. And so I think if we can resonate more with women about this is a great business to help people, we can attract more, number one. Number two, girls fall out of STEM in high school. We've got to figure out how to get them engaged early, and then in college, getting them in internship programs, showing them what a great business this is.
Jenny, always a pleasure. Thank you so much for joining us here in Davos. We look forward to seeing you in India, and I hope we see more of you in 2026.
You absolutely will.
Thanks very much for joining us. Well, the conversations will continue here from our live coverage and our live studio in Davos 2026. We're back with you in just a short moment. Welcome back. You continue to watch our coverage here from Davos 2026, the World Economic Forum's annual meeting. As I've been pointing out, this really is a Trump Davos. What is President Trump going to say? What is he going to do? What is the European response going to be? To answer all of those questions, I have with me a man who did predict, as part of his global risk, the fact that we are going to see a U.S. political revolution as the #1 risk, and of course the Don Roe doctrine as another key risk that the global economy was faced with, and what happens to Europe. Ian Bremmer, thanks very much for joining us here on CNBC-TV18. It's great to have you back. Sure. Yeah. Well, all of those risks even more amplified today.
Yeah, it is that way, and the United States is driving global uncertainty today. It's not conflict in the Middle East. It's not what Xi Jinping is up to. It's what's happening in the White House domestically in the U.S. in a political system that's much more divided and dysfunctional, and internationally in a global system where the United States is ripping up the old rules, whether it's collective security or free trade or rule of law, all the things that the Europeans really need, all the things the Europeans rely on. And now today, this week, they feel like they can't get them from the United States.
Is it the end of NATO?
If Trump persists in requiring control of Greenland, it is the end of NATO, if he does that.
He's doubling down on it.
It's very unpopular in the United States. It's unnecessary for U.S. national security. The Danes are a very close ally, or have been, and they're willing to provide whatever national security access the Americans need. But Trump has decided that's not what he wants. What he wants is his name on the territory. And look, historically, he has been very successful putting his brand on many things, on TV shows, on buildings, on the Kennedy Center in Washington, D.C., but on foreign territory is not one of them. And Denmark and their European allies strongly oppose this, and Trump's going to have to back down. If he doesn't back down, he's going to have a big fight in his hands, and he's going to have the end of the transatlantic alliance.
You know, there's no sign or indication of him backing down just yet. What do you expect the Europeans to say when they do meet with him here in Davos? We saw that joint statement coming in, and it was, you know, as opposed to the commentary that came in the previous week, this has been a very different tone that Europe has taken now with this Greenland threat. What do you expect the Europeans to say to Trump here in Davos?
Look, the conversation that the Danish and Greenland foreign ministers had with J.D. Vance, the vice president, Marco Rubio, last week were actually quite constructive. And the Danes explained the red line of sovereignty and territorial control, and the meeting did not break over that. They said, okay, let's find a constructive way to move forward. That is not what we've heard from Trump. It's not what we've heard from Stephen Miller. So, I mean, the question you're asking is, you know, how to predict what Trump is going to say on any given day. He's a unilateralist, and his interests are not always aligned with those of the United States of America. That's a problem, right? The Americans have this core issue where they've elected somebody who frequently is more interested in his personal enrichment and his personal embellishment than he is in what's good for the country. And the CEOs won't say that, but I'm not a CEO, so it doesn't really matter. That's a reality. And privately, everyone is concerned about this. How can you find a way to assuage Trump's ego the way Nobel Prize winner Maria Machado did when she visited him for lunch and gave him her own Nobel? Thank you so much for helping us in Venezuela. What can the Europeans do? What are they willing to do to make Trump look like a winner, but also maintain control over Greenland? And is there a way to navigate that? If you were negotiating with Marco Rubio or J.D. Vance, no problem. But you're not. The President of the United States is a different animal.
Well, we'll see what happens on that front. But, you know, you brought up Venezuela. Nobody's talking about Venezuela at all. It's almost as if it never happened.
Well, maybe in India. In the United States, people are talking about Venezuela every day. In the United States, every day. It is a big change in the Western Hemisphere. It puts a lot of pressure on Nicaragua, on Cuba, as countries that are adversarial to the U.S., puts pressure on Mexico and Colombia, allies that aren't doing enough from the U.S. perspective on interdicting drugs, on dealing with the narco cartels. And, of course, there's the question of what's going to happen with the world's largest proven oil reserves. They aren't U.S., not Saudi Arabia, Venezuela. And the Americans have said they're taking control of that oil. But the oil companies aren't ready to invest. So how is that going to work out? All of these things are very big questions, and this is still getting news every day in the United States, I promise you.
No, it is getting news in the United States. I'm saying that it's probably not top of mind here in Davos because Greenland is, and that's more topical and relevant to Europe. But what do you see as the next steps as far as the U.S. strategy for Venezuela is concerned? You're right in pointing out that oil company CEOs are apprehensive about putting down top dollars at this point in time, given the uncertainty around the situation.
Well, it would take a very long time to actually recoup those investments, as we saw from Darren Woods, the CEO of ExxonMobil, talking directly to Trump in the White House just over a week ago. We're talking about $100 billion necessary over 10 to 15 years to get Venezuela back to 3 million barrels of production a day. They're at about 600,000 barrels of production a day right now. That can happen with support from the World Bank. That can happen with proper investment and with proper governance structure. None of those things are certain today. And the thing is, if you're the CEO of an oil company, your expected timeline of investment is a lot longer than Trump has in office. So you can't just rely on what President Trump is telling you. You have to actually think about what's going to happen beyond that. That creates an asymmetry in the conversation, very different than the 6 months of planning that went into the very successful military operation to remove Nicolas Maduro from power in Venezuela.
What about Ukraine? You know, again, no breakthrough. We were talking about it when we met last year. What's the read now on Ukraine in light of what is happening with Greenland?
The fact that the United States is demanding territorial control of Greenland and that is taking up most of the oxygen in Davos this year means that the Russians don't want to sit down and discuss anything on Ukraine. They can hope that American pressure on Europe breaks the NATO alliance, breaks the transatlantic alliance. And if that were to happen, support for Ukraine from the United States would probably go away. And the Europeans are paying all the money, but the Americans are selling the weapons, and the Americans are providing the intelligence. So ultimately, that's a big win for Putin. If you are Russia right now, even though you've lost 1 million soldiers, 1 million casualties in this war, even though you're not taking very much land, it's not going the way you want it to go, the broader direction of Trump is very much aligned with what Putin wants to see strategically. It's good for him, it's good for China, it's bad for American allies, so you keep fighting. You keep fighting and you make life a lot worse. You increase the pressure on Ukraine, you increase the pressure on frontline European states, and you make the other European states like Italy and like Spain, the southern Europeans, you make them wonder, their publics wonder, why are we doing this? Why are we supporting the Ukrainians? Why are we going against the United States? That's not a good idea for us.
So a breakthrough in 2026, or do you believe that this war is going to continue?
There is increasingly capitulation from Ukraine. The Ukrainians are now saying that they are willing to accept a demilitarized zone in some of the territory that they occupy. Their troops would pull back even though they're not ready to renounce sovereignty. They're willing to talk about even holding elections while the war is still going on. Those are things that Zelensky just a month ago was not willing to consider because of the pressure from the U.S., from the Europeans, and the pressure from having to continue to fight Russia for almost 4 years now. They're a much weaker country, a much smaller economy, much smaller population. So if there is going to be an end to the fighting, I fear it is because of Ukrainian capitulation, not because the Russians are coming to the table and they're accepting European, American, Ukrainian terms.
If you're China today, what do you think Xi Jinping is thinking at this point in time?
Well, he just had a day with Mark Carney, the Canadian Prime Minister. That was a relationship that was considerably worse a year ago than it is today. Most of the reason for that is because of the breakdown in the U.S.-Canada relationship. We are seeing India, Modi has stabilized his relationship with China to a significant degree. I think he would have done that anyway, but certainly the fact that the U.S.-India trade relationship still is not done, the Indians are feeling that the Americans are less reliable, is a motivating factor to stabilize the relationship with China. Long-term, America's tactical unilateralism is a benefit to the Chinese. America is the most powerful country in the world. It's true. But a return to the law of the jungle does not work for America because Trump is not the most powerful leader. Xi Jinping is. Xi Jinping does not have midterm elections in November. He doesn't have to worry about term limits. He doesn't have an independent judiciary. He has a communist party that he has a monopoly of control over. Trump has none of those things. So long term, the ability of China to articulate a strategy and follow through on it and be reliable for other countries around the world is significantly greater than that of Trump's United States. And of course, that is something the Chinese intend to profit from.
So do you see a big reset even between Europe and China?
Not yet. But I think that if the Greenland crisis explodes and undermines the transatlantic relationship to the point that it breaks, I think China will be a beneficiary in Europe as well.
So, you know, the odds of that happening, how high are they today, as of today?
I think the odds of that happening today are maybe 1 in 3. I think 2 weeks ago they were maybe 1 in 10. But I think your level of confidence in those odds, very low. And they're low because Trump has the ability to change his mind tomorrow. There was a period of time when Trump was talking about making Canada the 51st state. I never thought that was credible. He never had a military option on the table, but he stopped talking about it. You know, Trudeau was gone, Mark Carney came in, Trump said it a couple times, then Carney came back and he said, we will not accept this, and we don't care what the costs are. Trump backed off. But the point is that the Europeans need to stand up to Trump on this issue. It's easier for them to do because it's not popular in the United States. It's a vote loser, right? Red land and blue land, a lot more popular in the U.S. than Greenland is, right? So they need to back off. But they only back off if the Europeans are seen as strong by the Americans, right? I mean, Trump has 2 different modes of foreign policy. He's got the FAFO mode, fool around and find out, which you get if you're Venezuela and Ukraine. He's got the taco mode, Trump always chickens out, which you get if you're Russia or you're China. Right now, Trump believes that the Europeans are FAFO. And the Europeans need to convince Trump that they are actually taco. And that is going to require both military response and economic response that is strong, unified, and credible. We will see this week what we get.
Retaliatory tariffs?
Certainly that should be a component of that if the Europeans want to be treated credibly by the United States.
So let me end by asking you, Ian, as you know, we deal with the geo-fragmentation, the geo-economic confrontation, the spirit of dialogue clearly, as the World Economic Forum would like us to believe, you know, that's not evident. Do you see space for any kind of discussion or dialogue?
Well, you've been talking to me about the geopolitics, and the geopolitics are in recession. It's a G0 world. It's not a G7. It's not a G20. It's not a G2, as Trump said after meeting with Xi Jinping. Not at all. But of course, the multinational corporations here, the big banks, the crypto companies, the AI companies, they're having a completely different Davos. And for there, the spirit of dialogue and investment and raising capital has never been stronger. So let's not forget that there's a completely second Davos going on that has virtually nothing to do with all of these concerns that you're raising.
Well, that is correct. Yeah. And that Davos is, as you point out, in a super cycle of its own. But yes. Ian, always a pleasure. Thanks so much for joining us. And we look forward to seeing more of you. And hopefully, if there is, in fact, a breakthrough here in Davos, look forward to having you back with us on CNBC-TV18. Thanks very much for your time. We are going to take a break here, but the conversations will continue. We're going to be back after this short break. Don't go anywhere. Stay tuned. Our coverage here in Davos from the World Economic Forum's annual meeting continues. As I've been pointing out, this is unequivocally a Trump Davos. President Trump returns to the World Economic Forum's annual summit for the third time, and this time he's coming with perhaps the largest ever U.S. delegation of government officials. Joining us now to talk about Davos and all things World Economic Forum is the man in charge of it, Borge Brende. Always a pleasure. Many thanks for joining us here on CNBC-TV18. It's great to have you. President Trump making an appearance the third time in the World Economic Forum. Was it a hard sell to get him back to Davos?
I think already last year he was virtually with us because it was 2 days after the inauguration. And I did say to him then, we wish you back in Davos in 2026 physically. And then we started the dialogue just after Davos. And I think he was keen to come. And what he's saying to us is that he likes it because he also meets a lot of business people here. There's like 850 of the leading CEOs of the world here. And he does like to make deals and speak to business.
And he's coming with the largest ever delegation of U.S. government officials.
That's true. He's coming with 5 secretaries, Secretary of State Rubio, also Treasury Secretary Bessent. But, you know, it's true that the U.S. delegation is large, but we also have overall historic numbers. We have probably 6 out of 7 G7 leaders here. So on Monday and Tuesday, especially, we will start off with Ursula von der Leyen. We'll also have the Chinese Vice Premier. We have President Macron, and also then Prime Minister Mark from Carney from Canada, just coming back from a visit with Xi Jinping in China.
Well, you know, President Trump has lit a match, quite literally, ahead of his Davos appearance by imposing or threatening to impose 10% tariffs on Denmark and 7 other European nations, NATO allies, because he wants Greenland. Now, you know, the theme for Davos is dialogue, the spirit of dialogue. You've talked about the fact that you believe dialogue is not a luxury, it's essential in times of uncertainty. We're talking about unilateral action being taken. Where do you believe there's space or room for any kind of dialogue in an atmosphere like this?
I think the importance of dialogue is even more there. The only way to deal with Ukraine, with Gaza, and the terrorist situation is that people get together, discuss their differences, and move the world forward. I think there will be quite tough dialogues here, and frank dialogues, as they say in diplomacy, around those topics, including tariffs. And tariffs has been, of course, there for almost a year now with the U.S. and different players. We also know there's still ongoing dialogue between India and the U.S. On the tariff situation. So there.
But this is different. This is saying that my ambition is to take Greenland, and I'm going to impose penal consequences on those who don't support that idea. We've just got, in fact, a statement coming in, and I'm reading to you live, a joint statement by Denmark, Finland, France, Germany, Netherlands, Norway, Sweden, and Britain, saying that they stand in full solidarity with the Kingdom of Denmark and the people of Greenland. Tariff threats undermine transatlantic relations and risk a dangerous downward spiral. So how do you now see this reshaping and redrawing fault lines in 2026?
I think